Russia. There have been meetings taking place in recent days over in Geneva, some in the Middle East as well. I have yet to see any progress, but it does seem as if the many conditions attached to some kind of ceasefire maybe aims to reduce them, at least from the European side, Guy.
Okay, here we go. Let's find out what actually the market is going to do this morning. We think it's going to be a fairly flat open, but the sector story, the single stock story, is going to be interesting. So I'm not expecting fireworks. Fireworks came yesterday. Today we're kind of just waiting for the next catalyst, I suspect. Where does it come from? Is it the UK budget? Is it more Fed speak? Remember, the Fed goes into a blackout period Friday. Anyway, I'm talking because actually there's not much happening on the screen right now. Stock 600 is up by 0.1%. The FTSE 100 is flat. We are waiting a CAC that may be a little bit more positive, but not by much. Elsewhere in Europe, maybe we get some of the defence names moving on the back of some of the news that Anna's just been bringing us, but we'll watch that one. Tech maybe continuing a little bit of upside. Is that why the AEX is having a better day? But you also got the ABN AMRO story to fold into that as well. They've got an investor day today, and it looks like big job cuts are coming. What does that do to the cost picture? So that's where we are. IBEX is absolutely flat. We're waiting for the DAX. What are we seeing in terms of the sector and the single stock story? Critty.
Well, it's a fascinating one. When you look at this market, it is kind of split half and half. I'm pulling Guy Johnson here, 265 versus 214. And you can see it red and green on your screen across the board. Telecom, chemicals are your laggers this morning. But when you look at the outperformers, I'm some sort of narrative here. I'm not seeing a ton of it. It just feels like yesterday's underperformers, the energy sector that had taken a hit, some of the banks that were taking a hit yesterday, the underperformers are your outperformers this morning. Tech still very much on the forefront. ASML, your biggest index contributor.
I wonder if the Fed narrative is sort of sidestepping into the European markets. I saw earlier on someone attributing the higher copper price to Fed rate cuts, and I now see that basic resource stocks are higher by 1%. Copper was higher in the Asia session. Iron ore was a little bit higher in the Asia session, but not by a huge amount. But basic resources, the best performing sector, up by 1% in this morning's session.
So what I find surprising is biggest points gainer, ASML.
I know, I was just saying, it's a tale of two tech, isn't it?
SAP is the biggest loser. So even tech is split this morning and doesn't have a sort of convincing narrative running it through. Maybe the chip story is more positive. Novo's up, Barclays up, Novartis is up, Lloyds is up. Lloyds and Barclays both, I think, probably representing that story that we talked about earlier. It looks like we are going to see additional levies being applied to UK banks by the Chancellor in the budget. The cost of that may be that you've got to talk up the budget. Maybe if you're a UK bank, I don't know, much being made of that this morning. So the UK banking story is positive. Shell's up, NatWest is up. So there's some UK stocks in there. In fact, the UK story is and the budget, kind of the preamble to the budget, is definitely represented in the market this morning, which I think is interesting.
It is. It's fascinating. And I think sticking with kind of the fiscal story, we're talking, of course, about the countdown to the UK budget. The conversation's happening in France as well right now. This isn't a massive move that we're necessarily seeing, but I think it's worth noting that just from an index perspective, the CAC 40 is the outperformer, higher by 0.3%. So again, not a massive move. But we should point out there were some headlines crossing earlier from the Socialist Party talking about French radio. Our colleague Caroline Conan, who of course is our French correspondent, saying that they have really been the linchpin in some of these budget negotiations. If they're saying that a budget is actually possible, that could be a game changer. I think the market may be still casting a little bit of a skeptical eye on that this morning. But
or already thought that.
Yeah, but still, France is the outperformer.
What I think is it's the French industrials that are up this morning. So you've got Airbus, Safran, Schneider. These are the kind of companies that are doing well. The banks are doing all right as well. Some of the luxury names less so. So LVMH under a little bit of pressure, Hermes under a little bit of pressure. So that's where you've got a kind of reasonably balanced market in terms of the French story. But there are definitely more up and down, like 30 up and 10 down.
Yeah, we don't see that. We don't see that very often in the French market. Do we? Let's get a little bit more analysis this morning if we can. Hugh Gimber, global market strategist Strategist at JP Morgan Asset Management, joins us around the table. Hugh, pleasure to have you. We have a lot of, let's put the U.S. to the side for a moment. There's a lot of questions around the fiscal conversation here in Europe. We've got the U.K. tomorrow. We were just talking about France as well. There's also that tech theme in the U.S. What is the driver for European markets? The local issues or what's going on across the pond?
Good morning. The driver for me is fiscal policy. This all comes down to government's willingness to spend through 2026, in some ways independently of what the data is suggesting they should be doing. You look at the European growth backdrop, you look at the labour market, you look at inflation, there's really no strong need here for booming fiscal stimulus in 2026. But when you throw Germany into the picture, that's what we think we're getting. These are governments who have decided across the board, UK, France being two good examples, that cutting back on spending is politically unfeasible, and therefore the narrative for next year is about further spending. We can argue whether the deficits are too large. I mean, when we look at the numbers, we think really you have government spending at levels that imply we're already in recession, or perhaps we're already in kind of war phase. Obviously, that's not where the global economy is today, but with spend, the way we're framing this in our outlook for next year is about fueling the engine. Governments that are continuing to power ahead with fiscal stimulus, and so we're focusing in European markets on the potential beneficiaries of that, whether that's the industrial story or potentially further upside for the defence names as well.
At the end of the day, though, they are still promises. They haven't actually hit the market just yet. So I am curious, to what extent is the under-delivering of that priced in?
So this is all about timing, and I think you hit on a really key point, which is that broadly, the consensus narrative for Europe next year is still very pessimistic. We're getting a lot of pushback on our positivity around the fiscal pivot, and that comes not just around question marks about Germany's ability to deliver, but also whether French or UK politics might derail the story. Ultimately, France, I think, are engaged in one big can-kicking exercise where all of the tough decisions are being pushed out to 2027. And in the case of the German story, we had the announcement back in February and March, and enthusiasm around that fizzled out quite quickly. But this is just an issue of waiting for that spending to start hitting the economy, which we think should be first showing up in the Q4 GDP data. So this story remains on track, despite lots of the excitement that has faded quickly over the course of the summer.
Hugh, will we continue to enjoy tech concentration in 2026, or will we try to protect ourselves against it? What's the strategy?
I'm not sure we have enjoyed tech concentration in 2025. I wouldn't say it has been. It's been so difficult for managers this year to position in what feels like a broadly diversified and broadly prudent way, and to keep up with benchmarks that are still being driven by a small number of names. So if anything, I think we could enjoy next year hopefully a bit less tech concentration and some broadening out of earnings across a wider range of sectors. But critically, given how important US tech spend has become for economic growth, that broadening out is not about tech pulling back and others starting to take on that mantle. Rather, it's about a continuation of the tech capex story and others being able to benefit. So it's a broadening of AI, which then starts to drift into other sectors. I think the common narrative that many had at the start of 2025 about a tech pullback that would see others step forward is just very, very difficult to envisage here when tech has become such a critical driver, not just of the market, but the US economy overall.
And will competition start to be part of the narrative? Tech competition, competition amongst tech giants, will that start to be part of the conversation? Because it seems as if everybody's just gained, not everybody, but there's been a lot for everybody in 2025. Will that continue to be the case?
Absolutely, but I think there are three specific areas we're expecting to see that competition. So one is within the different buckets of the tech ecosystem. So look at the chip makers as one example. We're still not clear, I don't think the market is clear, as to whether or not in 5 years' time there's going to be room for many chip makers, or whether this is really a winner-takes-all type scenario. Same is true with the LLM providers. Are we going to need multiple different models, or is it actually going to be that one of Google or OpenAI or Anthropic turn out to be the ultimate winner? So that's, I think, competition area number one. Two is regionally. We've seen developments overnight with the US and China. I think really all that tells you is about China's key role in critical minerals that are so essential to tech production, and therefore the US being forced to make more concessions. And then the third is that balance between public and private markets. where we think the change in the structure of capital markets today that's allowing companies to stay private for much, much longer means that the balance of power within this AI story could be more tilted towards the private markets because companies have just fundamentally changed their route to large cap. It no longer needs to go through small and mid cap. You can go private, 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 and then bang, a large cap IPO.
Hugh doesn't sound like he's worried about cockroaches, Guy.
I know somebody who is. I've just been speaking. I've just been kind of writing a few notes down. Governments are going to continue to spend. Central banks are going to cut rates. Fed's going to cut rates. Tech keeps spending. Inflation?
So this
is that the biggest risk for next year?
This is one of the two biggest risks that we're flagging. We have a chart in the Outlook, probably my favourite, looking at consensus forecasts for inflation next year, which are broadly flat in the US, hovering around 3%. And we've overlaid that against all of the consensus forecasts through 21 and 22 that told you every time inflation rose, don't worry, this is the peak. Oh no, don't worry, this is the peak, this is the peak. And history tells us when you have excess stimulus in an economy, it typically shows up in one of two ways. In the 20s and the 90s, it was about asset price inflation. In the 70s and the early 2020s, it was about consumer price inflation. And so this is where I still think...
both at the moment.
Well, we have to a degree, but we have enough confidence in the labour market slowdown that we're not derailing.
Okay, so this is the 1920s.
So, well, I think there are definite echoes of the 1920s to today. For me, wage growth is key. Because if wage growth remains under control, if you continue to see that labour market slow down, the Fed can dismiss the pickup in US inflation that we do see ahead by saying we're more focused on our labour market mandate. If we're here in 6 months' time, inflation has picked up and the labour market is not only stabilising but wages are starting to accelerate, there you have a true test of Fed independence and you have the market getting a lot less comfortable about the inflation narrative. So diversifying against that pickup in inflation, I think, is absolutely essential, even though it's not our core scenario.
My kind of... If we go back to the 1920s, the Fed was a big part at the end of it in terms of what happened next. If the inflation is not coming down, is the Fed going to have to hike rates at some point? And if so, when could that come?
So in the interim, I think the Fed goes lower. Let's be clear. We should separate out...
So inflation's still sticky, but the Fed's going lower?
Yes. That is our core scenario for the first half of next year. You have an inflation pickup, but one which is contrasting with a labour market slowdown, and therefore this is still a Fed in cutting mode. It's where the labour market starts to turn that Fed narrative becomes far more difficult. Because look how they've justified
That's a 2026 story.
This is a 2026 story, potentially. Now, I think, again, you take into account Powell leaving in May. You take into account some softness in broader parts of the economy. This is not a red-hot US economy today. There's enough here for the market to look at the Fed cutting and say, this comes with risks, but we can understand why they're taking this position. If the wage story starts to change, that market narrative becomes more difficult. And so this is where alternative assets, your inflation diversifiers, are a critical part of a well-balanced portfolio, because it's not just your typical, are we going to be fine or are we facing recession story? It's the inflation risk that I think is actually greater than the growth risk.
Hugh, nice to see you. Interesting charts. Worth a read. Hugh Gimber, Global Market Strategy at JP Morgan Asset Management. Thank you very much indeed. Okay, let's take a quick look at the Core 6 this morning. Interesting market. Yesterday was the big day, but today, actually, there's some interesting gains still coming through. Defence stocks are up after getting hit hard yesterday. At this time, ASML is up, which is interesting. SAP's having a tougher time. Let's deal with the details of what is going on. Chloe Melly joins us now with a look at what's happening in banking.
Good morning, guys. So ABN AMRO is up quite strongly this morning after announcing plans to cut more than 5,000 jobs over the next few years to boost profitability. This is part of a broader revamp plan for the bank, which also includes ambitions to become a top 5 private bank in Europe, as well as strengthen its position in Dutch retail banking. And this is a plan that is being welcomed very warmly by the market, and we are up 3.5% for ABN AMRO this morning. Moving on to defense, and we have also got a wall of green across the screen for defense after falling yesterday, and that is because the prospect of peace between Ukraine and Russia looks increasingly fragile. The two have exchanged heavy fire, and that is putting in question Trump's efforts to strike that peace deal between the two. And we have got that reflected across that defense industry this morning, with Rheinmetall and Hensoldt in particular up more than 2% this morning. Moving on to Continental, which is also up. The tire maker is up because the European car sales have risen optimism for the fourth month in a row, and that is because more affordable electric vehicles are being pushed onto the market, and so it is really boosting optimism for that car sector that has seen quite a lot of weakness. But we are up this morning 1.3% for Continental. And finally, Kingfisher, the owner of B&Q and Screwfix in the UK, boosted its profit guidance this morning, and we are up almost 6% this morning for Kingfisher on the back of that profit upgrade.
Chloe, thank you. Chloe Melly from our equities team. Coming up, we'll continue to focus on one of the stocks that is on the move this morning, EasyJet, down by just 0.8%, underperforming the broader market just a touch on the back of their numbers. Highlights from our conversation with the CEO next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Morning, welcome back. 20 minutes into a session that in some ways is going nowhere in a hurry after a massive day yesterday, though. I think we're just pausing for breath and reassessing the situation. Let's talk a little bit about some of the single stocks that we are watching this morning. EasyJet shares have had a really choppy ride this year. Part of that's been driven by kind of what is happening at the operational level. Part of it's been happening as a result of what's been happening on the M&A front. This morning, the stock is a little off after rising into the numbers that they've delivered this morning. Headline profit pre-tax for the full year beat the average estimates. Some of the other metrics were a little softer. We spoke to CEO Kenton Jarvis about the investment areas that he is focusing on for this business.
Because of the resilience measures we have put in, we actually saw an improvement in our punctuality, and we also saw, really pleasingly, that customer satisfaction increased by 4% up to 80%, which is the highest level we've had in over a decade. And as a consequence, our our kind of disruption costs came down almost 50 million on an underlying basis. So the investments were made mainly in the second quarter to set up for the summer, and they really came through.
Kenton Jarvis, the CEO of EasyJet. Kate Duffy joins us around the table, Bloomberg's aerospace reporter, covering EasyJet for us. Good morning.
Morning.
What's the takeaway? What is the kind of read on EasyJet right now? Where should I be focusing on it? Is it the fact that the holiday business is doing well? Is it the fact that they're trying to get costs under control? Is it the fact that we're going to see more capacity next year? Where am I looking?
It's a bit of a mixed bag this morning. So as we've seen, the holidays business is doing really well. They've met their medium-term targets early, and that means that they've upgraded their target for about fiscal 2030. Their profit is good, it's looking up, but as you say, they've really struggled with their costs over this year, whether it be from the air traffic control disruption, that's caused planes and crews to be out of position, passengers to want refunds and compensation, so that's added costs. Also their Airbus deliveries as well, these were slightly slow, but what we're saying this morning is this growing confidence that actually they're stabilising. So they got the expected 9 aircraft this year, they're getting 17 next year. That's all in line with expectations, and that means that they can grow their capacity into next year by about 7%.
Kate, I've lost track of the number of times we've had stories, reports about people possibly interested in buying EasyJet. And when asking Kenton about it this morning, I thought I was going to get a really short response. I mean, I did in the sense that he says there's nothing to see here. But he went into a lot of detail about how all the flag carriers keep combining with each other. Seems not very interested in talking about where the low-cost airlines do. But we know that others in the sector have thought that it's a good idea. Michael O'Leary, for example.
Yeah, exactly. Michael is very outspoken about the fact that
the others should consolidate.
The others should consolidate, yes. That EasyJet is this prime target for that. Also Wizz Air as well. I mean, there's lots of chatter in the sector, and as Kenton was saying, there's interest in the moment at TAP, the Portuguese airline. That's something that IAG, Lufthansa, Air France are all vying for. So it's a really sort of meaty airline consolidation environment at the moment. But Kenton said there's no plans for him at this present moment to be involved in that environment.
So what happens next? What do we think the winter demand picture is going to look like? What are we looking at in terms of the demand picture next year? We've got a budget coming up very soon. They obviously have significant exposure to the UK consumer. What is the message they are delivering in terms of what demand is going to look like and the health of the consumer?
Well, winter's always a really tricky time for airlines. Obviously, summer is when they make their most money. People are going on holiday. Winter's a little bit more subdued.
But that's changing a little bit, though, isn't it?
Yeah. He did say that fares are sort of flat year on year, but then going into Q2, which starts in March, they're slightly up a little bit. That's something that we probably do expect. But then next year, as I said, more aircraft's coming through, capacity is looking up. So it's...
So does more capacity equal steady fares, but more volume?
Yeah.
Well, presumably that must be the argument here.
Yeah. Yeah.
Okay. We'll watch that one with interest. Kate, thank you very much indeed. Kate Duffy.
All right, our Bloomberg aerospace reporter, Kate Duffy, thank you so much. Let's talk about another topic we are, of course, monitoring this time out of Brussels. The EU's antitrust chief has ruled out easing the bloc's tech rulebook. This comes after U.S. Commerce Secretary Howard Lutnick said Brussels needed to change its digital regulations in order to get a deal to lower steel and aluminum tariffs.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
Howard Lutnick there, the U.S. Commerce Secretary. Let's get a little bit more analysis from our Brussels Bureau Chief, Suzanne Lynch, joins the program this morning. Suzanne, we've heard this narrative before. Europe has too much tech regulation. Did Lutnick move the dial at all?
Well, I think it's clear that under this administration, there has been a renewed push for Brussels to roll back some of that regulation that affects US big tech. And Howard Lutnick made it very clear here in Brussels yesterday that he was linking these issues, that he was linking the call for laxer EU regulation on tech with a deal and further concessions on trade tariffs, particularly steel and aluminum, something that the Europeans want. So this is a real dilemma for the EU. I mean, the EU has always had huge power when it comes to regulating tech, both through its digital regulations and through its antitrust laws that are very, very powerful here in Brussels. But at the same time, it is said that is not negotiable. We heard from the EU Commission Vice President Teresa Ribera last night that the EU digital regulation is not for negotiation. European consumers would be protected. So the question is now how far the EU would go to roll back on these regulations, but the message seems to be from Brussels, not very far.
Right, yeah, Suzanne, it's interesting, isn't it, that the Europeans keep trying to say that these are not linked, that tech regulation and tariffs around metals and steel, you know, there's no link between them. But do you get the impression that the US decides what's linked when it comes to trade policy?
Look, the reality is that the Trump administration does link issues. These technical trade talks are connected to them with the broader relationship between the United States and the European Union. Now, I mean, the European Union would say that it is already moving to pull back on some of its more stringent regulations. So, for example, last week it announced a digital omnibus package, it was called, which did decrease some of the reporting, some of the red tape around digital regulation. So the EU are trying to say, look, we're doing this anyway, we're pulling back on digital regulation. It doesn't just affect US companies, also our own companies in Europe have been complaining, and we're listening to them. So whether that will be enough to convince the Americans that the EU is changing its tune when it comes to digital regulation remains to be seen. Because at the end of the day, these fines that the EU have levied against US tech companies have been enormous, particularly on Google.
Suzanne, do you think there's a connection between what is happening on trade and what's happening on Ukraine? Is that going to influence the overall relationship between Europe and the United States and vice versa?
Yeah, in one way, the timing of this meeting in Brussels this week, I mean, it was a big deal having the US Commerce Secretary and the US Trade Representative attending the EU Trade Ministers meeting. That doesn't happen that often. And yet that coincided with a real crisis in the Ukraine talks, where their colleagues were scrambling to try and get in front of the Ukraine story, to get the ear of Donald Trump and try and influence this 28-point peace plan that had been circulating. So yes, the two issues are connected ultimately. That's politics. The EU is trying to keep the US on board on Ukraine, so it's trying to keep that relationship strong. Now, the Europeans also say it's got leverage. We heard Secretary Lutnick say in the clip there himself, it's a huge market of 450 million people. The US knows this. US tech companies know this. They know that they want to operate in these markets, and the EU say they have to play by their rules. So it's not that the EU has no power in this, but yes, I think the two issues are linked.
Suzanne, thank you very much. Suzanne Lynch, Bloomberg's Brussels Bureau Chief. Thank you very much for joining us. Coming up on the programme, we'll stick with the tech theme, in fact. We're going to be speaking to Data IQ's CEO about the artificial intelligence platform company that he leads, the role it plays in agentic AI in business, and the rate at which businesses are adopting AI. He is at the Adopt AI Summit that's currently underway in Paris. We'll check in on the AI theme next. This is Bloomberg.
Do you think the dollar will remain the only reserve currency in the world, and are you as comfortable with the dollar as it used to be?
The dollar has been, as you say, a reserve currency for about 80 years. Actually, if you wanted to go further back, you could say it's almost after World War I, when the US had lent money to Europe and the UK for ammunition and so on, and then they had to get paid back in dollars. And that's when the strength of the dollar really began. So it's 100 years, 80 years, 100 years of dollar strength. So much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
Okay, so you think the dollar will stay as the reserve currency of the
Absolutely.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to the opening trade. 30 minutes into today's session, green on the screen across the board. The outperformer, I think this is interesting, is actually coming here in France. CAC 40 higher by 0.3%. We don't say that very often. There's a political overhang over all of it, but it looks like some commentary potentially coming out of the Socialist Party there. Maybe, just maybe, removing some of that political hang in today's session. They're saying that a budget is possible. They were the linchpin. We'll see if it really moves the dial, but this morning, the French index is your outperformer. But green on the screen across the board. Futures were showing a negative open, Guy. We've come back from that.
Yesterday was a party. Today's definitely kind of meh. That's what we're seeing in terms of the internals right now. Look at this. 312 up, 270 down. Nothing to see here. Volume is light. We're down. This is on a 20-day average as well. Is down by a quarter. More than a quarter. So this is a very unconvincing session in terms of what you're seeing in terms of the internals. But I guess you've got to see it in the context of yesterday. Let's talk about some of the leaders and laggards. Let's talk about the leaders first. Chips are up. SAP's down. We'll show you that on the next board, but chips are up. Barclays is up. UK banks look like they may get a reprieve when it comes to the budget. Shell is up as well, which is interesting. A little bit of volatility in the oil space recently. How low do we go there? There were some interesting notes floating around on that story yesterday. Let's follow this up with the laggards because they are equally balanced this morning. SAP is down by 0.8%. Roche is down by 0.7%. 3i. Is that a UK story? I don't know, but it's down by 1.9% this morning. But it's a really balanced market. There's nothing really kind of obvious that gives us a clear vector, a clear sort of sense of direction this morning as to where we're going. Anna, what you got?
Yeah, in the meantime, let's get an update on some of the geopolitical news flow that we need to keep across, Guy. Bloomberg has learned that the Chinese government has instructed the country's airlines to reduce the number of flights to Japan through to March. The move signalling that Beijing is braced for a protracted spat between the two nations after the Japanese Prime Minister's comments on Taiwan caused disquiet in Beijing. Russia and Ukraine have exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Russia launched a wave of heavy air raids on Ukraine's capital, Kyiv, while the Russian Black Sea coast region suffered sustained suspected drone attacks. And Nvidia shares fell on a report that Meta is in talks to spend billions on Google's AI chips, suggesting the internet search leader is making headway in efforts to rival the industry's best-selling AI accelerator. According to reporting from The Information, Meta is in discussions to use the chips from Alphabet, known as Tensor Processing Units, or TPUs, in data centers from 2027. Meta may also rent chips from Alphabet's cloud division starting next year. Pretty?
Lots of big moves in the tech space. Of course, it comes amid this backdrop of this rally that we've seen, some of the corrections that we've seen, driven both to the upside and the downside by the tech names on both sides of the Atlantic. Let's bring that to a little bit local in terms of that tech conversation. Europe's biggest corporates are revealing their tech spending plans at the Adopt AI Summit in Paris today. Dataiku is one company hoping to lead the race. Its aim, of course, to build the integration of AI into everyday business operations. Dataiku CEO and co-founder Florian Duetto joins us now from Paris. Florian, a pleasure to have you on the program. Thank you so much for joining us this morning. As we've been talking about on the show today, but also for, I want to say, months and years, there's a lot of optimism around AI, a lot of investment in AI. Do you feel like the community and outside investors who are learning about this are maybe getting too excited about the prospect of adoption of AI into our everyday lives?
I think the AI market is incredibly early. I think if we are to compare to anything, building AI, building agents in 2025 is like building websites in 95. You're very excited, you're building lots of things that will have lots of value, but in the context of things, you're building websites without having invented yet the concept of blog post or the concept of e-commerce. So that's where we are in the market. That's why everyone is excited. Lots of investments are happening and lots of adoption is going on, but it's also a very early market.
Well, Florian, to your point, I love that you talked about 1995. It's certainly a parallel a lot of people are making. But to your point, there are a lot of websites that failed, a lot of domains that failed, a lot of technology associated with the internet that failed before they took off. What is the equivalent timescale here? It feels like a blog post we talk about all the time, but that's 25 years after the dot-com bubble. Do we have to wait 25 years for this AI bubble to manifest in real life?
I think the concept of AI bubble is related to investment in infrastructure, which is potentially unrelated to the fact that in the grand scheme of things, enterprises are already finding value with AI. We have customers all around the globe, some of the largest companies on the planet, and they've been investing in AI, not just in terms of data centers or GPU or whatever else, but in terms of building application with AI, automating the way they manage their customers, finding efficiencies in terms of internal processes all around, finding 1, 2, 3, 5, 10% here and there. And I think that those efficiencies will compound over time, creating for companies the ability to actually find this value of AI that everyone is after. But indeed, it requires ambition. It requires to actually invest, not just in infrastructure, but it also in the transformation of the business.
Florian, good morning, it's Guy. You spend a lot of time in the States, you spend a lot of time in Europe. How is the perception of AI different on either side of the Atlantic?
I think that there is a difference in terms of timescale, in terms of speed of investment, where investment in the US is probably in advance in terms of how corporates are actually investing and adopting AI more rapidly. But I think what's common is that there is this problem of trust related to AI, meaning trust at every scale. Individuals are not sure whether AI is good for their job. Corporates are not sure whether AI will work, whether these agents will actually prove to be working versus not. And there is also a trust in terms of infrastructure, vendors lock-in, potentially technology that could be locked over time, creating for companies kind of like the trap associated to AI if they are not actually free to use any type of AI technology in the future. So you've got like trust issues at every level throughout the planet, even if speed of adoption is potentially ahead in certain countries, notably in the US.
Okay. Let's just kind of segment that a little bit. The labour market is clearly one area that everybody's watching for very carefully. Agentic AI and its impact on the labour market, what do you think it's going to be? People are worried about mass job losses. People are worried about a significant shift in the labour market. You're at the cutting edge of this. What do you see?
I think we are, again, too early in this market to make a call from a macro standpoint. But indeed, there is the potential of a significant augmentation of jobs. What I want to believe in, what I hope for, is that AI will be a way to actually spend less time over our keyboards and more time, well, human-facing. In the last 20 years, meaning our jobs have changed. Our jobs have changed from being like human-facing a lot to being screen-facing a lot. People spend time filling up forms with their fingers on their keyboards. Potentially with AI and agentic, you will find back augmented jobs where you find back this ability to talk to your customer directly, to favor human time. And I think it will be a profound change of the workforce, of course. This will be radical, this will be tough, but indeed, this is something that I think will be for the better in the long run.
Florian, so with that, I mean, would you expect to see, I mean, maybe I should ask a labour market economist, but would you expect to see job cuts in the short term, but maybe not in the longer term? Is that one way of thinking about this? I've seen that applied to other technological innovations over time.
I think there will be efficiencies in businesses. There will be a way to actually augment jobs to find efficiencies, and there will be new jobs being created with AI, new opportunities for revenue. We see some of our customers focus quite a bit on immediate efficiency, but others also looking at AI and AI technology through the prism of innovation. How can I actually put drugs faster on the market? How can I actually design an aircraft engine faster? Meaning this type of capabilities will actually lead AI to actually, well, faster economic growth, not just job cuts.
Florian, I want to ask you about the subject of tech sovereignty. And as a Franco-American business, I've seen your business described in such terms. Perhaps you have something to add on this subject. I mean, Europe worries quite a lot about the extent to which Europe relies on big tech names in the States, and maybe something about the politics of late makes that feel like a vulnerability. Do you get asked that by clients? Is this part of the conversation at all?
Yeah, it is. It is top of mind for every corporate on planet Earth, even some in the US, meaning they actually don't want to be locked with AI, to be locked to certain providers. And it's a matter of sovereignty. It's also a matter of controlling their costs in the long run. So they want to keep optionalities in terms of AI. It's about where the data is, about where my compute is. And most of our customers end up having a hybrid approach, where they mitigate the risk by having a multiplicity of vendors, American cloud vendors, on-prem, meaning GPUs they own and they can control fully, as well as data. And I think that those robust strategies, meaning are not obvious. It's not about like picking one vendor and making things easy, but it's necessary for large enterprise in order to mitigate the risks. And it's, I think, something and an opportunity for building cloud capacity all over the planet with a multiplicity of vendors providing it.
Florian, we're getting close to Christmas. My tree's already up. I'm very much in the Christmas spirit. What is on your Christmas wish list in terms of making your company and the AI ecosystem in Europe a success? Are we talking about labor? Are we talking about energy, credit financing, cutting the red tape? What's on your Christmas wish list?
Oh, none of that. It's ambition. I think that in order to find the value of AI, and ambition is actually to some extent easier to get. Maybe you can't get it from Santa Claus, but you can get it from your art. So it's actually closer. I think that European businesses need the level of ambition matching American businesses. And in particular, in order to find the value of AI, you need to look at your most mission-critical processes, the big, heavy mammoth that you've got in your business, or you onboard customers as a bank, or you manage clinical trials as a pharma, or you manage all of your supply as a manufacturer. Those things cost hundreds of millions for most companies. They are like heavy information-driven processes. There is no way those processes are the same in 5 years for the leading companies on planet Earth. So as a company, if you don't change those processes today, if you don't start now, you will be lagging behind in 5 years. And then, actually, maybe we will find some economic impact of AI in terms of job cuts, but they might not be coming from jobs being cut by companies. It might be coming from companies failing.
Florian, thank you very much. Thanks for joining us. Good to get your perspective. Florian Duetto, the CEO of DATIQ. Thank you for your perspective. Let us tell you what is coming up on the programme then. We continue to focus on the UK budget, of course, ahead of tomorrow's budget. We speak to Rupert Harrison, Senior Advisor for the UK. Well, he used to be a senior, he's a Senior Advisor for the UK at PIMCO, I should say. Previously has advised the UK Conservative government, of course. And we will get to a conversation with him shortly. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Welcome back. This is the opening trade, 45 minutes into today's session, Tuesday, 25th of November, and European equity markets not really going anywhere in a hurry. US futures pointing just a touch lower. Are we off earlier lows, though? I mean, yesterday was a stellar day, up by more than 1.5% in S&P stocks, up by more than 2% on the NASDAQ, but that was yesterday. Today is today. Let us move on to tomorrow. Investors will be keeping a close eye on UK markets tomorrow as Rachel Reeves makes her much-awaited UK budget statements. Joining us now, Rupert Harrison, Senior Advisor for the UK at PIMCO, former Chief Economic Advisor to the UK Conservative Government. Rupert, really nice to have you with us. Thank you so much for joining us. So, I mean, the bond market must be front and centre for everybody's thinking when it comes to the UK budget tomorrow. What does fiscal credibility look like, do you think, when it comes to the budget? What does she need to keep an eye on specifically to keep that bond market movement in check?
Yeah, I mean, I think there's been a bit of a risk premium priced into the bond market and probably the currency over the last few weeks because of all the speculation and particularly the U-turn on income tax. So I don't think she needs to do very much to see some of that sort of come out and a bit of relief in the gilt market. She needs to deliver on the fiscal plan. She needs to show that she has the political ability to raise taxes, maybe a little bit of spending cuts in the mix, but mainly tax rises, that she is going to deliver more headroom. I think the market is expecting a minimum of 15 billion headroom, ideally 20. Even that would be relatively small by historical standards, but it would be an improvement on 10. Yeah. And then I think that the profiling of the consolidation is going to be quite important for credibility. So if it's all backloaded in those last couple of years, I think that might raise a few questions.
Yes, with similar numbers coming to us from the IFS earlier on when we spoke to them. They were talking about the 15, but also suggesting this in terms of the headroom, but also suggesting that this would be low by historical standards. I mean, wouldn't it just be a relief for everybody if it were substantially higher, and then the government wouldn't necessarily have to be whipsawed by daily moves in bond markets?
I mean, completely, but it's a bit like that old adage of, I wouldn't start from here.
Yeah.
So, the best decision would have been in that first budget to do more on tax and spend or whatever, the mix that she'd chosen, and give herself more like 30, maybe even, 30, 35 billion. That would be more comparable with the previous periods after previous changes of government, so after 2010 or the early Gordon Brown era, and gives you much more, leeway against changes in the forecast. The problem when you're starting with minus 10, which is probably where she starts before any measures, is that, every 5 billion is extremely politically painful. That's a lot of tax that you have to raise from a lot of people. And so what we've heard in recent days is that 15 billion I think is the bare minimum, and I think the Treasury would love to get to 20 and to be able to say, well, we've doubled the headroom. I think that has a decent ring to it.
Yeah.
We had a conversation the other day with RBC Blue Bay, and the line there was that the gilt market won't believe anything this government says until it incredibly shows that it can cut as well as raise. That's true.
I'm not sure that's true in the short term, because I think the market has come to terms with the fact that serious spending cuts are really off the table while you have this Labour government, particularly because the Labour backbenchers are so influential given the U-turn we had on welfare. I mean, I think we will see a little bit on spending. We might see a tweak to the spending assumptions at the end of the forecast. That is probably on the less credible side. I think if we get some cuts to budgets over the next couple of years dressed up as if, efficiency savings, that will add to the mix. But I think the market understands there's got to be tax. And I think the test will be, is it tax revenues that the OBR think are stable, predictable, and will these tax rises definitely get through the House of Commons, which I think is much more likely with tax rises through the Labour Party than spending cuts.
Is this going to be growth negative or growth positive?
On balance, clearly tighter fiscal policy is going to be growth negative. I think we will see downgrades to the growth forecast, not least because we know the OBR is going to downgrade its trend growth assumptions. So I think we will see probably almost every year of the forecast lower growth. In a sense, that is good for the gilt market because I think that's going to create more space for the Bank of England to cut rates. And also, I think we are...
Do you think they're going to need to cut rates?
Well, yeah, certainly at PIMCO we think that the market is underestimating the need for rate cuts, particularly because the labour market is weakening and inflation is already coming down. And I think to the extent that we might get a surprise tomorrow in the budget, I think that more action than expected to cut inflation, bring down people's energy bills, fuel duty, I think that might be where the Chancellor would like to pull some sort of mini rabbits out of the hat.
Mini rabbits.
tiny rabbits.
Forgotten the diminutive of a rabbit.
Going back to the growth picture, should growth still be a priority at this moment? You talked about what would be reassuring for the gilt market. Is it just about plugging the gap for now?
Look, growth should, of course, be a priority because when you're thinking about medium-term and longer-term fiscal sustainability and, of course, the growth in living standards that the government was elected to try and deliver, growth is absolutely crucial to both of those. But a prerequisite for growth is stability and predictability in policy. So I think that they have to restore fiscal credibility as kind of step one towards growth. And indeed, it would be, going back to the discussion about headroom, getting out of this 6-monthly cycle of speculation is really important for growth because it's been politically damaging, all this speculation, but it also has very real economic consequences in terms of frozen investment and the hit to consumer and business confidence. So, it's possible that this budget, if it does enough, could be a bit of a clearing moment for that uncertainty and speculation and allow people to focus on a longer-term horizon.
Well, you mentioned the tax rises. Helen Miller over at the IFS earlier in the program had talked about that and called them delightful little treats, as in like a fun little combination of various tax rises. Is it just better to get one giant tax rise? How damaging would that be?
She wasn't a huge fan of the small little treats. We
I know.
But she didn't call
a raised eyebrow, I imagine, when she said that. Look, clearly that would be better. And actually, that's not just the view right now. If you look back in history, in the UK in particular, but also other countries, in the UK, successful tax-raising budgets, so if you think of Geoffrey Howe in the early 80s, Gordon Brown in 2001 when the Blair government raised national insurance, Geoffrey Howe and George Osborne in 2010 both raised value-added tax. Those big levers, first of all, they raise the vast majority of revenues in the tax system, and they're also predictable. They raise revenue without big distortions. No one likes paying more income tax, but a big income tax rise is evenly spread, easy to forecast, and less distortionary and has less growth impact than some of these kind of capital taxes that I think we're going to get tomorrow. So clearly that would have been preferable, but in the end, the politics has come down on the other side of that, and that's why we're going to get this. The word that is being used in the Treasury is this smorgasbord of a list of...
That's where the delightful little treats thing came out.
I know, but buffet,
exactly.
I always struggle with the buffet. Never know, it's always confusing, and I do wonder whether business is going to see it that way, that it's just going to be, it's going to get more complex, not less complex.
I'm taking you to a buffet after the show, so I can teach you how to do it right. Rupert, but isn't the argument you're making on the tax piece, that completely undermines the growth picture, though? You're talking about trying to tackle growth in the medium or long term and incentivize it, while also advocating for the giant tax rate. Aren't those contrarian measures?
Look, I clearly think that the market and most economists would prefer more of the emphasis to be on spending, particularly the less productive parts of spending. So I think that they would like to see serious welfare reform, for example, particularly in areas like health and disability benefits, where you've got a very rapidly rising bill. So even limiting the increase in that, not even reducing the spending, would be a really good start, and that would be good for growth, good for confidence, good for credibility. If the assumption is that's off the table, all we're left with is tax rises, and then it's a question of minimising the damage.
All we've seen so far is fewer Mercs and BMWs, but we'll see whether we get more detail on that. Let me ask you more seriously about AI and whether the UK, we haven't got time to do justice to this subject, but is the UK going to be well positioned to make any productivity gains that are available to it from AI technology, do you think, Rupert? Given, the service nature of the economy, does that make it a good thing or a bad thing?
Well, a very heavily service sector economy has been a real problem for productivity growth for many countries, but particularly the UK, because some of those services have been very stubbornly resistant to process and process changes and innovation. And I think the big hope is that AI can be a real transformational technology in services. I think the UK is relatively well positioned because it also has a good AI sector in terms of, particularly around London, but also some other parts of the country in terms of some of those big firms are located in the UK. There's a big skill base. Yeah. So the UK should be relatively well positioned and also should have a little bit more flexibility. So this could be one area where actually the flexibility of Brexit allows the UK government to set a regulatory framework for AI that is perhaps a little bit more permissive than the rest of Europe. So it should, if done right, be relatively well positioned.
Can I ask you the tricky question around all of this? Is the gilt market going to focus on the the growth aspect, the what happens with the economy when it comes to this budget, or is it going to focus on what it means for Rachel Reeves' political career and whether or not she gets replaced by somebody that is further left than her, whether the government gets changed and there is a further left government? Which way, what's the most important bit here?
So I think that's a really good question, because I think that the most that the budget can do is settle the short-term nerves now. And I think, as I said, I think it can be a short-term clearing moment by getting back on track with the fiscal path. But the reality is, and I think this is what underpins your question, that over the last couple of weeks, the genie is out of the bottle now about Labour leadership. And about the markets are now talking a lot about what is the probability that Keir Starmer and Rachel Reeves won't be here in a couple of years' time, and you'll have a different leadership in the Labour Party. And I think that clearly creates risks. And therefore, you have seen that particularly in the longer end of the gilt curve. I think that premium is going to be much harder to remove. And something that maybe we'll be living with for the foreseeable future. Okay, something to keep in mind then. Rupert, thank you so much. Thanks for joining us. Rupert Harrison, Senior Advisor for the UK at PIMCO and former Chief Economic Advisor, of course, to the UK government. We have a lot of programming on this subject tomorrow. UK Chancellor Rachel Reeves is expected to deliver her budget 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. And it doesn't stop there. The opening trade will break down the numbers with key business and political voices in our budget special. That is Thursday in the cold, just for you, Thursday morning.
With a beautiful view of St. Paul's Cathedral. We're very excited about it. In the meantime, we are seeing these markets kind of mixed. Green on screen in Europe, red in the States. That does it for the opening trade. The pulse is up next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season. Take a look
look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Tech drives gains for global stocks as confidence grows over a potential rate cut by the Fed next month, but the rally fades in Europe. The gold standard under threat, Nvidia shares slip on a report Meta is in talks to spend billions on AI chips from Google. We'll bring you the pre-market moves in just a moment. And tensions over Taiwan. President Trump holds back-to-back calls with the leaders of China and Japan as the diplomatic fallout continues between Beijing and Tokyo. Let's get you up to speed on these markets because we saw a positive end for Wall Street yesterday with both of the majors, S&P and NASDAQ, posting solid gains north of 1.5% for the S&P, 2% for the NASDAQ. Today, the handover from Asia pretty positive as well. The Asia Pacific Index up 0.5%. S&P futures trading sideways, moderately weaker, with the focus on some of the more dovish commentary coming through from Chris Waller, one of those Fed policymakers, putting a December rate cut firmly back on the table again. 10-year yields at 4.04, and then the euro slightly firmer versus the USD, 115.30 is where we are at. A little bit of weakness in the dollar. Keep a close eye on those EU-US trade discussions. As for the European map, it's a mixed picture. All eyes on the UK as we get closer and closer to that budget happening tomorrow. Of course, a bit of green on the FTSE CAC 40 as well. The underperforming indices today seem to be the peripheries, with the FTSE showing a bit of red today. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Joanna Versace in Dubai. Well, the information reporting that Meta is in talks to spend billions of dollars on Google's AI chips. An agreement would help establish Google's chips as a rival to the industry's best-selling AI accelerator made by NVIDIA. So take a look at the respective price action. This is the first glimpse that we're getting of pre-market price action. NVIDIA down 2.5%, Alphabet up almost an equal amount, 2.7% firmer. And what we're seeing is more competition come through, especially with those TPUs, an important AI accelerator component, in addition to, of course, the launch and the success of Gemini, a competitor for OpenAI. So this is one of the big themes that we're watching out in the tech space this morning. One of the other big themes is vis-a-vis growing calls for a rate cut. So let's talk about that. Confidence is growing for a potential Fed rate cut in December. Governor Christopher Waller says he will advocate for an interest rate cut at the next meeting.
My concern is mainly the labor market in terms of our dual mandate, so I'm advocating for a rate cut at the next meeting. We're going to get a flood of data that's released, and if it's kind of consistent with what we've seen, then you could make the case for January. But if it suddenly shows a rebound in inflation or jobs or the economy's taking off, then it might give concern to at least, look and see or be more cautious. So I think just because of that, you may see more of a meeting-by-meeting approach once you get to January.
Well, traders are now pricing in an almost 80% chance of a U.S. rate reduction next month. Let's bring in Bloomberg Markets Live Executive Editor Mark Codmore. Mark, it wasn't that long ago that there were only 6-7 basis points priced into the meeting next month, and now we're looking at 19 basis points. All of that has happened in the last couple of days. What is it about the Fed's messaging? What has prompted the Fed's messaging to change?
I think Williams' speech at the end of last week was absolutely vital here. He's seen as a bit of a spokesperson for Powell, and importantly, he was the person who hadn't said much recently. So his kind of guidance that there would be, there's possibility of a rate cut in December, kind of spoke to the way that Powell is probably leaning. And I think Powell's probably got the votes to deliver that rate cut. We're in a slightly strange dynamic that the Fed blackout period starts this Friday. Normally, we have a decision about 80% priced or higher going into that blackout period. Fed officials make sure that the pricing is right. They don't like surprising the market. And it's very rare that we then change plans. It's obviously completely different this year because we've got so much delayed data coming through from the shutdown that there's a genuine debate out there. But I think that the messaging from Williams last week is very important. I think that the base case now is that we will get a rate cut in December, and it'll require the data between now and then to kind of really surprise, to change that narrative. There is a lot of data to come which has the possibility to do so, but I don't think we're going to get enough of the kind of the headline CPI and jobs data that's going to really change things.
Yeah, and looking ahead today, we have obviously retail sales and PPI on the docket as well, something to watch out for there. But I guess if you look back at that jobs report, the delayed jobs report that came through, maybe the market simply misinterpreted it. The strength in the headline should have been focused more on that uptick in the unemployment rate. Do you think perhaps that is really what the Fed policymakers are focused on here, the weakness in the job market?
I think that's definitely a viable narrative, but you've got to remember that also an outdated jobs report at this stage, and we're going to then missing some jobs data. I think the fact is that because of the administration pressure, because you've got several candidates on the current board who are angling to be a potential to be the next Fed chair, you've got pressure to provide easier policy than orthodox monetary policy, economics would suggest. So in orthodox economics, there's no way we'd have enough data to justify a rate cut just yet in the US. But people can't risk being behind the curve. They want to err on being premature if they make any error, which is not how normal orthodox central banking should work. Normally, it should work that you wait till you're definitely going to a recession and then you cut super aggressively. Premature rate cuts aren't always a good idea, especially when we've had an inflation scare in the last few years. But we are erring towards being a premature rate cut. And I think that because of that, there are enough inconsistencies in the data to say that, hey, maybe the economy is slowing enough to provide what Donald Trump and the administration wants, and that's why we're leaning that way in the pricing.
Yeah, always good to chat to you. Bloomberg's Markets Live Executive Editor Mark Codmore laying it out for us. Well, another day, another debate on private credit, this time with Apollo's Mark Rowan weighing in, saying that people have, quote, lost their minds over private credit fears. If he's right, where should we be looking for credit opportunities across both public and private markets? Joining me now to discuss is Omotunde Lawal, head of EMEA Corporate Credit and EM Corporate Credit at Barings. Good to have you with us. Before we lean into the opportunities, I just want to bring it back to something that our colleague Mark was just talking about, which is what he's referred to as a premature cut. Other people are calling it as an insurance cut. Do you think we're going to get that out of the Fed this December?
Thanks, Jemana. Yes, certainly. I think if you look at the last sort of 4 weeks, we've seen quite a lot of sort of big swings in the market with what the market is pricing in about the December rate cut. We've gone from less than a 90% chance to less than a 30. Sorry, more than a 90% chance, less than a 30, to now around 80% chance. So certainly the market oscillates between the narrative of a weak labor market to a weak labor market plus sort of AI tech bubble to what it seems to be AI bringing productivity gains and all of that. And certainly from where we sit today, it does seem like we're set to see perhaps this rate cut for December. And generally what we're thinking there is potentially there is a scenario where you're seeing this dichotomy play out for much longer, where the front end of the yield curves are anchored down by this sort of concerns around the weaker labor market, but actually the long end starts to price in the expectation for next year, where ahead of midterm elections, the U.S. probably starts to come back to life with some of the tax cuts that are due to come from the one big beautiful bill, the sort of high tensions from trade uncertainty starting to fade away, and some inflation starting to creep back in there. And so potentially you do see a scenario where the Fed, as Mark was saying, preemptively cuts in December, but then we have a scenario where the front end of the curve is anchored there lower, but actually the longer end of the yield curve actually starts to price in this stronger growth picture for U.S. for next year. You've seen quite a few of the sell side guys have actually revised out their U.S. GDP growth forecast for next year.
Yeah, it's interesting you mentioned the shape of the curve as well, because you have seen just in the last couple of days money pour into the front end of the U.S. yield curve. Is that also happening in EM, or has it yet to catch up?
So within EM, for us, generically, I mean, lower rates is good for everyone because everyone's pricing off of that, right? So EM generically has benefited from the fact that U.S. rates coming down or the Fed cutting rates is good for yield-seeking assets. If I think about what history tells us that EM corporates actually have generated quite positive returns after peak Fed rate. We've seen peak Fed rate since July of 2024. And so we're seeing EM returns sort of matching what history tells us. I think year to date, coming up to July of this year, we've seen EM corporate returns coming up around 18% cumulative, which is in line with history where cumulative EM returns post-peak Fed rates has been anywhere from 18 to 22%. So EM generally benefits from that. And for us specifically, we actually find the short-dated part of EM corporates quite interesting because that again speaks to the kind of rates volatility that we've seen. If you focus on the short-dated part of the curve, you're minimizing that volatility that you ordinarily get from the swings with, is the Fed going to cut, is the Fed not going to cut, what are rates doing or rates not doing? And that's why we like EM from the perspective that EM is less vulnerable to all the AI tech bubble noise, but also the short-dated part of the curve because you benefit from what we think might happen with the front end being more anchored and with the long end reflecting a stronger growth picture for the U.S. next year.
And to be clear, you're buying this on all-in yield as opposed to on a spread basis. Spreads, you could argue credit spreads are extremely tight. It would be tough to see a replication of 2025's performance in 2026. So what is the best way to position?
Correct. We're really looking at all-in yields here. When you look at yields, especially on the sort of EM corporate side, you're looking at IG yields anywhere from 4.5% to call it 5.25%. And that's actually quite interesting for us. And when we look at that, you're still seeing a 20 bips pickup to developed markets for the investment grade portion. And you're seeing anywhere from 80 to 100 bips pickup against developed market on the high yield segment of the market. So actually, that's still quite interesting when you look at it on an all-in yield basis.
Yeah. I want to ask you about private credit and pick your brains there. And I wonder whether there's some crowding out effect that may be going on because of the sheer amount of investor interest there is in getting exposure to the private markets. Is that moving attention away from some of the public markets that you look at in EM and, of course, in DM as well, but EM in your case?
So we've seen a huge amount of interest in private credit, and the size of the market, if you believe any of the stats out there, is anywhere from $2 to $3 trillion, and that's certainly taken some of the heat off our public market. Some of the issuers that might ordinarily try to come to issue in our dollar public market have probably found other avenues. So it's become another lever that borrowers can pull in terms of private credit. Is it taking away business from the public side of the market? No, not necessarily, because I think it's just another lever for the markets to pull. And I think it also provides a bit more diversification for capital structures for different borrowers. So it's a good thing in terms of that. In terms of whether or not there are concerns of what is going on in the current private sector space in terms of a couple of instances of distress within the private credit market and what it might mean for the public's market. We definitely keep an eye on it, because if you see distress in some private credit sectors, it has the potential to reprice leverage loans, which then has a potential to reprice all of credit, EM included. Potentially, that also has the impact that where some investors suffer some distress or credit events on some private credit stuff, they might be seeking liquidity or redemptions from other liquid parts of their investments, and that tends to come through from the public credit side, which impacts us as well. And also just general risk sentiment, where sometimes if these sort of credit events persist, that general risk sentiment around credit in general also has the potential to impact us. So we do keep an eye on it for multiple reasons, the repricing risk, the liquidity risk, the credit sentiment risk. These are all the reasons why we do keep an eye on what's going on in the private credit market. But by and large, we find it quite encouraging that there is just another level for investors for borrowers to use in terms of borrowing, especially in EM. We are starting to see a lot more private credit activity within emerging markets. Markets like India, we're seeing a lot more private credit activity.
Yeah, makes sense. We've talked about the fundamentals being solid, the fact that many of these EM economies have undertaken reforms that are actually beginning to pay off. I just wonder, from a technical perspective, what you think issuance is going to look like for next year in an environment where the Feds continue with their easing cycle. Will you see a lot more issuance come to the market from some of these EM issuers?
Yeah, I think if you take a step back, you look at this year, EM corporates, for example, gross forecast for supply for the year from JP Morgan, who we track closely for the asset class, originally was supposed to be something about 430 billion. That got revised upwards. I think right now, the forecast for the full year for 2025 is something about 460 billion, and we're currently around 455-ish billion. So we're very close. It probably will exceed the upward revised forecast. And that is in comparison to the US IG market, for example, where they've had a huge amount of supply. I think the number that I heard more recently is a net supply of about 800 billion, which is up 60% year on year in the US. And a lot of that is the AI and tech capex investments driven supply. Do I see that repeating in 2026? Absolutely. I think some of the numbers that are being thrown around in terms of AI tech investments for the next few years varies from 5 trillion between now and 2030 to 9 to 13 trillion per year between now and 2030, depending on whose sell-side research you believe. So that's a huge amount of supply. And that will be funded through developed markets. Some of it will emerging markets, some of it will be public, a lot of it will be private, some of it will be equity. So do I think some of that sort of seeps into the emerging market space? Absolutely. You've got the likes of the Babas, the Tencents, the China tech companies. This morning you were speaking about Google buying chips from Meta. Some of that sort of AI capex with China is also in that race. Some of that AI capex will be funded through EM as well, but I think it pales in comparison potentially to the supply that we will likely see from developed markets.
Yeah, so interesting to make the comparison between the two. And actually, it's DM where the issuance is getting ramped up. Matunde Lawal, thank you so much for joining us, head of EMEA Corporate Credits and Emerging Markets Corporate Debt at Barings. Thank you so much. Coming up, a Russia and Ukraine exchange fire just hours after President Trump struck a positive tone on the prospects of a ceasefire. More details next. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Wednesday. Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
U.S. Commerce Secretary Howard Lutnick saying Brussels needs to change its digital regulations in order to get a deal to lower steel and aluminium tariffs. Now, the EU's antitrust chief has since ruled out easing the bloc's tech rulebook. So for more, Bloomberg's Hong Kong news desk editor Balazs Pence joins me now. So the EU really digging their heels in here. It seems very unlikely that they're going to yield to the U.S. demands to make modifications on the digital rulebook.
That's correct, Jumana. The U.S., especially the big tech companies, have long been pushing to ease some of those EU digital regulations. Some of the biggest companies like Meta, like Amazon, like Apple, I could go list almost the entire Max 7. They have been hit by multi-million-dollar fines, lengthy litigation processes. So they have been trying to push the EU to ease on some of those rules. And clearly, the White House now saw an opportunity to tie those regulations to the tariff talks. As Howard Lutnick mentioned, we just heard him talk about the metals tariffs. They thought that there may be some leeway if they tie these two issues together, but the EU was very firm, and they said immediately that these regulations are not up for negotiations. They don't think they are discriminatory. They say that these apply for all companies, including European companies, and they say that these are vital to protect the interests of European consumers. So, as Howard Lutnick said, the EU is a large market, 450 million people, and if American companies want access to the market, the Europeans are saying they have to play by the rules.
Yeah. Well, let's switch over to something that's closer to your neck of the woods. President Trump has spoken to both President Xi and Prime Minister Takaichi. Obviously, we know that there's a bit of a diplomatic spat going on between China and Japan right now. How delicate is the U.S.-Taiwan tightrope?
Well, I think you have to look no further than the fact that President Trump spoke with both President Xi and Prime Minister Takaichi over this issue. And from Beijing and Tokyo, we heard that it was the U.S. side that initiated those talks. So clearly, Trump is trying to insert himself into this very, very delicate situation and trying to keep both China and Japan on his side. Let me just remind you, the U.S. is in the middle of very important trade negotiations with China. So the last thing they need is for those to fall apart over the issue of Taiwan. Trump had a very important meeting with President Xi in Busan not too long ago, and both sides described that as a very good meeting. But crucially, the issue of Taiwan did not come up. So now the issue is back on the table, and the president needs to make sure that Japan, a very important ally, stays on its side, but at the same time, he can continue building a constructive relationship with China.
Yeah. Bloomberg's Hong Kong news desk editor Balash Pence, thank you so much for the overview. Well, Russia and Ukraine exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Bloomberg's chief Europe correspondent, Oliver Crook, joins us now. So, Oliver, this Thursday was supposed to be the original deadline for Ukraine to agree to the peace plan presented by the U.S. What is the latest on these negotiations? Where does the peace plan actually stand?
Yeah, I would begin by saying that the Thursday deadline is probably a pretty fluid one. This is something that Marco Rubio, the U.S. Secretary of State, suggested after those Geneva talks that lasted about 24 hours over the weekend, that basically this may not be the fixed and the firm deadline, because as you know, Jumana, this is an intensely complicated issue to deal with a great many issues, from sort of NATO-like guarantees for Ukraine, territory swaps, all of these sorts of things still need to be thrashed out. But of course, the U.S. administration's ambition is to put a fire beneath the Ukrainians, beneath the Russians, and try to drive everybody to the negotiating table. So what we started with was a 28-point plan. We understand that we now have a 19-point plan after those discussions in Geneva that is now being shopped around to the various parties. We should say that today the attention is in the UAE, where Dan Driscoll, the Army Secretary of the United States, who is now taking a larger role in these negotiations, has been speaking with Russian officials. We should say that the Russian officials were quite dismissive initially of this now 19-point plan, but we should say, again, this is an ongoing negotiation. It seems like this 19-point plan is currently the sort of living document that we have that is being amended and being shot back and forth between the two sides. We should also say that we're hearing just now from some Ukrainian officials over the last couple of minutes here saying that there's an expectation that President Zelensky will go to the United States within the next 4 days before the end of the month of November to discuss with Donald Trump, because another thing, Jumana, is within that 19-point plan that the Ukrainians gave back to the United States, many of the most difficult issues, such as territory and some of the other political solutions, have been left off the list because Zelensky wants to speak to Trump about it personally.
Yeah, what are the types of measures that the U.S. and Europe can exert to get this across the line?
So I think for both sides, we've talked about it many, many times, Jumana, and I'm sorry to sound like a broken record, but the main point of leverage for the Europeans is about those Russian assets that are now frozen, 140 billion euros worth of them that are sitting here in Belgium. They have not had consensus on how to proceed with that. There is some question now because those assets were discussed in the 28-point plan by the United States. Are they now off the table, or is there even more urgency for the Europeans to move on it? That is kind of a divided opinion within Europe. But we should also say, Jumana, we shouldn't forget two things. One, that sanction package on Rosneft and that went into effect, that happened last Friday. That is going to begin to start hitting the Russian economy over the next weeks and months to come. And there is, of course, that bipartisan bill about secondary sanctions that would really hurt Russia that is sitting with the Senate. That just takes Donald Trump to put it forward. It's one of the few things bipartisanly there is agreement within the United States. That would go through, and that would damage Russia immensely if Trump wants to pull that trigger.
Yeah. The story that we're watching very closely, Bloomberg's chief European correspondent, Oliver Crook. Thank you so much for that. All right, well, coming up, we're going to tell you what to expect from the budget. It is finally here. The day is finally here. That's tomorrow, obviously, with Barclays' Jack Meaning. Stay with us for that conversation that's coming up next. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning. This is The Pulse. I'm Jumana Versace in Dubai. Tech drives gains for global stocks as confidence grows over a potential rate cut by the Fed next month, but the rally fades in Europe. The gold standard under threat. NVIDIA shares slip on a report Meta is in talks to spend billions on AI chips from Google. These are the market moves. You can see NVIDIA down 1.5%, Alphabet up 2.6%. And tensions over Taiwan. President Trump holds back-to-back calls with the leaders of China and Japan as the diplomatic fallout continues between Beijing and Tokyo. And in corporate news today, EasyJet says it's receiving aircraft from Airbus at a growing rate, helping the UK budget carrier improve capacity as demand for low-cost travel remains high. The carrier's CEO also told Bloomberg he hoped the UK government would freeze or cut air passenger duty in its budget this week.
Well, I hope there's some consistency in the budget. The government have been very pro-aviation and pro-growth. They really recognise the valuable role that aviation plays, especially to an island economy, in enabling growth. So I would hope that there is some sort of freeze or even reduction on air passenger duty, because last time we saw a reduction in 2023 on domestic APD, EasyJet added capacity, other carriers added capacity, that increased the connectivity, increased the consumer choice, and brought down fares. And I think that that kind of action would be very encouraging, but we'll have to wait and see.
Well, for more, I'm joined by Bloomberg's aerospace reporter, Kate Duffy. Kate, it's interesting to see the price action in EasyJet stock today because even though they beat for the full year, I guess some concerns about the outlook coming through?
Yeah, absolutely. It was a real mixed bag this morning from EasyJet. So what we really saw was this strong demand for package holidays. So EasyJet's holiday business, the profit target there has been upgraded for fiscal 2030, and also seeing a growing confidence for Airbus deliveries as well. So that they were all in line with expectations. They received 9 aircraft in 2025. Going forward, they are expecting to receive 17 aircraft as well. But what really struck us was the consumer demand as well on top of that, and that flows through into the positive momentum that they're seeing for their holidays business.
Yeah, and let me take you in a slightly different direction. Some news coming through this morning from Boeing saying that they have gained ground in its war against defects for its 737 MAX. What more do we know? Obviously, this is a big issue that's been swirling around the production of these 737 MAXs.
Yeah, absolutely. So our colleague Julie Johnson got access to one of the main factories at Boeing and spoke to the key players over there. Essentially, what we're seeing is very subtle changes, but important changes that are contributing towards the improvement in the quality of Boeing's aircraft. So what we're seeing is a decline in lost tools, also less defects in the airframe, and more inspectors looking at the fuselages that come into the factories. And this is all in the wake of the Alaska Airlines panel blowout that we saw nearly a year ago now. And obviously, they're looking to increase the FAA production rate on some of their aircraft as well. They've achieved that with the 737, also the 787, but they're not quite out the dark yet. They're still trying to get the certification for the 777X, and that's something that customers have really long been waiting for. But in terms of the reaction to the quality of the products that they're seeing, customers are really happy. You know, Ryanair's Chief Executive Officer, Michael O'Leary, was a fierce critic of Boeing earlier this year, saying that, you know, that the deliveries were slow, they were stunting growth. But in more recent times, he's been really positive about Boeing's production, the communication style that they have. So, yes, our colleague Julie Johnson, she was over there and really saw the improvement that Boeing is making in its factories.
Interesting. Kate Duffy, Bloomberg's aerospace reporter, thank you so much for bringing those lines from Boeing and EasyJet as well. Now, investors will be keeping a close eye on the gilt market tomorrow as Rachel Reeves makes her much-awaited UK budget statement. Bloomberg understands the Chancellor is to slash the amount Britons can save in their tax-free cash ISA savings accounts each year from £20,000 to £12,000. The move is a bid to get households investing more in UK stocks. For more, Anna Andrade from Bloomberg Economics joins me now. It feels like every day we're getting a drip feed of measures that may or may be coming in the budget. Let's just talk about the ISA here. How big of a deal is it that the level is being lowered to £12,000? I guess the goal is to try to incentivize UK savers to invest more in the stock market, but big question mark as to whether they may succeed.
Yeah, I think that's exactly right. This is part of a push from Rachel Reeves to sort of raise revenue while at the same time incentivizing growth. I'm a bit skeptical she'll be successful at either of these, essentially because it incentivizes households to move their savings away from cash, potentially into stocks, but not necessarily British stocks. And the second thing, from a public finance perspective, it also represents Reeves going after sort of a narrower tax base than, you know, if you look at income tax, VAT, NICs, and corporation tax. These are bigger tax streams. So essentially, Reeves targeting savings and Reeves targeting pensions, which you've also seen in the news, represents she trying to get some money out of these narrower tax bases. The problem is that they won't yield as much, and there's another big question mark about how certain these sort of revenues will be, because these are mobile tax bases. People will adjust their behavior in response to these taxes, so there's a risk that they don't yield as much as, you know, the OBR forecasts or Reeves is expecting. And I think that's something that's worrying investors, sort of the composition of the savings, and that's something they will be looked at very closely tomorrow.
Yeah, most definitely. Bond Vigilante's keeping a close eye on everything that's announced, and also whether she actually sticks to some of her own fiscal rules. What are some of the other measures or policies that we're expecting out of the budget tomorrow?
I mean, I think one thing that Bond Vigilantes will be looking at in particular would be sort of anything that can sort of impact inflation. And there's two things, there's two ways that the budget can impact inflation tomorrow. I mean, if Reeves delivers a big fiscal consolidation, that by default will sort of, you know, be disinflationary, it will weigh on the economy. But I guess what investors will want to see is that this consolidation is sort of front-loaded, so it happens sort of in the next few years. If Reeves sort of backloads the fiscal consolidation, investors might get concerned that she actually won't follow through with these measures in 2029, which is like an election year. That's one thing. The second thing that they will be looking at is measures that directly impact inflation. So here we're talking about, you know, freezes to sort of a reduction in the VAT of energy bills and freezes to rail fares. So all of these will sort of mechanically bring down inflation by as much as 0.4 percentage points according to our estimates, and that that's something that would be really welcomed by investors, as it would sort of clear the path for the Bank of England to sort of cut rates this year.
Ana Andrade from Bloomberg Economics, thank you for setting up our next conversation. Well, staying with the UK, my next guest says tomorrow's budget has been weighing on spending and activity in the economy. Joining me now is Jack Meaning, Chief UK Economist at Barclays. I'm going to start off by simply asking you, Jack, what your expectations are for the amount of fiscal consolidation we're going to get from tomorrow's budget.
Yeah, thanks, Jemana. I mean, I think, look, it's clear there's a lot of uncertainty around this, probably more than we've had for most fiscal events in recent years. But I think, where we think there's broad consensus is the Chancellor's going to need to find something in terms of 25, maybe 35 billion pounds of net consolidation if she wants to increase her headroom from where she was last time to at least 15 billion, which is what we think the market's looking for.
Yeah, so anything short of 15 billion pounds on the headroom, you think will spook gilt investors out? Is that your interpretation, if 15 is sort of the line in the sand?
Absolutely. So if you look back at previous budgets, normally chancellors have been able to have somewhere between 0.5% and 1% of GDP, and we haven't had this repeated conversation that markets have been obsessing about for weeks now of whether the chancellor's going to breach her headroom. We did some work at Barclays with the Institute for Fiscal Studies and found that, if she had 10 billion of headroom, that would give her maybe a 1 in 3 chance that at the next fiscal event she'll have to come back and ask for more tax increases, which obviously politically that's bad. From a market sentiment point of view, that's not a great look. So we think 15 billion is probably the minimum the market is looking for. Anything closer to 20, anything more like 25, that's harder to get given the fiscal constraints the Chancellor has put on herself. Yeah. But actually that would be a more positive reaction from the market.
Yeah, my colleague Ana Andrade raised another good point as to whether the fiscal consolidation is front-loaded or back-loaded. How closely are you going to be watching that for? And again, how closely will Guild participants be watching out for the timing of this fiscal consolidation?
Yeah, I mean, I think there are a few things within that, Jemana. The first is that actually we know that some of this will be backloaded, or we have a good idea that some of it will be backloaded in the fact that we think that the freezing of income tax thresholds for another 2 years from 2028 onwards will raise maybe 8 to 10 billion pounds of the gap. So obviously that doesn't kick in until the latter part of the Parliament. And so to some extent there will be something backloaded in there. But actually for market credibility, the market is kind of a, we'll see what you do rather than what you say. And I think that means that actually it's important that, the rest of the consolidation is front-loaded. Add into that, there's an important political economy consideration here, which is if their front-loading comes in at this budget and is in the next year or two, the peak pain for the UK economy will be maybe on our model in early 2028. If you delay, if you muddle through this budget and you ultimately end up having to make another consolidation next year, then peak pain is really hitting the economy at the point that we go to the polls for the 2029 election. And that's a difficult sell, I think.
So they've got to be mindful of that. Yeah, they've got to be mindful of that. Okay, very good point on the impact on the economy. She's also talked about, the Chancellor's talked about wanting to bring down inflation levels. Do they have the power to do that mechanically? I mean, we know that one of the measures that's being leaked is the freezing of rail fares. Is that likely to have knock-on effects to the inflation path looking ahead to 2026?
Yeah, I mean, I think there's a whole range of measures. Anna was talking about them, some of them just before this. But, I think if we look at freezing of VAT on household energy bills, rail fares, maybe freezing of fuel duty, all of those things could take out 0.4, maybe 0.5 percentage points out of inflation by the time we get to April next year, maybe even sooner for some of those measures. Ordinarily, you would think the Bank of England would look through some of those price level shocks, some of the things that temporarily bring down inflation. But actually, the hawks on the Bank of England's committee have pointed to the risks that persistent inflation at the moment could lead to higher inflation expectations, more persistent inflation in the medium term. So anything that brings down that near-term inflation profile probably reduces that risk and therefore, just frees up the Bank of England that little bit more to look at rate cuts.
That's exactly why I was asking you that question, because, the knock-on effect from that could be that it frees up Bank of England's hands to pursue a more vigorous rate-cutting strategy. What is your outlook for the Bank of England going into next year?
So Going into the budget, we think there'll be 2 more cuts before the end of Q1 next year, so most likely in December and March. And then we're broadly in the range that we think the Bank of England views as neutral. So we think at that point, all else equal, they'll take a pause. Now, there's some definite downside risk to that. If the Chancellor delivers a little bit more disinflation in the budget, then, on our kind of forecast, you would be taking out, again, 0.4, maybe 0.5 out of the inflation rate, and that could free you up for more cuts than our baseline.
Yeah. Are you concerned that the net impact on growth also could, again, be very growth negative for the UK and put even more pressure on the Bank of England to come up with expansionary policy?
I mean, look, I think it's pretty obvious that a consolidation at this budget will be a drag on growth. Actually, if the Chancellor manages that consolidation without creating inflation and without losing the confidence of the market, actually, our modelling suggests that the drag may not be too big, maybe 0.25% of GDP, maybe as much as 0.4% of GDP on the level. And as I said, that's peaking in terms of pain in around early 2028. Now, the risk is that on our modelling, if the Chancellor finds inflationary levers, either directly through duties and changes to kind of alcohol duties and things, or through something indirectly that puts costs on businesses that they have to pass through, if there's an inflationary consolidation, that could double that impact. So you'd be looking at more like 0.5% of GDP to 0.8% of GDP, and that's a more material drag. So there's a good outcome here where the Chancellor manages the consolidation with a pretty muted effect on growth. But alternatively, if she makes a misstep, which is why the market's so focused on her, then it could be a more material growth drag.
Yeah. What would you say is going to be the ultimate determinant of whether this UK budget has been a success, at least for market participants? Should we single-handedly just be watching out for the price action and gilt yields afterwards? Or should we also be focused on some of the micro sectors, the various parts of the UK economy that also may be exposed to certain measures announced tomorrow?
I mean, I think, look, across gilt yields, FX, the whole constellation, that will give an initial market reaction to the piece and tell you whether ultimately the market finds this credible as a budget. So I think we'll be looking across that whole range of asset prices. But you have to remember as well, we're kind of going into the Thanksgiving weekend. There people kind of around the world may not have as much of an eye on markets necessarily. And so I think actually what we've seen in previous budgets is there's an initial reaction to the kind of headline numbers, but it's taken a day or two really for people to digest what is a huge piece of analytics by the OBR, and ultimately then to come to more sustained conclusions. So I think, yeah, look at those initial reactions, but also take time to work through exactly what's going on in the kind of the broader macroeconomic piece.
Jack Meaning, Chief UK Economist at Barclays, thank you so much for joining The Pulse today. Well, UK Chancellor Rachel Reeves will deliver that budget at 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. And it doesn't stop there. The opening trades will break down the numbers with key business and political voices in a budget special on Thursday. And European car sales have climbed for a 4th straight month in October as the region's automakers continue to push out more affordable electric models. The European Automobile Manufacturers Association says new vehicle registrations rose 4.9% from a year earlier to just shy of 1.1 million units. China's BYD saw sales in the region more than triple, easily outstripping Tesla, whose sales continue to slump with registrations down 48%. And New York Mayor-elect Zoran Mamdani has selected several corporate executives to join his transition team. It comes as the Democratic Socialist seeks to ease concerns that his policies might harm the city's business community. Amongst those chosen to help in his move to City Hall are former Goldman Sachs partner Margaret Anadu, developer Jed Walentas, and Kathy Wild, head of the partnership for New York City. And in other news, a federal judge has thrown out criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruled that the prosecutor who brought the cases had been illegally appointed. President Trump abruptly installed the prosecutor in September after her predecessor resigned under pressure to bring charges against the pair. Comey and James are amongst a group of Trump's perceived political foes who have faced investigations after the president called for their prosecution. And coming up, China has instructed the country's airlines to reduce the number of flights to Japan following comments by Japan's Prime Minister on Taiwan. We'll have more details next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver. Reduce the opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg. Good morning. This is The Pulse. I'm Jumana Versace in Dubai. Bloomberg has learned the Chinese government has instructed the country's airlines to reduce the number of flights to Japan through March 2026. Tensions between the two nations were inflamed after Japanese Prime Minister Sanae Takaichi's comments on Taiwan. For more, I'm joined by Bloomberg's chief Asia correspondent, Ross Matheson. So we've all been keeping a very close eye on how this diplomatic spat between Japan and China has been playing out. What is China's latest move signal vis-a-vis the flights, Ross?
Well, as you were saying, they've given this edict essentially to Chinese airlines to cut the number of flights now through into a proportion at least of next year. And that signals that Beijing is really digging in there. In fact, both sides seem to be digging in here. It's been affecting travel to some extent. It's been affecting trade to some extent, although they've held fire on some of the really big impactful stuff, which would be, for example, if China decided to penalize Japan in its eyes by cutting off supply of things like rare earths. For now, the economic impact has been a little bit limited, but this does suggest that they're willing to drag it out. It could become quite protracted. It could, in fact, impact that peak Lunar New Year holiday period, of course, for travel in Asia. And the question again is, what is the off-ramp in this situation? Because Beijing is insisting the Japanese Prime Minister, Sanae Takaichi, apologize and retract her statement. She's saying she won't. She needs to also sound tough and that she's standing up to China because she's pretty newly in the position as Prime Minister. And so we're in a bit of a standoff here in terms of how this can be de-escalated. And the indications are from China, at least, that it's willing already to play the long game and to see this run on for quite some time.
Yeah, and it's interesting that in the last 24 hours, President Trump has had calls with both the Japanese Prime Minister and President Xi. Really speaks to the tightrope that the U.S. are walking on when it comes to Taiwan. Do we know whether Taiwan was discussed on the call that took place between Presidents Trump and Xi?
Well, at least according to China and their readout, it was discussed. Xi Jinping is said to have told Donald Trump that what they said was the return of Taiwan, which is essentially a self-governing island to China, is for China a key part of the post-World War II global order. Interestingly, the US readout of the conversation between Xi and Trump does not mention Taiwan at all. It talks about trade, it talks about the latest with Russia's war in Ukraine, but it didn't touch on Taiwan. And for Taipei, at least, they're interpreting that as a sign that Donald Trump does not want to use Taiwan as a bargaining chip with China in his broader conversations around their relationship and trade, that he doesn't want to get too pulled into this. But obviously, as you say, it's very delicate times because the US probably wants this to de-escalate. Donald Trump sees himself as a peacemaker. He would not want this to be escalating, but equally he can't be seen to be siding too much to Japan, for example, even though Japan is a long-running ally of the US. And so you've got all these delicate issues at play between Taiwan, Japan, China, and the US on this. But indications, at least, China says that the US instigated this call with Xi Jinping, which does suggest that Donald Trump is keeping an eye on what's happening at the least and has a vested interest in it not escalating.
Yeah, absolutely. Ross Matheson, thank you so much for bringing us the latest there. I'm going to pivot to markets now. Tech stocks were helping global equities advance for a third day, but the rally seems to have run out of steam in Europe. Bloomberg's Markets Today co-editor Marwana Konayam joins us now. Marwana, talk us through the price action this morning. A lot of volatility going on with some of these key tech stocks today.
Yeah, absolutely. What we have seen is some of those gains that we saw earlier falling back, and actually we are now seeing stocks falling in Europe, and that's mainly because US futures are also turning lower after Nvidia shares are slipping, and that's been not surprising because it's been driving so much of the recent equity rally, and it really shows the vulnerability there and how dependent, in fact, world equities right now are on Nvidia and the AI industry that surrounds it.
Yeah, well, let's speak a bit more about NVIDIA. You mentioned that the shares are slipping. Last time I checked, they were down about 2% in pre-market. But this one report that Meta is in talks to spend billions on AI chips, but from Google. So what challenges does this pose for the industry's poster child for AI dominance?
Yeah, so it's quite significant because we haven't really seen that level of competition before. And a lot of the success is driven by pricing power. But I am kind of interested in what it means longer term, because having some increased competition does suggest that perhaps there's actually more gains to be had elsewhere in the sector. We've seen everything very much driven by NVIDIA so far. And actually, that does pose some risk as well, because as we've just seen, the vulnerability, the moment that the sentiment turns sour. So actually, if there's some diversification, it could also make it a bit more secure as a sort of longer-term underpinning of the equity market.
Bloomberg's Markets Today co-editor Marwana Konayam. And speaking of markets, let's take a look at how some of the key European indices are faring. We are about an hour, well, almost 2 hours now into the trading session. You can see that not a lot of movement for the Stock 600, trading flattish, essentially the DAX down about 15 basis points. The FTSE, all eyes on the UK index as we head to that important UK budget tomorrow, trading sideways today around 9,500. As for US futures, this is how markets are pointed to open up slightly weaker, just as Marwana was saying. And this on back of some of the weakness that we're seeing in NVIDIA. So keep an eye on that and how it all plays out. On the flip side, though, investors continue to bet bigger on the possibility of a rate cut come December. So that is your picture as we head into the U.S. session. Up next, Bloomberg Brief. You've been watching The Pulse. This is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes. And And I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. A win for Alphabet. Meta reportedly in talks to spend billions on Google's AI chips as an alternative to NVIDIA's GPUs. Moscow and Kyiv trade airstrikes, even as President Trump cites progress on his peace proposal and as U.S. and Russian delegations are set to meet in Abu Dhabi. And markets eyeing a raft of economic data from September retail sales to November's Conference Board survey after a blistering tech rally. So that blistering tech rally looks to be coming to a little bit of a halt today, primarily on weight from NVIDIA, most likely after that Google Meta news. So we have futures pointing lower. This after the S&P 500 rose 1.6% yesterday, and the Nasdaq 100 was up 2.6%. We'll see if this picture takes a turn, because of course the other thing on markets' minds is the Federal Reserve. Let's take a look at the bond universe, because we have now just a couple of weeks, not even before that Fed meeting, and odds are rising. We're up to about 75% now of a December rate cut. Because think about it, if we don't get one until January, that meeting isn't until January 29th, and that's really more than 2 months away. Can the markets really wait that long? Well, right now the 10-year yield is down to 4.03. We do have the 2-year yield below 4.50 and the 30-year yield still hanging out around the 4.67 mark. Mary Daly out now siding, it looks like, with a cut. And we also have Nick Timiraos in the Wall Street Journal, the Fed whisperer, of course, saying that the ground has been laid for Powell to actually make a cut in December. So we'll see how things progress. For the moment, though, let's get to some individual stock movers. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. Let's start with the biggest story of the day today, which is the report that Meta is in talks to spend billions on Google's AI chips. That would be potentially a big blow to NVIDIA, whose chips have been the gold standard, really, in that tech industry for quite some time. We can see that reflected in those shares today, with Alphabet up quite significantly and NVIDIA down. But there will be more on that very shortly. Moving on to SanDisk, which is the newest inclusion in the S&P 500. That is a company that makes memory cards and USB sticks, and it is set to replace Interpublic, the key ad agency in the S&P 500. That follows a really impressive rally in those shares, and we can see that continuing today with shares up 2.7% pre-market. And finally, let's end with Symbotic, which is a warehouse automation robotics, a company that counts Walmart as one of its biggest customers, and it is up after providing a very upbeat forecast for revenue in the first quarter. Follows a very good year for the company as well, and it is up almost 13% in pre-market trading this morning.
A nice rise there from Symbolic. Chloe, thank you. That is Chloe Melly. And coming up in this hour, we're going to look ahead to that raft of data coming this week and later today in particular with JP Morgan's Priya Misra. The AI race heating up then. Alphabet getting a boost this morning after a report from The Information that Meta is in discussions to use Google AI chips and data centers starting 2027. That's dragging on NVIDIA shares. Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. So these would be TPUs, apparently, Tom, as opposed to NVIDIA's GPUs. How are they different? Are they better for the likes of inferencing, for example?
Yeah, so they were developed in-house by Alphabet, the parent company of Google, about 10 years ago, and they have since been adapted, and they can continue to be adapted because, of course, Google, as well as having its own chips, also has its own large language model, Gemini, of course, so there's this feedback loop between how the model performs, then the developers can take that to the engineers of the chip and adjust the chip to add in those performance changes that they may need. In terms of whether or not it's better or not, it kind of depends what your specific aims are when you're one of these AI researchers building one of these models. But certainly it seems to be meeting the needs, certainly not just, it seems, of Meta, at least that's the expectation according to this reporting from The Information. We know it is meeting the needs of Anthropic, and they think that's going to work because Anthropic is committed to a deal with Google as well about being supplied with close to 1 million of these TPUs. The key standout point, Vonnie, obviously, is that it seems that Alphabet, with these partnerships with Anthropic and potentially this partnership with Meta, one of the biggest spenders, hyperscaler spenders on AI chips, it seems that Alphabet is being better positioned with its TPUs as being potentially a bit of a competitive threat to NVIDIA, which essentially has dominated the market for these chips.
Yeah, exactly. So what would switching look like in this arena? I mean, is there an incentive on price? Do we know anything about how relative pricing, relative margins would be?
Well, they can work very well in terms of both training the models, but also inference. And it seems to be that is what the emphasis is for Meta in this potential deal, is they want to be able to use these chips for inference. So when we and consumers and enterprise are actually using these chatbots and these large language models, that is the process of inference, and TPUs work very well in that sphere as well. They do have to, and they will have to prove that they can meet both in terms of energy efficiency and in terms of cost as well, of course. And look, Jensen Huang at NVIDIA has been very keen to emphasize that with each new iteration of his own chips and the whole package that comes with it, so the CUDA software, but also the networking that comes with those NVIDIA chips, that you get those gains in efficiency, both on energy and on cost as well. And the latest, of course, generation of NVIDIA chips will be coming, the Rubin will be coming out in 2026, and he says there's already strong demand for that. So this is heating up competition, but in some ways it's also a reminder this is just as much Alphabet's world as it is NVIDIA's world, because not only are they performing and getting demand for their chips, they're also getting demand for Gemini 3, which of course dropped a few days ago and has had a very good response, and you've seen that impact in terms of the competitive challenge versus OpenAI, and you've seen the read across to what is essentially a proxy node now for OpenAI, which is SoftBank, listed over in Japan, which has this sizable stake in OpenAI, and its shares have been under pressure. So that has SoftBank's become something of a proxy for the privately held, of course, OpenAI, and concerns that maybe OpenAI is facing more of a competitive threat from Gemini, and particularly Gemini 3.
Yeah, SoftBank shares have been pretty volatile of late. Tom, thank you so much. That is Tom McKenzie, host of Bloomberg Tech Europe. Well, staying on AI, President Trump has signed an executive order to establish what he's calling the Genesis mission in an effort to boost innovation in the AI space. Joining us now is Bloomberg's Suzanne Lynch. Suzanne, what are the details? We know that the president has been making all sorts of deals with individual companies, but as it pertains to specifically this Genesis mission, what is it?
Yeah, the Trump administration had flagged that this was coming, and this is part of the effort by Donald Trump to federalize AI investment, if you like, to try and inject some momentum, some power, and some money into the federal government when it comes to investing in AI. He has in the past criticized the role of states for what he sees as holding back AI investment, and is even touting the possibility of being able to censor these states in some way for that. But I think it speaks to the fact that the Trump administration sees AI as the next big investment opportunity. Donald Trump has long spoken about the need for the US to be on top when it comes to the AI race. Of course, a lot of questions remain about the pressure this is going to bring in terms of not just spending investment, but infrastructure on the energy grid, for example, given the role of data centers in this. But it shows that the US administration is prioritizing this AI issue for now.
Yeah, that's domestically. Now, as it pertains to international space, the president has been holding calls. So one with his Chinese counterpart. Just have a listen to this, Suzanne.
I did speak with him about the call. It lasted about an hour, and it was a very positive call. The focus of the call was really Russia, Ukraine did come up, but the focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction.
So that was all very positive from the press secretary there, but on the Chinese side, the foreign ministry briefed this morning and said that, there's a lot going on when it comes to China and Japan, and that Japan's Prime Minister Takaichi hurt Chinese people's feelings, and that this 1972 agreement with Japan recognizes that Taiwan is Chinese. Do we have a problem here, Suzanne, in the sense that the president is keeping both the China premier and the Japanese Prime Minister happy?
Yeah, that's exactly what's happening here. And considering he had those two calls on Monday evening, it shows the balancing act now that is facing the US president. On the one hand, he needs to keep his ally Japan happy on board. On the other hand, he is trying to sign some kind of a trade deal long term with China and resolve the issue of critical materials exports. So I think we can see Donald Trump, who of course sees himself as something of a go-between, something of an international peacemaker, has to tread very carefully in these increasing tensions between China and Japan. Of course, Japan also has had a lot to lose here if this escalates. China is a major trading partner, and Japan also depends on a lot of critical mineral exports from China that go to Japan. So it's a tricky geopolitical issue for Donald Trump, but I think for the rest of the world, for Europe, for example, it shows that his interest is not just on the issues of Russia and Ukraine in the Middle East, but also further afield in Asia.
Yeah, exactly. And of course, where you are in Brussels, we just had the Commerce Secretary and a delegation from the United States there as well. Can you bring us up to speed on talks between the US and the EU and where we're at on any kind of deal?
Well, look, there were no big takeaways, no big results from Monday's meeting between those EU trade ministers and those two top Trump officials. And it was significant that these officials were here in Brussels. That doesn't happen that often, that they come to these meetings. But Howard Lutnick, the Commerce Secretary, was very clear in his comments to Bloomberg News yesterday that he wants to see changes to the EU's digital regulation in order to move forward on any trade deal, particularly as regards steel and aluminum. Now, the EU's antitrust chief, Teresa Ribera, last night warned that EU tech regulation is not negotiable, and she has poured cold water on the idea, the prospect that the EU could change its tech regulations. So look, let's see where this goes next. What the Europeans really want is something on steel and aluminum. They are still facing 50% tariffs, but there are also other sectors that they want different treatment for, including wine and spirits, everything from Italian pasta to other exports. So those negotiations are going to continue at official level.
Suzanne, thank you so much. That is Suzanne Lynch there in Brussels. And Moscow and Ukraine trading airstrikes overnight as a US official was due to meet a Russian delegation in Abu Dhabi. This all as President Trump cites progress on his peace proposal. Let's bring in Bloomberg's Oliver Crook for more. So as I understand it, Oliver, the 28 plan was brought down to maybe an 18 or 19 point plan, but now even that potentially isn't going anywhere. Can you bring us up to speed?
Yeah, Vani, there's a lot of confusion about the different plans that have been circulating. There was one that was proposed by the Europeans, but what we understand now is that that 28-point plan that sort of dropped like a bombshell in the middle of last week here in Brussels and for Kyiv has now been reduced to a 19-point plan after those discussions in Geneva, those 24 hours of frenzied diplomacy between U.S. Secretary of State Marco Rubio and the Ukrainian delegation. Now it seems that that living document, that 19-point plan, is what is being shopped around the world right now. And we heard from Volodymyr Zelensky speaking last night, saying that after those Geneva talks that many of the right elements had been taken into account into that framework. Of course, the Russians, for their part, have sort of dismissed this 19-point plan out of hand. That being said, one of the sort of new protagonists in the negotiations, Dan Driscoll, the U.S. Army Secretary, is in the UAE today. We understand that he met with the Russian delegation yesterday, that those talks will continue again today to try to get them on side in terms of what they need to see from this document. Of course, Trump administration and President Trump himself would like to see a deal struck by Thursday. I think that that is probably a fairly ambitious, if not totally impossible, deadline to actually strike. That being said, crossing the wires about an hour ago, we heard from some Ukrainian officials that we understand that Volodymyr Zelensky, the president of Ukraine, will be heading to D.C. in the next couple of days before the end of November in order to speak with President Trump, because we should say, Vani, one of the big differences between the 28-point plan and the 19-point plan is that many of the most contentious issues like territory and some of the other complicated political issues have been basically removed from the document because Zelensky wants to speak personally with Trump about those in person in the coming days.
Yeah, and Sergei Lavrov saying that Russia has seen neither plan and expects to see this new peace plan after the US agrees it with Europe. We'll see. Oliver, thank you so much. Oliver Crook there, Chief European Correspondent. Now to other top stories trending on the terminal this morning. UK bondholders are preparing for the government to release a tax and spend plan that could impact their returns. Chancellor Rachel Reeves is expected to announce measures to help meet debt targets in her budget speech tomorrow. A benchmark gilt portfolio has returned almost 4% so far this year, on course for the best performance since 2020. That China-Japan rift widening. The Chinese government has instructed the country's airlines to reduce the number of flights to Japan through March 2026. The order was made last week after Japanese Prime Minister Sanae Takaichi's comments on Taiwan inflamed China. And ABN AMRO's new CEO, Marguerite Berard, seeks to slash its workforce by nearly 20% in a major revamp. The net reduction of 5,200 full-time roles is anticipated to be completed over the next 3 years. Coming up, we'll bring you our exclusive interview with the CEO of State Street Investment Management. That's next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Investors awaiting a slew of economic data coming out in the next 2 days to gauge the potential for a Fed rate cut. Bloomberg's Katie Greifeld spoke exclusively with State Street Investment Management CEO Ye-Shen Hung on her outlook.
We still would very much like to see a 25 basis point cut from the Fed. We think inflation is more contained, even though maybe there's higher goods inflation. Services are softer in the housing residential sector. And at the same time, we're very worried about the employment picture. Unemployment has ticked up, hiring has slowed down, and consumer confidence is weaker. And so to really protect against this, we'd like to see the Fed take that 25 basis point cut. A little less clear as we move into 2026. We may be not calling for as much as 100 basis points, but somewhere in the neighborhood of 50 to 75 basis points makes sense to us.
I also want to talk about how investors are positioning amid all these different cross currents, because one of the most interesting stories to me, I think, of 2025 is still this red hot demand for cash. You take a look at money market funds, you take a look at cash like ETFs, the lines just keep going up, even though you do have the Fed starting to reduce interest rates here. And I wonder, first off, what you make of that and what will finally break the fever. Is it lower interest rates or is it something else?
Well, the need for income is very significant, and whether that's because of sort of developed economies, have aging populations that are looking at cash is providing multiple uses within a portfolio. It's generating income, it's dry powder should there be a major correction, and it also helps to diversify the overall portfolio. And for that reason, we think cash probably stays at these sorts of levels. May come down, but I think that might need some greater investment opportunity than perhaps investors see today.
It's interesting to hear you say that, because I talk to a lot of folks, a lot of investment professionals, and it's the most urgent question they have to answer is how do you get investors out of cash, get them off the sidelines, so to speak. But it sounds like you're saying this isn't necessarily the sidelines. That's not necessarily the way to be thinking about cash.
I think that's right. And what we're seeing is just a continuum of cash, if you will, right? Short-term deposits and money market funds to short duration and the like. And we do see some argument for extending maturity slightly in the short and intermediate term of the curve. At the moment, credit spreads are incredibly tight, investment grade and high yield. And so moving along that sort of treasury spectrum, we think is warranted. But again, it's not the same as a lot of cash moving into the market.
I want to talk about retail demand for private assets more generally, because you think about the turbulence that we've seen in the past couple weeks, of course, when it comes to private credit, when it comes to, for example, cockroaches and Blue Owl's pooled fund merger. Has that dampened at all retail enthusiasm to get access to some of these private strategies?
I think from where we sit, we continue to see investment discipline in the private credit arena. Defaults may be rising slightly, but from a very low base. And some of the big profile ones we think are more idiosyncratic. And at the same time, there's a secular long-term trend of the private markets providing credit capability and availability, given that the banks are more limited. And so the liquidity aspect, the income aspect of private credit, we see continuing to be in demand by retail investors. One area that we're focused on is in the defined contribution arena. We're one of the largest USDC managers, and we've been first to market to introduce a target date fund with a 10% allocation across private equity, private credit, and real estate. And we think it makes sense for individual investors to really participate in this part of the market that is showing tremendous value creation, yet they don't have easy access.
State Street Investment Management CEO Ye-Shen Hung there speaking with Bloomberg. Coming up, one story making headlines across major newspapers. We look at the progress being made in the Russia-Ukraine peace talks. More on that next. This is Bloomberg.
case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. Most major papers and news outlets leading with the latest on the Ukraine-Russia deal. CNN saying that talks are gaining momentum as U.S. and Russian officials meet in Abu Dhabi. Now, the Wall Street Journal is looking at how the U.S. drafted a Russia-friendly peace plan. The New York Times, leading with how Secretary of State Rubio tried to bring that plan to the middle ground. And the Washington Post is highlighting the grinding progress for Russia on the battlefield this year. Let's take a look at where markets stand now. NVIDIA really weighing on this market. It's down 3.5% of the pre-market, and that's dragging on futures. As you can see, S&P futures, Dow futures, and NASDAQ futures, they're all pointed to a loss at the open, although we did see a gain for the NASDAQ 100 yesterday of 2.6%. A little weight to the Bloomberg Dollar Index, and the 10-year yield, now it is below 403. Of course, is there a December cut coming? Nick Timmerose of the Wall Street Journal seems to think so, at least says the ground is being prepared. Mary Daly now on the side of a cut, it seems like, as well. Let's have a look at some other asset classes. The VIX has come down a lot since we saw those down sessions, but we are still well above 20 and just a little bit on the rise today, as you can see, with stocks lower. Bitcoin, very volatile in recent sessions, above 87,000, but it was below that just a little bit ago. And no real reaction in crude oil to those sanctions being put on Russia. 58.65 for WTI. Coming up, we're going to be pushing ahead to today's data and the Fed meeting with JP Morgan's Priya Misra. This is Bloomberg.
Our North Star is do the work. Keep your head down and do the work. There's always going to be speculation in our business. We're in a you know, a massive time of disruption, and everyone's going to constantly be saying, what's going to happen next? Who's going to be there? Who's, you know, you can't focus on that. You have to focus on the work. And I think what's so exciting about Warner Brothers right now, even though it's an over 100-year-old company, we all approach it with like startup energy. So it's actually a really great time to be making movies.
Our teams are used to it because it's, you know,
this company's been bought and sold.
Right. Yeah. Some of the inherited Warner people, you know, understand this feeling. But when we started to work for David, you know, one of his edicts to us is, you know, challenge all assumptions. You know, the business has to transform. It has to adapt to the moment we're in. And we talked about Moneyball a lot, you know, because Billy Beane in that movie and in the book was all about adapt or die. The company right now has been battle tested and it has been challenging assumptions for 2 years. As far as the day-to-day, like we're heading for that split. That's the course that David has charted. And people trust David because this whole slate strategy, this whole diversified slate, the label strategy, getting DC up on its feet, getting New Line pumping, getting animation, which comes online for us next year, pumping, we still think it's the winning strategy.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. A win for Alphabet. Meta reportedly in talks to spend billions on Google's AI chips as an alternative to NVIDIA's GPUs. Moscow and Kyiv trading airstrikes. This even as President Trump cites progress on his peace proposal and as U.S. and Russian delegations are set to meet in Abu Dhabi. And markets eyeing a raft of data from September retail sales to November's Conference Board survey. This after a blistering tech rally. So let's take a look at those markets. Futures are pointed lower. We'll see if that changes in the next 4 hours, but certainly NVIDIA weighing on the pre-market. It's down about 3.5%. And of course, this comes after yesterday's 2.6% gain for the NASDAQ 100 itself. So perhaps there's a little bit of give back. Let's take a look at bonds because we're going to be talking about them in a moment with Priya Misra. As you can see, we have had a little bit of movement. The 10-year yield is now down below 403, the 30-year down below 467, and the 2-year firmly at 348.32. Just a few more days to go before that December meeting. And of course, the blackout starts on Saturday. Let's get to Chloe Melly in London now for some individual movers to watch. Chloe.
Good morning, Bonnie. Let's start with the big story that's on everyone's mind today, which is the report that Meta is in talks to spend billions on Google's AI chips. And that is a big blow to NVIDIA, which, of course, has the chips that have been the gold standard in that industry for both big companies, big tech companies, and startups for quite some time. And we can see that reflected in those shares in pre-market trading today. This is a story that we'll be following throughout the day. Moving on to the latest addition to the S&P 500, which is the company SanDisk, which makes memory cards and USB sticks, and it is set to replace Interpublic, which is the ad agency in the S&P 500. That follows an impressive rally in the shares, which is continuing today. And finally, let's go over to Symbotic, which is a warehouse automation and robotics company. It counts Walmart as some of its biggest customer, and it provided a revenue forecast for the first quarter that was seen as very upbeat and definitely ahead of expectations. This is a big win for the company and also for that broader automation sector that has seen a little bit of a setback, including with the European peer Ocado, which has seen a little bit of weakness recently. And we are up 13% for Symbotic.
All right, a nice pop there for that company. Chloe, thank you so much. That's Chloe Melly. JP Morgan's Priya Misra weighing in on the data catch-up, saying that the absence of some raises the bar for a December rate cut. Still, she writes, quote, "We do think that a cut is more likely than not, since policy is still restrictive and risks are skewed to the downside." I'm pleased to say Priya joins us now and in studio. So Priya, we have, 10 days before the meeting? You're still thinking that a cut is more likely. Does the fact that Mary Daly has now weighed in and the fact that we get the Nick Timmeros article saying that the path has been sort of paved for Powell to cut, does that make it even more likely?
So I do think so. I mean, there is a lot of data that we're going to get today and, between now and the Fed meeting. So it's not a done deal. And there's clear divisions at the Fed. But I think if I take a step back, policy is still in the restrictive territory. Now, I think there's a lot of debate. The divisions at the Fed really come from what is neutral. And there are Fed officials who think it's closer to 4, in which case we're at neutral. And there are others that think it's 3 or a little lower. But if I look at the range, if that's the range of neutral, you're just at the upper end of neutral. So there is, a case to be made for policy is being a bit restrictive. And then you look at the labor market data, and I think that's what, Mary Daly's comments about the non-linear slowing, it's something we've been concerned about. If the hiring pace is slowing and you're seeing a pickup in layoffs, and we are seeing some of that, we're not seeing it in claims yet, but we're seeing it in challenger, warn notices. I think the Fed really doesn't want it to become a non-linear slowing, because anytime these layoffs start, they can non-linearly increase a lot. And I think they're trying to provide some protection against that, some insurance against it. So I think just given the labor market slowing that we've seen, and even the new data that's coming, you saw the rise in the unemployment rate, almost 4.5 on the unemployment rate. I think the Fed would want to provide a little bit more insurance. And then I think Governor Waller's comments around meeting by meeting, I think that's what we're looking at next year, where if the economy does slow down more, the labor market slows down more, they'll cut a lot more. But I think provide this one more cut and then base it on data. And I think the Fed will get more reliable data only next year. So provide this one cut, then wait for that reliable data and play it by ear.
Well, there is the argument out there that, the difference between December and January is not that much. If it doesn't happen in December, it'll happen in January. But that's a 6-week gap, because the FOMC meeting doesn't happen until the very end of January, at which point we might even be looking at another government showdown or what else have you. Would it make much of a difference to the economy if it had to wait 6 weeks for a cut and the labor market was getting more fragile?
Yeah, monetary policy works with a lag. So whether they go in December or Jan, even though it is 6 weeks, it may not matter as much. I think it's the messaging from December. So if they don't cut, but we get the press conference, we get the dot plot, and if in that the Fed suggests, and Chair Powell suggests that another cut is imminent, I think it really won't matter. If the messaging is that we're at neutral and we're worried about inflation or fiscal easing in the coming months, and the Fed might be done cutting, at that point, I think you are going to get rates moving, and that's going to, I think, filter through sentiment across markets. So it's more than just that rate cut. I think if they don't cut, they still signal cuts in the dot plot. So I think the market may take comfort in that.
Is there any concern for the current leadership that, sure, they've done an insurance cut, and yeah, maybe it would be nice to do another insurance cut, but given that the Fed is very likely to skew a lot more dovish next year, perhaps hold back on a cut, and then maybe the economy won't suffer too much if there are too many quote-unquote cuts next year?
That's a fair point, I think, but if you listen to Fed speak, I think the concerns around independence seem to be a little less. The chair is extremely important. The chair will build consensus, and so the chair decision is really important. But we've heard from so many Fed officials with different views. And so I think there's clear divisions at the Fed around risk management and which is a bigger risk, inflation or the unemployment rate. But I think this is a message to any incoming Fed chair, that they've got a committee with views, diverse views, a vocal committee that's not just saying what the chair wants. I actually think it's improving the idea of Fed independence. That you can get, even if you get a very political Fed chair who's skewing dovish, the rest of the committee might entirely take the other side. And it is a democracy, it is a committee at the Fed. Everyone has the same vote. So I actually think this whole debate, this very public debate from the Fed, whether inflation's a bigger risk or unemployment rate, actually makes the Fed look more independent, and it makes the Fed chair's job to bring consensus so that you don't have a 6-6 dissent type issue.
The bond market has been very well behaved, actually, through all of this, right? I mean, when you think about it, so sure, we've been moving a few basis points here and there, and the odds definitely have been moving way up from, just more than 30% to sort of 75% of a cut. But the 10-year yield is still in that range that you talked about, 375 to 425, right?
And we got a lot of pushback with that range, because people were saying, why can't we get to 5%? Look at the deficit, sell America. Well, I think we're not seeing Sell America. We have auctions every other week, and the auctions are going okay. So, yeah, great point that bonds have been extremely stable. I would also say bonds are doing what bonds should do. They're giving you income. There's a reason why it's called fixed income. They are giving you that coupon income, and they're acting as a diversifier. I mean, we saw this last week. You had these days where equities were struggling, bonds were acting as that diversifier in the portfolio. So I think one of the reasons why bonds have been so stable is people are seeing that diversifying aspect of bonds. And so when they are over-invested in equities or they get a little nervous about being too positioned too long there, they're buying bonds. So I think we are seeing that demand. High quality bonds, so I think investment grade, high quality, high yield treasuries are seeing that demand despite a lot of supply. There has been a lot of supply.
Are you seeing a lot more inflows? Are you getting a lot more, phone calls and questions since the AI bubble talk started?
We are seeing inflows. And I think it started even before that, and it's absolutely increased because people are seeing price action. I mean, you might have a view, but when the market confirms that view, it makes you feel better. And so we are absolutely seeing inflows, a lot of inflows from passive to active. And I think that makes sense because dispersion is picking up. I think this is not the time to be in passive anything because, this is not a case of the Fed's easing to dovish territory, all assets will go up. I think you're seeing that dispersion with company earnings, so whether it's equities or fixed income, but we're seeing passive to active. We're also seeing people saying, well, if the Fed's going to keep cutting cash, which felt really safe at 5% Fed funds, and now, you think, oh, well, maybe it's going to go to 3%. So we're also seeing money that was on the sidelines saying, you know what, let's extend out the curve because duration is less risky now because inflation is less of a concern. I mean, we did get that CPI report, and all of the data suggests that inflation is slowly but surely getting to 2%. And inflation is the problem for bonds, but I think we are seeing the inflows from all sides.
And I know you're not expecting it to re-accelerate. Priya, thank you so much for coming into studio today. That is Priya Misra of JP Morgan Asset Management. Now, to other top stories trending on the terminal this morning, President Trump still working on a proposal to address a spike in Obamacare health insurance premiums. The White House has not confirmed when the proposal will be unveiled. Treasury Secretary Scott Bessent had said it would be announced this week. Apollo CEO Mark Rowan has rejected the notion that adding private assets to retirement and insurance portfolios can pose a systemic risk. Rowan said, quote, people have really just lost their minds and the headlines get more and more hysterical. Rowan told investors that most private credit held by insurers and pension fund buyers is rated investment grade. Michael Burry is standing by his criticism of NVIDIA after the company pushed back on his analysis of its stock-based compensation dilution and stock buybacks. NVIDIA and rival AMD have sparked concern among some investors by making so-called circular deals with AI providers. Coming up, trading attacks. Russia and Ukraine carry out airstrikes overnight, just as President Trump cites progress in a peace deal. More on that next. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
We have two crises, two essential crises, and for both it's now or never, democracy and climate, and they are absolutely interlinked. and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Just hours after President Trump struck a positive tone on prospects for a ceasefire deal, Russia and Ukraine exchanged fire with heavy air raids on Kyiv and southern Russia. This as delegations from Washington and Moscow are set to meet in Abu Dhabi. Bloomberg's Suzanne Lynch joins us now. Suzanne, peace plans are being thrown around. Russia says it hasn't seen the first one, it hasn't seen the second one, and yet these airstrikes continue. Is there any hope to be placed in this particular peace process?
I think there is renewed relief around the world that the initial 28-point plan that was presented by the US has, it seems, been amended in some way, has been pared back, and is now reflecting more of the Ukraine perspective on this. I think it's fair to say that Ukraine and US international allies were taken aback by the content of this plan. And those talks that happened in Geneva on Sunday did appear to make progress. Now, as you heard there, Donald Trump himself is predicting that some progress will be made, but a lot will hinge on the Russian response to this revised plan, with that meeting taking place between a senior US official and a Russian representative today in Abu Dhabi. But it does look for the moment that the initial Thanksgiving deadline for which Ukraine was under pressure to reach a deal has now been pushed back, and these talks will continue for some time.
Well, at least they're talking. I mean, in another theater, there's talk as well, but it's just annoying everybody, apparently. China and Japan trading barbs. China's foreign ministry out this morning saying that the people's feelings were hurt. I mean, it's getting very emotional. But President Trump has spoken to both leaders and apparently had a good conversation with both leaders. Can he calm this spat?
This is an interesting moment for Donald Trump when it comes to Asia and his Asia policy. He is really trying to strike a balance here between two powers, China and Japan. Japan, obviously an important ally. Donald Trump wants to keep them on side. At the same time, he is looking to find some kind of a longer-term trade resolution with China. And is expected to meet Xi next April. So quite a delicate balancing act here for the US. Donald Trump, as we know, sees himself as something of an international peacemaker, but this escalating situation between Japan and China is yet another challenge, and one that has to be treated delicately.
Yeah. And then domestically, the president has decided to take on AI. He signed what he's called the Genesis mission to boost innovation with AI. How is this Genesis mission going to work, Suzanne?
Well, look, this executive order had been flagged for a few weeks by the administration, and really it is an effort by the Trump administration to federalize, if you like, AI policy, to try and bring these different operators or different regulatory systems and different investment ideas behind AI together, and to give more of a role to the federal government in terms of regulation. Look, Donald Trump is saying that this is akin to maybe the space race, that this is a big moment in terms of harnessing scientific, technological power and ensuring that the United States is on top when it comes to the AI race. Of course, the US is not alone in this. All countries around Europe, around the world, in Europe, Japan, we've just been speaking to, and of course China, are very aware of the opportunities offered by AI and are trying to get ahead in this race. So I do think this is an important marker by the US in trying to advance this. Let's see, does the investment go? Does the investment flow and the regulatory system adapt to make this happen?
Suzanne, amazing context. Thank you so much for joining us today. That is Suzanne Lynch. And sticking with technology, Alibaba just out with its earnings, revenue topping estimates thanks to AI and cloud growth. And you can see the ADRs there moving pre-market pretty nicely up, more than 4.5%. Bloomberg Tech Europe host Tom McKenzie is back with us. So how did Baba do it, Tom? Where did it exceed expectations?
Yeah, Vonnie, an interesting time as we talk about those tensions between Japan and China and the moves by President Trump to secure the lead that the US currently has when it comes to AI, because Alibaba really is a litmus test in terms of how far and how effectively China is particularly pushing the adoption as well as the innovation around AI. So the top lines on revenue, yes, it was a beat. E-commerce was also a beat for Alibaba. This is a stock that's already up about 100% year to date, so it's had a massive run up. But the focus of scrutiny really is on how it is delivering on AI. And the key part of the business, because this is a multifaceted business, Alibaba, the key focus when it comes to AI is the cloud intelligence unit. And there you saw growth of 34% growth in terms of the cloud infrastructure bit, showing that demand from their end consumers and enterprises in China to ensure that they have access to those cloud offerings of Alibaba. So that is good news. We're also hearing from executives saying that they are going to be investing free cash flow into future innovation. So read into that AI. This is after 4 straight quarters where CapEx and spending on AI infrastructure, according to executives, came in at about $17 billion US. This is a company as well that's had recent success with its own relaunched chatbot, with a lot of demand from Chinese consumers for that as well. So it seems to be Alibaba continues to be well positioned to lead domestically in China when it comes to the AI story, a company that has really reshaped and reformed its focus around AI innovation and getting it into all of its end products and uses.
And of course, huge competition for Alibaba with Tencent and Baidu as well. And speaking of competition, here in the US, Alphabet is gaining because Meta is going to use its AI chips, its TPUs, as opposed to NVIDIA's GPUs. And NVIDIA is down more than 4% pre-market. Is this a harbinger of things to come, Tom?
Yeah, this is, according to reports, that this potential deal is being struck by, of course, Meta, a company that's one of the biggest hyperscaler spenders out there, with potentially up to $100 billion US being spent next year just by Meta alone on this AI infrastructure. So the reporting suggesting that they have struck a deal with Alphabet to get access to those TPUs. It may not be that Alphabet actually ships the hardware, the chips, to Meta. It may be an infrastructure story similar to the kind of deal that we've had between Anthropic, of course, a key rival to OpenAI, which recently secured access to about 1 million of Alphabet's TPUs. These are the in-house built chips on which Google and Alphabet have been training their own Gemini model, as well as the inference as well. So it seems to be further evidence that customers and end users of these AI accelerators are looking to diversify away from NVIDIA, and hence the pressure on that stock.
All right, Tom, thank you so much. We'll see how everything trades throughout the session. That is Bloomberg's Tom McKenzie. Retail earnings also on deck this morning. We're going to hear from Best Buy, Kohl's and Dick's Sporting Goods, all before the market open. Let's get a preview now from Bloomberg's Maddie Parker. So, Maddie, we've seen how the consumer has been faring from some other big retailers. What about these ones? What can we expect from these big retailers?
Yeah, exactly. So if we look at Best Buy, that's obviously one of the big results coming out today. The good news for Best Buy is that we're finally seeing some signs of sales growth kind of emerge. We've had a very rocky 4 years, but in the last quarter they were able to reverse that, and we're expecting to see that momentum kind of continue. This is clearly one of the key back-to-school periods. This will benefit Dick's as well. So obviously people are buying laptops, they're buying tablets, they're buying sports equipment. So hopefully that will come through in some of these results. In terms of Kohl's, which is obviously another key result coming out today, things are looking a little bit more difficult. We are expecting to see same-store sales decline. They reported declines for the first half of the year, but clearly it's been a difficult time for the brand. They've had a lot of CEO turnover. So I think these results will actually be more of an indicator in their case to their new CEO, who was appointed just yesterday, in terms of how they're going to navigate this time.
So as always, some idiosyncratic stories and then some stories about the US consumers. So how is the consumer looking as we head into the Thanksgiving and the broader holiday season? Still a K-shaped consumer?
Yeah, we sort of, the kind of story of the whole year has been a lot of, negative consumer sentiment. Clearly, there are big macro concerns that are hitting the consumer. Things like, very stubborn inflation and unemployment, and also things that retailers have been warning about for a long time, like how tariffs can impact prices. Having said that, there are definitely stories coming out lately that American consumers are actually likely to be spending more this Christmas than last Christmas. We think that people are actually a little bit more positive about their finances than we might think, and hopefully that will come through, in sales and kind of give some hope to retailers in this festive period.
All right, Maddie, it's going to be a busy day for you, but thank you so much for making time for us. That is Maddie Parker covering all your retail earnings. Well, coming up, we'll get you set up for your trading day with more of those earnings and lots of economic data on deck. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
You up to the minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg. Now, a look at what's ahead this Tuesday trading session. Huge consumer theme today. We're going to hear from several retailers, Best Buy, Kohl's, Dick's Sporting Goods, among them. But we also get September retail sales data out at 8:30 New York time. Maybe a little stale, but we do get the Conference Board Consumer Confidence Survey out at 10 a.m. Eastern, and that's for November. A few micro movers, as you can imagine. Google and Nvidia both moving on this report that Meta is going to use Google's AI chips instead of Nvidia's GPUs. Nvidia down 4%. That'll weigh on this market. And then SanDisk up 2.6%. It's up more than 500% already this year, and it's replacing Interpublic in the S&P 500. Take a look at the macro picture for your Tuesday session. Futures pointed just a little bit lower, though well off their lows, and the 10-year yield at 4.03. That's it for Bloomberg Brief. Surveillance is next. This is Bloomberg.
The aim here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
The reality is the fundamentals are still sound.
I don't think we have yet seen the real bubble trade in AI.
The market's done a little bit of work here to take some of the froth out.
I think you could have a situation where the Magnificent Seven become a little less valuable and the rest of the market becomes more valuable.
We think there's a broadening out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks taking a breather after the biggest two-day gain since May, with investors looking out for retail earnings and data later this morning. President Trump lowering the temperature even further with China, with plans to visit that nation in April. And Alphabet exerting a new influence over the Magnificent Seven, with futures surging on reports that they're posing some competition, Danny, to NVIDIA.
I just want to extend my sympathies for everyone like us who have had to all of a sudden do a deep dive on TPUs versus GPUs, but that is the place we're in. There's some real churn underneath the surface of tech of who is the winner of AI. The market still hasn't fully decided that. The price action, I think, will be interesting today. Can you continue to get a rebound if NVIDIA isn't playing along, even if we've decided, at least for now, the new winner is Alphabet?
Yeah, can you get a dispersion in the Magnificent Seven, in the big tech space, and not have an overall market rollover? This is the key question. We saw this yesterday when there were questions about OpenAI and Google once again posing real competition to the entire model with more profitability. And now a real question of whether they could supersede, maybe not NVIDIA, but clearly the other Magnificent Seven. It's clearly right now number 3 in terms of market capitalization, very much on course for $4 trillion.
And it's added so much to the S&P 500, just given the rally we've seen over the past month. So does it mean that we have all of a sudden have chips that are more energy efficient, that have better use cases, not as broad, but more efficient at doing the task at hand than NVIDIA? The problem with that is that NVIDIA has created this really complex web. So it's not just NVIDIA that suffers, it's Microsoft, it's SoftBank whose shares are getting killed today. OpenAI maybe has a problem, Anthropic has a problem. Just these interrelationships mean that it's bigger than just one company specific.
This is clearly an area that is rife for some sort of disruption, which is very clear to a lot of people, increasingly so as we see some of this price action. We'll get into your studies on GPUs versus TPUs because you'll whip out your PowerPoint presentation, and I'm sure everyone will actually be really interested in it. We do get a bunch of retail earnings this morning, and I think it's
it's interesting. Before the market opens, we get Burlington, Kohl's, Best Buy, Dick's Sporting Goods, Abercrombie & Fitch. After the bell, we get Urban Outfitters. To get these earning reports in the kickoff season of the holidays really creates some possible visibility into consumer appetite.
Because I think there are now some serious questions being asked about the consumer. There are being more cautious things put out there. BMO, for example, did a survey of 1,000 consumers, and they say that holiday spending will be more modest this year. There was also a report on Carnival from Barclays yesterday that said we went and we surveyed the management, and they also seem more cautious. Cruise lines have been these things that people have pointed to, saying, look how good the consumer is. What happens if that's starting to soften?
Yeah, and yesterday you did see about half of the S&P 500 stocks not participate in the best two-day rally going back to May, including Carnival shares, to exactly that point, because of this fear around the consumer. Later this morning, we also do get retail sales data coming out for September. Some interesting Fed speak over the past 24 hours. Mary Daly lining up very squarely in the camp of Chris Waller and potentially John Williams to cut rates. She's not a voting member, but she has never departed from what Fed Chair Jay Powell has ultimately voted with, and it really is signaling to markets, guess what? They're going to cut.
And this is what it's come to, right? Of reading tea leaves, trying to figure out which way Jay Powell leans, because we haven't heard from the man himself. And just given how divided the Fed is, the thinking goes is that Jay Powell will have the ability to sway to cut or not to cut. And to your point, because Mary Daly is so aligned with Chair Powell, we're looking to her for direction.
So right now we're looking for direction in equities. You are seeing a bit of a bounce back from earlier lows, still off though, still lower, down about 0.1% on the S&P futures. You are seeing yields just marginally creeping higher on the long end. Yesterday we did see an auction that did tail 10-year yields 4.03%, still lower than where we were yesterday, and crude off at just about 1/3%. Coming up this hour, Peter Shear of Academy Securities with stocks coming off their best day in 6 weeks. Ed Al-Husseini of Columbia Threadneedle on why AI may not have the impact on economic productivity that so many people think. And former senior White House trade advisor Kellyanne Shaw with fresh talks between the U.S. and China. We begin this hour with stocks edging lower as investors count down to retail earnings as well as data. Peter Shear of Academy Securities writing, the end of free money has been a major factor in the recent downturn and could weigh on the economy and markets going forward. I think the economy is at a greater risk than we've seen in some time. Peter joins us now. Peter, great to see you.
Good to see you too.
This seems to be echoing what we heard from Neil Dutta yesterday of Renaissance Macro, where he said that he thinks the train may have already left the station when it comes to Fed rate cuts and the potential damage that has been foisted upon the economy. Why are you so negative as well?
So what I'm seeing, I think, is what we're calling the end of free money, and kind of being a bit cavalier about that. But there was a time, right? If you announced you were spending X billion on data centers or AI, your stock went up 2X. And all of a sudden, now you're seeing people question that. You're seeing stories emerge about, ooh, which technology should we use? So I think we're going through this breather, right? A year ago at this time, if you didn't have an AI strategy, you were ridiculed as a CEO. Your stock was going to suffer. So there was spend, spend, spend. There was this kind of real rush to spend, spend, spend. Now I think everyone's sitting back, okay, what do we want to spend on? What is the best value? And the hyperscalers, right? All of a sudden, you can't just say you're going to build more and your stock goes up. So this is kind of this first time I think we might see a bit of an AI diet where people are like, okay, how do we be cautious on this? Where do we spend? What do we spend on? What technology is emerging? We haven't talked about anything out of China yet that could derail some of our stocks. So I think this is where we get a bit of a slowdown right now.
Before we get into the details of the AI trade, you said the end of free money. And I want to dive into that because yesterday we were talking about tightening liquidity conditions. Now, a lot of people attributed that to the sell-off that we saw in things like Bitcoin and also the big tech names. Why is this now the end of free money with the Federal Reserve cutting rates and ending quantitative tightening?
Well, you've also seen, coming back to some of the crypto, you had the DACCOs, or the digital asset treasury companies. Some are very sophisticated, some do a lot of things, some simply buy the underlying. And there was a period of time, right? If you bought X amount of Ether, your stock went up 2X. All of a sudden, that's not happening. So all these trades that were kind of self-perpetuating are falling down, and you're having a bit less liquidity come through this. And everything I hear and see when we're talking, whether it's consumers, corporate, I feel there's belt tightening going on everywhere. I think people are going to be a little bit surprised as they go through the budgeting process that companies are actually shrinking their budgets rather than growing, full scale.
What do you think the administration does in this? Because we were speaking with the Commerce Secretary yesterday who was beating the drum saying AI has been such a boon for our economy. David Sachs, the crypto czar, which also has an ear to the administration, was putting on X yesterday that it is an AI-related investment accounts that half of GDP and a reversal would risk recession. Is this an administration that would see this sector as too big to fail, as Sam Altman has hinted at to the chagrin of others at OpenAI?
You know, what I think they are doing, and I think it's rightfully to do, is investing heavily in electricity and energy production, right? We are putting money into nuclear, we're putting money into everything that's really the bottleneck right now is this electricity. And supposedly that's one of the arguments with the TPUs versus the GPUs is lower electricity usage. So I think electricity is actually a bottleneck. I see the government spending a lot of time on that, which fits very much, I know you're sick of hearing it, but production for security or PROSEC. I think they are trying to figure out I think these are the things that the government's trying to make sure goes along. I think it's gonna be hard for them to intervene directly in AI, but yes, if we get this AI slowdown, unless other parts of the economy really pick up, we are going to see that this potential, maybe not a recession, but a slowdown, and that's why I'm concerned.
How does the wealth effect play into that? Lisa's been talking about how just more of everyday people, of households own equities at this point, and a lot of the gains in equities have been tied to AI. If AI starts to take a breather, what overall wealth effect does that come back and have on the consumer?
Well, I think we've already seen a big hit to crypto, right? Bitcoin itself is down $650 billion, and it seems to track very well. You know, I always use ARKK as a proxy for disruptive, stocks. Those stocks are down. So you've kind of seen this big move in certain segments of the market. Almost anything momentum related is down. So I think you've already seen a chunk of wealth wiped out for people who would spend that money. So I think we need to see this turnaround, or you're going to see everyone, hey, maybe we got to be a little bit cautious, right? We are kind of, everything's going to the moon. Crypto's going to 200,000, whatever the number is. All of a sudden you're sitting here at 86,000 on Bitcoin. I think it does create this negative wealth effect where people are going to be conservative coming into their spending.
So there are three ways to look at this. There's one way to look at it saying, okay, this is going to be a recession next year that no one's expecting, which is typically how it happens, which is what we heard from Neil Dutta. Then there's a way of saying that actually there's going to be a rebound early next year because of the tax refunds and other types of stimulative effort, but that there will be sort of this flagging growth. And then the third way of looking at this is it is going to be morally hazardous for either this administration or the Federal Reserve to allow this market to crater. So you're going to see this bazooka of stimulus coming from quantitative easing, from Fed rate cuts, and from fiscal that will ultimately propel this market higher. Where do you fall in?
I do think coming into the midterm elections, we are going to see a huge effort. I think Trump and Trump 1.0 learned the pain. If you don't win the midterms, it's really hard to govern your next 2 years. So I expect a lot of stimulus coming into that. And I have liked, for example, my favorite trade right now has been to be underweight NASDAQ 100, so QQQ in ETF form. And I like the S&P 500 equal weight. So RSP is one, ETF that you can use for that. And I think you're going to get this bit of a rebalancing, right? Some of the air is going to leak out of the AI. Some of it should be transferring to the rest of the economy. And that's why I like kind of the equal weighted S&P 500. I think as we take away investor focus from the AI to electricity, which is still going to be a part of this, but what else is going on in the economy? What else are we building? What are we making? We are going to be trying to build manufacturing plants. We're going to be trying to build mines. We're going to be trying to build refining and processing companies. So there will be activity, and I think that's the area that's going to shine next year.
If you are defensive, can you go into long-term bonds with the expectation that this is an incentivized Federal Reserve to ultimately bring down long-term costs in whatever type of financial engineering it requires?
Normally, I would say yes, but I'm kind of stuck more on the belly of the curve, 5 to 7 years. I just think there's going to be some outward pressure on the 10s and beyond as people are nervous. Did we cut too much? Are we being too aggressive? Are we paying attention to inflation? So I think that's going to diminish a bit of the rally there. So I kind of like the belly of the curve. I think you're going to see 2s10 spreads actually go potentially to 100. So I could see us down at 3% on Fed funds, and I could still see a 10-year close to 4%.
Are you getting those vibes from the Fed that they are going to be forceful in their cuts? We heard from Chris Waller yesterday saying, yes, December, and then it's meeting by meeting.
I'll be slightly embarrassingly honest. I'm not really paying that much attention. I think we are going to get a new administration. The Fed's going to look very different next year. We're going to get to 3% before the middle of the summer. I don't really care whether it's a cut in December or not. That's kind of my base case, right? This is the direction we're headed. It's going to come almost hell or high water. So that's kind of how I'm thinking about it. I'm spending less attention to who's talking today and tomorrow. Look who's going to be talking in the future. We know we're getting these cuts next year.
I love it. It tells you something, Danny, when Peter Scheer is not keeping track of each Fed speaker. Maybe they have no clue, and it's completely divided.
Also a great way to preserve your sanity, I think.
100%. So congratulations for being sane. Peter Scheer, the sane one, is going to be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Good morning, Lisa. Fighting between Russia and Ukraine continuing overnight with heavy Russian drone and missile attacks on Kyiv and Ukrainian assaults on southern Russia. The exchange is coming after President Trump suggested, quote, big progress was being made on a deal to end the fighting following weekend talks in Geneva. White House Press Secretary Caroline Leavitt says he still hopes the deal can get done by Thanksgiving. President Trump and his Chinese counterpart, Xi Jinping, held their first talk since agreeing last month to a tariff truce. Trump says the call was very good and touched on issues such as trade and Ukraine. He also says he will visit Beijing in April and that he invited Xi for a state visit next year. Shares of Google parent Alphabet rising in the pre-market on reports Meta is in talks to spend billions of dollars on the search giant's AI chips. The information reporting Meta plans to use Google's Tensor processing units, or TPUs, in data centers from 2027. An agreement would help establish TPUs as an alternative to NVIDIA's GPU chips. That's your Bloomberg Brief. Lisa.
Thank you so much, Vani. All right, this is the time. Just 5 minutes.
Oh, wow.
5
okay.
seconds.
Thank you. I'm so honored.
GPU versus TPU.
Okay.
30
GPU,
seconds.
NVIDIA's chip, originally for graphics processing, so it takes a lot of energy and has a lot of broad applications. TPU, built by Google, very application specific, so more efficient, maybe a better chip, but people are already using a lot of NVIDIA chips, and there's a kind of locked-in thing to it, so it's hard to get to the other one.
This is the debate. More energy efficient, although more restrictive, or potentially more expensive, energy intensive, but flexible. The race is on. Up next, we're going to be talking about lowering the temperature with China.
It lasted about an hour, and it was a very positive call. The focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction.
Bloomberg's Michael Solner joins us next. This is Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Stocks just kind of meandering here, dipping just a touch after yesterday's surge, the biggest in 6 weeks for the S&P 500, the biggest two-day rally for the S&P and NASDAQ going back to May. Today, taking a little heat out of that, down about 0.1% for S&P futures, seeing yields just up marginally, but still lower than they were to start yesterday, 4.03%. Meanwhile, take a look at NVIDIA and Google, Alphabet in pre-market trading. A huge dispersion here in the fates of the two, and they're connected with Alphabet shares up 4.1% in pre-market trading. NVIDIA lower by 3.6%. On that news that Alphabet might be gaining some clout in the TPU game. We'll get into that coming up. Under surveillance this morning, lowering the temperature with China.
I did speak with him about the call. It lasted about an hour, and it was a very positive call. The focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction. And the president and President Xi discussed continuing to stay in correspondence.
Here's the latest. President Trump saying his call with Chinese President Xi went well. The two leaders now planning in-person meetings next year. Bloomberg's Mika Solner joins us now. Mika, what was the understanding of what was discussed in that hour-long phone call between Xi and Trump?
Yeah, so the president and the Chinese president spoke for roughly an hour, largely focused on trade and trade negotiations, particularly around soybeans and how, you know, China is impacting U.S. farmers as well. So that was a large focus of the call. But the two also touched on Ukraine-Russia war briefly. But I know that, you know, there's been significant steps taken with the two promising to see each other in person next year.
Mika, the two readouts, whether it was from China or from the U.S., were vastly different. The one from the U.S. was talking about trade as well as a little smattering of Ukraine-Russia. The one from China really focused on Taiwan. Can you talk a little bit about that huge difference between the two readouts?
Yeah, I think that's really interesting, and I do think that there's going to be tension around Taiwan. I know that that's a big priority for the administration, but I also think that President Trump really wants to have a good relationship with China. I think that it's you know, really different from previous administrations in the way that he negotiates with countries considered to be U.S. adversarial to the U.S. So you know, there's going to be a lot going on and a lot of reaction from China hawks as well in terms of what's going to happen, particularly around Taiwan.
Mika Solner of Bloomberg, thank you so much for that. Peter Shear of Academy Securities is still with us. Mr. Prosek, let's put that hat on, because ultimately this really does go down to what is your takeaway? Does this have more consequences potentially for Ukraine, Russia, or potentially for Taiwan?
I think probably more for Taiwan. So when we're looking at this, and again, I work with 30 retired generals and admirals, a couple CIA people, so we spend a lot of time on where this is all playing out. And I think as we're having conversation with clients, we're reminding, one, Xi said he wants his military to be ready by 2027. It's not a sign that he's going to do anything in 2027. But we've always thought what's going to happen is there's going to be a multiple application of the levers of power. So the levers of power are diplomacy, information, military, and economics, so the DIME framework. I think they're going to put so much pressure on Taiwan that Taiwan may eventually just say enough's enough. And we are seeing the U.S. pivot a little bit away from the kind of this global, policeman of the world to really focused on domestic, right? North-south, the Monroe Doctrine seems to be taking place again, right? We moved the Ford into the aircraft carrier into the Caribbean. So there's this big domestic focus. So I think there is some risk that Taiwan feels a little bit maybe left out, a little bit nervous. And when we look at trade negotiations right now, the two things that I think China has some power over us are still the processed and refined rare earths and critical minerals. So on PROSAC, I think we are trying to do a lot of that. I am convinced that this administration, from some talks as well, one, we want to produce the rare earths and critical minerals, but really we want to make sure we can process and refine them to break that lock that China has on us. We control the chips. We control the best quality chips. Again, maybe now we throw the TPUs into that. Those are things China wants. At the same time, China controls a little bit the ability for Taiwan to ship things. So far, China has not done anything, but they do have this very, very large maritime militia. They've used it in the past in little incidents, but they could put this to work. It's largely shipping vessels. They have larger vessels within that, and they would just disperse themselves in such a way that it would slow shipping down. They would throw logs off back. They would throw nets trying to foul propellers. So they could do a lot if they really wanted to push on us against Taiwan. So I don't know where this is all headed, but it feels a little bit parcel and parcel where we're focusing a little bit more north-south, Monroe Doctrine, and maybe China has a little bit more control in that region.
Where does that leave someone like Japan, who has been leading on the U.S. alliance in their current heightened tensions with China after the Prime Minister made those off-the-cuff remarks that they would support or take action if China had military action against Taiwan?
I think it leaves everyone a little bit questioning, what is our mission, right? The Biden administration was very clear that we would support Taiwan. Trump has not been clear so far. And our official doctrine before Biden had always been ambiguity, right? So strategic ambiguity has been a part of this. The one thing, to me, it comes back, and we've been talking to clients about this for 4 years, and people used to kind of roll their eyes at us, and now I think they're listening, is shipping, you have to diversify your supply chains along shipping routes. You cannot be dependent on one shipping lane. So Thailand and Vietnam, you're not diversified. They're going through the same place, maybe even South Korea. So I think this this as a kind of a huge wake-up call that everyone has to look at shipping as a bigger risk than we ever have in the past and say, hey, what happens if? And maybe it never happens. Maybe we go on living peacefully and we have these great economic deals that allow it. I think we have to prepare for more and more deglobalization and more risk.
That's so interesting you say that, because I've had conversations with private equity executives who have companies, lots of them that need to deal with supply chain issues, and they've said, we've done such a good job since Trump came in as president because we've de-risked from China, and now we're in South Asia. To your point, we're in Vietnam, we're in these places that still might feel blowback should there be a larger scale conflict. Are there other options? Is the supply chain resilient enough to completely move away from that region, even if it's not China?
No, but I think you can diversify. You can have some there, you can have some other reasons, because you are going to want to try and sell into that region, right? India is a huge growth story. There's all sorts of opportunities. So you want to be there, but I think you want to look at South and Central America. What's going on there, right? Whatever happens, how do we do better with Brazil? So far, Brazil's been tough. We are working closely, I think, with Argentina. So I think there's going to be a lot of opportunities in that north-south. And again, keep coming back, and lots of things I've learned not being military, but they talk about at Academy Securities the tyranny of distance. So in war, it is really hard to fight a war if you're far away. If you look at where Guam is relative to Taipei or Taiwan, it is a very far distance. It's going to be hard for us even when we try and do something to support that relative to what China. They have the same problem when you look at Central and South America. And let's not forget, the first place Marco Rubio went was the Panama Canal. That has never really happened in our history, right? The Secretary of Defense, Secretary almost always goes to the UK. He went to the Panama Canal. So there is something shifting in this administration. So I pay close attention to that. And if you want to be where the U.S. government's going to protect you and do the most, I think it's pretty clear to me you want to be edging or favoring North and Central and South America over Asia.
5 years ago, when the pandemic was raging, everyone was talking about the deglobalization and this idea that you had to build in sort of inefficiency in your supply chain to create redundancies. It was going to be inflationary. Now we're not talking about inflation. We're talking about disinflation from artificial intelligence, even as we see an acceleration of this trend of being more regional. Is there still an inflationary overlay to this that's the reverse of what globalization provided?
I think there is as it comes online. There is going to be some pressure on commodity prices. If we really start building these factories, if we build out the energy production that we need or electricity production, we are going to see levels of inflation that have been higher. I think it's persistent, say that 2.5% to 3.5%. It's not going to get out of control. But over time, we've also built a much more secure system. I think costs will go down over time, right? If you're not shipping things long ways. Again, I just keep coming back to, I really believe this kind of concept of production for security is going to replace kind of ESG. When we're thinking about sustainability, it's going to be much more like, what do we need at the base? And this is going to sound wonky, but I look at Maslow's hierarchy of needs. I always think that's probably the most useful course I took with Psych 101. But it talks about you basically need shelter, you need food, and all those things before you can move up to self-actualization. And we are kind of at the self-actualization. What we would like, I'd love to do this, I'd like to do these things. And then we realized we had our base eroded. We cannot produce the things that we need. How can you be safe or sustainable if you're not making some level of your basic necessities? So I think that's where we are headed. I think the government's the first to see it. I think capital is already starting to flow into it. So capital is going to be second. Corporations are going to adopt it. And I think Europe's going to start following. I think Europe's going to fight it a bit more tooth and nail. But ultimately, they're going to get dragged into this where you have to produce your basic necessities or some portion of it yourself and work with close allies, because you cannot just rely on China to be your friend.
Peter Scheer, thank you so much for being with us. Always really illuminating. Peter Scheer of Academy Securities, and this kind of goes to the heart of the issue. I remember a year ago when APEC was being held in Peru, and there was a real question over who is going to win the war right now. Is it going to be China or is it going to be the United States for one of the most important reserves of copper, of pretty much a ton of minerals that are absolutely essential to our modern world?
I remember when you were there, and the reporting you did was China is so present at this conference. They're present there. They're present in Africa. What does the U.S. do about that? To Peter's point, as they increase their reliance on those beneath us to the south of us.
There were Chinese flags. Xi came. He was going down the board. Everything stopped. Real difference in tone. Coming up, we're going to be talking more about the emerging markets as well as artificial intelligence with Ed Al-Husseini of Columbia Threadneedle, who thinks that maybe AI productivity gains are overstated.
issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
We are heading into the open about 3 hours away. Right now, what we see in the morning futures is lower across the board after the biggest one-day gain going back 6 weeks. NASDAQ leading the charge lower, down 0.3% despite the gains that we're seeing on the likes of Alphabet. What you are seeing yesterday was the biggest two-day pop for both the S&P and NASDAQ going back to May. Optimism around potentially Fed rate cuts. Take a look at 2s, 10s, and 30s. You do see a bit of that optimism fading, but definitely below where they were yesterday. 2-year yields getting a bid after we heard from Mary Daly that she was inclined to cut rates next month. She is not a voting member. Nonetheless, she tends to work with Jay Powell and tends to agree with him. John Williams also on deck for a cut. I am the one who's actually watching, Danny, and counting each of these. It looks like it's pretty evenly split right now with a lot of undecideds, and a lot of people are saying this is up to Jay Powell to decide whether or not this is a Fed cut or a Fed hold.
Which is why Mary Daly was so important, because to your point, she's very closely aligned with him. It's a very different environment. We've moved away from consensus building. And I also think interesting in that Mary Daly article, interview with the Journal, was she said, this is a good thing, this is a healthy thing, you don't want groupthink. The question will be whether that protects the Fed or exposes them in an era where you have a Trump pick at the top of the helm.
Yeah, and whether it gives any kind of guidance at a time where the guidance aspect is very much part of monetary policy transmission, which is a key question. Right now, we are 3 hours away from the cash open. Let's get some morning movers with Vonnie Quinn. Vonnie.
Well, Lisa, it is all about AI today, so let's take a look at these companies because you've been talking about it already this morning, TPUs versus GPUs. Remember, NVIDIA was great at making those graphics processing units. Well, now Meta is in talks, apparently, according to the information, to buy billions of dollars worth of TPUs from Google, the Alphabet company. Obviously, that could have an impact on NVIDIA going forward. Now, is this the very, very beginning of maybe what looks like the end of dominance for NVIDIA? Maybe, we'll see. But the shares are definitely suffering. Pre-market down 4%. AMD also along with it down 3.5%. And the Google parent up more than 4%. Let's switch it up because we are now looking at Alibaba. Just reporting this morning, we were talking about Qwen yesterday and the relaunch of all of its AI tools and its push into that. Its rivalry with Tencent and with Baidu, well, paying off apparently in the quarter. The ADR is up 4.5%. Overall revenue was up 5%, but its cloud intelligence revenue up 34%. Massive growth in that revenue in the quarter. And then let's take a look at SanDisk because you mightn't think of it. It's a memory chip company. We all remember carrying around those thumb drives and so on. But this is also really an AI story. This was bought by Western Digital back in 2016, spun out this February, up 530% year to date since it was spun out, up another 2% because it is now joining the S&P 500, and that's been giving the shares a boost. But obviously, there has to be an AI portion to this. It's in talks for the build-out of large-scale data centers as well. So that's helping this memory chip maker today.
Thank you so much, Vonnie. On our radar this morning, tensions rising between China and Japan over the status of Taiwan. President Donald Trump holding back-to-back calls with the leaders of both countries. Any sign of the U.S. aligning with Japan could end up derailing its trade truce with China. Meanwhile, NVIDIA under pressure following a report that Meta is in talks to spend billions on Google's AI chips, millions, billions, trillions. The information reporting Meta plans to use Google's tensor processing units in data centers beginning in 2027. And real quick, TPU versus GPU, Danny, it is...
I wish I brought my PowerPoint with me.
Yeah.
Okay, TPU is Google's chips. They're specifically designed to do the tasks of Google's cloud, so they're very efficient, both in terms of ability to get work done and energy, versus NVIDIA's GPUs, which were originally built as graphics processors, so they do more tasks, but a little bit more clunky, take up more energy. So you could say Google's better. The issue is there's a lot of locked-in syndrome. It's really hard to change cloud providers because so many people already use those types of data centers with NVIDIA chips. It makes it harder to transfer to Google.
There is this 1-2 punch, and it comes to something we were discussing yesterday with OpenAI and this question of whether Google could potentially supersede it in terms of Gemini 3 and some of its capabilities. This next story about NVIDIA versus Google and the idea of Google selling chips to Meta just reiterates this feeling of disruption and this ongoing sense that the story that we're seeing right now in AI is not the full story. It is not the end of the story. This is just the beginning, and we're not really seeing the full iteration.
And it's still a market, you'd have to argue, that hasn't decided who the winner is. You could do the Dan Ives thing. He's just put out a note with his top AI picks. It's kind of literally all of them. So that is one bet and one way you could do it. But if anything, it's a market that is more discerning. And again, I think Alphabet coming in as a challenger is so interesting because they have so many corporate relationships. They have better brand power than OpenAI does. So who's to say, if they can get people to switch over, that they're not going to be the ultimate winner?
Yeah, and just to add on to this, SoftBank shares tumbling to a 2.5-month low, with investor concerns really coming out after OpenAI with respect to potentially Alphabet's Gemini 3 superseding OpenAI, which is part of the reason why people are wondering, what is this iteration going to look like? Let's stick with AI. Ed Al-Husseini of Columbia Threadneedle casting doubt on the so-called productivity boom, writing, AI will lead to an acceleration in automation, which has been a central feature of economic growth. AI will have no impact on aggregate economic productivity. Ed joins us now with that bold statement. Ed, why do you think that that's the case, given the fact that so many people are saying that is when this will start to pay off? That is when this will be disinflationary and not necessarily just the investment in nuts and bolts in the physical world?
Yeah, absolutely. Look, we've seen these waves before. The point I wanted to make is it's really difficult to translate technological innovation, which we've seen pretty much continuously over the course of the past 40 years, into aggregate economic productivity. That's extraordinarily difficult. It really requires us to reorganize how we make economic widgets.
So at this point, you're saying that there are implications for the fixed income world in terms of the ultimate payoff, right? Because it comes to not only the corporate debt market that's been fueling, funding a lot of this, but also it goes down to the expected inflation rate and just what kind of growth you can see on the heels of AI. So where do you think the biggest misunderstanding really is right now?
Yeah, I mean, part of the problem is we're channeling an extraordinary amount of savings now into the AI thematic. It's going to cannibalize to some extent the capital that's available to other parts of the economy, including the treasury market. We're in the early stages of this. The AI theme has just come to the investment grade market wholesale. It will be with us for a number of years, no doubt. But one of the risks is it starts to lift yields across the board and starts to make the cost of capital more expensive for other companies. That ultimately could be a drag on growth down the line.
This is a real crowding out, because not only in capital, but in manufacturing capacity, the way that energy is used too. So wouldn't that be a healthy thing if all of a sudden we've decided we've gone too far and AI backs up and the spending on AI backs up? Does that open up other parts of the economy to make use of this capital, make use of the energy, make use of America's manufacturing capacity?
Yeah, eventually that could very well be the story. We've seen this happen in other parts of the world. China is a fantastic example of this. It's gone too far. We're now seeing deflation, outright deflation, because of that capacity in China. It's very early in the story, but one of the risks is we've invested an extraordinary amount of capital, some starting with a T at this point, in the AI thematic, and some of that capital either depreciates rapidly or is stranded and doesn't contribute to economic growth.
What happens to private asset players who have all started to pour money in this? A lot of the conversation there is, we're not taking AI risk, we're taking meta risk, we're taking Oracle credit risk. If what you're talking about, that corporate bond markets also start to feel some of the pain, what does that do to this entire ecosystem of funding?
Yeah, it's quite vulnerable. Let me say this, the good news is we're starting with corporate balance sheets that are extraordinarily strong. These are high quality, high grade issuers. The corporate bond market, particularly the investment grade market, was practically invented for this. It's there to fund these themes. So it's going to be a while until we get to a point where it starts to degrade and we see whether it has an impact on earnings. But the fact that the story is so deeply interconnected is definitely a vulnerability. That's not a new theme, but it's going to be with us for some time.
So how much of a liability do you think this is for the Treasury market?
A little bit. And again, the good news is we're sort of focused on the narcissism of small differences. What is the Fed going to do in a couple of weeks? The AI theme doesn't affect that in any meaningful way. One of the core questions for the Fed in the next couple of years is, should we assume, the way Greenspan did in the mid-90s, that productivity is rising? That's a license to keep monetary policy tighter than it would have been otherwise. If they make a mistake, and look, Greenspan got lucky and he got it right, but if we make a mistake, that leads to lower growth, that leads to tighter policy, that leads to lower inflation in the coming years. And that's going to be a really, really interesting debate in both 2026 and beyond.
If this does lead to greater weakness and potentially overly tight financial conditions, at least for the rest of America or the rest of corporate America that hasn't experienced the AI boom, are you expecting this to be essentially disinflationary for the wrong reasons, right? The idea that it could actually slow growth and end up in a situation where the corporate debt issuance really suffers because the growth just isn't there to really fuel the returns and the profits in an ongoing way?
Yeah, let me start with the second part of the question. So if productivity does not materialize, or in other words, productivity is very concentrated in parts of the economy that potentially deliver earnings to these companies, it's fine. If productivity becomes more diffuse and the economy as a whole starts to lift, that's a license for, again, higher interest rates across the board. That's a license for a healthier growth story. That's something we saw in the mid-90s through the mid-2000s. Great outcomes in terms of inflation, fiscal, interest rate stability, and so on. The challenge for the Fed is, again, if we make the wrong assumption in the short term and we put that higher productivity story into our strategy at the moment, you could make a much stronger case for tighter policy, and that would be a mistake at this stage.
So if that's the case, what's your highest conviction right now heading into year-end, into 2026?
With respect to interest rates, look, I think we have a starting level of real yields, inflation-adjusted yields across the board that are still quite healthy. At the same time, when you look at the corporate debt market, where we're financing and underwriting this AI story, corporate spreads are extraordinarily tight. There's a lot more room for those spreads to widen, and there's a lot more room for real interest rate, inflation-adjusted yields to come down in the course of the next 12 to 18 months.
What would it take for spreads to widen, though? Because this is a market that's flush with cash, looking to put it to work. And it feels like every single auction, every single debt issuance, that there is so much demand that spreads, even when they widen, are widening to, like, I don't know, 70 basis, like nothing crazy still, even when you do see widening.
Absolutely, and the appropriate answer is, I have no idea. All I know is, at the moment, investors are not being compensated for a lot of the risks that they are taking, particularly in weaker balance sheets. How quickly those balance sheets degrade, ultimately, is going to be the key part of that narrative for next year. And then, most importantly, we need a shock to our beliefs. That's what always happens. There are deep stories that are embedded in the way we price these spreads. There are deep stories around the AI thematic, for example, that are being embedded in how we price assets in the economy. Shocks to stories like that ultimately are what reorient credit spreads.
I think that we've had enough shocks for this year, but we could have more, and that's what Al-Husseini of Columbia Threadneedle is laying in. And thank you so much for being with us. Have a wonderful Thanksgiving. Right now, let's get you an update on stories else for this morning. Here's your Bloomberg Brief, the Vonnie Quinn. Vonnie.
Lisa, thank you. UK Chancellor Rachel Reeves is getting ready to deliver her autumn budget tomorrow. Sources telling us here at Bloomberg she will announce plans to slash the amount Britons can save in their tax-free cash ISAs each year by nearly $16,000. The decision is part of Reeves's push to get households to invest more in UK stocks. Apollo Global Management CEO Mark Rowan saying people have, quote, lost their minds over private credit fears. Rowan rejecting the notion that adding private assets to retirement and insurance portfolios could pose a systemic risk. According to the Apollo executive, most private credit held by insurers and by pension fund buyers is rated investment grade. Rare layoffs taking place at Apple. Sources telling us here at Bloomberg the iPhone maker has eliminated dozens of roles in its sales organization in a bid to streamline the way it offers products to businesses. The affected positions include account managers and staff who operate Apple's briefing centers and product demonstrations. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, looking for the edge in trade talks.
I think the question that we are negotiating is how to do things bigger and better together between our two great economies.
Former senior White House trade advisor Kellyanne Shaw joining us next. This is Bloomberg Surveillance. Good morning.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Less than 3 hours away from the opening bell, you can see a little bit of a rebound from the earlier lows in futures. Futures softer across the board, down about 0.2% for S&P. But you can see a bit of just sort of meandering after yesterday's rally. Yields marginally higher on the long end, lower on the front end, 4.03% on the 10-year. Take a look at these retail names. We are getting some earnings this morning. We're getting Kohl's, Dick's, Best Buy, Abercrombie & Fitch, Dell, HP. Just moments ago, we got Burlington Stores, which is a discounted retailer. And Danny, it did seem to be a beat, which is, again, sort of this interesting question of, is a beat on some of these discount retailers a good thing for the U.S. consumer or one that potentially belies a little bit of concern and choicefulness, as the award of the day seems to be.
You add that, and then you add Walmart doing better, getting higher income consumers coming down. Maybe it's not a great thing, but I have to say expectations clearly were very high for Burlington. Shares are down very sharply, and I wonder if it has to do not with what they're saying are great trends, but the fact that their third quarter comp sales were much less than expected, about half the rate that they expected. Maybe they didn't raise things enough. So it's one of these companies that people are like, yeah, you're a discounter. We know you're doing well. And if you don't show up and raise things more than you have, we're going to punish you.
Yeah, revenue missing. They did say that traffic to our stores fell off significantly after the back-to-school period, driven by unseasonably warm temperatures in our major markets. This comes after some discussion over hurricane season when it comes to the Lowe's and the Home Depots of the world. We'll be watching out for other retailer earnings just as a forward-looking read on what we might expect during this holiday season. Under surveillance this morning, looking for the edge in trade talks.
I think the question that we are negotiating is how to make the deal bigger, how to make it stronger, how to make it more inclusive, how to bring in these digital Markets Act and try to improve that for digital America, how to maybe do steel and aluminum and how to include that, how to do things bigger and better together between our two great economies.
Here's the latest. Talks underway to preserve trade deals reached earlier this year. Former senior White House trade advisor Kellyanne Shaw writing, the détente between the U.S. and China is continuing to hold, and I expect it to through New Year's. I am increasingly skeptical about the durability of the U.S.-EU trade deal. Kellyanne joins us now. Thank you so much for being with us, Kellyanne. Let's just first talk about what you make of the idea of negotiating a deal for the EU and the U.S. that supposedly was already set in stone.
Yeah. Good morning. Thanks so much for having me on. This is why I'm so skeptical about this deal and frankly watching it very, very closely. The United States and Europe announced back in July that they had agreed on a package of mutual concessions, including tariff cuts going both ways. The U.S. implemented that going all the way back to August 1st. The EU has only introduced its legislation with no real hope of even passing it in the short term. So the EU has yet to cut a single tariff line. Now, the U.S. is in Brussels. You have Ambassador Greer as well as Secretary Letnick, who are there talking to their counterparts. What seems to be on the table is a potential deal on steel in exchange for concessions on the digital single market, on the DMA, on some of these digital regulations. But the EU has said that they're not budging on that. So I don't expect the U.S. to budge on steel and aluminum either, which means we have an impasse. And I think as soon as the president starts to connect with the fact that the EU hasn't cut a single tariff line, that's going to spell some serious trouble for this relationship.
That relationship has been frayed for quite a while. There are ongoing questions also about the U.S. and China, and I think that right now more people are focused on that just simply because of how essential trade is between these two economies, particularly when it comes to rare earth minerals and a couple other products. I'm just wondering what you make of the phone call between President Trump and President Xi and this idea of a visit coming in April.
Yeah, this was a really interesting conversation. It wasn't interesting so far as the two leaders spoke. They speak all the time. It's not unusual to follow up with a successful meeting and a deal that is being implemented to touch base, to talk about the trade issues, to talk about China's soybean purchases, wheat purchases, and other commitments that are coming due. But what I found so interesting were the competing readouts, and one in which China really rushed to get out. The president didn't even give his own readout for several hours later. China's was almost exclusively focused on this issue of Taiwan, on the importance of Taiwan, saying the U.S. had acknowledged the importance, talking about its criticality for the post-world international order, while the U.S. readout didn't mention Taiwan at all. It was focused on the trade deal, focused on Ukraine, and so it's this he said, she said, what actually happened in this call mystery. Now, of course, there are no transcripts available to the public about what happens in these behind-the-scene phone calls, but what is interesting is the narrative that both sides are laying out. And I think what is clear is what's on China's mind right now. I think the president's focused on this trade deal, but when the president does go visit President Xi in April, I have no doubt that Taiwan is likely to be on the agenda, at least from China's perspective.
The fact that Taiwan wasn't mentioned by President Trump, Kellyanne, does that say anything about the White House's willingness to step in should there be military action from China to Taiwan?
I certainly wouldn't read that into an omission. I think from the U.S. perspective, this call was really about checking in on the trade deal, discussions around what's happening in Ukraine. The administration has said several times over the past few months that there's no end to the Ukraine-Russia war without China's active participation. So I do think that those are the things that are likely on the administration's mind right now. I think what is clear based on what is happening between China and Japan right now, the concern over Taiwan is really this messaging campaign that we're seeing from China. This seemed to me more about a race to win the narrative versus what actually happened in the call. And I think that's why you're seeing the U.S. just not address it.
I was going to say, in terms of competing narratives, you also had the Japanese prime minister say that she received a call right after that China-U.S. call from the president. But we didn't really hear about it from the side of the U.S. Kellyanne, what do you make of that?
Yeah, clearly there is a tremendous amount of tension right now between Japan and China. China's threatening to cut flights. There is a huge diplomatic row right now over the prime minister's comments about the existential threat to Japan of any sort of military incursion by China into Taiwan. I think what the United States president is showing is solidarity with the prime minister. I think this is about saying that we are with you, we stand with our ally. I don't think the president needed to issue any sort of statement to make that point. The fact that that phone call happened was the message. And so I do think that the United States and Japan are united. But again, this issue of Taiwan is increasingly on President Xi's mind. And I think this will be a real point of tension, particularly going into those April meetings. And I expect President Xi to try to squeeze the president for something on Taiwan. And that's when we'll see what the U.S.'s real position is here.
Kellyanne, how much is it a tit for tat, this idea that if the U.S. does shift away from hardcore rhetoric around Taiwan, that China will help with the Russia-Ukraine war and potentially bringing an end to it sooner?
Look, I think that China is likely to use all of its leverage points in terms of trying to push issues that are so important to it. And Taiwan is issue number one in terms of the things that President Xi wants to do. But look, I do think that the U.S. position is strategic ambiguity. I don't think that the fact that the president hasn't departed from that, or at least said anything from that, indicates a different pivot point in U.S. policy. But again, the rubber is really going to meet the road come April, when I fully expect President Xi to push the president on this issue. And then again, we'll see what the result is. But the U.S. position, as far as I'm aware, has not changed. I think strategic ambiguity continues to be the U.S. view.
Former senior White House trade advisor Kellyanne Shaw, thank you so much for being with us. Definitely the two different readouts were notable, given the idea that people were wondering, what exactly is this phone call and what exactly will this meeting be in April?
Right, and what did President Trump say about Taiwan? What was his response? Because the Chinese angle was very clear. To them, it's a matter of sovereignty. And for the White House's response, just question marks at this point.
Yeah, and question marks around AI and just how much the U.S. was willing to sell chips into China. Coming up next, John Bilton of J.P. Morgan Asset Management, Jeanette Lowe of Strategas, Lauren Murphy of Wells Fargo, and Samantha Dart of Goldman Sachs as we get retail earnings, as we parse through the day ahead with Google very much front in focus.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You said they ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What I am a little bit worried about is that the Fed is kind of dragging its feet.
It's sort of confusing what you're hearing out of the Federal Reserve.
You might not want to hold the Fed to the same standard as in normal times.
It's certainly a much more rowdy and disorderly process from the Fed than what we're accustomed to.
We will get 3 rate cuts over the next 12 months, but December's still a toss-up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks meandering after the biggest two-day pop since May, taking some heat out of that today in futures. Retail sales trickling out for the likes of Burlington earlier, Kohl's and Dick's Sporting Goods as the holiday shopping season kicks off, with traders awaiting September retail sales data in about 90 minutes' time. And Alphabet becoming the U.S.'s third most valuable company, approaching $4 trillion in market capitalization as it presents stiff competition to both OpenAI and NVIDIA. Danny, this question of disruption very much roiling the artificial intelligence space.
It does. There is so much churn underneath the surface as the market hasn't fully decided on who's the winner. We're going from the, yay, everybody's a winner that does anything with AI and spends money to, hey, maybe not everybody is going to be okay. But one of the interesting things is, despite how volatile that sort of back and forth has been, it is the Fed that's dictating the overall directions of markets. It was yesterday in hopes of a cut that was lifting us up. Weeks before, it was doubts of a cut that was pushing us down.
Yeah, and this is really going to the bifurcation that you're seeing in the market. So even though we did just see the biggest two-day pop going back to May, there was, again, that bifurcation, this tale of two halves within the market, with about half the market not participating, the consumer-facing stocks not exactly rallying. You saw, for example, Carnival shares falling quite considerably. And it goes to this question, how long can the AI trade continue unless you get participation of the rest of the economy? And is the Fed too late to turn around the weakness that we've seen in certain pockets, akin to what we were hearing yesterday from Neil Dutta?
I also think that's why what El Hudsaini told us from Threadneedle was so interesting, because the idea that a productivity boom is going to come to the rest of this market and to save us, even if AI spending slows, he cast doubt on that. And that's a real problem for those that say, yes, the AI trade, but all these other companies are benefiting from it too. What happens if they don't? And what happens if that happens at the same time of a slowing consumer?
Meanwhile, this is the shopping season, and that's the reason why the retail earnings have been so interesting. We saw from Burlington, they did raise their full-year forecast, still taking a beating on comp sales. Kohl's, just take a look at that. jumping 15% after their comp sales beat estimates in the third quarter. This is a company that just had a new CEO come in, but those shares really rallying after seeing full-year operating margin significantly above where it previously expected, and just beats pretty much across the board, Danny. This to me is really interesting.
It is fascinating. And the margin story, which you just pointed to, again, this is a sector that we assumed margins would be really bad. We assumed that they'd be paying more and they'd have to move it along to the consumer. That's not what's playing out. They're finding clearly efficiencies from somewhere else. And for a company like Kohl's that has been in such need of a turnaround plan, the idea that they're able to do it in this environment with a new CEO at the helm, again, is getting greatly rewarded by this market.
The word efficiency keeps coming back to that, and we will keep looking at that. Right now, the efficiency in market is just slightly lower after yesterday's rally. You're seeing equity futures lower by about it was 0.2%, reprising some of that as we do get some of these earnings now basically unchanged. We are seeing unchanged on the 10-year. Wow, this is not a very active board today. Coming up this hour, John Bilton of JP Morgan Asset Management, as investors maybe tap the brakes, maybe just take a pre-Thanksgiving pause. Jeanette Lowe of Strategas as Ukraine peace talks gain momentum, and Samantha Dart of Goldman Sachs on why energy is the key to winning the AI race. We begin this hour with stocks sort of meandering following yesterday's tech-fueled rally. John Bilton of JP Morgan Asset Management seeing potential for positive returns, writing the recent pullback is presenting a buying opportunity, and we feel the gloomy narrative on tech is somewhat overdone. John joins us now. John, thank you so much for being here. I could use a little bit of excitement and optimism this morning. I'm wondering why you think that any kind of rally is going to come on the heels of people watching the AI space and gaining enthusiasm about it again, rather than focusing on the transformation and the competitive landscape that we're seeing certainly on a morning like this one.
Well, I think that we've got to remember what tech actually is. It's about innovation. It's about the next new idea, and it's about continually challenging itself. Think back to, I think it was February time, when, of course, we had DeepSeek suddenly appeared on the horizon, and I thought, oh my goodness, what does this mean for US tech? You know, it's all over. Was it? Absolutely not. We got the strongest rally out of tech that we've seen in an awfully long time from April onwards. So I think what we're beginning to see is something of a maturation. We're seeing competition begin to come in. You know, we're seeing different opportunities using different technologies for different purposes, etc. There's a lot of money going in. This year's or this third quarter's results from the tech leaders show huge capital spending commitments, which will continue to boost the investment share. Open question on productivity. Longer term, you know, we've looked at this in our long-term capital market assumptions work. We do feel that productivity is set to gain, but it's a long burn. It requires the investment first. And so we think that there's reasons to be positive, and we think that with this cycle of investment happening now, there's reasons that we will see dips board.
Is there enough cash and enough investor enthusiasm to supersede any kind of hiccup that would come from, say, just theoretically, a company that's worth about $500 billion and is private, that has a lot of loans, that's sort of trying to grow into the image that it has for itself, OpenAI? If you do get some sort of blow up of one of these companies that has been more speculative.
Well, look, take a step back from the individual companies themselves. There's a lot of capital in motion right now. There will probably be winners and losers out of that. I'm not a stock analyst. I wouldn't want to project as to who's who. But with the amount of capital being spent, we know that up to around 80% of total factor productivity gains typically can be explained by the upfront investment. Bigger issue we have right now, actually, again, if we take the long view, we know that the input of labor into growth going forward is going to shrink. We've got bipartisan support for clamping down on migration, and it's a global factor, by the way. It's not just a US thing. So it amplifies the impact of an aging population. So as my colleague Dr. Kelly likes to say, someone who I know is on this show quite a lot, productivity is what happens when you run out of workers, and guess what? So we are constructive there, but we're tracking a chain of events from the investment being made to the technology being built to the adoption taking place and then the full deployment. No prior tech cycle, mainframe, e-commerce, mobile telephony, and now AI has not gradually broadened out through time. So we are optimistic about the overall technology cycle here, and still in the early stages, we think.
It's incredibly complicated, though, and I was joking with Lisa earlier that, I, for some reason, spent a huge chunk of my day yesterday understanding the differences between TPUs and GPUs. You say you're not a stock analyst, and you're certainly not a tech-specific one at that, But is there a sort of sense that in order to be an active investor, in order to actually understand who are the winners and losers, you need to have a technical know-how that most people don't have? Does it pay to be hyper-specialized on tech in this kind of environment?
Well, I think that the same is true on any sector. If you get down into the depths, if you don't know the difference between an oncology drug and a therapeutic, you're not going to be a very good pharmaceutical analyst.
But this is a sector that dominates the market, though, whereas you can't say the same for pharma.
But fair point. But if we think about it, you can break it down into the jobs that tech is doing. Highly specialized functions need that real top-end, cutting-edge innovation. That's where your GPUs are coming in. Your TPUs, which are much more, brute force, can apply a lot of processing power to a more single direction. I think the ability to be able to scale and learn fast about what one is investing in. Actually, funny enough, if you think about it, that's an amazing AI use case. So I think what we can see is how we stratify different uses of AI. Are we automating simple tasks? Are we doing large model, sort of modeling of very unstructured data? Those are two different endpoints. But just having that basic understanding of what's leading where, I think is reasonable as a financial analyst anyways.
To that point, there was the dream of agentic AI and super intelligence, and it's something that Sam Altman talked about, Jensen Huang, and it's a thing that really built up stocks and had this, I don't know if you want to call it bubble, but anyway, high valuations because of this far promise in the future. Has something changed? Have we decided that we care less about what's happening in the future and more about the here and the now in terms of profitability and actual use cases of AI?
Well, I think there's a little bit of both, really, because I think that we always want innovation. It's one of the reasons why we continue to see that the US carries on dominating global market capitalization, even out 10 to 15 years from now, when we look at the work we've done in our capital market assumptions. So that innovation cycle is incredibly important. But at the same time, this is what separates in our mind from the dot-com era to where we are now. We've got high-quality, cash flow generative companies making investments that actually have real-world gains. And once more, I'd come back to that point. Productivity is what happens when you run out of workers. And that's the biggest driver to us. It's not the robots coming for our jobs. It's the fact that there are fewer of us. And we still want to be able to sort of develop processes and growth around that.
This is the reason why people are having such a hard time getting a handle on what exactly is going on with the economy during this transformation that has a very different kind of time frame. We're going to be getting ADP payrolls numbers coming up on their weekly at 8:15. At 8:30, we're going to get backdated, stale data from September. We are getting details from some of the retailers who are reporting earnings today. I'm not going to have you comment on them because I know you're not a single stock analyst. But it's been generally a positive read. It hasn't been gloom and doom, and yet what we're hearing from a lot of people is that there is a lot of gloom and doom, and you are seeing that in the bifurcation of market performance. Do you think that that is overstated in the non-tech names or not tech-obvious names, the idea that the consumer really is a lot weaker than it might seem?
Well, I think there are differences in the consumer as you look across the income cohort, for instance, but we know that the dominant piece of retail sales of any sort of activity in the consumer space is driven by the upper income brackets. Where we will get some impact, though, of course, and this is the delayed impact of the Fed, we'll be on gradually lowering those costs for consumers across the board. We're also seeing oil prices reasonably stable, which is great for households at the end of the day. These operate with a lag. Right now, if we had a very exuberant consumer, I'd feel much more concerned about the outlook for the economy. When you've got the consumer, we've got consumer sentiment really, really weak. In Europe, 15.3% household savings rate. It's the highest we've seen outside of the pandemic. The consumer has actually a surprising amount of coiled up sentiment and coiled up savings as we look around the globe more generally to put to work. We get big issues, a thawing between Washington and Beijing, as we've seen a little bit of. Possibly, and we hope, perhaps steps towards peace between Russia and Ukraine. As we get some of these big sort of geopolitical overhangs working their way through, the potential for a pickup in sentiment could be quite powerful from the consumer's perspective.
And a lot of retailers are trying to get ahead of that and build up their portfolios. John Bilton, thank you so much for being with us. Have a wonderful Thanksgiving, if you celebrate. John Bilton of JP Morgan Asset Management, and we are seeing certainly Kohl's shares absolutely surging now, up more than 20% after those earnings. But what you can see across all of the earnings is a tale of different corporate execution. And this question of efficiency, this question of market share, this question of which goods they can actually raise prices on. And Danny, to me, that's the reason why it is so hard to get a more macro read from some of these micro earning reports versus just corporate strategy to adapt and adjust.
It's such a good point because you've seen it all throughout earnings season. Does the fact that all of a sudden the fast casual restaurants are doing really poorly, does that mean everybody is doing poorly, but TJ Maxx is doing well, Kohl's is doing well, Walmart is doing well? Is that a good thing or a bad thing? It is a choose your own adventure depending on what company you pick and what narrative you want to build around it.
Just give more protein. That's, I think, what we've learned. Anyway, we'll get into that, or we won't get into that. Let's get to an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vani. Vani, thanks so much.
Lisa, thank you. Tensions rising between China and Japan over the status of Taiwan. President Donald Trump holding back-to-back phone calls with the leaders of both countries. China's foreign ministry saying the U.S. initiated the hour-long call with President Xi Jinping. Trump then called Japan's prime minister to reaffirm their ties. Any sign that the U.S. is siding with Japan on Taiwan could jeopardize its trade truce with China. A federal judge has thrown out the criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruling the prosecutor who brought the cases had been illegally appointed. And nearly 2 years after the mid-air calamity that plunged Boeing into crisis, the company says it's making progress in its war against defects at its 737 jet plant factory. The company's efforts include weekly meetings where employees discuss on-the-job impediments and irritants. Boeing says it's seen encouraging results and is planning to increase 737 output to 60 jets a month. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vani. Up next, bringing the war to a close.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth.
Jeanette Lowe of Strategas joins us next. This is Bloomberg Surveillance.
Day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Less than an hour until ADP Tuesday. It kind of doesn't have the same kind of ring, and yet we are going to get ADP payrolls data coming out at 8:15 that might give us a little bit of a current look at the underlying economy. Right now, stocks doing nothing. Futures basically unchanged. On the S&P, we're tracing losses from earlier this morning. We are seeing 10-year yields marginally higher, but lower versus where they were this time yesterday, 4.03%, and crude just off by about 0.4%. Under surveillance this morning, bringing the war to a close.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth. I have watched as the president and his team have worked around the clock overnight with both sides on endless phone calls, endless meetings to try to bring this war to a close.
Here's the latest. Peace talks between Russia and Ukraine gaining momentum. Sources telling us here at Bloomberg, a U.S. official is meeting a Russian delegation in Abu Dhabi ahead of President Trump's Thanksgiving deadline. Bloomberg's Mika Solner joins us now. Mika, what's your sense of where we are? It's gotten from a 28-point now to a 19-point. How close are we actually getting to some resolution in this push for a peace negotiation?
Well, the White House is very adamant to bringing this war to an end, but they have softened that Thanksgiving Day deadline, which is obviously just a couple of days away. But I know that, that they're really trying to stress and emphasize. We just heard White House Press Secretary Caroline Leavitt say that they're negotiating strongly with both sides. Now, this is to say the White House is also facing some criticism, saying that they're playing too much into what Russia wants. So we're going to see what they're doing there, and they're trying to work out those kinks now.
Mika, do we have a sense of what Europe's role is in trying to negotiate this and get back on the stage when it comes to trying to understand what the discussions are, who's having discussions with whom?
Yeah, I think that the White House says that they're working very closely, trying to keep everybody in communication. I know that there is a consensus that everybody wants this war to end, and I think that the U.S. is working strongly with European allies in terms of rebuilding Ukraine. But right now, they're still negotiating out a lot of this. The deal keeps changing and shifting, and so we're really going to see what comes, but I know that these talks are ongoing, and the administration believes it's making strong progress here.
Mika Solner, thank you so much for being with us. Jeanette Lowe of Strategas writing, it remains a question as to whether negotiated changes can hold and if Putin will agree to the ultimate plan. Jeanette joins us now. Jeanette, what do we know about what's been taken out of the initial 28 points that could potentially bring Ukraine closer to agreeing to this?
So, there's a couple of things that definitely started to push things a little bit more towards Ukraine's favor versus Russia's favor. That would be things like allowing Ukraine's military to be larger than it was under the 28-point plan, the potential for it to still be allowed to enter into NATO at some point if there is agreement, to allow NATO troops to be in Ukraine, but not on a permanent basis. So those were some things that allows Ukraine to have a little bit more stability with regards to its military, but then also having more security guarantees longer term. So we'll see if that holds. I think one of the issues has always been whether or not Putin really will agree to a deal. He came to the Alaska summit, made it seem like there was going to be progress made with President Trump, and then basically the talks went nowhere. So I think that remains to be seen. We hadn't seen Putin specifically say that this would be something he would agree to, even when it was the original 28-point plan, whereas there was much more pressure on Ukraine to actually agree, and it was left to kind of see then what would happen with Putin on the other side.
Given that after this, or as this negotiation has been going on, we had the call yesterday between Presidents Trump and Xi. What role will China play in this? Do you think that they will be able to exert pressure on Russia to accept any sort of deal?
It's interesting because I think one of the things that we've been watching too is what's been happening in Venezuela, and could that be an effort to try to put more pressure on Russia to accept a deal? I think there could be some pressure with regards to China to try to get them to get Russia to accept a deal as well. It also could be just China watching what's happening. Maybe they hadn't been involved in these discussions and wanting to make sure that they were at the table and kind of seeing what might be at play with Ukraine and thinking that there might be some similar tactic that might be taken with regards to Taiwan, since that obviously was a piece of the conversation that they held yesterday. But I do think Trump is really trying to push Russia to get to a deal. We'll have to see if that ultimately is successful, but he does want the war to end. He does kind of want lower oil prices, getting that geopolitical premium out of the oil prices. He probably also wants to separate Russia and China and having those linkages during the war, breaking those apart a little bit, as he is trying to really remove the strength of China overall, kind of also focusing on decoupling the U.S. from China. All of those things are coming into play here. So I do think that ultimately it was probably more still about trade and Taiwan and issues with Japan at this point, and maybe even less so about Ukraine.
I was going to say, when it comes to trade, does it make any difference that these Ukrainian negotiations are happening at the same time that you have Trade Representative Jameson Greer and U.S. Commerce Secretary Howard Lutnick in Brussels trying to negotiate yet again with the Europeans on trade deals with the U.S.?
Yeah, I mean, it was obviously interesting that the Europeans were a little bit caught off guard by the original 28-point plan. So things are also within the administration kind of focused on very separate tracks at the same time. Things are definitely in their own lane, and then they do have spillover effects. But obviously, this has been something with regards to the EU and the US that there has been a little bit of tension with the Europeans thinking that with the steel and aluminum derivative products and things like that nature, that it seems like the 15% tariff rate that they've ultimately had is not going to hold and is not going to be as beneficial to them. They're obviously also looking for other tariff exemptions, thinking about things like wine and spirits and pasta. So there's also that very separate thing. But I think those I would probably tease apart. I think this is much more focused on there was the effort in Gaza that was relatively successful. The administration wanted to take that momentum and put it towards getting some sort of deal with regards to Ukraine. And there's obviously this piece about trying to put a little bit more pressure on Russia with regards to oil, with Venezuela. And I think now there's just trying to see if we can actually get to a deal. But I do think Putin is probably the bigger question mark here.
There's a potpourri of issues here, and I'm trying to parse out how much is cost of living issues, how much is some sort of domestic win to celebrate international victories, and how much is an effort to work with allies and really get some sort of understanding that can hold. How much of it do you think is a cost of living issue that makes the U.S. more amenable to potentially lowering tariffs or being more cordial in some of the discussions in order to at least lower anything that people pay back home?
Yeah, I mean, I think the one thing here is that the oil piece, even before this affordability issue has really kind of come to the fore over the past few months, the oil premium that, him trying to say, I want to end wars, I want to lower oil prices. This was something that Trump pointed out early on in his administration before he came in, and then early on in the beginning weeks and months. So this has always kind of been his goal here. So I think this is less about affordability and more about getting the war ended, but still having lower oil prices. The tariff exemptions, obviously, to some extent, were about lowering prices, but the administration had also flagged this early on. You've always had Secretary Lutnick talking about the fact that the U.S. doesn't grow mangoes and that we'll probably have to exempt goods like that from the tariffs. So that is where we have ultimately ended up. Of course, it's happened as the conversations about affordability have really grown. So there is that component to it. But the fact that they've decided to make the exemptions across the world for all of those goods. But even if you get some additional exemptions, let's say with Europe, and there's a cost coming down in some of those things, it's really not significantly large. We looked through all of the tariff exemptions that came out, and it only really reduced tariffs on an aggregate basis by $7 billion. And we still have nearly $380 billion worth of tariffs in place. So it's really not going to lower overall prices. It's really much more targeted at specific food items and that affordability aspect.
Jeanette Lowe of Strategas, thank you so much. Currently, affordability very much front and focus during the retail season, and we've heard from some retailers about how they're handling it. A real motley picture here. I gotta say, Danny, I mean, you look at the performance of these shares after they report earnings, and it's, again, choose your own adventure. It seems like everything is, as you were saying earlier, with some really delivering and some talking about efficiencies, Dick's potentially closing some Foot Locker stores.
And they're saying that even though they've boosted their outlook for a second quarter, and shares are being punished because everybody's looking for cracks, and the fact that they might need to turn to efficiencies, maybe that's a crack for Dick's Sporting Goods.
And this is the reason why so many people say this idea that AI made us cut jobs isn't really the story. It's actually, we're just looking to cut money, to cut costs and preserve our margins. Coming up next, we'll be talking about that with Lauren Murphy of Wells Fargo, as holiday shopping offers a fresh read on the consumer. This is Bloomberg Surveillance.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
About 2 hours away from the opening bell, and you can see futures just trying to find some kind of direction after being down as much as 0.2% on the S&P, now essentially flat. Even NASDAQ futures have really retraced. Yesterday was the biggest one-day pop going back 6 weeks, biggest two-day pop for both the S&P and the NASDAQ going back to May. The Russell 2000 turning around, up 0.2%, possibly on the heels of some comments from Fed officials yesterday. Take a look at 2s, 10s, and 30s, and you can see in the bond space, particularly on the front end, a bid. And this really comes after we saw San Francisco Fed President Mary Daly in an interview with the Wall Street Journal say she would support a Fed rate cut next month. She is not a voting member, but definitely is considered an ally of Fed Chair Jay Powell. There also has been Chris Waller, who wants to go. Of course, John Williams has also indicated, which is the reason why you are seeing a bid into that space. Here are your morning movers with Vonnie Quinn with 2 hours away from the cash open.
Well, Lisa, one of the narratives that's going to dominate today is TPU versus GPU, right? What are the switching costs? Would companies want to even switch? And that's because Apple is in the news, obviously up 4.25%. Meta is in talks, according to the information, to buy billions of dollars worth of Google's TPUs. Now, it could have gone the other way. It could have gone and bought NVIDIA's GPUs. It didn't. And the question is, are TPUs better for inference? Are they more energy efficient? What would it mean down the road? Does it mean the beginning of the end of the NVIDIA dominance? It's a big question. So you can see NVIDIA down about 3.5% off its lows of the session, AMD down 3.8%, and those Alphabet shares rising. Let's get to some of the retailers now, because we had many report today. One of the better stories, Kohl's, up 22%. That stock already up about 12% this year. So the interim CEO, Michael Bender, who was put into the position in May, has really proven himself in the third quarter, definitely stabilizing Kohl's. He has now been named full CEO. He is in that position from now on, and today bears him out. So sales were still down, but only by 1.7%. The estimate was for a decline in the third quarter of 3.9%. And for the full year, the outlook is now comp sales being down 2.5% to 3%, as opposed to down 3% to 4%. So you can see the ranges are a lot better. Different story at Dick's Sporting Goods. So Dick's down about 10% on the year, down another 8.5% today. It did raise its outlook for a second straight quarter, citing sales from existing stores. But consumer sentiment down in November, as we know. And this, how does it, bring Foot Locker into the equation? Well, CNBC is saying that it's actually going to sell some of the existing Foot Locker stores. And so that's one of the parts of this story. Adjusted earnings per share missed at $2.07. The full year forecast did get boosted, though, but obviously investors not buying this particular idiosyncratic retail story.
Thank you so much, Vonnie. There is this question of Abercrombie and Fitch as well. Those shares popping more than 10% after reporting better than expected earnings across the board. We'll get to that in a bit. What you are seeing, though, is, Danny, a sense that their third quarter comp sales came in Not exactly well. They came in actually below, but you did see overall net sales increase and a sense going forward, some commentary saying people are really buying more strongly heading into the holidays.
It does contrast with what we've heard elsewhere, to be fair. You've had, Bonnie was just talking about Dick's Sporting Goods trying to close some of their Foot Locker locations. It speaks to this moment where if companies do innovate, and Abercrombie & Fitch has really changed their lineup, or you look at Gap, who's leaned into celebrities and different collaborations, that there is money to be spent. It's a story that's been evolving for the past few years. It's a consumer that has money to spend, but it's choosy, which makes it hard to develop an overall narrative about where we stand.
Yeah, the commentary coming from the C-suite. We achieved 3 years of consecutive quarterly sales growth, delivering record third quarter net sales with 7% growth to last year. The strong finish to back to school and fall seasonal transition very much front and focus. Meanwhile, spending on other things is on our radar this morning. Meta reportedly in talks to use Google's AI chips in data centers. According to the information, the agreement would help establish Google's chips as an alternative to NVIDIA's. The deal hinges on whether the chips demonstrate power, efficiency, and computing muscle. That is what Bonnie was talking about with TPUs and GPUs. Meanwhile, Apollo CEO Mark Rowan saying, quote, "People have really just lost their minds when it comes to concerns over private credit." Rowan rejecting the idea that adding private assets to retirement and insurance portfolios can pose a systemic risk. Danny, this is what we've heard from so many of the titans of the private asset management world.
Yeah, because it's really hurt them. I mean, you look at the share price of these publicly traded companies of private credit, private equity, and they have been really damaged by it. I think it's a fair argument to make that it's not systemic. There can't be a run on the bank with these kind of companies. But maybe what some of the wobbles do demonstrate, and Mark Rowan has talked about this, that we are late cycle dynamics. So much money has been poured into the sector. It's no longer a niche corner of finance because of insurance money, because of the move into wealth, and that money has to be put at work. So has due diligence softened? Has it been moved to the wayside? And does that mean the certain blow-ups or at least stress you've seen just does become more commonplace?
So late cycle in private credit, early cycle in the economy, early cycle in some sort of downturn. I'm getting lost in terms of what inning, what cycle we're in, because I've heard 5 things this morning alone, Danny.
Yeah, maybe we're just, the cycle is dead. Maybe that's the answer, that the cycle doesn't exist.
Well, maybe we'll get some inclination from U.S. economic data. It is getting back on track. Sort of. Delayed September PPI and retail sales due this morning at 8:30 a.m. September PCE now set to be released on December 5th. Meanwhile, a slew of results from the retailers, as we've been talking about, continue to give insight into the U.S. consumer. And sticking with retail, just days away from Black Friday and the unofficial start of the holiday shopping season. Lauren Murphy, Retail Finance Managing Director at Wells Fargo, writing, "Holiday shelves are full, but prices may rise in 2026. Lauren joins us now for more. Lauren, thank you so much for being with us. We've been trying to get a read on the holiday shopping season this morning in an ad hoc way with all of the earnings reports that have been coming out. Do you have a better sense of exactly any consistent themes running throughout the retailers?
Yeah, so I think the good news is retailers, as I mentioned, are well stocked. The inventory is on the shelves. They're ready to meet their consumer where they're at. I think the constant theme is just this question of consumer sentiment and really what is going to be needed to get that consumer and traffic in the door this holiday.
Lauren, there have been various notes this morning. One from UBS Securities saying that consumers' willingness to spend has waned and they expect a mediocre finish to the U.S. holiday season. BMO on their survey saying that consumers are going to raise their spending on the holidays more moderately than they have in the past. What are you seeing? Are you also seeing that softening around the edges of a consumer spending this holiday season?
Yeah, so Wells Fargo economists are forecasting that holiday sales will be between 3 and 4% increase year over year. However, that is not accounting for inflation. So I do think that consumers are seeking out value, they're seeking out discounts, and they're really mindful of their wallet this holiday.
A lot of what we've heard from the retailers too, Kohl's being one of them, having a really good quarter, Best Buy, another one that's lifted their outlook because everybody's buying the new iPhones. Lauren, if there is this concern, is there a scenario where people have spent all of this money because they're concerned about the future? They're concerned about where prices go, where employment goes, so past strength can't necessarily be indicative of future strength.
That's right? This is still the prime time spending season between November and December. And we think retailers did a really good job trying to keep prices low heading into this holiday, pulling up forward inventory purchases ahead of price increases. I think we're seeing that in the results. We haven't seen the margin hits that we were probably anticipating. However, what we're hearing from our retailers is that may be coming in 26, right? They're trying to hold the line right now. However, the question is if they're going to have to increase prices just because they can't sustain it any further heading into 26.
And this goes to a question a lot of people have been asking. Have we already felt the ramifications from the tariff costs? Have they already been borne by a lot of these companies, or are they yet to come? Are you saying that they're yet to come?
Yeah, I think what we're hearing is there is a lag, right? Where people are, what we're seeing in the margins today are still at that pre-price increase because they pulled forward so much inventory in the first quarter. However, what we're hearing is that we do think that there will be further margin prices heading into Q1, Q2 next year.
Do you have a sense of how much prices will increase? Is it just commensurate with inflation? Is it beyond that? I mean, is there a range that retailers are getting a sense of during the holiday season based on what they can pass along and where now?
Yeah, I think that's a great question. I think what we're seeing, at least in this holiday season, is that there is a mixed bag of discounting strategies, right? And I think how that falls into price increases, where you're seeing retailers capping markdowns on well-selling items that still may have value that the consumer is still going to show up and buy, or they're trying to expand their discounting strategy to make sure that they're getting, that more consumers are getting value for a particular product. So I think it's a mixed bag, and that's more on the margin side. But as you relate to the price increases, I mean, I really think it's going to see where they have to hold the line and making sure that they're hitting their margin forecast because they're all worried about their bottom line P&L.
What about within the subsectors, Lauren? Are there certain parts of retail that are facing price increases more than others?
Yeah, I would say right now, most immediately, we're seeing it in home furniture, home goods, right? I think because there was such a high preponderance of sourcing in China in those industries, the price increases were just too swift and they're already being passed through. However, I think we're seeing better resiliency in apparel and some specialty items as well. So I do think consumers are going to hopefully benefit from that this holiday season.
Is the home goods also an issue, just the fact that we've seen some of the big box home improvement stores that they continue to lag because of issues within housing? How does that trickle down to a home goods sector, for example?
Yeah, I think furniture is a good example, right? We're seeing a little bit more distress in that sector, knowing that just consumer spending, discretionary home sales, et cetera, right? People aren't going out purchasing houses, therefore they don't need to furnish these new houses. And so I do think that we are seeing the immediate impact of that across the sector.
Lauren Murphy of Wells Fargo, thank you so much for taking the time. And Danny, do you go to the store ever on post-Thanksgiving and celebrate by shopping?
As a creature who has a natural level of built-in anxiety, I can't do it because it skyrockets. I am one of the ones comfortably on my computer, like a cup of hot cocoa on one hand, scrolling through the deals. That's more my speed.
I think that you're more the common denominator than you are the exception at this point, given how many deals and offers I've been getting in my inbox. But it seems like people definitely decked out. Interesting to see some of the retail earnings that have come out this morning. A more positive tone than not, aside from Dick's Sporting Goods, but a sense that if you have a product that people want to buy with efficiencies, a lot of them are resurrecting some of their post-pandemic malaise.
But that's also why I'm kind of scratching my head, looking at, again, the notes that I mentioned from BMO and from UBS Securities saying that this is a consumer whose spending is waning. You're not necessarily seeing that across the board, but maybe it gets back to this issue we've been dealing with. People will say one thing and then they still buy when faced with deals.
Yeah, this has been the conundrum. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Gwynn. Vonnie.
Lisa, thank you. The European Union is rejecting the US's demand to ease tech regulation in return for lower steel tariffs. The EU's antitrust chief says the bloc's digital rulebook is, quote, not up for negotiation. The comments came after Commerce Secretary Howard Lutnick told Bloomberg his administration could relax levies in return for the rollback. President Trump signing an executive order on Monday establishing the, quote, Genesis mission, a federal effort to boost innovation using AI. It aims to coordinate research done by government agencies to integrate AI tools. Officials say the push will accelerate scientific discoveries in engineering, health, sciences, and energy. In sports, the San Francisco 49ers beat the Carolina Panthers on Monday Night Football. 49ers running back Christian McCaffrey had over 140 yards from scrimmage and a touchdown, while the San Francisco defense held Bryce Young and the Panthers to just 9 points. The Niners improved to 8-4 on the season, and Carolina falls to 6-6. That is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, powering the AI build-out.
We are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy.
Samantha Dart of Goldman Sachs joining next. This is Bloomberg Surveillance.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Day 3 of a rally. After 2 straight days of gains that were some of the biggest that we've seen since the post-Liberation Day rally, we are seeing an S&P futures, at least, that are turning around after being down as much as 0.2% earlier. NASDAQ also turning around as people get a little bit more optimistic about the efficiencies and some of the new progress and new developments going on there. You are seeing a little bit of a lift in longer-term yields, but just 4.03% on the front end of the yield curve. You do see a bid with the Fed very much in focus. San Francisco Fed President Mary Daly endorsing the idea of a December rate cut. Under surveillance this morning, powering the AI build-out.
Everything is about energy, right? Energy and technology are the main drivers of productivity. And we are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy. So the technology and the energy are combining.
Here's the latest. Electricity demand set to surge as the race to revolutionize AI calls for more energy. Samantha Dart of Goldman Sachs writing, as AI demands massive power, a reliable and ample power supply is likely to be a key factor shaping this race. Samantha joins us now. Sam, thank you so much for being here. Let's start there. The idea of a race against whom? Is this China versus the U.S. and a question of who can get the most computing power and then who can actually power said programming?
Yeah, these are the two front runners. You have today the U.S. holding over 40% of all data centers in the world right here. But China's number two, a little over 20%. And when we look at what's ahead, do we have the capacity to keep this going? I think that's where the differences really start to show, because in the US, we're already seeing about 8 out of the 13 power markets, regional markets in the US, already strained during peak summertime. Whereas in China, spare capacity is not only much larger, but we estimate it will get even larger over the next 5 years.
So without the U.S. building massive amounts of power the next 5 years, which is really going to be the time when AI is really ramping up, this really comes down to efficiency and how much more efficient can chips get, which is the reason why everyone's focused so much on Google today and this idea of their TPUs, the idea of a more efficient chip that uses less energy versus NVIDIA's GPUs. How much is that important and a necessary ingredient for the AI race to really continue in the United States?
I think it's key, because otherwise we're just not going to be able to add enough capacity to continue to fuel this. So, for example, already this summer we saw the Eastern Atlantic market in the US, the power market, really tight. We saw real-time power prices spiking to reach record highs. We saw capacity auctions reaching record prices. So it's the market positioning not just to price your peak summer price very high, but hey, we're going to need to pay utilities a lot more to build additional capacity in the long run, because what we have is just not sufficient. So either we get more efficient, or we're going to start to see bottlenecks, or at least a slowdown in the addition of data center capacity in the U.S.
How much is there a timing mismatch? Because everybody's running to the gold rush, the field of dreams, build it and they will come, trying to build more energy capacity. Presumably it takes some time for these to get online. Is there a concern that we are ramping up so much with our demand of AI and what we're expecting versus the ability of these projects to come online?
Yeah, it's almost like you have two lines. The data centers are coming in troves, and on the power generation side, it's not that it would normally take so long. You would ordinarily build a natural gas-fired power plant in 2 years if you had the turbine. But we have a 4 to 5 year queue to get a new turbine if you want to start a project today. So you're having to rely on other sources. And what do you have? Well, we're still building a lot of renewables, but they are intermittent, so they are not always there. You need something to back it up. We can't build nuclear because every time we try, it takes many, many more years than planned, and it costs a lot more. So we're sort of running out of options if we don't have that efficiency gain in the very near term. And the result ends up being that our peak summer periods are going to be tighter and tighter in power markets, and giving room to price spikes and potentially even outages.
All of this conversation also just always leads me to think, what does Europe do? Europe already faced an energy crisis. They're still trying to wean themselves off of Russian energy. Can they compete when even without data center demand, they struggle to get the capacity that they need?
Yeah, I think it's unlikely they can compete. And a lot of that is because they haven't even secured their energy sources. So when we think about who has enough energy to power all of this. And the US has already become an energy net exporter. But if you look at Europe, even though a lot of Europe is not using Russian gas, for example, anymore, that dependency just switched to imported liquefied natural gas. You still have to import it. So almost 50% of Europe's energy has to be imported. So that dependency is still there. The grid is very old. They don't have rare earths. They don't have uranium. So it's a very vulnerable place to be.
So let's start talking about some price levels. Liquefied natural gas, how much do you see prices increasing, say, in the next 12 months?
Actually, we're now starting a wave of supply growth in liquefied natural gas, and the U.S. is a big driver of that. The U.S. is going to drive more than 50% of global growth in LNG supply. So that's the bright side for Europe, if I can find one. is that their access to energy is likely to become more affordable over the next several years.
So this is the conundrum. You have on one hand the liquefied natural gas prices going down because of supply. You have actual gasoline, diesel, also diesel I guess less so, but prices going lower because of the supply glut that you're seeing coming out of the Middle East and other places. So where is the crunch going to happen, right? Where are the prices going to go up so materially that people are going to really feel the pain?
Yeah, I think at least in the U.S., what we're seeing so far is that the bottlenecks and the price pressure points, I think, are more likely to show when it comes to power price than, for example, natural gas prices or even gasoline prices. So it's really a power story a lot more than gas.
This is an administration that's increasingly been focused on affordability in recent weeks. If the net result of what you're talking about is everyday consumers also feel that higher energy price, is there anything the administration can do to solve these bottlenecks, or do they just need to be worked out?
That's a great point, because we're here talking about potential bottlenecks on infrastructure. But if it becomes a political issue because electricity prices are rising, that becomes another type of bottleneck. And because we can't really fix infrastructure building that fast, the only thing that policy can do is just make permits come a little faster. But if we can't get a turbine in less than 5 years, we still have a problem.
How much is this ultimately going to rest with the hyperscalers having to pay for the power themselves and create their own power plants themselves, which to some degree they're doing off the grid to some degree that could essentially become stranded assets, but how much is that kind of the path of travel going forward?
That seems to be the path of travel, but they will face those same bottlenecks. They still need the gas turbines for their own power generators, even if those are off the grid, right? If they are separated from the grid. And by the way, even if you have a generator off the grid, as your capacity grows, if your power demand grows with it, by the time you reach that generator capacity, guess what? You need to connect to the grid eventually anyway.
So what's the trade? I mean, if you're going to advise investors on what to invest in to capitalize on the demand outstripping supply, where do you go?
So there are a couple of things to think about. I think from a U.S. perspective, we think the trade is much more focused on power prices. So one thing that we have raised to clients is, hey, look at the back end of power price curves, because we're going to need to incentivize more build out, and that's going to show up in the back end of the curve. But if you turn around and look at Europe, for example, we were talking about all that vulnerability. You need to import a lot of materials. You don't have rare earths. You don't have this. You don't have that. So we have been recommending that investors in Europe in particular hold commodities in their portfolio as a hedge to all of this going wrong.
Samantha Dart at Goldman Sachs, thank you so much for being with us. Really appreciate it. Sam Dart there, talking about the power demands. And this is going to be an affordability issue. And Danny, I'm so glad that you brought that up, because increasingly there was a chart that I saw that prices for energy have remained steady because gas prices have come down so much that's offset the increase that so many people already felt in their electricity bills.
And what happens if that reverses? And how does politics get involved? It's happening in multiple sectors, this idea of crowding out. It's happening in electricity, also in manufacturing. A really great Bloomberg story a couple weeks ago that manufacturing spending, not AI related, has started to trail off. So a lot of the capital, resources, energy increasingly going to the dominance of AI.
Yeah, and to retailers, which is what we've seen this morning, which we'll be talking about coming up as we get some retail sales data from September, as well as, of course, ADP numbers coming out at 8:15. Coming up, Joe Amato of Neuberger Berman, Tracy Chen of Brandywine, Pooja Sriram of Barclays, and Krishna Namamani of Lafayette College. This is Bloomberg Surveillance. Good morning.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras. The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
The reality is the fundamentals are still sound.
I don't think we have yet seen the real bubble trade in AI.
The market's done a little bit of work here to take some of the froth out.
I think you could have a situation where the Magnificent Seven become a little less valuable and the rest of the market becomes more valuable.
We think there's a broadening out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. U.S. retail sales and inflation data on deck in about 30 minutes as retailers kick off the holiday shopping season, with more Fed officials signaling a willingness to cut rates next month. The real question of the consumer in focus, and Alphabet displaying new market dominance on both the software and the hardware sides of the AI story, with the latest reports saying Meta may buy Google's AI chips in the years to come. Danny, showing the evolution of the AI trade into efficiencies and winners and losers.
It's not all tides are rising, or at least all rising at the same rate. But what does it mean for an industry that started to get very reliant on NVIDIA, not just their GPUs, but the funding that they're doing? OpenAI has that relationship with NVIDIA. Anthropic has a relationship with NVIDIA. If all of a sudden they're thinking, oh, we need to change to different chips, NVIDIA starts to suffer. What does that mean to the interconnected web that it is woven?
Yeah, and is this part of the natural transition that actually is healthy, with people moving from AI is everything and superseding any kind of weakness you're seeing in the underlying economy or the consumer to, okay, let's figure out what's going on with the consumer, the underlying economy, and cater to it? It seems like right now, that's the question that's bearing out in markets where you didn't see participation over the past 2 days of the rest of the 493. This morning, maybe we're seeing a little shift in tone.
Because of the earnings, it is kind of remarkable to look at the companies that have reported this morning. Best Buy lifting their outlook. Burlington, those shares dropped because apparently it wasn't good enough, but Kohl's soaring. It is some real dispersion among the retailers. The takeaway, though, is people are buying. They are buying goods, but will that strength continue with, again, I saw a lot of bearish notes this morning, maybe not outright bearish, but basically saying that some of the consumer is going to wane this holiday season and the pickup in spending won't be as big as we're used to.
Yeah, bearish, talking about 7,500 rather than maybe Binky Chada's 8,000 from Deutsche Bank for year-end 2026. Right now, we're seeing some of the tepid losses turn into tepid gains on S&P futures, unchanged on the day. You are seeing a bit of a bid into the bond space across the board as people start to look to the Fed to potentially cut next month. 10-year yields now below 4.02%. In the day ahead, we get ADP payrolls number coming out at just about 13 minutes time. Then at 8:30, we do get retail sales as well as PPI. And then, of course, tomorrow we do get the beige book as well. Watch for that as we try to get a sense of sentiment. Coming up this hour, we've got Joe Amato of Neuberger Berman with the latest stock rally, sort of trying to find direction. Tracy Chen of Brandywine as Google's chip challenge has NVIDIA shares falling, and Pooja Sriram of Barclays as we break down the latest, or maybe not the latest, but at least the latest that we get economic data. We begin this hour with stocks just about flat following Wall Street's best day in 6 weeks. Joe Amato of Neuberger Berman writing this: AI is a double-edged sword. Diversification across asset classes put a focus on quality, plus a focus on quality could help mitigate shocks stemming from AI-related disruption at the macro or micro levels. Joe joins us now. Joe, thank you so much for being with us.
Good to be with you.
This really goes to the heart of the question, right? Is it a feature or a bug that AI kind of marches to its own drum at a time when there are so many questions about the underlying economy? Do you think that this is a feature in a place that can actually keep equities charging higher into 2026?
I think AI is going to be a massive creative destruction process. So you're going to see a lot of winners and a lot of losers. So those companies that are able to adopt AI techniques to help protect margins, enhance their own earnings, I think are going to be the real opportunity, right? You've had the enablers rally in a big way over the course of the last number of quarters and years for that matter. So the first and, as I call them, the first and second derivative AI stocks. But now as that gets dispersed through the broader economy, you're going to see the benefits of that, as you saw in the early 2000s when more and more companies adopted the internet and got the margin enhancement from that.
Well, the rest of the economy feel it, right? I mean, we're sitting here trying to assess the state of the U.S. economy and how much you can get this divergence between AI and everything else. Will you get a convergence as you see a broadening out of the AI-related gains in non-tech companies?
I think that's what we expect. I mean, that's what drives this broadening out theme that we're seeing. And, you know, you're already seeing it in the context of companies talking about use cases to gain efficiencies, whether it's Walmart talking about on their quarterly earnings about not really increasing headcount over the course of the next couple of years, yet showing good earnings and good margin improvement, right? So they're figuring out ways to get that efficiency from adopting these technology tools.
There was a study I was looking at from Kyndryl, it's a spinoff from IBM, which does consulting for different companies, saying that 62% of companies who are trying to implement AI are in pilot purgatory, as in they're trying to find ways and experimenting with ways, but haven't actually cracked the nut. If we are going to see productivity play out, how long is the timeline? Is this something you expect to be adopted and put into motion very quickly, or is this a multiple years long trajectory?
I think it's gonna happen faster than the integration and adoption of the broad-based internet, we think, which took a good decade or so. But that said, it's a challenge, right? We see it in our own firm, right? There are use cases we develop for our investment professionals that can be quickly implemented and find real efficiencies in their investment processes. At the same time, when you're changing workflows and you're affecting multiple areas of, in our case, our firm, or the examples you're using, it's a little harder. It's going to take some time, but I think it's coming. And some of the studies that we've all read about, seen, whatever, around questioning the return on investment or the efficiency gains, it's just too early to tell. I mean, we see it, like we've been in what I would consider an early adopter at our firm. I mean, we were pushing out these tools in the summer of 23 for folks to start using. Yet we're still in the, I would say, early innings of really having it more integrated in the entire firm.
So does that mean you're not in the camp of, oh no, the financial services industry is about to lose all of its junior employees because ChatGPT is going to develop some model that takes away the grunt work?
I do think that AI is going to put pressure on low-end, white-collar services jobs, and that's a lot of what the folks coming right out of school. So what you're seeing now, college grads are struggling to find a job. Right? We're all seeing that the level of youth unemployment is higher than it's been. So that's worrisome for the labor market, right? At the same time, from the financial services industry, they can gain those efficiencies where you didn't need to necessarily have as many young folks as you needed before.
How are you understanding the recent declines that we saw before 2 days ago, before last Friday, in the AI space? I mean, is this an opportunity to buy? Is this a sign of tightening liquidity? Is this a sign that maybe people are getting less patient? And how are you sort of using this period to reset going into 2026?
We had a massive rally in those enablers that I talked about, right? The first and second derivative AI stocks. So having a pause, considering the challenges, the question whether, you know, the pace of AI investment is going to continue at that level. What are the hurdles, right? I heard your last guest talking about power. Power is going to be, I think, an important element of the AI trajectory. But, you know, as we move into 26, we're optimistic. I think we see the economy running, particularly here in the U.S., at a reasonable clip. Third quarter could be in the 3+ range for GDP growth, which is pretty remarkable. And when you think about the level of job growth that we've seen in the third quarter, it tells you something's going on with productivity, because we had it seems we'll have reasonable economic growth, yet modest amount of job growth. But as we move into 26, earnings are in good shape. Economy seems to be running at a decent clip. And we think the Fed directionally is cutting rates, and that's a good foundation moving into the new year.
Your characterization is different than what we heard yesterday from the likes of Mike Wilson over at Morgan Stanley, as well as Oh-Sung Kwon over at Wells Fargo, who is talking about a real tightening in both liquidity as well as a sense that the economy was flagging and that it wasn't necessarily productivity. Sort of the jury is still out about why we haven't seen more job growth and why we have seen ongoing earnings from corporations. They were saying they expect aggressive rate cuts, quantitative easing, essentially, by another name, and fiscal stimulus coming in. How much is that part of your thesis for 2026?
Well, I think the fourth quarter is probably going to be a little bit of a soft patch because of the government shutdown. So it won't, we don't think the run rate of the economy in the third quarter is going to continue in the fourth quarter, but I think we do expect to pick up in 26 based on rate cuts, based on the stimulus in the bill, which is very much front loaded in calendar year 26, purposefully so by the administration. Surprise, surprise. So I think that builds, again, a foundation for a better environment. This is what makes markets. People have different views on the pace of economic activity. I mean, we're reasonably sanguine about where things are right now.
When it comes to what makes markets and the structure of it, do you take anything away from the last 2 weeks where you had a risk-off that really felt to be led by high-momentum names, by crypto investments, and it had a spillover effect in the whole market? Is there some sort of fragility or at least concern you can take from that and extrapolate into 2026?
I think we saw a fair amount of frothiness, and I don't think you have a market rally as hard as it has, or in every bull market, you're going to have some level of excess excitement, if you will. So that coming back to reality is a good thing in our view, right? And again, it also plays into the notion that it's not just about those AI technology stocks that are where you want to be. I think you want to think about how that broadening out it becomes an opportunity from an equity market standpoint.
A lot of people, though, have been punished, either one, missing some of the AI stuff or trying to outright bet against it. Michael Burry is traded in his hat as a hedge fund manager to be a Substack writer, apparently, because of it. And there's this really interesting Goldman note I was reading. People who want to short this market seem to be playing it through utilities. 3.2% of free flow to short interest isn't a huge amount, but apparently it's one of the highest on record. And they reckon that it's a way to play against AI. If someone were to come to you and say, Joe, I'm nervous about AI, what would you tell them to do? Can you be short this market, or do you need to turn somewhere else?
I would be careful shorting this market. I think because of the foundations that we talked about in the expansion that we see in the broadening out. But you're going to see a lot of this, as I referenced, this creative destruction process. You're going to see a lot of winners, but you're going to see a lot of losers, and it's going to happen faster than people think about. So does it create an opportunity to short individual names versus the losers that you think versus the winners? I think it does. That level of dispersion and single stock volatility, I think, creates those opportunities. But from a broad-based standpoint, I would be careful to be short.
Yeah, it might make people feel more confident, actually, to be long. Joe Amato, thank you so much for being with us. Joe Amato of Neuberger Berman. That's what a lot of people have been saying on the show, right, Danny? That the more people talk about bubbles, the better they feel that there isn't one.
Well, also, if you're in the beginning stages of a bubble, the best thing you can do is buy and to ride it to the top. But yeah, a lot of people have been punished betting against it. Michael Burry, kind of a poster child at this moment, I think, for that.
But Substack, a warm and fuzzy place. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Kohl's shares jumping in the pre-market after it reported third-quarter earnings that topped analysts' top and bottom line estimates. The retailer also posting better than expected comp sales and raising its full-year outlook. Best Buy shares also rising. The tech retailer reported strong third-quarter earnings that beat estimates. The company boosting its full-year adjusted earnings per share guidance and projecting higher comp sales and revenue for the fiscal year. And in tech, shares of Google parent Alphabet rising in the pre-market on reports Meta is in talks to spend billions of dollars on the search giant's AI chips. The information is reporting Meta plans to use Google's Tensor processing units, or TPUs, in data centers from 2027. An agreement would help establish TPUs as an alternative to NVIDIA's AI chips. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, we'll be breaking down the ADP employment report, plus Tracy Chen of Brandywine as Alphabet has its sights set on $4 trillion. That's next. You're watching Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
The AI theme has just come to the investment grade market. One of the risks is it starts to lift yields across the board and starts to make the cost of capital more expensive for other companies. That ultimately could be a drag on growth down the line. The investment grade market was, practically invented for this. It's going to be a while until we get to a point where it starts to degrade.
That was Ed Al-Husseini of Columbia Threadneedle speaking just moments ago. As we head to the market open, we are looking for those economic data points, including ADP. We will bring them to you when we get them. Right now, I believe that the ADP numbers just crossing. Let's head over to Bloomberg's Michael McKee. Mike.
Good morning, Lisa. Well, this is not good news considering it's the second week in a row that we see a decline in ADP. Average 13,500 jobs a week were lost in the 4 weeks to November 8th. Now, remember, this is a 4-week moving average, and it's also a couple of weeks behind, but it is the latest information that we have from ADP, and it isn't particularly good news. We will get the monthly numbers next week, and that may give us a better clue as to where the labor market is. But it certainly looks like The weekly ADP numbers, to the extent you can trust them, are making the case that the doves were making the last couple days and suggesting that the Fed might want to cut rates again.
The idea that private payroll losses are accelerating in the past 4 weeks, Mike, speaks to what we heard in the Wall Street Journal article with San Francisco Fed President Mary Daly when she was talking about how she has seen a real-time deterioration in the labor market. How much is that sort of coalescing, that idea kind of bringing together a lot of the Fed members based on just what's happening on the ground over the past few weeks?
Well, you look at the number of open market committee members who have said they are open to or want to cut rates, and you can see that there is a trend that has solidified since the last Fed meeting when Jay Powell told us it was not by any means a foregone conclusion that they would cut. It seems that a lot of these Fed officials talking to businesses around their districts have seen that companies are going ahead, and this was always a question out there, would be when do companies have to make a decision one way or another about personnel while they wait for the confusion about Trump's economic policies to clear up. Hasn't cleared up, and they do seem to be making some decisions now.
Thank you so much, Michael McKee. We are seeing just a little move in bond futures, although not significantly. Two-year yields lower now, more significantly to 3.47%. Now the bonds across the maturity spectrum getting a bid. Time now for the morning calls. First up, BMO Capital lowering its price target on Novo Nordisk to $46, expecting negative headwinds for 2026. Next up, Mizuho lowering its price target on Tesla to $475. Noting weaker electric vehicle makers in China and the U.S., those shares essentially flat. And finally, D.A. Davidson keeping a neutral rating on Alphabet, seeing increasing demand for Google's TPUs following a report from the information that Meta is in talks to spend big on the company's AI chips, and Google shares up 4.3% in early trading. Sticking with tech, NVIDIA, the other side of that, shares falling following that report from the information. Tracy Chen of Brandywine Global writing, the winner-takes-all mentality in the United States has led to aggressive CapEx spending and hoarding of computing capacity, which is gradually diminishing free cash flow. Tracy joins us now. Tracy, thank you so much for being with us. I want to just start with a question of how much we're seeing the winners and losers shake out now, or were they just getting a hint of what it's going to look like, say, in 6 months?
Good morning, Lisa. I think we are still in the early stage of this AI investment or AI arms race. Right now, we are still getting some little hint about this winner and loser because today you can see Google share up and NVIDIA share down. I'm not saying who is the winner, who is the loser, but you start to see this differentiating market response to this AI development. Because before we have seen anything that touched AI, we will see the stock up, right? But now we can see the differentiation, and which is a healthy development.
Does that mean, Tracy, it doesn't pay off to play this passively? Considering we're starting to see some of the differentiations between companies, do you want to be actively managed, not even only in just picking sectors, but within some of the hyperscalers and big tech concentrated around AI?
Definitely. So if you look at their CapEx spending as a share of the free cash flow, you can see a divergence among the Magnificent Seven or AI 30. You can see some companies already over 100%, meaning their CapEx spending already exceeding their free cash flow. But some companies, the percentage is still below 20%. So you can see who is really stretching and who is still having a lot of free cash flow room for expansion.
So Tracy, year to date, it's a market that the best performing sectors have been anything AI related. Communication services is number one, then infotech, then utilities, then industrials. Again, those last two you could argue about AI. The thing that's been left behind and has barely inched to a year to date gain is consumer staples and consumer discretionary stocks too. We have a whole host of earnings coming out this morning of some of the retailers. Some of them are strong, some of them aren't strong. Tracy, when can you jump in and buy these parts of the economy that don't touch the AI related story?
I think next year we should see a broadening of this AI theme, especially if you look at the key shape economy of the U.S., especially the consumers, the haves and have-nots. I would think that if you look at the consumer discretionary, that has been outperforming the consumer staples, and that I think next year would probably will accelerate this kind of dispersion. But if Trump is tackling the affordability problem, we will see this trend probably reverse a little bit, and the AI expansion theme or broadening theme should continue next year.
There's been about $200 billion of debt sales tied to AI in just the past couple of months alone. I mean, I feel like it's been an absolute bond bonanza over the past couple of weeks, and I'm just wondering at what point you say no mas. I mean, as an investor, are you buying, or are you saying, I don't really want to get stuck with this stuff?
Yeah, I think I'm more optimistic of this AI investment theme. I think we're still in the early stage. As an investor, you just can't miss this secular trend. AI revolution is so massive, right? It's arms race not only within the U.S., but also between China and U.S., and the government will support this investment. So I think the market actually give the message that the hyperscaler or hyper spender, you have to slow down. And this kind of winner-take-all mentality might not work out as well, because in China we see it's not winner take all, it's winners share all, right? So there are several companies they share with each other their know-how and they build something together. But in the U.S., you can see this aggressive competition because of the winner take all mentality, and this aggressive new issuance in the IG corporate market definitely get some pushback from investors, right? Investor will give them more scrutiny to see the monetization pace, right? Whether the monetization will go well or not, and they start to differentiate among different players. And I think we are going to see some spread widening next year in the IG corporate market, and this will actually have some pressure on the long end of the treasury curve. That is my view. But as an investor, you can still play some short duration like data center ABS, and it has structural protection as well. So you can diversify your portfolio and be very active and have some active selection, and you should have an attractive return.
Tracy Chen of Brandywine, thank you so much for being with us. Just digging into some details now from the ADP report. Joining us again, Bloomberg's Michael McKee. Mike, we've got some more details about what potentially is causing the deceleration and where the bright spots are and where the weak ones are.
Well, we don't really have any particular bright spots other than healthcare, which has been normally the biggest job creator. The weaknesses have been concentrated in manufacturing and construction, and those don't seem to be improving. And what's interesting is that ADP had previously reported a gain of 42,000 jobs in their monthly report for the month of October. And this report that's out today covers the 4 weeks up until November 8th and suggests a collective weekly average loss of 13,500. So those two don't square exactly. And this is much more of a gloomy report. This would take you into the first week of November and the last 3 weeks of October. So it's hard to get a clear reading on where the economy is at this point. But it does suggest there's some question about how strong the economy, the labor market is.
Michael McKee, thank you so much for that. You do see two-year yields falling in response to this report, leading into the data that we get just in about 5 minutes' time right now. You're looking at a decline of about 3 basis points, not that much drama in the two-year yield, but nonetheless, Danny, definitely raising questions about the trajectory and just how stale September data is in a very rapidly moving labor market.
And that's why you care more about data points like this, and it also feeds into the Mary Daly argument that the labor market is more concerning, because if there should be a linear move, that's more difficult to control than inflation is.
Yeah, coming up, we are going to be speaking about retail sales and PPI. That's due in less than 5 minutes' time. Pooja Suram of Barclays joining us to react to the ADP figures, as we do see a shift, at least in tone, from the jobs landscape. This is Bloomberg Surveillance.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
25 seconds away from retail sales and PPI data from September. Right now, the state of play is lining up like this. You are seeing a bit of a lift in equity futures. S&P futures higher just a touch by less than a basis point. Meanwhile, you've got NASDAQ futures just meandering. Again, you are seeing the Russell 2000, though, with a lift of half a percent, which it really comes in the heels of the rally that we're seeing in the bond market, 2s, 10s, and 30s. You are seeing that bid. Right now, we are getting that data. Let's head over to Michael McKee with retail sales and PPI. Mike.
Oh, Lisa, we've got a little bit of a disappointment in terms of retail sales. Headline retail sales come in up 0.2%. They were up 0.6 in the month of August. Now, remember, this is September data. The expectation was for a 0.4 rise. Ex-autos were up 0.3, which is what was forecast. But the control group, we don't have that number yet, hasn't come through yet. We'll get that for you in just a second. But ex-autos and gas up only 0.1%. So a lot having to do with prices there. In terms of PPI, the headline PPI comes in up 0.3%. It was down 0.1 in the month of August. So there's a little bit of an inflation issue there. The core rate up 0.1%. PPI on a year-over-year basis is up 2.7%. That's a tick up in September from August. And PPI core on a year-over-year basis falls by 0.2 to 2.6% from 2.8%. Retail sales control group comes in down 0.1% after a 0.6 rise in August. So retail sales weaker than expected. Inflation a little bit hotter than expected, but mostly in the headline groups, which probably suggests the same thing as retail sales, that gasoline prices, energy prices, and car prices may have played the role there.
We've seen a little bit of a build on the market moves that we saw after ADP. We see the bid into the front of the yield curve continuing with 3.4668 if you want to go out to the fourth decimal. The sense that the Fed is going to be prompted to cut rates based on the fact that heading into this holiday period back in September, there wasn't that much momentum, or at least as much as people had expected. And that, yes, inflation maybe at the headline level a little concerning, but under the hood, not so much. Mike, how important is data from September that we're getting now? How do you understand this in the scheme of understanding an economy that seems to be rapidly moving?
Well, I think you hit the major problem there, Lisa, by saying the economy is rapidly moving, because the Fed can't take a lot of comfort in this data one way or another, even having it, because it just tells you where we were 2 months ago. And that is way behind where we may be now. The real question is, what, in terms of retail sales, are we going to see in this holiday period? We've got Black Friday coming up to kick it off. And when you look at what we saw in the retail sales numbers, car sales down 0.3%. Gasoline stations were up 2%, but that was after a 3.1% gain. So gasoline and food, part of the problem here. Clothing and accessories down 0.7 in the month of September. And the sporting goods, hobbies, toys down 2.5%. General merchandise up only 0.1%. People weren't spending money on the things that we're going to see them, in theory, spending money on for the holidays. So it is a bit of a warning that consumers are a little concerned. We've seen that in the consumer expectation numbers as well.
Maybe, which is why we're seeing Dick's Sporting Goods shares falling and them closing some Foot Locker stores. Bloomberg's Michael McKee, thank you so much. I'm sure there is more to it. Let's head over to Pooja Shriram of Barclays, who joins us now here in studio. Pooja, thank you so much for being here. What's your initial read on not just the numbers that we just got, but the importance of them based on the fact that they're pretty old?
Yeah, I think, look, in a situation where we haven't been getting a lot of fresh data, some data is useful. I would say this helps sort of fill in the gap between what happened before this holiday season. And if anything, you know, it's slightly useful. You're able to build on a trend in terms of what was happening in the economy heading into the holiday period. But I would not deny that it is a bit backward looking.
Is there a little bit of a tension between Mary Daly, someone who's very close to Chair Powell, saying that she is more concerned about the labor market, John Williams saying that he would endorse something of a cut, again, the top lieutenant at the Fed, versus the last time we heard from Chair Powell talking about this data fog, saying that when you're in that fog, it makes sense to move slowly. Is there tension in those things?
I don't think so. Look, I think one thing that seems to be clear is everyone is having a hard time figuring out if policy is generally restrictive, and people have very different views on that. In addition to that, like you said, the data fog makes it difficult, but the doves have something to pick on, and that would be the rise in the unemployment rate that we saw last week, maybe even this morning's weak ADP data, although I do think it's somewhat of a noisy signal. And on the other hand, you have some of the others, the hawks on the committee, who are generally worried about inflation and would like to see more contemporaneous data, perhaps, before making the move. So I think there's just a genuine difference of views.
And do you think that genuine difference of views continues on because of the fog, or has something fundamentally shifted at the Fed, especially as you get more politics injected into it? Do you expect that, regardless of how some of the data shakes out, that just lack of consensus is the new normal?
Well, you know, I wouldn't go as far as saying that politics is coloring how the Fed is thinking. It's just, you know, we need to recognize the fact that the data that we've been getting, you know, paints a picture of a slight tension between the two mandates of the Fed. You do have a world where labor market momentum has clearly slowed. Downside risks have emerged. On the other hand, we haven't really seen much progress on the inflation front. I think the last time I was here, we were discussing core PCE inflation has been stuck at 2.8, 2.9 since, you know, a while now. And so I think there is a legitimate reason for hawks on the committee to be worried about the inflation side of the mandate.
How important is this holiday shopping season?
Well, usually it is reasonably quite telling of consumer momentum, the health of the consumer. Again, how much we're able to capture in the official data is questionable, just given we're coming out of a long government shutdown. But usually it's something that people look at quite closely.
I guess, how accurate can we get a reading when we take a look at something like holiday shopping? And I was struck by an essay that started to talk about how the poverty line was really referencing 3 times the average family's food bill, and that food now comprises 5 to 7% of a budget rather than 1/3 of the budget. And so it's completely changed the equation. And what people are feeling on that lower end is a lot of significant pain that is not being reflected in any of these numbers. Can that persist? Can you have a universe where there is a growing cohort of people who are feeling a lot of pain and are not able to afford things and are forgoing a lot of basic purchases, but you have wealthier individuals that continue to spend and prop up retail spending? The holiday season does fine. Can you have that indefinitely?
Yeah, I think it's hard to answer. Indefinitely doesn't seem like it's a reasonable assumption to have, but that K-shaped economy has been going on for a while now. I think it's, you know, it comes down to some very basic statistics, like the top 20% of your income group drives more than 40% of consumer spending. And I think that's your point, that you could have data that looks absolutely fine even when you have a lower income group that's clearly feeling some pain. Now, just coming back to your holiday season shopping, you know, there's also a view that consumers are now being very intentional spenders. So one of the things that some of the credit card data show is Consumers have not really done off-season shopping as much this year, but it's really been a lot of shopping that's been reserved for promotion periods. So think about the July Amazon Prime Day sort of an event, and perhaps coming into the holiday season, spending may look fine.
That doesn't sound like the healthiest of developments, though, that everybody's just waiting for value or a deal. When does that become something worse? That, okay, yeah, spending's still happening because they find deals, but that in itself suggesting that there is a little bit more tension.
Yeah, I think a lot of it is also tied to the labor market, right? We've been in a labor market that seems very stagnant so far. Yes, we're not seeing as many layoffs, but there's not been too much hiring as well. That's also likely to feed into consumer thinking and sentiment. So to the extent that the labor market is just about stuck in this phase, I think caution is perhaps where the consumer is headed towards. It depends really on developments on that front.
What about then some of just the headlines coming through, Verizon letting go people, Amazon letting go people? Does that have a measure of just denting sentiment, even if people themselves haven't lost their job, but just seeing these headline figures, does that also cause some pullback in people's willingness to spend money?
Perhaps. I mean, absolutely. The media narrative around this has been, quite immense. A lot of the headlines clearly grabbing attention. And these are big companies we're talking about. So, it can't go unnoticed.
And right before Christmas, too.
Yes. And I'm sure it is feeding into sentiment. It's making people a little more reticent to spend. But again, I think in the grand scheme of things, the extent of layoffs that we've seen are still not alarming. Yes, they've come from big companies, but I would say it's about the usual amount of friction that you would see in a labor market, which is in the state that it is right now, but surely something that we need to keep watching.
Pooja Sriram of Barclays, thank you so much for being with us this morning, and have a wonderful Thanksgiving. Let's head back to Michael McKee, who has some details after parsing through the latest retail and PPI data that we got out of the United States government.
Well, Lisa, I want to look at a little bit of the PPI here. When you look at the breakdown of goods versus services, the index for final demand goods increased 0.9%, but services were flat. And it's the service price increases that have been worrying Fed hawks. So maybe this gives them a little bit of reassurance. 60% of the September rise in the index, the headline index overall, is traced to gasoline, which is what we thought when we first saw the numbers there, gasoline and cars. Indexes for meat, residential electric power, motor vehicles and equipment all went up, and that's what you've been hearing pretty much from everybody these days in terms of inflation. So the Fed is seeing a picture that it basically understands, it appears. So now the question is, what kind of data do they have that tell us where we've gone from here? We do get the GDP report on now December 23rd for the third quarter. It should be relatively strong given the numbers that we have gotten. But the Fed is more concerned with where we are at the moment in the fourth quarter. And that we're going to have to wait on.
Michael McKee, thank you so much for all of that. Right now, priced into Fed funds futures is an 80% chance of a December rate cut. That is up from 35% last Thursday. So a sense of how much the market has really shifted its perception of how the Fed is going to respond. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. So recapping that data we got moments ago, U.S. retail sales in September rising just 0.2%. Half the estimate for 0.4% of an increase. Producer prices rose 0.3% month over month, which met expectations, but ticked up to 2.7% from a year earlier, which was above estimates. And in the labor market, ADP private payrolls fell an average of 13,500 per week over the 4 weeks ended November 8th. Apollo Global Management CEO Mark Rowan saying people have, quote, lost their minds over private credit fears. Rowan rejecting the notion that adding private assets to retirement and insurance portfolios could pose a systemic risk. According to the Apollo executive, most private credit held by insurers and by pension fund buyers is rated investment grade. Apple cutting jobs across its sales organization in rare layoffs. Sources telling us here at Bloomberg, the iPhone maker has eliminated dozens of roles in a bid to streamline the way it offers products to businesses. The affected positions include account managers and staff who operate Apple's briefing centers and product demonstrations. That is your Bloomberg brief. Lisa.
Thank you so much, Bonnie. Up next, Krishna Mamani of Lafayette College as traders add to December rate cut bets. Plus, Vonnie Quinn comes back with your morning movers. Kohl's and Abercrombie shares soaring following strong earnings results. This has been quite the initial read on the holiday shopping season. This is Bloomberg Surveillance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
This third quarter's results from the tech leaders show huge capital spending commitments, which will continue to boost the investment share. Open question on productivity. Longer term, we've looked at this in our long-term capital market assumptions work. We do feel that productivity is set to gain, but it's a long burn. It requires the investment first. And so we think that there's reasons to be positive.
That was John Bilton of JP Morgan Asset Management joining the crowd of investors who are seeing a better 2026, potentially even another year of double-digit gains. This morning, you are seeing a lift pretty much across the board, although S&P futures going nowhere at this point, essentially flat. You are seeing, though, a bid into bonds after data that really pointed to ongoing softness, particularly in retail spending. 10-year yields now almost at that 4% level, a little bit of dollar weakness. Euro strength 115 with an increasing number of investors gaming out the idea of ongoing dollar weakness. Under an hour away from the cash open, here are your morning movers with Vonnie Quinn. Vonnie.
Well, Lisa, one of the stories out there today is when will NVIDIA's prevalence in the GPU space be undermined? And today might be the beginning of that, because we are seeing the information reporting that Meta is buying billions of dollars worth of Google's AI chips. Now, they're TPUs, right? So if people start buying TPUs instead of GPUs, then that might be a problem for NVIDIA. So we're seeing the stock suffer, AMD suffer a little bit as well, and Alphabet continue its rise. The thing is, it's a very, very big question, right? NVIDIA has been the market leader for so long now. What would switching costs be? Would companies even be able to get out of contracts? It's a very open question, and we'll be getting lots of analysis on that throughout the coming days. But let's take a look at some retailers, because here are two turnaround stories, and boy, are investors rewarding these companies. Kohl's essentially continuing the same strategy as the new CEO's predecessor. So the new CEO is Michael Bender. He's been in the job on an interim basis since May. Well, the third quarter really bore out that strategy, which was to focus on jewelry and to focus on petites. And it beat and raised, even though it was still seeing lower sales year over year and on a quarterly basis. But that said, investors rewarding that stock. Now, Abercrombie & Fitch, the same thing. Fran Horowitz really delivering there as well. For the Hollister brand, mainly, same sales, comp sales for Hollister up 16%, as opposed to a forecast for up 6 to 7% for the whole company. So not a bad story. The reverse is Burlington, right? Burlington used to be known as Burlington Coat Factory, and of course warmer weather stymied Burlington in many of major cities. At least that's what Burlington is saying. It didn't beat, it didn't raise. In fact, it missed estimates, and investors are really punishing that stock. Although, to be fair, Abercrombie was down 56% year to date before today's move. Burlington was actually flat year to date.
Thank you so much, Vani. I appreciate it. Have a wonderful rest of your day. Counting down to the opening bell. Here's a trading diary for the week ahead. After the closing bell, earnings from Dell and HP. Wednesday, another round of jobless claims, durable goods, and the Fed releases its beige book. Thursday, U.S. markets are closed for Thanksgiving. And finally, Black Friday, the unofficial start of the holiday shopping season, although perhaps this is a Black Week because it is clearly a full week affair. Turning to the economy, Krishna Mamani of Lafayette College writing, before the shutdown, stronger hard data anchored the market expectations. The lack of hard data is giving vibes a freer space. Krishna joins us now with his vibes ahead of Thanksgiving. Krishna, why is this problematic given the fact that people have learned to depend much more on alternative data sources, whether it's ADP or whether it's some of the corporate executives on their earnings calls?
Well, I think people talk a good game, but if you go back and look at how the markets have reacted over the last 4 or 5 quarters, the vibe data has been reasonably soft, and then hard data comes out and kind of gets it out of that particular funk. So yeah, I mean, alternative data are certainly is helpful, but I don't think they tell you the whole picture. That has been the case for a while. So if third quarter GDP, as Michael Key says, is going to be reasonably strong, and the underlying deficit situation hasn't changed that dramatically, at least not yet, then it's kind of unreasonable to expect for things to slow down massively despite the vibes.
Does that mean, Krishna, those on the Fed that are arguing for a cut are making that argument based off of vibes? Is that a problem if they are?
Well, I mean, part of it is vibes, but I think the labor market is certainly softening, and therefore, getting ahead of it makes a little bit of sense. I was a little surprised as to how hard Jay Powell pushed against that cut in the last meeting. So he clearly had a bit of a situation in the committee. And I think with everyone else kind of lining up, or at least the voting members lining up, he's in a much better situation, so any doubt. Not much layoffs, but not much hiring either.
So, okay, we have to read the tea leaves to understand where this economy is. And then when it comes to the Fed, Krishna, we've gotten to a place where we're counting each vote. Who's on the hawkish side? Who's on the dovish side? Who has an ear to Powell? Who's the top lieutenant that could sway things? Is it a problem that you don't have that clear message coming out from the Fed? Because as we've seen, it transmits into markets, and there's been a lot of volatility from that. In this new era where the economy is confusing and there's a divide among the Fed, is that problematic for the transmission of policy?
Well, so, if you think about it, you have 2 separate blocks forming on the committee. And those blocks are, the presidents on one side and the committee, the FOMC members on the other side. The challenge is when Jay Powell was in charge and there weren't all sorts of politicking going on, it was easy to kind of get to a consensus. And right now, you can't get to that consensus. So I think until the new chairman is announced, that particular challenge will probably persist with us, and we'll have to kind of slog through it somehow. That being said, I think, as I said before, the labor market was slowing, continues to slow a little bit, not catastrophically so. So I think the pushback for the last cut, for the future cut, that Jay Powell provided maybe was slightly misplaced, and the markets are basically calling him out on it.
Krishna, heading into 2026, since this is the moment of year-ahead outlooks, and everyone seems to be giving one, how are you seeing the year shape up in terms of risk-reward for the stock-bond allocation, and just, what are you baking in terms of Fed action behind that?
Well, so I think if you look at the market projections, there are a few more cuts coming down the pike. But the key thing with cuts is, even if they do come, I don't think they change the tone of the market meaningfully. It'll still be driven by growth. It'll still be driven by what happens in the labor market. I think one or two cuts in the front end of the market does. You look at 10 years. Hasn't really moved much despite all the talk of Fed cutting and Fed not cutting. So I think that sort of tells you how it will persist. And that's the environment where inflation is still up, so 10-year cannot drop too much, and growth is slowing down, so or at least modestly anyway. And that's not an environment where risk assets do fabulously well off of very high valuations. I think that is really the challenge for the market right now.
So you see kind of a middling 2026 in terms of returns for both stocks and bonds.
Yeah, again, there are people out there saying that it'll be another double-digit type of, a high double-digit type returns. I can't square that with what I see there. For that, everything, all this AI-related stuff has to come much before than it is likely to come. So I think the profitability outlook is decent, but it is not as superlative relative to current valuations. I think that's the biggest challenge for the market.
Krishna Mamani of Lafayette College, have a wonderful Thanksgiving. Thank you so much for joining us. It feels like a Rubik's Cube right now. It feels like people are picking up different threads of the narrative, pointing to the idea of rate cuts along with AI escalation, and saying it's going to be a really good 2026, and other people saying, watch the economy and it's not so hot. What are you focused on in the next couple of hours? I know you're going to be heading over to do another 2 hours of television.
I am indeed, and it has to be the churn underneath the surface of these big tech players, because it kind of dominates all these themes, because it's an economy that's becoming more reliant on the AI spend. So if NVIDIA is kind of losing some of its throne to Google, what does that mean for all the spending, the investments, and thus the American economy?
Yeah, this is what we'll be talking about for many days and weeks to come. Coming up tomorrow, Amy Wu Silverman of RBC Capital Markets, Dan Ives of Wedbush, Deborah Cunningham of Federated Hermes, and Vinu Krishna of Barclays. This was Bloomberg Surveillance. Good morning.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Our North Star is do the work. Keep your head down and do the work. There's always going to be speculation in our business. We're in a massive time of disruption, and everyone's going to constantly be saying, what's going to happen next? Who's going to be there? You can't focus on that. You have to focus on the work. And I think what's so exciting about Warner Brothers right now, even though it's an over 100-year-old company, we all approach it with like startup energy. So it's actually a really great time to be making movies.
Our teams are used to it because it's
this company's been bought and sold.
Right.
Yeah.
Some of the inherited Warner people, understand this feeling. But when we started to work for David, his one of his edicts to us is, challenge all assumptions. The business has to transform. It has to adapt to the moment we're in. And we talked about Moneyball a lot, because Billy Beane in that movie and in the book was all about adapt or die. The company right now has been battle tested and has been challenging assumptions for 2 years. As far as the day-to-day, we're heading for that split. That's the course that David has charted. And people trust David because this whole slate strategy, this whole diversified slate, the label strategy, getting DC up on its feet, getting Newline pumping, getting animation, which comes online for us next year, pumping, we still think it's the winning strategy.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
A little bit of a pause after yesterday's rally. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Google's AI ascent is poised to shake up the rankings of the world's most valuable companies.
Meanwhile, investors combing through a full bag of retailer reports. Delayed data suggests some consumers are hitting pause on spending.
And oil swings on a report that Ukraine agreed to terms of a peace deal with Russia, though some minor details are still outstanding.
So a lot to comb through, but kind of the dominant story is what's happening with Meta and what's happening with Google, because late yesterday, Meta reportedly in talks to spend billions of dollars on Google's AI chips by 2027. It would establish a real challenger to NVIDIA's AI chips. I spent probably too long reading about the differences between TPUs and GPUs last night. Oh, look at us. This is our life now.
Yeah, I now know about tensor math, which I had no idea.
I'm sure that'll be very useful in daily life
about
for you.
before. Yeah. Well, when I'm talking to Caroline Hyde now, I can pretend I know what I'm talking about. NVIDIA shares are down on this news, and the concern is that it could lose its title as the most valuable company. That's one of the concerns, prompting investors to reevaluate a potential new AI pecking order. You can see a drop of 4.5%. I looked at a chart, though, of NVIDIA shares versus Google shares over the last 5 years, and this chip maker still has come so far so fast.
It is very true, but that's why so many people got out there and said, hey, look at Alphabet. Maybe it's undervalued. Maybe it's catching up. And for more on that competition, we welcome Bloomberg macro strategist Michael Ball and Bloomberg Tech co-host Caroline Hyde. Caroline, I think you can fall into the camp of people who's been like, hey, I've known this for a while. I've known that TPUs are so efficient. Does it really make a difference that you have Meta now buying into this? What does it mean to have a market awaken to the possibilities of what Google has developed?
I think what's different here is before Alphabet had been selling it as part of the cloud winning formula. Come to us, you can use our cloud and you use our TPUs, which are on their 7th generation now. They've been developing these for 10 years. They've been offering them to other clients since 2018. We haven't seen them really sell them specifically to others to use within their data centers, not just Meta, but maybe banks who need to trade at high frequency. That's a clear area of edge for them. So they're starting to get this inbound. In fact, a lot of analysts, Stacey Raxton over there, we've heard also from Bernstein, you've also heard from Gil Luria saying this is kind of an obvious dimension of the business model. The question, though, is what will NVIDIA do about it? Now, we've heard before reports from The Information that OpenAI was getting very close to potentially taking TPUs from Google, Alphabet, maybe using their cloud more ever since that relationship when Microsoft got disrupted a bit. And then NVIDIA went and put $100 billion into OpenAI and said, oh, please do use our GPUs if you wouldn't like to. What is Meta going to suddenly get offered from Jensen Huang? That's my key question, because you've seen big deals with Anthropic, but Anthropic suddenly has got some more investment from NVIDIA as well. There's going to be a tussle at the top here, but be sure, Jensen Huang's been eyeing TPUs for a while, and Alphabet, this has been a winning formula. That's why Gemini 3 has been so efficient, and efficiency's everything. It's all about energy and what more they can do with it, because that's going to be the bottleneck.
Yeah, we have actually updated our circularity chart, which continues to grow and boggles the mind no matter which form you look at it in. Michael Ball, is this a problem for the whole market? I mean, so much is built on NVIDIA reigning supreme. Here's the new version, right? And you can see all of the deals that they do with other big players like AMD, like Oracle, like Microsoft, like Intel, and that those players do with them. So if NVIDIA is brought down, is it a problem for everybody?
I don't think so. And this has been the question that the market's trying to figure out, because capital so far is staying in the market. So although we've had NVIDIA now break below that 180 level, which was a key battleground and had a lot of sort of positive, negative connotations if it was below or above, the fact that Google has taken on $1 trillion and that the market is just finding a more efficient answer to the AI CapEx question. And that's what we want to see. We want to see competition. We want to see these guys have choices. We don't want the hyperscalers all bottlenecked into one choice that has backlogs growing and energy efficiency questions. We want optionality. We want capitalism to work. And that's sort of what we're seeing. And although it's violent in some ways, given the price action of the winners and losers, it is a positive development in the long run.
Okay, so if we do get, and we have, something more efficient, something more energy efficient, Caroline, is that enough? Or is this an ecosystem that's incredibly sticky? So even if there are hyperscalers and others who want to use Alphabet's chips, if they're already with NVIDIA, can they just so easily change over?
What's going to be interesting is how the development of the software works out here, because we understand that Alphabet is doing a lot to show the prowess not only of the TPU, but also the software that goes with it, and some of the ability to use software that's adjacent, not just their JAX, which is their own programming language that they've developed to go alongside TPUs, but you can use others that use different ecosystems. Look, the thing with NVIDIA is that they have CUDA, and everyone is locked in not only to the hardware that NVIDIA offers, but the entire ecosystem that NVIDIA offers. If Alphabet can start to chip away at that and show, look, with us you can have prowess the entire way through, I think there is going to be a real recognition that this is a clear alternative. But remember, the whole vertical integration story, what Google has shown so well is that it can develop incredible models because it's using its own tech stack, and then it's putting it out into the ecosystem. We're all using it. Look what Alibaba is just announcing. They too want to be a full vertically integrated company that makes their own chips, that develops the models, that offers it out on their cloud, and then offers the models as well. But also remember, this is what Amazon does. Yes, we're talking about TPUs, but Trainium is on their third iteration. We understand that many people are using not only for training, but are we going to use it not just for inference, but the training of models as well? How much can Amazon start to show its competitive edge as well with its chips, not just its AWS offering?
By the way, maybe you can clear something up. I don't really understand Jensen Huang's argument that the GPUs they sell, what are we in now, Blackwell or Hopper?
Vera Rubin for the next one.
Right, so those are capable of many different things, right? The graphics processing units are flexible, as you may have read last night, whereas the tensor processing units are supposed to be ASICs, so they're application specific. However, if that application is AI,
machine learning,
I don't care if GPUs can show me good graphics. I want AI, right? From
and I think this is where the battleground is going to be. How much efficiency can you wring out from this hardware with the software within it? And if Jensen Huang can say, look, my GPUs have been able to accelerate your AI models, your machine learning that much faster. And by the way, I've got a chunk of change that I can continue to invest in you as a company and continue to invest in your entire ecosystem. Maybe there's the winning formula. But this is why Google has made everyone sit up straight and why analysts have become noisier and noisier as to how much this has been a winning formula for them, is that the DeepMind were able to go directly to their semiconductor team and say, look, with this, we're learning this, let's work in it together, let's understand where the efficiencies can be brought. And I really do think that the infrastructure issue is not going to be whether you eventually can lay your hands on the hardware. It's going to be whether you can do more with the grid, with the electricity. And if they can show energy efficiency at this point, that's going to be what's music to the government's ears and therefore to users' ears. But I just think this turf war is just starting. We're all going to start talking about Inferentia and Trainium and what Amazon's doing and what everyone else is doing in ASICs. Because remember, that's what Broadcom's been doing so well on. All these companies, Meta's designing its own chips.
Broadcom was up 12% yesterday.
OpenAI is developing its own chips. Eventually, maybe that's going to become commoditized, not just large language models.
So it's a world where there are different changes, Michael. I mean, it's no longer sort of like the tide is lifting all boats. You have to be more discerning with what these companies are doing.
Right, and I would add that the depreciation question now is even more forefront, right? Because we don't know, to everything you just said. I do this, I watch this, and my head is blowing. Like, it's just so much to keep track of. And as an investor, if someone who's trying to look at a balance sheet, whether it's a hyperscaler or whether it's the provider of these chips, looking at the backlogs, looking at the inventory builds, how much is this all gonna be worth? If there's all these new options of energy efficiency versus training, inference kind of duration, how long something stays practical and efficient.
Well, this is why Zuck is supposedly thinking about renting them, right? When I look at a new EV out there in the car world, that's where my mind goes. I think, why don't I lease it instead of buy it? Because there's going to be something better in 2 years anyway, and who knows about the battery. I want to ask, though, more about Danny's question, which is that you have less sector correlation if two people in the same sector are at odds, right? So...
Well, funny enough, tech's still been under pressure. So looking at what I like to look at the option markets and seeing where sort of bullish skew / bearish skew is, people are still very negative on tech. People have obviously rotated into more value-focused sectors like healthcare, like defensives. And that makes sense in a lot of ways because the valuation thing over the last 3 weeks has been what spurred this. But to your point, that like internal battle of is this good for the overall AI CapEx story is still being fought out, and we're not seeing it with people trying to regain exposure to it. Google calls are expensive, the ball's a little bit high, but it's not necessarily being reached for like we've seen in NVIDIA in the past.
And can I ask whether this whole short OpenAI suppliers, long Alphabet suppliers is still working? Because yesterday Oracle pushed higher, but today Oracle's back trading in negative territory before the market opens. Is that long in the tooth, or are we still thinking about that trade?
You know, that's a great question. I don't understand, quite frankly, if everyone's sort of in this together in a lot of ways, why there's been such differentiate to this scale. Now, I get the weaker links were being picked off, but we're looking at CoreWeave and Oracle's down almost 50–40% in their equities, and then obviously we know what's going on with their CDSs. So it looks like we've had that emotional pulse come through the markets, as we often do, and now valuations are sort of reset in a lot of ways, and it's suddenly like going to be a point where people might try to pick bottoms. Now, I'm not calling for that, but I guess to your point, it can't all just go back into Google now. Like, we've got to have this ecosystem of going on.
Apple's next, like, is that the...
Yes.
So at the moment, it's NVIDIA. Apple's at, what, 4.2 trillion, there or thereabouts?
I think the Apple questions are incredibly fascinating. But bottom line is this market may have gone from a monopoly operator to an open ecosystem in AI, which is fascinating. Michael Ball of Bloomberg Markets Live, thanks so much for joining us. Check out his work by typing MLIV on your Bloomberg terminal. And of course, Caroline Hyde, you can see her. Well, we feature her on our show every day, but she actually has her own show, Bloomberg Tech, that kicks off at 11. Now, Ukrainian President Volodymyr Zelensky says talks with the U.S. about a peace plan are ongoing. His comments follow a report suggesting that Kiev agreed to the terms of a potential deal with Russia. There's also a report that Russia no longer agrees with this deal. Let's bring in Bloomberg's Russia economics and government editor, Greg Sullivan. So, Greg, is it possible that the U.S. has manipulated this 28-point peace plan to something that Ukraine could accept, but now Russia doesn't want to deal with?
Well, that's still unclear, but what we do know is that President Volodymyr Zelensky did say that talks were ongoing. Of course, that comes today as U.S. and Russian delegations are meeting here in Abu Dhabi to discuss the proposal and the peace plan. More broadly, we've seen recently President Trump has signaled that there's progress that has been made. Zelensky seemed to echo that last night in an address to his country, that there was progress being made towards these proposals after talks in Geneva over the weekend. The original 28-point proposal that the White House proposed basically adhered to Russian positions. Obviously, once in Geneva, they tried to narrow the differences with the Ukrainian side, with both sides signaling that there could be progress. But that leaves open the question, how much did this deviate from the original 28-point plan, and will Russian support still be there? Russian officials have cautioned that they have not seen the revised proposals, that they're waiting to see those. But they they have signaled that if it deviates too far, that could risk their support going forward. So a lot of questions remain as the talks are ongoing, both with the Russian side and the Ukrainian side on these proposals.
All right, Greg, thanks very much. Greg Sullivan there talking us through what we know so far, which is just a lot of reporting, and we're going to continue to bring you that as it crosses the wire. Check on futures as we head towards the opening bell. We're looking at very little change on the S&P, but remember we had a runaway rally yesterday, adding over 100 points. The NASDAQ had one of its best rallies that we've seen, I think, since May. Yeah. So tech stocks really getting a leg up. And the small caps actually gaining this morning in the pre-market, so we'll see what happens when the bell rings.
Helping with yields that are coming down this morning. Also on our radar, some of the other movers. SanDisk, that is climbing. It's going to be replacing Interpublic in the S&P 500, another AI-related company, just underscoring how much of a bigger makeup it is of overall markets.
J.M. Smuckers lowered the top end of its full-year guidance after scrapping planned price increases on coffee products.
Meanwhile, some retail reporting this morning, and Macy's surging off the back of its peers like Kohl's reporting strong results.
Coming up, retail earnings. We're going to give you a lot more, showing signs that consumer spending remains healthy into the holidays, even with the miss that we got in retail sales. We'll explain on the other side of this break. This is Open Interest.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Let's get now to high interest. Look at what's making headlines around the world. Wall Street's top cop is warning private market giants to quit playing games with their numbers. Jay Clayton, who runs the DOJ's Manhattan office, says regulators are zeroing in on how firms value private assets, especially when they shuffle them between funds and continuation vehicles. The former SEC chair says watchdogs won't tolerate price picking that puts firms ahead of investors. And Wall Street's macro desks are headed for their best year since 2009 as investors pile into bets on shifting global interest rates. Goldman Sachs, JP Morgan, and Citi are set to haul in $165 billion from fixed income, credit, and commodities trading. That's up 10% from last year. Rates desks are the standouts, with G10 revenue hitting a 5-year high of $40 billion, while emerging market macro traders will rake in a record $35 billion. But one consultant says don't count on that coming through in your bonuses. U.S. home sellers are pulling listings as the market cools. Nearly 85,000 homes were delisted in September, the most for that month in 8 years, according to Redfin. High rates and affordability woes are keeping buyers out, forcing sellers to hold off rather than accepting lowball offers. Miami led the pullback with almost 8% of listings yanked from the market. Danny?
Meanwhile, a number of retailers matter reporting this morning. We heard from Kohl's. They raised their full-year outlook. That's the second straight quarter they've done it. They also named Michael Bender as permanent CEO. Abercrombie, that's surging this morning, up 16%. They boosted their outlook. They cited demand for its Hollister brand, which I was super into in high school. And Dick's raising its outlook again, but investors focus on the cost of trying to turn around the Foot Locker sneaker chain that it recently acquired. Let's bring in Bloomberg consumer editor Emily Cohn. Emily, maybe you set Dick's to the side for just a moment.
Yes.
These seem like really good results in a period that like maybe the consumer was supposed to be a bit more challenged.
I agree. I think, you know, it continues what we were speaking about last week with this tale of two retailers. Today we're talking about a split screen consumer spending picture where we see the companies that are known for brands that add value. So we have Kohl's. You can go into a Kohl's and buy Nike. You can buy Sephora makeup. Abercrombie, the Hollister brand, really resonating with teens. And then with Best Buy, it's people going in there to buy expensive iPhones. Consumers are willing to spend when there are brands that they know and trust and know that they're going to get value for what they're shelling out money for. It's the retailers like Target and Home Depot where that value, that brand proposition just isn't quite there. That's where we're seeing the slower spend.
So what's the problem then with Foot Locker? I know this has been an ongoing saga, but I feel like if I wanted to buy sneakers, the only two names that pop into my head are Foot Locker and Finish Line, right? So why can't they sell shoes?
I think Dick's would agree with you, like in the long term, that this is going to pay off. I think what investors are seeing today is the cost of turning that around and are not happy with that and the timeline here. But clearly, Dick's sees promise in that premise long term.
All right, Emily, thanks very much. Bloomberg's Emily Cohn there covers retailers for us. We're following all the retail earnings out this morning, and we also got some retail spending data. We got more economic data that was delayed is trickling in. So retail sales data came in below estimates. PPI came in line with estimates. Those are the big headlines, I think, other than ADP. Let's break down all of it with Bloomberg economist Stuart Paul. Stuart, how do I read this retail spending data? Because it looks horrible, right? Retail sales advanced month-over-month reading only a gain of 0.2%, and we were looking for double that in the survey.
That's right. The thing that's really shocking in the retail sales report is that auto sales, vehicles, were down during the month. When you look at alternative data sets, it looks like unit sales of vehicles was up about 2%. So that's why we missed on the headline. When you then look into the control...
By the way, why is that? Is that because of discounting?
It could be because of discounting, but it's also just different measurement according to different factors here. If you're including vehicle parts, and parts were down, and that's creating the drag in retail sales, that could help to explain some of the disparity. But it's pretty poor just across the board. The only thing that was really propping up the headline is spending on healthcare, which folks have to do when they're feeling sick, spending on furniture, household durable goods, and a bit of spending on dining out, which of course is a good thing. A little bit of discretionary services spending is good. But what's most important here is that the downside surprise in control group sales means that folks are going to have to revise down their estimate for Q3 GDP growth. This was one of the last things that we were waiting on. And as the Fed crunches its numbers and then considers fading input cost pressures, which we saw in the PPI today, it should solidify a December rate cut decision.
do we care? It's September data. What difference does it make?
Well, so it's September data, but it does serve as a baseline for when we consider October. And a lot of what we're seeing in October is a little bit stronger than what we saw in September. We're also starting to see more alternative data when it comes to the labor market looking a little bit weaker. So it's still something that has to fill out our full data sets that we could get some sort of a comprehensive understanding of the macro. And for a Fed that's still looking to just get more and more and more information so that it can build a coalition somewhere around some decision, it's helpful to have a little bit more information.
Feels like we are a far ways away from that coalition. Stuart, thank you so much for joining us. Stuart Paul of Bloomberg Economics, and a quick look at some of the other movers on our radar this morning, Matt. Zoom earnings, those top expectations. They raised their full year forecast, leaning into enterprise products. People still use Zoom. Those shares are up 5 1/3%.
Yeah, people use it a ton. It's so
too much.
It's so shocking to look at the
like
poor
so
performance.
So many Zooms could just be phone calls.
It's down, by the way, year to date and over the past 5 years. All right, we're going to come back. The closing bell in 7 minutes. This is Bloomberg.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Check on futures ahead of the opening bell. We're looking at, it's kind of lame actually, down 0.1% on the S&P 500. Not getting me going. NASDAQ futures down about 0.4%, but we had our biggest rise since May yesterday in the cash trade, and Russell 2000 futures, they're up a little bit, but that's because the 10-year yield is moving back down closer to 4. 4 minutes to go until the opening bell. Morgan Stanley Investment Institute's Tichania Kandari on the other side of this break.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no. I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're seeing lackluster futures trade this morning with S&P futures slightly in the red. NASDAQ futures down a little more after the outperformance that we saw yesterday. Ringing the opening bell at the New York Stock Exchange, Aero Mexico. It's clear what they do, and their stock just started trading there a few weeks ago, so watch this space. I think more interesting is ITRN. This is a company that had technology to find and retrieve stolen cars. And unsurprisingly, the shares are up like 173% on a total return basis over the last 5 years, because as cars get more and more expensive, used cars as well, more and more valuable, more people are going to steal them.
I'm just really upset by the lack of ties in both these groups.
Yeah.
It's like no one, you're ringing the opening bell. Show up in a tie.
I mean, it's truly slacking off. It's not Friday even, right? So
it's not Friday
on a Tuesday,
even.
You're ringing the opening bell at the New York Stock Exchange. That's like part of the pinnacle moments of your career.
Right.
Wear a tie.
Right. I mean, look,
be decent.
Thank you, Matt. I agree with you. All right.
Not the West Coast.
Some stocks are watching this morning away from the world of fashion. Meta reportedly in talks to spend billions of dollars on Google's AI chips by 2027. That means that with this boost we're seeing to Alphabet, it's not as strong as it was in the pre-market trade, but up 1.5. It is nearing that $4 trillion mark for that, Matt, and Meta, that's also up 1%.
All right, that is honestly not only the story of the day, but the story of the week. NVIDIA shares down on increasing competition. It could lose its title as the world's most valuable country. We're not like inches away, but we're getting there, as Google is set to be worth, possibly now as it started trading live, more than $4 trillion, and NVIDIA getting ever further away from that $5 trillion mark that it hit a few weeks ago. Joining us now is Jitanya Kandari, Deputy CIO of Solutions and Multi-Asset at Morgan Stanley Investment Management. Solutions are very important, so congratulations on that. I wonder what your take is on this AI race, because all of a sudden the narrative is shifting from a monopoly story to an open ecosystem. Is that the case?
Yeah, so I think the markets are the best barometer, right? So if you look at year to date, in the Mega 7, only 2 out of the Mega 7 have outperformed the S&P. So the market's been very discerning, and I think that's the way forward, because you have a lot of these issues as, within the AI chain, whether it's like raising debt to fund CapEx, the whole circular funding, and hitting constraints on electricity and power. So you really have to be discerning at this stage of the AI cycle and move beyond just the picks and shovels and the providers of the new technology to the adopters and the users of this technology, which means more industry-wide usage and how companies will harness the power of AI to improve their efficiencies and their profitability.
It does feel, though, that on the other side of more efficient and profitability, that is slow. We had a guest on who was a spinoff from IBM basically saying that a bunch of companies are stuck in pilot purgatory. I was speaking to Ed El Husseini, a Threadneedle earlier, who said that the promise of some of these efficiencies hasn't fully come to bear, and it won't fully come to bear. The trade that goes beyond AI and the use of AI for companies, how long does that take? And is that as clear-cut as maybe we once assumed?
Yeah, I think in every past tech innovation, the productivity gains always have come with a lag. So I don't think this time is going to be different. And I know, there are two schools of thought. One is that the usage and the uptake has been very slow. And another one that is, yes, it's pilot stage. The delta of change is positive. So I do think that I see it personally. I feel much more productive with using some of the, AI tools today. And I think over time, some industries will adopt faster. And I think incumbency has an advantage here. So in industry verticals where companies have already an existing moat, they may be able to even expand their moat and harness the AI potential to really drive efficiency. So you really need to look outside the typical tech names in healthcare, in retail, in e-commerce, in music, in digital platforms. And we find a lot of opportunities all over the world that we think will really be able to do well in this new environment with this new resource.
We recently saw a new Porsche Cayenne, an electric version, stick with me here, that a lot of people thought looked like a Chinese design. And their reaction was, I might as well just buy a Chinese EV, because they're all the same in terms of massive acceleration. And if they look the same and the quality is comparable, what's the difference? Are we thinking the same thing about AI models? Do you see, cheaper, more efficient AI models coming out of China that we might as well use instead of the American ones, if they're just as good or better for the same price?
Yes, great point. I think just like we had the two internets, beyond, there will be the silicon curtain with two AI ecosystems, right? And as you said, the three differences between the US AI and Chinese AI ecosystems. One is US is the high-cost innovation model. China is the low-cost inferencing model. Secondly, US is spending CapEx at least 7 to 8 times more than China. So the China CapEx spending is not to the same extent as the US. And China is the country in the world which has excessive power and electricity. And US is running constraints on that data center power requirement. So I think these are the big differences. And yes, Chinese model in terms of the digitized economy in China will help harness the B2C, which is business to consumer applications, in a much more accelerated way. That's my opinion. I was just there, and it seemed really interesting how they are really using those super apps in the consumer-facing apps to harness this. And I'd say one last thing. This year, Chinese Mega 7, we have like a basket, have outperformed the US Mega 7. Interesting. The bulk of that outperformance has come from a multiple re-rating. Earnings haven't done anything. In the US, a large part of the outperformance has come with the earnings momentum. I'm wondering whether finally Chinese earnings pick up and the US earnings could roll over, especially in some of these names. So it's an important inflection in the markets and something to keep in mind for global investors.
Jitani, this also makes me think of the politics of the moment, because it's a U.S. that part of the negotiating leverage has been NVIDIA chips and their willingness to give them H20s or H200s. Do they lose that edge in this debate if all of a sudden China is running more efficient models and they can use old NVIDIA chips to do just as much work or something more internal?
Yeah, so clearly US has that lead and China is behind. They are closing that gap, but I don't think it'll take a long time to get to those superior chips. But, you know, they are reasonably good models and they are cost efficient. So far, so good. I'm sure, you know, there will be, you know, the high-end industries and the high-end chips, wherever they are needed, US will clearly have the lead. But I think from an overall perspective, there is a lot of merit in what they've been doing.
All right, Chaitanya, thank you so much for joining us. After your world tour, that's Chaitanya Kandari of Morgan Stanley Investment Management. Let's get a check on your stock market right now because we are about 9 minutes into your trading day. We're moving higher by 0.1%. The good news is that's some pretty good breath. 406 stocks moving higher this morning. Moving higher is a lot of the tech players. Surprise, surprise. Alphabet is helping lead us there. Apple is also there too. Broadcom helps in the development of some of those TPUs. To the downside, it is NVIDIA. And this is perhaps why we're unable to get any really big gains. NVIDIA getting crushed, down 5%. And considering how big this company is, that means it's subtracting nearly 27 points from the S&P 500. And this is about the circularity of this economy. Microsoft is down, Oracle is down because these are companies that have deals with NVIDIA. What does it mean if all of a sudden NVIDIA is under stress? Looking at the sectors this morning too, again, it's a push and pull from tech, but it leads us overall lower just because, again, NVIDIA is such a large weight, so it doesn't matter how well Alphabet is doing. But Alphabet is going to be at the top with your communication services. That's followed by healthcare, materials, consumer discretionary. It's interesting that that's not doing better considering we've had some good earnings. Maybe it's Dick's Sporting Goods, though, that's making it so it's not doing even better because of the closing of Foot Locker stores, putting some pressure on that. But overall, Matt, we are just ever so slightly higher after a negative future session.
Anytime you know, Joe can click right into one of those sectors. So anytime you're looking at a sector and you're like, I wonder what's behind.
Can I trial this, Joe?
Yeah, you can just say, hey, Joe, click in there.
Joe, why don't you click on consumer discretionary for me? Because Matt has made me do this. I'm going to blame him. Let's see what's going on. You know what? It is the cruise. You know, Matt, this was very worthwhile. It's the cruise operators bouncing back. Carnival got crushed yesterday because there was this Barclays report that said that they talked to management and they were kind of negative or at least hesitant. So it was a big sell-off. And we are buying that dip. So thank you, Joe, for that valuable piece of information. And thank you, Matt.
Yes, well, thank you, Joe. I thank you, Joe, as well. Coming up, more on the budding rivalry between Google and NVIDIA. Mandeep Singh of Bloomberg Intelligence joins us next. This is Open Interest.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Used to be, one would say, What's that got to do with the price of tea in China when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Top calls for you on this Tuesday morning. The analyst action we're focusing on. First up, Redburn. They're downgrading Estee Lauder to sell. They say the turnaround rally looks overdone and investment needs could limit margin recovery. Shares down nearly 2%. Next up, Citi. They upgrade Brinker International, the parent company of Chili's, which has delicious chips and salsa, to a buy. The analysts say there is still legs to the story with fatter margins, solid sales, and easing beef costs after Brazil tariffs were cut. He added that Chili's is winning over younger diners, a key brand momentum. Finally, Alphabet shares, those are jumping on reports that Meta may spend billions on their AI chips, their TPUs, signaling that there's more demand for them. Analysts are positive on the news, saying that the deal could drive faster growth for Google Cloud and position Alphabet as a credible alternative to NVIDIA and AI infrastructure as market cap reaches near $4 trillion, Matt.
Yeah, it's I think the most fascinating story of the past few sessions, because it's really tens of billions of dollars, or could be, according to our next guest. Shares of NVIDIA continue to slump in early trading as the AI rivalry heats up. For more, we welcome the boss of technology from Bloomberg Intelligence, Mandeep Singh, joins us. And Mandeep, I was looking at your notes. Obviously, the capex of Meta is massive, somewhere in the realm of $100 billion in the next year, right? What proportion of that do you think they could spend on Google's tensors or TPUs?
Look, and I mean, you framed it perfectly. It's $100 billion for 2026, and Mark Zuckerberg has talked about spending up to $600 billion by 2028. So we know the capex numbers are going up, and what these companies are spending on training right now is a lot more than inferencing. But out of that $600 billion spend, I would bet, at least 50 to 60% would be on inferencing. And that's where I think it makes perfect sense for Meta, which has used NVIDIA so far for all their training and inferencing, to diversify and have a second chip provider, even if the chips are not as capable as the NVIDIA chips are, which are still the best of line. It makes sense. If you're planning to spend $600 billion, you got to have more than one provider, and I think that's the intent here.
If some of these competitors, Mandeep, want to spend even more aggressively to keep up with some of the technology changes, do you think the backers will still allow that to happen? Or does the competition between these companies, the fact that it's not everybody is a winner in this environment, change some of the capital needs and the ease of liquidity in this arms race?
Look, I mean, who would have imagined, Meta really buying something from Google? So the landscape is changing, the stacks are changing, and what NVIDIA told us during their earnings was, look, for every gigawatt, our content is going to grow. In fact, they said up to 30 to 35 billion. So if a 1 gigawatt data center takes up to 50 billion, they said our content is going to grow. And I think that message probably scares a lot of companies, because you don't want to be that reliant on one vendor in terms of the build out of your AI infrastructure. So from that perspective, also it makes sense whether it's AMD or Google TPU that you've got, other providers. And, that's where the market would be willing to fund a build out like that, as opposed to, where you have a virtual monopoly with one provider.
Mandeep, we've been looking once again at the circular investment chart. It's made its rounds over the past couple of weeks. Now the infamous Bloomberg chart. Is that going to be a problem if NVIDIA loses its basically monopoly status here? Is that a problem for Microsoft, for Oracle, for AMD, for Intel, for all of these companies that have done, circular investments with NVIDIA?
I mean, clearly the optics for NVIDIA didn't look great when they, invested in OpenAI, and OpenAI was buying back the chips. Since then, they have also invested in Anthropic. And to my mind, one thing is clear, that there will be a huge build out of AI infrastructure, whether it's coming from, OpenAI, or it's the hyperscalers, Microsoft, Alphabet, Oracle. You need a more AI infrastructure. And that's where, the circular financing obviously didn't have good optics, but I would argue, whether it's the free cash flow for the hyperscale providers or the private funding, it will happen. And it's just what's going to make most sense is if you've got more providers, if it's more diversified, that's when it's going to be more palatable. And I think that's where we are headed in terms of how diversified this is going to be.
Hey, Mandeep, just quickly, I was reading research in August, and I think that needs to be called out because it was well ahead of this, from Citrina Research, James Van Gielen over there, basically saying that the branding power that Google has is important, not just among the consumer, but the relationships with over 40,000 companies that it works with. Does that give it an edge in this race, the kind of ties it has, again, both to everyday people and to corporate America and beyond?
I mean, clearly Google has the best surface, 7 apps with over 2 billion monthly active users. So you could say they have the most impact in terms of the reach they have, and they are deploying their own AI. And that's where their cost efficiency when it comes to their CapEx is really coming into focus here, because they have accomplished a lot with the $90 billion in CapEx that a company like Meta hasn't been able to do so far.
Mandeep, thank you so much for this. Mandeep Singh of Bloomberg Intelligence on a vastly changing and vastly interesting story. Coming up, we get back to the consumer. Dick's Sporting Goods raises its outlook for the cost for its Foot Locker turnaround, concerning clients, or investors rather, sending shares down by nearly 3%. That's coming up next. You're watching Bloomberg Open Interest.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks right now, and you're going to see some big red arrows because NVIDIA is getting hit hard, and Google isn't gaining enough to outweigh it. So the S&P 500 is down 1/3 of 1%. The NASDAQ down 0.9 of 1%, unchanged on the Dow. But you can see NVIDIA now down 5.6%. That's a big drop for the behemoth chip maker. The concern, of course, is that people may choose Alphabet's chips instead. It came out with its TPUs that apparently made Gemini 3 so great, and now, according to the information, Facebook is considering buying a ton of those or renting some as well. So Alphabet shares up 1.2%, not enough to make up the difference. Macy's and Kohl's are gaining. Wow, Kohl's is up 33%. We had some strong retail earnings, even though retail spending was only half of what we expected and only 1/3 of what we saw last month, according to gains, or the prior month. Best Buy also up 1.75%. Dick's getting hurt, though, down 2.5% on the costs to turn around Foot Locker. Danny?
And let's get more into that story on Dick's raising its outlook, but the Foot Locker turnaround cost. Joining us is Bloomberg Intelligence senior retail analyst Lindsay Dutch. Lindsay, are we going to look back at this and say it was a mistake for Dick's to even buy Foot Locker?
Hi, thanks for having me. I don't think so. I think the big worry is, it is about the turnaround, how quickly they can do it and sort of execute a similar turnaround that they executed for the legacy business with Foot Locker. And you saw strong results coming out of that legacy business, 7th quarter in a row of more than 4% same-store sales. That's pretty strong in this environment.
What is the problem with Foot Locker that it really needs a turnaround? For those who aren't versed in this, it seems to be the only, sneaker store you can think of that's a pure play, right? I guess there's Finish Line, but I think JD Sports picked that up. So why isn't that the go-to destination for everybody who wants to get tennis shoes or basketball shoes or soccer shoes, which we now call football boots in this country, apparently? So why?
Right. So I think it comes down to assortment. And what happened is, Foot Locker, heavily exposed to Nike. Nike had its own missteps in its inventory, not putting out enough new product, not innovating. And Foot Locker, ended up, continuing this year. They just don't have the right assortment in the store. They don't have the newest product. They don't have the trendiest product. And Dick's is looking to change that around very quickly. They're looking to offload a lot of inventory by the end of the year. Basically, anything that is not new, sort of old inventory, is going to be extremely marked down. They're trying to get it off the books so that they can start next year fresh. They're also looking at the stores. They're looking into remodeling them. It sounds like a capital light type of strategy, just, showcasing the right assortment in the store and also adding some apparel. So they're really looking to turn that around pretty quickly to start off 26 strong and for an inflection by back to school next year.
All right, Lindsay, well, it's difficult today, for Dick's, but if you look over the last 5 years, this stock has basically quadrupled in value. Lindsay Dutch is Bloomberg Intelligence senior retail analyst, talking to us about one corner of retail. Coming up in the next hour, Marianne Bartels of Sanctuary Wealth breaks down her call for the S&P 500 to reach 7,500 by 2027.
game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Michael Wallace. Ukraine says there are minor details to settle, but it has agreed to the peace deal brokered by the Trump administration to end the war with Russia. The BBC's Jonathan Beale.
Rustem Umerov, the head of Ukraine's Security Council, said the US and Ukraine had reached a common understanding on the core terms of an agreement. He said Ukraine looked forward to organizing a visit by President Zelensky to Washington this month. America's made clear it wants to sign a deal quickly, and Ukraine is having to respond to that pressure.
There's been no official response from Russia, which launched attacks on Kyiv today, killing at least 7 people. The Pentagon may return Arizona Senator and former Navy Captain Mark Kelly to active duty so he can face a court-martial for misconduct. Kelly was one of 6 Democrats who released a video last week urging service members to refuse illegal orders. CBS's Nancy Cordes.
Kelly, who flew on 4 space shuttle missions, said if this is meant to intimidate me and other members of Congress from doing our jobs and holding this administration accountable, it won't work.
Snow in the upper Midwest and heavy rain in the Ohio Valley and Northeast could impact flight schedules today as more Thanksgiving travelers hit the road. This woman at Orlando's airport took some precautions.
I thought my flight would possibly be canceled, and I also bought travel protection just in case it does. I was very concerned.
FlightAware reports 1,200 flights are already delayed today. 50 have been canceled. More arrests in the Louvre heist.
I'm Vicky Barker at the Foreign Desk in London. Prosecutors in Paris say 2 men and 2 women have been arrested in connection with the $100 million jewel heist at the Louvre Museum, bringing to 8 the number of suspects in custody. It's not yet clear what part these new suspects are believed to have played in the theft. There's still no sign of the stolen jewels, including a diamond and emerald necklace given by Napoleon to Empress Marie-Louise.
The latest economic report delayed by the government shutdown shows retail sales inched up 0.2% in September compared to August. Spending moderated after consumers splurged a bit over the summer. Economists have warned consumer spending could slow during this fourth quarter as Americans struggle with inflation. There's a new study on women who stop taking their GLP-1 weight loss drugs before or during pregnancy. CBS News medical contributor Dr. Celine Gounder.
What they saw is when women stopped, they regained the weight quickly, and then you saw a slight increase in risk in things like gestational diabetes, high blood pressure, preterm birth.
Doctors recommended women who are pregnant not take the weight loss drugs. Stocks have opened mixed. The Dow is up 121, NASDAQ down 167. This is CBS News. The UN has released its annual report on the number of femicides around the world.
On this International Day for Elimination of Violence Against Women, new global and regional estimates find 50,000 women and girls were killed by intimate partners or other family members last year. That amounts to 137 per day. It also means one woman or girl is killed by a partner or family member almost every 10 minutes. The highest number of killings were in Africa, at 3,100,000 women and girls. The Americas had 1.5 per 100,000, while Europe had the least at 0.5. Linda Kenyon, CBS News, Washington.
The Consumer Product Safety Commission is warning customers to stop using lithium-ion e-bike batteries made by Rad Power Bikes. The agency says it has received 31 reports of the batteries igniting or exploding and causing fires. The company says it strongly disagrees with the warning and refuses to agree to a recall. Michael Wallace, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Brokers Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. Head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. Got some economic data coming out here in the 10 o'clock hour. Scarlett Fu and Paul Sweeney with you. Scarlett, looking at the consumer confidence data, 88.7 was the actual. Consensus was 93.3. Also down from last period's 95.5. So consumer confidence waning there.
Yeah, sliding the most in November in about 7 months. And of course, we pay more attention to this, even though it is survey-based data, because it's more current. All the data that we're getting right now from the government goes all the way back to September,
right.
maybe October. But I can't even remember what happened in September.
Exactly. We had retail sales come out also this morning at 8:30, a little bit weaker than expected. Let's check in with someone who's an expert in all this eco stuff. Yelena Shelyoteva. She is an economist for the Conference Board. And again, Yelena, thanks so much for joining us here. What do you read into a consumer confidence number of 88.7 versus kind of a consensus around 93.3?
Sure. So consumers revealed reduced confidence across jobs, incomes, and financial situations, both now and in the future. And that could potentially be due to a government shutdown. Remember that in the past instances of a shutdown, we did see a significant drop in consumer confidence in the months of a shutdown. So this data is for November. It was still going, and the 6.8-point decline in November is not that surprising, although there are some nuances. And I think the kind of the decline in confidence is broader than just government shutdown induced one.
So one thing that you do at the conference board is break it down according to the state. And we know that people's confidence depends on whether they are Republicans or Democrats. What does it look like when you break things down on a state-by-state basis?
Well, it looks pretty broad-based. This subsiding confidence is broad-based, based on the ages, based on political affiliations. Although in November, what was interesting, it was like the biggest drop was among independents in consumer confidence. I'd say we also look at write-in responses. And it's not only about politics, it's not only about the government shutdown, although we did see a little bit of a pickup in those mentions. It's about inflation still. It's still about tariffs. And I think that, the pass-through into consumer prices continues from tariffs, and we will see the bulk of that impact in this current fourth quarter.
Another number that jumped out at me, Yelena, is the conference board expectations. And the actual number came in at 63.2. That was at 71.8 last month here. So that seems like a big drop to me. And what does that number tell you?
Well, it's a big drop, and usually when expectations fall this low, it usually means recession, believe it or not. Obviously, we're not expecting a recession right now. Consumers are still relatively healthy and continue to spend, but that to me indicates a significant deceleration in economic growth. If you look deeper into the details of the report, consumers' views on their family current and future financial situation faltered in November. So government shutdown aside and all the different factors affecting it, consumers are feeling some strains in terms of their financial situation, their family's financial situation. And that is not affected by the news. Consumers kind of know what their financial situation is and what they are expecting, and they're not happy about it. They are cutting on their services spending plans as well. So things like, amusement parks and all kinds of different plans for that services spending are subsiding.
All right, Yelena, really appreciate your joining us. Yelena Sholyacheva is senior economist at the conference board on the U.S. consumer confidence data, falling the most in November since April on this growing anxiety about the labor market and the economy. Let's go now to Lisa Mateo with our Bloomberg Business Flash. Lisa.
You got it. Okay, so we have stocks mixed right now after that more eco data. You talked about consumer confidence. Also coming out this hour, pending home sales for October month over month. The expectation was for a rise of 0.2%. Came in much higher, a rise of 1.9%. Then earlier this morning, we learned retail sales rose modestly in September, and wholesale inflation, that picked up in September from a month earlier. Right now, the NASDAQ leading the losses. It's down about 0.5%. That's after the index soared more than 2% in Monday trading. NVIDIA, other chip stocks falling. A report that Meta is in talks to spend billions on Google's AI chips. So we have NVIDIA shares down more than 6%. It raised about $243 billion in market value. Advanced Micro Devices slipping 8%. Alphabet, yes, rising on the news, up more than 2%. And that's extending its surge over its latest Gemini AI model as well. It's also inching closer to a market value of $4 trillion. Now, meanwhile, that latest Gemini AI model from Alphabet, well, it has shares of SoftBank down more than 9% in Japan. There's concerns that it may intensify competition for OpenAI, and that's SoftBank's key investment. So we talked about the NASDAQ. We have the S&P 500 falling 0.2%, 14 points. The Dow off about 0.3%, 163 points. The two-year yield, 3.48%, down 1 basis point. The yield on the 10-year, 4.0%, and that is down about 1 basis point. The Bloomberg Dollar Spot Index weakening by 0.3%, and Bitcoin down more than 2% at just above 86,000. That is your Bloomberg Business Flash. Scarlett and Paul.
Hi, Lisa Mateo. Thank you so much. We appreciate that. Mixed red and green on the tape, as Lisa just reported. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we are joined by Bloomberg's Tatiana Darrier. Tatiana, what are you looking at today?
Yeah, just to follow up on Lisa's observation on NVIDIA, now down nearly 7% as its dominance in the AI race is getting challenged by no other than Alphabet. We're starting to see a little bit of differentiation here among the AI agents as everyone suddenly gets excited about their chips and their Gemini 3 model. And I'd say this is a little bit of a DeepSeek moment for the industry, right? But the key difference is that it's a domestic rival. So it's a really real head scratcher in terms of what it all means for the market. Well, for NVIDIA individually, it is a clear negative, especially given the reports that Meta is now in talks to spend billions on Google's chips by 2027. Well, my only question is, do they have the capacity to compete with NVIDIA?
That is the question, because we know that NVIDIA has not been able to meet all the demand that it's encountered so far. All right, let's move on to some retailers.
Yeah, looking at retailers, given the jitters about consumer and their spending, Abercrombie and Fitch, that stock is up 25%. Your ticker is ANF. Raised the low end of sales guidance as its Hollister brand continues to gain momentum. Net sales will now grow 6 to 7%, up from the previous outlook of 5%. The move just shows that the retailer is hanging onto some momentum as the CEO there is still trying to turn this ship around. The stock has done really well last year. It has lost some momentum, down about 50% year to date. So this brings some reassurance. It also joins a group of retailers like Gap and TJ Maxx, which have reported good results, showing that resilience among consumers, unlike other chains like Target and Home Depot. So yet again, another mixed season for the retailers, but still some signs of resilience.
And Kohl's, we don't have Kohl's around here, do we?
There is one in Yonkers. Or there used to be. I don't know if it's still there. I haven't been there in a long time.
Okay, I don't see him in Jersey. Okay.
Yeah, Kohl's, those shares up 35%. Your ticker KSS. The company boosted its sales forecast for the year, saying now it sees sales declining less than predicted. So it's not an outright change of fortunes here. They're still dealing with some softness, but perhaps less than feared. The market is taking this as a sign that the new CEO is helping to stabilize performance at the struggling retail, because this company has seen quite a turbulent period. It had to fire its CEO not too long ago because of some internal issues. So now it's getting back on its feet, but still faces a tough path forward. It has now posted 15 straight quarters of declining year-over-year
Stock
revenue.
is up 35% today.
Yes.
That is a huge move.
Yeah, but it's tanked in recent years.
Yes,
so.
it has. It has. You're right. I mean, this is the first positive report I can remember from Kohl's, like, ever.
But the direction is still down, as Tatiana pointed out.
Yep.
What? How many straight quarters of declining
15. So tough road ahead for the new CEO, but nonetheless, some good news today.
Yeah, I mean, absolutely. We'll take it. And stock's up 50% year to date, so maybe they've kind of hit a bottom. And hopefully that new CEO got options when he joined, which are now way in the money, I would guess.
I'm sure that they had to entice him with something.
Exactly. All right, Tatiana Darrier, thank you so much. Tatiana is a strategist for Markets Live, Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. What are you looking at here today, Scarlett?
I was just paying attention to Kohl's stock, and the stock the high was back in 2018, $55. And then by, I would say, April of 2025, it got to about $6. So it's been this very up and down performance. Certainly the pandemic was the last big low, but then it did mount a bit of a recovery here. But I think it goes back to that idea where you weren't quite sure, where you've last seen a Kohl's.
I've seen them all over the Midwest. That's my thing. I think
they
it's
have shut down some stores as well, the underperforming stores.
Yep. So I just think, that department store business is a tough business. We've seen decades of shrinking footprints across the U.S.
And those are just for the higher-end department stores, too.
Yes.
I mean, this is a department store that caters to families and value, and people can go to TJ Maxx for value.
Yes, exactly. So it looks like maybe they've found their footing a little bit there, so good for them. The markets here today, I'm going to call out Bitcoin. Tom from the Upper East Side asking for a quote, down another 2.5% today, 86,500. So people still some concern there. WTI crude oil off another almost 3% here today. It's $57 a barrel for WTI crude oil. Again, I watched episode 2 of Landman yesterday. They don't like oil with a 5 handle. They like a 7 handle on there.
What else do you learn from Landman?
How to curse. I mean, some great world-class cursing from Billy Bob
They don't bring
Thornton.
in geopolitics into Landman, though, right? There's no Russia-Ukraine kind of thing.
Yeah, but they, it's very pro-energy talking points. So somebody was on the radio talking about, gee, this new administration, the Trump administration,
like from a
not
Texas
helpful.
point of view?
Yes, exactly. Very pro-energy point of view, and some people would say maybe a little overboard, but it's a lot of fun. So we're watching that, and that's where I learned about
Makes for
oil
good
and
TV.
natural gas. Exactly right. S&P 500 off 8 points, the Dow up 150, and the Nasdaq down 125. Coming up, we're going to check in with Mandeep Singh, Global Tech Research Head at Bloomberg Intelligence, on this whole NVIDIA Google thing. It's moving stocks. I mean, when NVIDIA moves 8-9%, it's like $240 billion of market cap being wiped out in a single trading day. So we need to get involved with that. That's coming up.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And is Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Well, tech shares taking a hit. This is on thoughts of a market shakeup. AI chip rivalry between NVIDIA and Alphabet escalating. Checking back in with NVIDIA shares right now. They're down about 6%. That's after the report. Meta's in talks to spend billions on Google's AI chips for data centers in 2027. Alphabet up about 3%. So we go to the NASDAQ, down 0.5%, 138 points. The S&P 500 down 0.2%, 14 points. And the Dow rising 0.1%, 79 points. The 2-year yield, 3.48%. That's down 1 basis point. The yield on the 10-year, 4.00%, and that's down about 1 basis point. Commodities, we have to check in with COMEX Gold up 0.7%, $4,161 an ounce. Brent crude down about 2.5% at $61 a barrel. WTI crude about $57 a barrel. To retail earnings, Kohl's shares right now up 34%, raise its full year outlook for the second straight quarter. Abercrombie & Fitch also seeing a nice lift, 26%. That's what it's rising. It raised the low end of its full year sales outlook. Strong back to school demand for its Hollister brand. On the downside, you have Burlington stores, their shares down to about 10%, and Dick's Sporting Goods down about nearly 4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, as Lisa was reporting, Meta Platforms in talks to spend billions on Google's AI chips, suggesting that the search giant Google has made the case that it can rival NVIDIA as a leader in artificial intelligence technology. Let's check in with an expert who's got an opinion there. Mandeep Singh, senior tech analyst for Bloomberg Intelligence. Mandeep, what do you make of this news with Meta investing and spending money on Google's AI chips? What does that mean for the space and NVIDIA in particular? Because we're seeing some big moves in the stock market today.
Look, I mean, we know CapEx numbers are going up, not just next year, probably through 2028, because Meta has given some sort of a 3-year forecast. In fact, Mark Zuckerberg has mentioned that, they plan to spend up to $600 billion in CapEx through 2028. So when you are spending such big sums, you don't want to be dependent on one supplier. And in this case, NVIDIA still has the best chips. They probably have a virtual monopoly when it comes to the training. But on the inferencing side, I think everyone, especially among the hyperscalers who don't have their own chips, are looking to diversify. And I think I'm very surprised that Meta is looking to buy something from Google, given they compete, so fiercely on the digital ad side. But that's really a reflection of the changing tech stack and how these companies are evolving with AI.
What is it about Alphabet and Google that we did not realize that they're making so much progress on their own chips, these TPUs, tensor processing units? It does feel like it's kind of come from out of nowhere. I know folks in the tech industry know that Google has been working on this for a while, but if you were just following along, it feels like NVIDIA had this locked up, and then all of a sudden it's a little bit more open.
Yeah, I mean, Google is in the 7th generation of their TPUs, so clearly they have been working at this for a while, which is the reason why the TPU has been able to catch up to NVIDIA's GPU in terms of performance. But to your point, look, the Gemini model was not comparable to OpenAI and Anthropic's leading models up until the last 6 months. So that is what has changed, that Gemini as a standalone model has been able to match up to, OpenAI, whether it's in terms of chatbot functionality, image generation, video generation. They are a state-of-the-art model. Maybe in terms of coding agents, they still trail Anthropic. So Anthropic released a new version yesterday, and they still claim that their models are better than Gemini. But if you are looking for a state-of-the-art model at the lowest cost in terms of tokens, Gemini is your best bet, and which is what Meta is realizing, that yes, they could use the low cost that Google has in terms of running their infrastructure and use it to their advantage in terms of how they are looking to deploy Gen AI on their family of apps.
So Mandeep, can you give us a sense of the competitive landscape today for NVIDIA? We know, I guess now we have a better appreciation for Google as a competitor.
Yeah.
Just lay it out for us and how you think it might play out.
I mean, the one metric that NVIDIA shared on their latest earnings call was their content per gigawatt is going to grow over the next few years. And the reason they said is because they generate the most tokens per watt. Now, for 1 gigawatt, Jensen said they'll have up to $30 to $35 billion of NVIDIA chips being purchased. Think about it, you know, if a 1 gigawatt costs $50 billion, any company spending 30 to 35 billion, and all these companies like OpenAI has talked about adding up to 26 gigawatts in capacity. That really translates into huge revenue for NVIDIA just from one hyperscaler. And that's what I think Meta, if they plan to add 10 gigawatts over the next 5 years, they don't want to be giving NVIDIA, you know, $300 billion just for the chips. They want to diversify and really make sure they're running their infrastructure at the lowest cost, which is what Google is doing. Google spent $90 billion in CapEx this year. And guess what? They have a cloud business. They have trained their new model. They're doing inferencing at scale. They're serving search and all their family of apps with GenAI functionality. So they're really running it very efficiently. They're not spending $30 to $35 billion per gigawatt. And that's what everyone is seeing now in terms of efficiency.
So you do a great job of explaining this from a technical point of view, from the technology's point of view. But for investors who really just understand NVIDIA as, you know, AI personified or embodied, is this just an opportunity to diversify and not rely so much on NVIDIA and maybe chase another company whose shares have not rallied as much?
I think so. I mean, it's very hard to see multiple expansion in a company like NVIDIA, which was close to, you know, 4 trillion plus. And I think they're growing very nicely into earnings. They've given a forecast of up to $330 billion in revenue next year. So there is embedded growth in there. But everyone has that scars from, you know, the dot-com bubble in terms of paying too much in terms of multiple. And that's where you're seeing people really being conservative in terms of what sort of multiple they pay for a stock like NVIDIA.
All right, Mandeep, thanks so much for joining us. Appreciate it. As always, Mandeep Singh, our senior technology research analyst for Bloomberg Intelligence. Against some big movements in the chip makers today is Meta places a big order with Google, and that has some repercussions for the competitors, most notably NVIDIA. All right, let's get talking a little bit about a topic we like to stay on top of. That is commercial real estate around here. Brian Klingsick joins us here. He's global head of research and strategy at LaSalle Investment Management out there in Chicago. Brian, just speaking for New York City here, it feels a lot better here in terms of the commercial real estate. Give us your kind of 30,000-foot overview of commercial real estate out there.
So we just put out our outlook for 2026, and our view is that transaction activity is going to recover. It's a good vintage to invest in real estate, and things are looking up for values and for rents across a lot of commercial real estate sectors and markets globally. But what's funny is that the outlook that we put out for 2025 a year ago had almost that same view. So it feels a little bit like a Groundhog Day moment. We had this sort of cycle of optimism and disappointment. A year ago, we were very optimistic, and 2025 was pretty much a sideways year in a lot of those indicators. I think Liberation Day played a big role in that. But you know, we think that the conditions are in place for this to be coming together for a real strong recovery in commercial real estate in the coming year.
So given that 2025 disappointed and didn't really live up to expectations, have conditions really changed, or is it just kind of the delayed effect of what was supposed to take off this year will now take off in 2026?
Certainly the uncertainty and the policy noise and the volatility around Liberation Day and other things going on in the world just shook confidence a little bit. That wasn't a phenomenon specific to real estate. But I think the most important thing that's happening right now in commercial real estate is putting data centers aside, the new supply, the development of new product, which would really kind of hit the rental growth across a lot of the markets and property types. That is plummeting. and we expect it to keep falling and fall below kind of all-time lows. And that's because at today's rents in commercial real estate, it's just not economic to develop new space. The construction costs have increased a lot. There is a lot of demand for construction materials and contractors' time that's coming from the data center space. So rents need to grow in order to justify new construction where that space is needed. And so that sets up a nice recovery on the fundamental side. And on the capital markets side, you have debt capital is widely available. It's not just private real estate, private credit lenders to real estate. It's kind of a broad, all of the different segments of providing debt capital to real estate that are back. And you have valuations that are in line with prices and prices that are in line with bond markets. And if you kind of make a comparison to equity markets, real estate looks a little cheap. So we see the foundation for a pretty strong recovery on the capital market side as well.
Brian, within the greater space of commercial real estate, what are the subsectors that prevent maybe the most opportunities in 2026?
Well, we still see a lot of strength in the logistics and apartment markets. The office market is what everyone wants to talk about. However, you referenced it at the beginning with New York coming back, and it's obviously a very important market for New York and a lot of cities. We said a year ago that the office market would start to rebound and turn around this year, and it has done that. But it's still very challenging. I mean, very high, almost 20% vacancy across markets. And, that sector is challenged not only by the impact of COVID and work from home, which is starting to normalize and improve with return to office. It's also just a very CapEx intensive sector to keep an office building competitive and well leased, which is why we'd be very, very selective in that space and are much more focused on logistics and rental apartments.
Brian, is there a city that you would be looking to in 2026 that's, kind of hitting it from all different dimensions, whether it's office space or retail or industrial?
Well, my role is global and our firm is global. And I know at the beginning you said I was in Chicago, which is where I'm based, but right now I'm in Tokyo. And I'm going to put Tokyo in as a mention for a city that is super dynamic and is really in this moment of generational opportunity as it transitions from a mindset driven by 2+ decades of deflation, no inflation, to a market where time matters again.
Yep.
And so people here need to manage these assets better, and there's a lot of opportunity in that.
All right, Brian, thanks so much for joining us. Appreciate you staying up late to chat with us there. Brian Klink-Sick, he is Global Head of Research and Strategy at Mind Global. He's in Tokyo. So that's pretty
From
cool.
Chicago and Tokyo.
Sure, why not? Two great cities. He's over there at LaSalle Investment Management. They're all over the global real estate space. We like to get an update every now and again to see what's happening. S&P up 5 points. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. And NVIDIA shares continue to fall, down nearly 6%. That's after the information reported Meta in talks to spend billions on Google's AI chips. Now, that news has shares of Advanced Micro Devices, Oracle falling, but Alphabet shares, they're on the rise, up more than 1.5%. We go to the NASDAQ falling 0.4%, 107 points. We have the Dow rising about 0.5%, 271 points. The S&P 500 is little changed, up about 2. The two-year yield, 3.48%. That's down 1 basis point. The yield on the 10-year, 4.01%, and that's down about 1 basis point. To the Bloomberg Dollar Spot Index, that's weakening by about 0.3%. We have the Japanese yen strengthening by about 0.5% at 156.01 against the dollar. The euro at 115.77 against the dollar. To company news, Boeing, they say they're making progress against quality lapses over at 737 factory right outside of Seattle. It's also planning to increase 737 output to 60 jets a month. Surprise layoffs at Apple, the iPhone maker, eliminating dozens of sales roles. It's a move to streamline the way it offers products to businesses, schools, and also governments. TSMC, it sued a former executive who left to work for Intel, saying there's a high likelihood that he leaked some trade secrets to his new employer. And finally, Bloomberg reporting Peloton's new AI-powered exercise equipment is off to a rough start, and that's despite the company running Black Friday promotions with discounts of as much as $1,500 off for a treadmill and accessory bundle. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, thank you so much, Lisa Mateo. And if you have a Chase Sapphire card, apparently you can get some credits for Peloton as well.
Really?
Yeah.
Wow.
That's one of the many things that you have to keep tabs on if you pay the $795 annual fee or something in that neighborhood. Can't remember what it is now. Let's talk about economic data because there was a ton of it this morning. 8:30 a.m. Lisa Mateo, I don't know how you managed through this.
No problem, like a pro.
Yeah, we had retail sales, we had PPI, we also had housing numbers. I don't think that was delayed, but that is always kind of backwards looking. And then consumer confidence at 10 a.m. So Ira Jersey is our chief U.S. interest rate strategist here at Bloomberg Intelligence, and he joins us now ahead of the Fed's meeting in about 2 weeks. Ira, the one data point that we would want to pay attention to is wholesale inflation. PPI numbers came out for the month of September, and they were slightly higher than what no, actually, let me correct myself. They were pretty much lower than what economists had anticipated, but higher than the prior period, right? So does this matter? Because it's old.
Lately. Yeah, it's old data. You know, I think actually retail sales was probably the more interesting and in a way potentially more important number that came out all at the same time. I mean, it was just a data deluge at 8:30, right? So it was like we had to pick what we were going to focus on. And I think that the control group of retail sales, which is all of the inputs that go into GDP, that got some attention because it was a negative number again, similar to what it was back in April and January of this year. So people are like, okay, so there's very uneven consumer spending, right? Where you saw the summer was reasonably good in terms of spending growth, and then September was low, and then some people pointed out that that Labor Day was very early, so you actually had maybe a little bit of pull forward into August for some back to school spending that didn't happen in September. All of those things are probably true, but it does show that maybe, and again, we won't get the October data, so we don't exactly know if this is a sort of a trend, you know, and I think that was a little concerning. You saw a little pop in treasury yields going down a little bit on that, and PPI was more or less as expected, and I agree with you, Scarlett. It's not very likely that that's what's going to be moving the market anytime soon.
So all that said, Ira, we've got the 10-year sitting right at 4% here. Is this it's a nice round number to me. Does it mean anything to the market?
Not really. A little bit below that is actually the next important technical level, right around 397 or so, which happens to be our year-end target actually for 10-year yields. So I'll kind of pat myself in the back close enough at this point. A lot of people were saying earlier this year, particularly in April when we had that call, that there was no way that was going to happen because they were worried that foreigners weren't going to buy our debt and maybe even sell it, and you were going to see 5% plus 10-year Treasury yields. But that obviously hasn't come to pass. We just put out our 2026 outlook yesterday. Our big deep dive is coming out next week, which you'll be able to see it on Bloomberg Intelligence. Just a wide variety of information, and I don't have as much conviction next year, quite frankly, Paul, because of the uncertainty about this data. Will we actually avoid recession? Will we go into recession? Will inflation pop back up because of delayed impact from tariffs? Like, all of these questions continually arise. So while yes, we have a base case and a forecast, I'm less convinced about that than I was all of this year with our call for just around 4% 10-year yields.
Where does this leave us in terms of listening for clues on what the Fed's going to do? I'm looking at our EcoGo, the calendar, and it doesn't appear that there's any Fed speakers on the docket today or tomorrow. And of course, they're going to enter that blackout period anyway. So who have you listened to? Because they're kind of all over the place.
Yeah, so basically there's two distinct camps, right? There's the camp with the Wallers and the Bowmans and a couple of other members who are like, we need to cut, we should just cut now, because if we don't cut now, we might have to cut more later, that kind of camp. And then another camp that says, well, things aren't terrible, and because they're not terrible, maybe we should skip December and then determine whether or not we should cut again in January. Look, unless you're trading like January Fed funds futures, it doesn't matter in the broad scheme of things if the Fed cuts in December and pauses in January, or does the opposite, right? It just doesn't matter. 25 basis points by the end of January is what's priced. I suspect that they will do that. Whether or not it's in December, doesn't really matter a whole heck of a lot, because they could just do a little bit more next year if they need to. So this obsession with will they go or won't they go in December, I think is the wrong question. It's, are we pricing for the right rate sometime in the middle of 2026, right? Which is right around 3%, a little bit above 3%. I suspect, and our base case is, that that's actually a little bit too high. I think by the time we get done and the Fed gets done cutting, they're going to have a 2 handle on the Fed funds rate, probably around 2.5 to 275. So, again, 50 basis points is more than what's currently being priced. And I think that that's the more important question. Where do they guide to? The summary of economic projections, I think, is going to be far more important in December than whether or not they cut, because I think if they don't cut, they're going to say, well, we'll likely cut in January.
Ira, Bloomberg News is reporting that President Trump says he thinks he already knows the choice for the Fed chair, and that the announcement will be made next month. How important is that decision?
Well, it's a key decision, right? The president of the Federal Reserve has not directly a lot of power, because they are just the chair of a committee, but they do set the agenda. They tend to be the voice of the Federal Reserve. So they do have, they're the basically greatest among equals. And I think that it's important that he's going to make that announcement in December, because I do suspect that that person is also going to take the seat that Steve Myron's in right now, as far as being a Fed governor. So that way, the new Fed chair will actually be a Fed governor for 2 or 3 meetings, probably 3 meetings, before that person actually takes office. So if it is someone who hasn't yet worked at the Federal Reserve yet, they'll at least get a little bit of institutional knowledge before they actually take on the chairmanship.
Yeah, Treasury Secretary Scott Bessent, I think, is leading the charge here, interviewing Fed chief candidates. Are we going to get a similar situation where he might end up as the Fed chair nominee, kind of how Dick Cheney was supposed to be vetting for vice presidential candidates, and then he became the vice president?
I don't think so. I mean, they've been pretty explicit, saying it was Hassett and Rick Reeder from BlackRock, someone who we all know very well, or a couple of current or former Fed people like Warsh, Waller, and Bowman. So I do think that the one kind of outside candidate there, in some ways, is Hassett, and I suspect that if it is Hassett, that's really someone who will need a little bit more betting in, maybe, than some of those other folks who are a little bit more familiar with Fed operations.
All right, Ira, thanks so much for joining us. Appreciate it. As always, Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence down there in Princeton, New Jersey. Coming up, we're going to check in with Lindsay Dutch, Bloomberg Intelligence. She's covers some of the retailers out there, some of the hardline retailers. We had some earnings from Dick's Sporting Goods, earnings from Best Buy. We'll break those down. How are those companies dealing with tariffs? What are they hearing from their customers in terms of consumer demand and consumer purchasing power. All that'll be coming up in just a moment. S&P up 6, the Dow up 318 points, the NASDAQ down 95 points. A little more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Let's talk some retailers. We got some retailers bringing up the rear of earnings season as they like to do. We had Dick's Sporting Goods and we had Best Buy. And let's break it all down with Lindsay Dutch, Consumer Hardline Senior Analyst from Bloomberg Intelligence, joining us from Princeton via that Zoom thing. Let's start with Dick's Sporting Goods. They raised their outlook again, but I guess investors are focused on, some of the costs trying to turn around Foot Locker. Talk to us about Dick's Sporting Goods, Lindsay.
Yes, that's right. The legacy business remained very strong in the third quarter, strong back to school, clear demand momentum heading into the fourth quarter. That's where the raised outlook came. It was really for the legacy business. But when we look at Foot Locker, the deal closed early September. The outlook for the fourth quarter is mid to high single digit same-store sales decline. Dick's is also looking to expedite the turnaround there, which means offloading old inventory, steep markdowns in that fourth quarter, which is going to really hurt the margin as well. So Foot Locker, needs a lot of work. Fourth quarter is going to be weak, and investors are really looking to see how quickly they can turn that business around.
Yeah, and probably they'll need to put some money into it as well to reorganize stores and freshen up the display. How much of this deal, Dick's buying Foot Locker, was predicated on Nike and what it was doing with this shift back to its wholesale channels and away from solely relying on its direct-to-consumer offerings and its own stores?
So Foot Locker was
I would argue, overexposed to Nike, several years ago. They had been working that exposure down. I think Dick's will remain focused on being diversified, just given that their own assortment, where they're leaning into lots of other brands, new up-and-coming brands like Hoka and On. They did discuss, though, that Foot Locker will sort of remain sort of a hub for basketball, and Nike does have a strong hold in the basketball market. So I expect Nike to be, a strong vendor with Foot Locker, but Dick's is looking to make sure that they have that right assortment, the newest stuff, the hottest lines coming from Nike and others.
What is Dick saying about tariffs in their business?
So, they are going to feel higher costs, in this back half of the year and even into next year. Dick's has, since the pandemic, since they've been able to see sort of an increase in demand for their premium assortment, they're not really a huge discounter for the holiday. They like to sell their product fully through. So I don't expect them to sort of discount, and they have taken prices up selectively, but certainly not across the board. And their higher income consumer is sort of accepting those increases. I think Foot Locker is a little bit of a different story. And you might see that impact a little bit bigger on that business just because they don't have those premium products, and they're already going to need to offload older inventory with steep discounts. So you sort of have that turnaround compounded with these rising costs heading into the next year. So something for them to work on.
Lindsay, I also want to ask you about Best Buy. The shares are up about 4.5% right now. And of course, this consumer electronics retailer had a beat and raise quarter. It looks pretty good, and it looks like it's on the usual strengths, sales of mobile phones and sales of computer equipment.
Yeah, so Best Buy had a strong third quarter, better than expected, as you mentioned. I think, the stock isn't getting a full bump because there is definitely some conservatism and a low guide for the fourth quarter. And investors are trying to figure out, is it just conservatism? Are they just worried about the consumer, or is there something really there that there's going to be a slowdown in that fourth quarter? But the business looks good. Demand looks strong. As you mentioned, computing, phones, gaming, all looking solid. And they're also seeing an improvement in home theater, which is really big because that has been a weaker category for the last couple of years. So if that comes to fruition, I definitely think there will be strength in the fourth quarter.
So and you think about a Best Buy, I mean, some of those are big ticket items here, and that would suggest that they're confident. They go to a part of the K-shaped economy maybe that is doing better. Is that a typical Best Buy customer?
So Best Buy, definitely promotions are going to be a big piece of the fourth quarter. They're sort of leaning into those promotional events. That's what worked last year. And I think they're trying to lean into the things that worked last year for this year. And I do think the consumer backdrop is quite similar when we do that compare. They also recently launched a marketplace, and they seem to have a stronger focus on marketing and advertising. And so they're really trying to meet the consumer where they are and make sure that Best Buy is top of mind when you're shopping for a wide array of things, not just those big ticket items like TVs or appliances. So they're trying to have a bigger wallet share with consumers across the board, and they're leaning on that marketplace and advertising to do it, and then hopefully get you into the store, and that's where they can bring their customer service and experience as well.
Did they say anything or give any indication on how they're preparing for Black Friday and for the holiday shopping season?
It sounds like very similar to last year. So they started their deals about a week ago. They roll out new deals each week. They are leaning into their paid membership program. So paid members get access to certain deals over the regular shopper. But the playbook looks very, very similar, but the demand picture looks better. So hopefully those promo events can really draw that shopper in, especially since everyone's already looking for those items.
Lindsay, thank you so much. Appreciate it. As always, Lindsay Dutch, Consumer Hardlines Analyst for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on SiriusXM Channel 121, access the world's only global audio Business Network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now with the S&P up 5 points, the Dow up 300. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio here in Midtown Manhattan. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We are streaming live on YouTube, and we've got a lot to talk about here on Tuesday, the day before Thanksgiving Eve. But for so many people in the markets, it's already like, I don't know if that many people even showed up. The parking lot was pretty empty this morning.
Was it on the train station?
Yeah.
Okay. Yeah, it could be people taking a long weekend.
All right, so let's take a look at what's going to happen in the second hour of Bloomberg Intelligence. Mari Shore, Senior Equity Analyst at Columbia Threadneedle Investments, will join us to give us her outlook for U.S. retail ahead of Black Friday on Friday. And, of course, after we got some dated sales numbers for retail sales number for the month of September. Mary Ross Gilbert of Bloomberg Intelligence will break down Kohl's and Abercrombie & Fitch's latest earnings. And then we're going to check in with Kim Forrest. She is founder and CIO of Boca Capital Partners to discuss her outlook for the markets. She is extremely read in on all of that's going on in tech and AI. So I want to get her take on Alphabet becoming like the second AI play after NVIDIA, or maybe even overtaking NVIDIA at the moment. Let's also talk with Sean Donnan, Bloomberg News senior economics writer, on Bloomberg's Big Take, which is about how President Trump's $21 trillion investment boom, that's how much he says the U.S. is attracted in investments, is actually short trillions. So we're going to dig into all of that. David Wu, of course, will also join us as well to give us his take on what the president and Bitcoin have to do with one another. All that is coming up, but first, let's go over to Washington, D.C. and Amy Morris for Bloomberg Business Flash.
All right, thank you, Scarlett. NVIDIA now facing one of the biggest competitive threats it's seen since becoming the face for AI. Google is in talks with Meta to spend billions on Google's AI chips after Google earlier agreed to supply up to 1 million chips to Anthropic. Bloomberg's Mandeep Singh.
Meta, if they plan to add 10 gigawatts over the next 5 years, they don't want to be giving NVIDIA, $300 billion just for the chips. They want to diversify and really make sure they're running their infrastructure at the lowest cost, which is what Google is doing.
Google parent Alphabet shares are about 1% higher. Since mid-October, Alphabet's up 35%, adding nearly $1 trillion in value in that time, while NVIDIA shares are down about 5.5%, erasing more than $240 billion in market value. That's all moving stocks lower. We do check the markets for you all day long here at Bloomberg. The S&P 500 is little changed on the upside. NASDAQ down about 0.5%. The Dow up 0.6%. The 10-year Treasury yield at 4.01%. The 2-year yield at 3.49%. U.S. retail sales rose modestly in September. U.S. wholesale inflation picked up in September from a month earlier, reflecting higher energy and food costs, while private payrolls fell. And traders are digesting all of this economic data, which was, as you remember, delayed because of the government shutdown. Money markets now pricing in about an 80% chance of a Fed rate cut in December after dovish remarks from some policymakers signaling support for the labor market. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's Bloomberg Business Flash. We go back now to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Amy Morris, thank you so much. We appreciate that. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Bailey Lipschultz. Bailey, what are you looking at today?
Yeah, let's start with this story of the day. NVIDIA, ticker NVDA, maybe the largest company in the U.S., maybe the second largest company in the U.S., depending on when you refresh your terminal, but down right now more than 5.5%. So that is quite the drop for the company. The largest drop, though, only since late October, mid-October. This coming after a report that Google may be, in fact, selling its TPUs to Meta. So back and forth, is NVIDIA going to be the player? Is Google going to be the player? Google parent Alphabet shares up about 0.5%. One thing that's interesting is we've continued to see the entire AI debate and ecosystem unfold. When you look back to NVIDIA's October 29th peak, stock's down 17%. Big move for a big company. Google up 16%. So that is a large divide between two of the largest companies in the world. And it all stems around whether you're debating if NVIDIA is going to continue to dominate with Blackwell chips, is Google and their TPUs going to actually give NVIDIA a run for its money, and then also kind of the underlying debate, will Google's Gemini actually be the top app, and what does that ultimately mean for the entire OpenAI ecosystem?
All right, so we'll continue to watch that one. What about Oracle?
Yeah, sticking to the OpenAI ecosystem, Oracle ticker ORCL right now down 3%. This comes partly on concern around who's going to win between Google and OpenAI, if we can call it winners and losers, but also on the back of a CFRA downgrade, CFRA analyst calling out the debate that Wall Street has been having for a number of weeks at this point around the company's mounting debt concerns. That's according to the analyst, Angelo Zeno, who calls out the total debt exceeding $100 billion following the recent capital raises, saying that they expect negative free cash flow through at least fiscal 2028. So again, Oracle, ORCL, from its September peak, down 41%. These are big companies. We're not talking about a small company. Oracle, $500 billion right now.
All right, dumb question of the day. What is a NIO?
What is a NIO?
N-I-O.
N-I-O, NIO, BYD, they were all going to be revolutionary electric vehicles.
Chinese companies.
Chinese companies that were going to change the way that we think about cars. They were going to kind of eat Elon Musk's lunch, depending where you sat. NIO down, ADR's down 3.5% right now. This came after the company reported revenue for the third quarter, softer than analysts were looking for. Analysts kind of calling out that maybe their volume guidance missed expectations. Battery supply is still playing out. NIO shares, or ADRs again, down more than 3%. Kind of has been struggling though. Still up 27% so far this year. But when you consider it, the stock or the company is really about a $14 billion market cap. So not a tiny company, but certainly not revolutionizing the world as quickly.
But isn't BYD going to eat everybody's EV lunch globally, with the exception of the U.S.? With the exception of the U.S.
exception of the U.S.
Because I understand it's a quality product at a cheaper price.
Well, when I was in Asia, the entire car scene is different, right? But like seeing BYDs and riding in BYDs when we were in different parts of Southeast Asia, fascinating. And like really nice cars, they kind of are very similar to the Tesla and kind of the sleekness. Again, they don't sell here, so a little bit of a apples to oranges comparison, but still a big company, and I believe Berkshire is still a big investor in BYD.
All right. Well, Tesla still kind of cutting edge EVs here in the U.S.
Yes.
And we know that they haven't freshened up their lineup in a while.
Yeah, exactly right.
All right, Bailey Lipsholt, thank you so much for our individual equity movers. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. You can subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We got some data today on retail sales. It was from the month of September, so kind of old, but we also got retail earnings because we're in the thick of it right now, Paul. So let's bring in Mari Shore. She focuses on retail. She's a senior equity analyst at Columbia Threadneedle Investments. Mari, let me just start off with the old news, which is retail sales. Is there anything to take away from the numbers that showed that sales for the most part rose 0.2%, slightly weaker than anticipated?
Thank you for having me. No, I think at this point, those retail sales are very much backward-looking and reflect warmer weather in September. So there is really not much to take from them. I think more notably, the improvement in October and November month to date that the companies have been talking about throughout earnings season is the more encouraging data point, and I think does bode well for holiday and beyond.
So, Mari, so one of the issues is, I think the K-shaped economy is out there. I think we all kind of got a feel for it. How do you see it in kind of what consumers are doing at the retailers?
Yeah, it's interesting. We certainly see more strength at the middle and high end and relative weakness at the lower end. I think really the issue at the lower end is the impact of aggregate inflation and cumulative inflation that we've seen over the past several years, and the weakness in the service economy. We just got off the phone with Walmart, and they did note that is weighing on the low end. But even with that being said, you're hearing some retailers like Ross Stores reported a very strong comp. Burlington, which just reported this morning, said they saw improvement through the quarter and believe that the low-end consumer is still resilient. And of course, Walmart's results continue to surprise to the upside. So even with that high-level caution for the low-income consumer, we can still find a group of companies that are taking share among that cohort and doing better than expected.
All right, Mari, really appreciate your joining us. Mari Shore is Senior Equity Analyst at Columbia Threadneedle Investments, giving us her outlook on U.S. retail. Let's dig into some of the individual companies a little bit more here with Mary Ross Gilbert. She's a Senior Equity Analyst covering the sector for Bloomberg Intelligence. And Mary, let me start off with Kohl's, because we talk about companies that are gaining market share. Kohl's lost a lot of market share over the past 5-6 years, and it's coming back a bit here. What is its strategy? Is it just that it's kind of simplified its business model?
Scarlett, what's happening here is that they've kind of gone back to the basics. What's something that Kohl's has always been known for. So one is their private brands. So if you think about some of the brands like So and Juniors, Lauren Conrad for women, and they brought those brands back because they actually sacrificed some of those brands under the prior leadership and replaced them with some more name brands like Madden Girl, trying to really attract the junior shopper there. And now that they've brought the private brands back, they brought back petite sizing, which was really important to their customer base. Now they're really starting to see, a recovery. But they're not out of the woods yet, Scarlett, as you pointed out. I mean, they're really cycling 3 years of declines, but we are seeing encouraging results. And given that they actually turned positive in the latest month, it looks like they could actually reach break even in the fourth quarter, even though they're guiding to a 1.7% comp sales decline. So it's very encouraging to see with Kohl's. Again, not out of the woods. And when you look at what's going on with Sephora, it's now a $2 billion business. And as you were sort of highlighting, that means they really lost, over the last 4 years, something like $4 to $5 billion in other categories. So they have lost market share. We think they're losing it to off-price and some of the value players in the specialty space, such as Old Navy, a Gap brand.
Stock is up 33% today alone, which is a huge move, up 49% year to date. So it seems like the market likes what it heard here. So from a competitive landscape, where does Kohl's kind of fit in out there, Mary?
So, Paul, Kohl's is really a value player in the department store space. So they're really a notch below Macy's, and they're also located off the mall, which can be an advantage. And because they brought in Sephora as a beauty authority, and beauty is a very big and important and higher margin category for department stores. So that's, sorry?
You have to invest in your face, somebody once told me.
Yes, you got to invest in your face. That's exactly right. Well, the idea there is that you're getting a repeat customer. They have to come back and they have to replenish product. But we did see a comp sales decline because as that business has matured, it's kind of tracking somewhat close to what the company is tracking in terms of comp sales. So we did see a decline in the latest quarter. So they do have a number of initiatives to try to bolster that because, of course, we're seeing gains with some of their competitors, and we think we'll see that when Macy's goes to report next week.
Right. And of course, that's a big one, right? In terms of department store chains, we'll be looking for that one. And of course, you'll help us break it down when those cross. Mary, I also want to ask you about Abercrombie & Fitch. It was the darling 2 years ago because the new CEO found a way to make the brand relevant to a new audience. It was no longer targeting teenage boys, for instance, and really targeting young working women. But it's had a brutal 2025. The shares have fallen, I believe, more than 50%. through Monday's close. A lot of concerns about tariffs, perhaps, and maybe even a lack of fresh ideas in terms of its offerings. When you look at the stock today, it is soaring up 30% on the latest earnings. What's the narrative with Abercrombie & Fitch right now?
Yeah, so Scarlett, with Abercrombie & Fitch, their numbers came in better than expected. So the namesake brand, as you pointed out, I mean, that had been double-digit increases over the last 3 years. So they're cycling those increases, and that's why their sales are coming in less than expected generally for the whole year and why the stock is down. But this quarter, the comp sales decline there was about 3.3%, so that was better than expected. And when you look at Hollister, though, Hollister has been coming in ahead of expectations, and they've been posting double-digit increases. So as you were talking about sort of the millennial women who really love, and also the men, but it does tend to favor more of the women on the Abercrombie side. On the Hollister side, which really caters to Gen Z, that has been on fire. And so that's what's helping to kind of overcome the weakness that they're seeing at Abercrombie. But also, it's looking like Abercrombie could turn positive in the fourth quarter with a number of the initiatives that they have in place going into the holiday quarter, even though they're cycling some pretty strong gains in the prior year and the year before that. So there's some encouragement there. And I think, and then, of course, you have some short interest both in that stock and also in Kohl's. And that's part of the big bounce back that you're seeing this morning is some of that short covering.
What we're not really talking about, Mary, is tariffs and the impact on these retailers. What's the story these days?
Yeah, so in the case of Paul, in the case of tariffs with Abercrombie, they expect to have a $60 million hit in the fourth quarter. So they are being hit by tariffs, but they're discounting less. Plus, they have lower freight expenses. And this is something we've been hearing from most of the retailers is that lower freight costs are also helping to bolster margin. So they are going to be impacted, but probably not as badly as before, given that they've got an improvement in average price points, less discounting, and lower freight. That's helping to offset some of the tariffs. And remember that $60 million hit on tariffs for Abercrombie? That's after mitigation efforts. So there is still going to be an impact. Kohl's even brought it up, which they hadn't really brought up tariffs in their prior two calls, but they did say that going into early 2026, there will be some impact there for them. And the reason why their margins have been holding up and coming in better than expected, and their margins are low, but it's because of the fact that their mix of business being more private label, which is higher margin, is helping to bolster those margins.
Yeah, I was trying to think back to the last time I did buy something from Kohl's, and it was a private label dress that they did a collaboration with some kind of designer, I forget, but I got suckered into that.
Nice.
Yeah.
They got you.
They did get me. All right, Mary, thank you so much for joining us. Mary Ross Gilbert is Bloomberg Intelligence's senior equity analyst covering retail on Kohl's earnings, on Abercrombie & Fitch's earnings, and of course, as she points out, Macy's is the next big earnings report to come out, and that will be coming out next week after Black Friday. So a lot to look ahead to as we figure out the retail landscape here in the U.S. With all the tariffs and with concerns about the job market and all of that going forward. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. NVIDIA now facing one of the biggest competitive threats it's seen since becoming the face for AI. Google is in talks with Meta to spend billions on Google's AI chips after Google earlier agreed to supply up to 1 million chips to Anthropic. Google parent Alphabet shares now 0.5% higher. Alphabet is up 35% since mid-October. That's added nearly $1 trillion in value in that time. NVIDIA shares now down more than 5%. We do check markets for you all day long here at Bloomberg. S&P 500 up 0.25%. NASDAQ down 0.1%, and the Dow up 0.8%. The 10-year Treasury yield at 4%, and the 2-year yield at 3.48%. Consumers much less confident in the economy in November in the aftermath of the government shutdown. Amid weak hiring and stubborn inflation, the Conference Board says its consumer confidence index dropped to 88.7 in November from an upwardly revised October reading of 95.5. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Intelligence with Paul Sweeney and Scarlett Fu.
All right, Amy Morris, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. So head over to youtube.com/Bloomberg, search Bloomberg Podcast, and that's where you'll find us. Some movement in the market today. Lots of economic data coming out today, influencing what the Fed might do December 10th. But that AI story, once again, it's back in the forefront here with Meta placing an order with Google. And that's really upending that tech space a little bit. NVIDIA trading down about 4.5%. Let's start there with our next guest. Kim Forrest, founder and chief investment officer of Bouquet Capital Partners out there in Pittsburgh. Kim, I know you've got that technology background here. What do you make of kind of, I guess, Meta's decision to do a deal to buy some chips from Google? What does that mean maybe for the competitive landscape?
Sure. Well, it sure makes things more interesting than last year, because last year, if you remember, it was driven by mainly one stock, and that was NVIDIA. And, you know, maybe we have a 2-stock race. I'm teasing. But really, I think it says a lot that everybody kept saying NVIDIA was years away from any other competitor, and now this comes out. And I think it's really interesting that, you know, you can't really bet on what everybody says, and you have to kind of go with the flow. And I think that's what the market's doing today, is saying, maybe there's other players out there.
And it might be Alphabet today, but who else is kind of up and coming that could, you know, in these next few months be making a lot of progress on their own large language model and prove to be a formidable competitor that we're kind of not acknowledging right now?
Sure. Well, I have a lot of thoughts about large language models, and I don't really like them, I'll be honest. I think they are awesome to replace search, because nobody really likes to type in the magical string of keywords and, you know, do the order and kind of hope you get the website that you want. You know, we just want an answer. So that's the thing that I think LLMs do the best. There are a lot of people working on them. You know, last year, about at this time, maybe a little later in December, DeepSeek came out. So I think that there is going to be a lot of innovation around who is driving the LLM leadership experience, and it's going to be people that think differently. So again, I don't know that you can invest in any of these folks necessarily, but I think the race is on to make a better experience with LLMs. And it's wide open, especially if you go the light model like DeepSeek, where they didn't necessarily have to, you know, build the undergird of the LLM. They just had kind of an overlay on top of it. I hope I answered your question.
Oh, yeah. Let's step back, Kim, and get your thoughts on this market here. We've got a slew of economic data today. Presumably, that's going to have some influence on our Federal Reserve December 10th when they meet here. What's your kind of view of the market as you think about next year?
Sure. Well, I'm particularly interested in, like the missing data that we'll never see, but we're kind of catching up with it, and it's syncing up with what companies told us in earnings season, which was October, right? Which is there's demand, employment. Companies are not adding to their employee count necessarily. In fact, they're going the other way. And that is leading the Fed to see a softening in the numbers, right? Especially with respect to employment. And today's PPI came in headline right spot on, but the underbelly of it looks a little soft, which gives the Fed some room to cut. And I think we're going to start marching down that interest rate ladder, which is good for a lot of companies, small companies, acquirers, companies that could be acquired. So I'm really excited about what 2026 could be looking like for investors.
So, Kim, with all that in mind, how are you positioning your portfolio? What are you doing to set up for some of the big trends in 2026?
Sure. Well, we don't really make sector calls all that much. We put a whole lot of thought into the stocks that are in our portfolio, and we have about half being large cap and about half being mid cap to just over $1 billion in market cap. So kind of that small cap. And we think that small caps can outperform in a declining rate environment for the reasons that I said, that if they're a high quality company, a large company may want to buy them. So I think acquisitions are going to pick up once the Fed kind of nods its head and says, yes, we're going to begin a lower rate environment.
Kim Forrest, thank you so much. We appreciate that. Kim Forrest, founder and chief investment officer at Bouquet Capital Partners, here talking to us about this market. And again, there's a big, I would say, pretty important shift or development in the AI story here about where you're going to get these chips.
Yeah, it's no longer a one-horse race.
Yeah, exactly right.
I wouldn't say that it's equally split between two companies, but it very much feels like, oh, there could be some other companies that we should be aware of.
Yep, absolutely. All right, let's get to our big take story of the day. We love the big take stories. Really interesting topics. They get a lot of resources, a lot of reporting resources, and they're really in-depth reportings. And what I like is they have a lot of great graphics and pictures and stuff that makes it easy to understand the story here. This one focuses on President Trump's investments. President Trump's $21 trillion investments boom is actually short trillions. Sean Donna joins us here, senior economics writer for Bloomberg News. He's down there in D.C. Sean, talk to us about this big take story, what you guys were looking at, and kind of what you found in terms of some of the investment promises that President Trump made.
Sure. Well, when it comes to President Trump's economic policies, and the main one being tariffs, there's kind of two sides to the story, right? There's the impact on prices and inflation, on the affordability debate, and then there's the benefit of tariffs that President Trump keeps talking about, and that is drawing investment into the U.S. economy, more domestic production in the U.S., less reliance on imports, and so on. And as we've heard from him increasingly in recent months, there's been this number that keeps going up, and he's reached $21 trillion, he says, in pledges from companies and countries to invest in the United States. Now, the White House lists $9.6 trillion. I just checked it a few minutes ago. It's still there. And we dove into those numbers, and we found that actually really only about $7 trillion of that counts as investment. So the investment boom that President Trump is talking about at $21 trillion really looks more like $7 trillion. And we should say even that $7 trillion has a lot of questions hanging over it. It's not clear how much of that is real or is going to end up being real investment rather than kind of spending on salaries and supplier costs and so on.
Okay, that's detail and that's nuance for someone like President Trump, who focuses on the big numbers. And even at $7 trillion, that is pretty meaningful. According to our reporting, that is more than all the foreign direct investment accumulated since the U.S. began tracking that kind of data. So if $7 trillion ends up coming through, how significant is that to the U.S. economy?
Look, absolutely, $7 trillion would, over the next 4 years, would be a historic number. We think it works out to be closer to $6 trillion over the next 4 years. If you track the actual timelines of these pledges that have been made, some of these pledges are over 10 years and so on, that works out to be 1.5% of GDP. Sorry, that works out to be $1.5 trillion a year, somewhere around 5% of GDP, and that is monumental. That's up there with some of the injections that we've seen, like the New Deal, the fiscal rescue plans around the Great Recession. It gets up there with the railway investment boom of the 1880s. This is big stuff in the economy. That's one of the reasons economists have some questions over whether it will actually happen. The key question being whether this is part of the kind of normal investment, and a lot of that is reflected in the $5 or so trillion that you get invested in the U.S. economy as part of, that's in the GDP figures that we see every year, or whether it ends up being on top of that. So again, when I say there's big questions about it, yes, this is a potentially historic number, but it's a historic number with lots and lots of questions.
So I guess one of the questions that I have, I think a lot of folks have, is who's going to make sure these commitments, these pledge commitments, are actually collected? I kind of feel like governments, companies, they figured out how to work with President Trump and this administration. Talk nicely, flatter him, pledge some big investments, and then you generally get better treatment. Is there someone who's tasked with really seeing that this money is actually invested?
Follow through?
Yeah.
Yeah, look, I mean, we will see, right? The big stick that President Trump has here in most cases is tariffs, and we've seen him threaten that. We've also seen in the case of the United Arab Emirates, for example, the Commerce Department say, okay, listen, we're going to give you export licenses to buy AI chips, as we've agreed, but for every $1 billion of chips that you buy, you have to come up with $1 billion in investment. So that's kind of an enforcement mechanism that's popped up. But, again, we're going to have to wait and see how hard it is to enforce these things. We should say in the first Trump administration, we talked about this in the story briefly, President Trump got a $350 billion commitment from the Saudis. And we looked into the numbers in terms of foreign direct investment. We found in the 4 years after that, actually, the foreign direct investment by Saudi Arabia in the United States only grew by about $5 billion. So there's some big gaps between these promises and what is often the reality, and we're going to have to wait and see if that actually what turns out this time.
Yeah, and in fact, of course, the Crown Prince of Saudi Arabia was just here in the U.S., and after some back and forth, he promised more than $1 trillion in investments in the United States.
Nice.
I think, yeah. And they were joking around, and he even told President Trump it keeps going up every time we talk.
Yep, exactly. So I guess that's what he wants.
All right, Sean Donnan, thank you so much. Sean Donnan is Bloomberg News senior economics writer on The Big Take, and be sure to check out The Big Take that was helmed by Sean Donnan. It's called Trump's $21 trillion boom is closer to $7 trillion. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We are looking at a market that is mixed right now with the NASDAQ in the red and the S&P 500 up by 0.25%. Bloomberg Intelligence on Bloomberg Radio right here in New York. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Amy Morris. The tech sector now trimming back that sharp decline it suffered earlier in today's session as an AI chip rivalry is going on between NVIDIA and Google. Meta is in talks to spend billions on Google's AI chips, showing that Google can rival NVIDIA as a leader in artificial intelligence technology. Google has already agreed to supply up to 1 million chips to Anthropic. Google parent Alphabet shares are less than 1% higher. Alphabet's up 35% since mid-October. That added about $1 trillion in value in that time. NVIDIA shares now down more than 4%. All of this has stocks wavering. We check the markets for you all day long here at Bloomberg. The S&P 500 is up 0.3%. NASDAQ down about 0.1%. The Dow up 0.8%. The 10-year Treasury yield at 4%. The 2-year yield at 3.49%. Retail sales rose modestly in September. U.S. wholesale inflation picked up in September from a month before. That reflected some higher energy and food costs, and private payrolls fell. Bloomberg's Michael McKee.
It's the second week in a row that we see a decline in ADP. Average 13,500 jobs a week were lost in the 4 weeks to November 8th. Now, remember, this is a 4-week moving average, and it's also a couple of weeks behind, but it is the latest information that we have from ADP, and it isn't particularly good news.
Traders digesting all of this data, which was delayed because of the government shutdown, and now money markets are pricing in about an 80% chance of a Fed rate cut in December after dovish remarks from policymakers signaling support for the labor market. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back to Bloomberg Intelligence now with Scarlett Fu and Paul Sweeney.
All right, thank you so much, Amy Morris in Washington with our Bloomberg Business Flash. You know, Paul, we haven't talked a whole lot about Bitcoin today.
Yep.
You look at a chart, and it does appear that the selling pressure seems to be easing a little bit. There was a big slide to $80,000 on Friday, but since then, we've seen higher lows, and it's come off those levels. The big question now is whether it's going to get that tailwind that it's enjoyed over the past year or so. You know, the idea that the Federal Reserve will be cutting interest rates and the growing institutional adoption will gather pace. David Wu joins us now. David is one of my favorite analysts and strategist. He's the founder and strategist at Unbound Retail, joining us from Tel Aviv. And David, you've been writing about the big question that kind of hovers over Bitcoin, which is, can President Trump save Bitcoin? Is he going to basically come in with a Trump put? Does he want to? How are you thinking about this?
Yeah, thanks for having me on. I think the way I think about this is this. I mean, the market, since the beginning of Trump's second term, has assumed that whatever is good for stable coins is good for crypto, good for Bitcoin. And there's no doubt, Trump is very bullish for stable coins because he wants to promote the digital dollar as the, as the alternative to, the cash dollar. And he sees stable coins as a way to cement the US dollar hegemony. However, I have a major issue with people who think that stable coins is good for Bitcoin. In fact, I think very much the opposite, because in many ways, stable coins is taking away the medium of exchange narrative from Bitcoin. Think about this. I mean, stablecoin has taken off over the last few months. And in fact, actually, whereas, Bitcoin as a payment exchange, basic medium exchange, has continued to basically languish. So I think from that point of view, I think there's no reason for Trump to step up to the plate and stop the Bitcoin decline. It's never been basically his agenda anyway. And I think that's why it's also not a surprise that after what he did for stablecoins, he's taken very few little actions actually to promote Bitcoin. So I think actually, obviously the market is still up 50% since Trump's election in terms of Bitcoin. So I think from that point of view, we want to just get back to, sort of the pre-Trump basically regime. I think Bitcoin definitely has got more room to go there.
So, and you mentioned President Trump, he and his family, they built up an enormous personal stake in the sector. How do you think that influences policy, if at all?
Exactly. But if you look at, once again, where Trump has made most of his money is from stablecoins, actually. I mean, he is now backing, he and his family basically owns 50% of a major stablecoin. essentially exchange, and then so on and so forth. So this is what I'm saying. Like, even if you look at from Trump's basically narrow, selfish perspective, again, Bitcoin is not, it's not going to do very much for him. And by the way, this is also something very important. His approval rating is going down. And we all know the midterm election just literally around the corner. And there's also no doubt that Democrats have statedly said that they're going after Trump in terms of an impeachment trial of exactly his family's dealing in crypto that's netted his family $5 billion, at least according to one estimate from the Wall Street Journal. So I think Trump will have to be extremely careful, I think, not to do anything that could be seen as self-serving. So I think from that point of view, that's another reason for him to basically stay on the sideline. I think in that respect, it's very different than, let's just say, the stock market overall.
Okay, so that's where things stand for Bitcoin. What about the infrastructure that's really popped up around Bitcoin and crypto overall? You have a lot of crypto companies applying for bank charters and wanting to become more like TradFi institutions, even as they say they don't want to be banks and presumably don't want to be regulated like banks. How do they move forward when a big part of the crypto narrative is struggling?
I think, listen, I think there'll be a lot of competition. I don't have to tell you, like Visa, MasterCard, they're all jumping on the whole stablecoin bandwagon. A lot of banks are doing the same and so on and so forth. So I don't know if all of a sudden this is going to be a free fall. I think where stablecoins is going to basically make a very big difference is in cross-border payment. And there's no doubt. That's going to be a big deal because it's just simply cheaper. That's why all the major mainstream traditional financial institutions are already going down this path. But I think outside that, it's not clear what this basically means. Because if you think about this, to me, what is very striking is how much gold has gone up and how much Bitcoin's gone down. And yet people think of Bitcoin as a digital gold. And yet, I'll tell you the big difference between gold and Bitcoin is that gold is benefiting from reserve diversification. There's no question. I think there have been a lot of reports about the fact that, China said that they bought 20 tons of gold so far this year, but unofficially, they might have bought as much as 100 tons. And then this is probably true about a lot of central banks because they see this current geopolitical realignment around the world as a reason to get out of U.S. treasuries, U.S. dollar into gold. Clearly, these central banks have no incentive whatsoever to get into Bitcoin because, in a way, Bitcoin can be confiscated, as we've discovered recently. So I think from that point of view, even if you're talking about safe haven, geopolitical, whatever, turmoil that's benefiting alternative to the U.S. dollar, I think it's very clear that whereas gold looks, you can make a very compelling case for gold. For that reason, I think Bitcoin is certainly right now, it's difficult to basically make a strong case for Bitcoin right now.
Okay. Then you look at the altcoins, anything that's not Bitcoin, and Ether and Solana, they're seen as beneficiaries of the build out of, as being the backbone for a lot of these stable coins, the infrastructure behind it. Are they in a better position then, David?
I think I look at these coins as essentially, a high beta play on Bitcoin. So it's difficult for me to get too excited about them because at the end of the day, what we need to basically, what it really comes down to is what do you think about Bitcoin and all the other basically coins that are not pegged to the U.S. dollar? What do you think about these in terms of store value? I think that's what it really comes down to. So I think from that point of view, obviously, as you said at the outset, a lot of it has to do with what the Fed does next. Now, my personal view is that when Powell pushed back on a December cut a couple of weeks ago, it was not because he's worried about the inflation, but more likely he's worried about a stock market bubble. I believe that, the Fed shares my concerns about the AI bubble. Obviously, the Fed would never come out and say, wow, this is a bubble. But I think they definitely don't want to become an accomplice to the bubble, and they don't want to blow more air into the bubble. I think this is the reason why they are uncommittal when it comes to a December cut. So I think from that point of view, whether December cut will happen or not, obviously matters a great deal for both Bitcoin and the stock market. But I'm assuming right now, if the stock market keeps rallying, I think that reduces the chance of a cut. We really need probably another 7% drop in the stock market for the Fed to jump on a cut in December.
Well, that's why a lot of people say the stock market is like the Fed's unofficial third mandate. David, always appreciate getting you to join us and spend some time with us. David Wu is founder and strategist of Unbound Retail, joining us from Tel Aviv. And it really goes back to the idea that, we've seen this tremendous rally in 2025 that's kind of dissipated over the last month or so.
Yep.
But still, pretty solid gains if you were invested from the start.
Yeah, from, again, as David said, Bitcoin up 50% since November election. This is Bloomberg.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live as well on YouTube. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. JM Smucker Company, SJM is the ticker symbol. They're in Orrville, Ohio. Stock is trading right at $100 a share. It's down 3% today, down 8% year to date. It's got a market cap of about $11 billion. I don't look at that company too often here, but they reported numbers. They lowered the top end of their full-year guidance after the company opted to forego a planned price increase on coffee in the wake of tariff relief from the Trump administration. Let's get the latest on this name and on some of the other food companies. Diana Rosero-Pena, consumer staples analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive studio, all the way from the 10th floor?
From the 10th floor.
Boy, that's a long walk now, because you guys used to be just one floor away. We could just stomp on the floor and you guys come running up to help us out. Okay, talk to us about JM Smuckers. This is jelly, this is coffee maker, Smuckers. What's going on there?
Pet food as well, you know, pet snacks and cat food. So basically, I mean, it was all right. There were some puts and takes. for the quarter. There's some signs of stabilization, but it doesn't seem that it's there yet. It's similar to other packaged food companies that we're seeing in the space. It's always a second half or the next 6 month story when it's gonna get, growth is gonna happen, and it really doesn't happen. So, people are starting to lose patience on that.
So specifically as it relates to the tariffs, they, like a lot of your companies, they're just telling you what the number is. Like,
Yes.
So what's their tariff cost, I guess, for the period?
Yeah, so right now they're saying that for fiscal 2026, it's going to be about $75 million, even excluding that tariff relief that they are experiencing, which is, the reason why they're not going to increase prices for the third time this year.
So they have been raising prices on coffee?
They have been raising prices on coffee. This is a category that is very pass-through category for Smucker. The problem with that is that competitiveness is a little bit, declining compared to private label. So they're trying to, forego some of the margin, recoup to be able to be more competitive.
Is that what most of the companies are doing, the packaged goods companies? Are they trying to take as much as they can in their margin and then pass the rest along to consumers?
Well, it depends on the category.
Okay.
For coffee, this is definitely normal for them. They tend to be also a category leader, so it kind of, they tend to say what the prices are going to be. But some of the other packaged food companies that we have seen, they take some margin hit. They try to are not putting that on the consumer because they have been increasing prices for the past couple of years. So they already think that elasticity is getting there.
Right. So what are these companies like Smucker's, what are they saying about the consumer out there? How's the consumer, are they switching down are they more price sensitive than usual and maybe switching to store brands?
Yes. So we're seeing private label to get some market share in the past 6 to 8 months, and that obviously has been a headwind for packaged food companies. They're becoming more competitive, not necessarily Smucker, but we're seeing others such as Campbell's and the like saying that they're going to be more price competitive in 2026. So we should probably experience a little bit more of muted sales growth and margin contraction.
So you also follow CW, the Post company,
Yes,
right?
yes.
Tell me, just remind me about their products. I mean, that's primarily cereal?
That's primarily cereal. They also bought their pet, category from Smucker. That has not done so well. And they also have some of the, like eggs product, side dishes and the like. And that has been a little bit on the upswing because, again, that's another commodity that they can pass through price increases, and they have experienced that, and they have been able to offset some of the declines from cereal and even pet food.
So if you're doing coffee or even cocoa, that's just a commodity. Yes. And those prices have been going up because there's been droughts in some of the coffee growing places and cocoa growing places around the world. So if you're Smucker's, you just pass it along, right? I mean, it's just, if your commodity costs are going up, you just got to pass that along, right?
Yes, and that is obviously exactly what they're doing.
When coffee comes down, did they cut the price up?
Yes, they actually do, which is, they anticipate or they hope that, price increases stop so they can actually become more competitive. But we'll see. It's a second quarter, second half of the year story now.
All right. Well, we've heard that before, right?
We did.
Okay. Diana Rota-Pena. She covers all the consumer staples companies. Again, think Campbell Soup and Smucker's and that kind of stuff. Post cereals, all the stuff that we take for granted. Hershey's is another one of those companies. So appreciate getting a thought there. Get a sense of kind of how the consumers behaving out there in terms of what they're buying. Also getting a sense of these tariffs and how are some different companies navigating the higher tariff regime here. So it's good to check in on some of those. And we're starting to finish up on some of those retail names in terms of the earnings cycle here. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121. It's presented by Oracle. Stay tuned for the latest market news and industry research, your top stories and global business headlines are coming up in just a moment. With a market that is kind of red and green here, we got some positiveness. S&P's up 27 points. That's 0.4%. The Dow's up 420 points. That's 0.9%. And the Nasdaq just a little bit down about 10 points there. So a little bit improvement from earlier trading. The VIX is below 20, 19.3. Calling that out for Tom on the Upper East Side. More Bloomberg Radio coming up right now.
This is CBS News on the Hour, sponsored by Steel.
I'm Jennifer Kuiper. At the White House this hour, an annual tradition.
Come on up, Waddle. Welcome.
Waddle is the first of 2 turkeys selected from a farm in North Carolina, receiving a presidential pardon this Thanksgiving. Gobble is his partner in crime, White House Press Secretary Caroline Leavitt.
Want to give us a gobble?
Gobble and Waddle will spend the rest of their days at North Carolina State University. The FAA predicts today to be the busiest travel day during the holiday travel period at the airports. CBS's Chris Van Cleve on what could gum up the works.
We are watching for the potential of weather disruptions again today. The FAA is watching for delays in the Atlanta area as well as the Washington, D.C. area up through New York. Also the potential for snow as we get further into today in the Minneapolis area. Those are all hubs for airlines, so potential disruptions there.
U.S. consumers were much less confident in the economy in November. The Conference Board says that its Consumer Confidence Index dropped to the lowest reading since April, when President Trump announced sweeping tariffs that caused the stock market to plunge. PNC chief economist Gus Fauché.
So we're not in recession in November of 2025, but certainly this softness in consumer confidence suggests that we could see a recession at some point in the first half of next year. Not saying that that's going to happen, but I think this is a potential indicator.
President Trump has criticized Fed Chair Jerome Powell for not lowering interest rates fast enough and said that he wants to replace him, but Powell's term doesn't expire until May. And Treasury Secretary Scott Bessent tells CNBC about the search for a replacement.
Yeah, I think that there's a very good chance that the president will make an announcement before Christmas.
There appears to be some progress in the Russia-Ukraine peace deal, but so far only from one side. CBS's Nancy Cordes.
According to U.S. officials, the Ukrainians have signed on to an agreement in principle, that there are still some details to be worked out, but that the Ukrainians are on board with a modified peace plan that has been changed from the original 28-point plan that was viewed as being much more favorable to Russia.
If you're thinking about taking a break from a GLP-1 weight loss drug to do a little indulging over the holidays, bariatric surgeon Hani Tekla says that is not a good idea.
If you're taking it for weight loss, the things that you could experience is that the hunger sensation might return. So you will probably eat a little bit more than what you're used to, or maybe even more than your capacity. So you might experience some nausea or fullness sensation.
This is CBS News. A volcano in northeastern Ethiopia has erupted for the first time in 12,000 years. CBS's Michael Wallace has more.
The
The Haile-Goubi volcano sent thick plumes of smoke up to 9 miles into the sky. The ash cloud drifted as far east as Pakistan and India. One resident likened it to a bomb going off. Ethiopian officials say no one was injured, but some villages have been covered in ash, threatening the food supply for local livestock. The huge ash cloud has forced some flight cancellations and delays. India warns the cloud is so thick it may even interrupt satellite signals. Michael Wallace, CBS News.
The United Nations is warning that abrupt and dramatic international funding cuts have had devastating consequences for the global efforts against HIV and AIDS. The executive director of UNAIDS says it's the most significant setback in decades and is voicing particular concern about a collapse in HIV prevention services. Jennifer Kuiper, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Fasten the chin strap. We've got breaking news. On the Tuesday edition, Bloomberg now reporting Kevin Hassett is the front runner to be the next chair of the Federal Reserve, the president's top pick as the search nears its end. We've got a redhead on the terminal and joined ahead by the journalist behind the scoop. Bloomberg's Nancy Cook will be with us here in Washington. Straight ahead, negotiations to end the war in Ukraine move to Abu Dhabi. From the revisions made in Geneva, the U.S. is trying to sell the deal now to the Russians, and we'll get the latest from Bloomberg's Michelle Jamrisco. And as the Pentagon launches an investigation into Democratic Senator Mark Kelly, the veteran, we'll have analysis from our political panel. Bloomberg Politics contributor Jeannie Shanzano, joined today by Republican strategist Ashley Davis at S3 Group. Let's check on the markets as this headline on the Fed hits investors first. Amy Morris has the latest on Wall Street from Washington. Amy, how's it look?
It looks all green all of a sudden. Thank you, Joe. Now, as you mentioned, this is crossing the Bloomberg terminal right now. The White House National Economic Council Director Kevin Hassett, seen as the front runner to be the next Fed chair. That's according to people familiar with the matter. He's viewed as someone who could bring President Trump's approach to interest rate cutting to the Fed, which the president has long wanted to control. That is helping to move stocks a little bit higher now. S&P 500 up 0.5%, NASDAQ now up 0.1%, the Dow up more than 1%. The 10-year Treasury yield at about 4%. The 2-year yield at 3.5%. And checking out now, COMEX Gold, it is up 1.2%, hovering around 41.79. NVIDIA now facing one of the biggest competitive threats it's seen since becoming the face for artificial intelligence. It's in talks with Meta to spend billions on Google's AI chips after Google earlier agreed to supply up to 1 million chips for Anthropic. Bloomberg's Mandeep Singh.
Meta, if they plan to add 10 gigawatts over the next 5 years, they don't want to be giving NVIDIA, $300 billion just for the chips. They want to diversify and really make sure they're running their infrastructure at the lowest cost, which is what Google is doing.
Google parent Alphabet shares now about 0.5% higher. Alphabet up 35% since mid-October, adding nearly $1 trillion in value in that time. NVIDIA shares now more than 4% lower. And U.S. retail sales rose modestly in September. Wholesale inflation picked up in September from a month before, reflecting higher energy and food costs. Private payrolls fell. Money markets now pricing in about an 80% chance of a Fed rate cut in December after dovish remarks from some policymakers signaling more support for the labor market. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much, and thank you for joining us here on the Tuesday edition of Balance of Power, live on Bloomberg Radio, streaming live on YouTube. Search Bloomberg Business News Live, unless you're watching Bloomberg on YouTube TV, Bloomberg Originals, and your satellite radio, channel 121. Program today brought to you by the words waddle and gobble. Yes, as the two turkeys set up for their pardon. It's Pardon Day, as the president just said a moment ago. At the Rose Garden Club, under cloudy skies at the White House. We'll keep eyes on this for you. We don't want you to miss the turkeys. By the way, the First Lady is with the president today in the Rose Garden. It's the red headline that crossed the terminal that has our attention right now and potentially market moving, although we've been talking about the Kevins for some time. It's just the Kevin at the top of the list of, well, a very short list to be the next Fed chair. Kevin Hassett, seen as front runner in a search that is nearing its end. Scott Besson has been talking about this. We know we're just about there. And we also know a lot about Kevin Hassett, which makes this an interesting moment. Of course, he's in the White House in a prominent role as one of the president's chief economic advisors. Sat down for a fascinating conversation just days ago with David Rubenstein for Peer-to-Peer, a conversation that was recorded at the Economic Club of Washington. Remember?
For me, I think that being director of the National Economic Council is my dream job. And if the president asks me to be Fed chair, then I'll do it. But if I'm not Fed chair, don't be disappointed for me, because I love the job that I have right now.
Don't make me say yes. When he was asked by David Rubenstein, is this actually a job you want? Everyone has to make clear that they love the job they have. But yes, if asked, I'll be there to serve at the pleasure of the president. The aforementioned Nancy Cook, our Trump whisperer, reporting for Bloomberg with the big breaker at high noon here on the East Coast, is with me now. We had to compete for Nancy's time here because she's the newsmaker today. It's great to see you. This isn't a huge change from where we started, right? We added a bunch of names. We turned a bunch of corners. The president talked to a lot of people, but it was the Kevins. And this Kevin in particular, who's had the president's attention this whole time, is it not?
Yeah, President Trump has been pretty high on Kevin Hassett really since June. They had a bunch of private meetings in June that my sources told me went really well. And then, the process just, petered out a little bit. There have been so many sort of foreign policy challenges that he's been dealing with that the Fed search just took a little bit of a back seat. And so now it is cropping back up now that people are looking to Powell's term ending in 2026. And Hassett really is still the front runner. I mean, the thing is that he has a good rapport with the president. They have a long-standing relationship. You remember that he served on the president's Council of Economic Advisors in the first term. When I was going down to Palm Beach during the transition, I ran into him on a plane once. He was in and out of Mar-a-Lago a lot then. He is someone that the president calls on the phone to speak about economic policy with. And over Kevin Warsh, he has the added benefit of proximity to Trump. He is the head of the National Economic Council, and he's in the West Wing every day.
And he's been doing an almost daily audition on cable news to some extent or another, defending the president's economic policies. That's got to play a big role.
That plays a huge role. And for Trump, that is such a key thing, someone who can sort of be out there defending his policies. He spoke at the Economic Club. I saw, yesterday that he's speaking at the Wall Street Journal CEO Summit in D.C. in early December. He is really doing a lot of high-profile interviews to kind of, I think, make his case with the hope that Trump will see it. And I also think that there are some people in the Trump orbit who view Kevin Warsh as a little less predictable and a little bit too Wall Street, and they're wary of that.
Interesting. So the interviews are over, obviously. What's left in the so-called search process as we look at the baseball cards here on YouTube? That was the, I guess, not so short list when they were even looking outside of government to a Rick Reeder, for instance. What's left to be done here? Just having a sit-down conversation and coming to a decision?
There's still a few different steps. And so the interviews are done with Scott Bessent, the Treasury Secretary. But now people are going to be interviewed by the Chief of Staff, Susie Wiles, who's incredibly influential in the Trump orbit, and the Vice President, J.D. Vance. And they're going to sit down with interviews with them, and then Trump needs to sit down with people. Trump has met Kevin Warsh a bunch of times. He considered him for the Fed governor during his first term, you have to remember. He was also down at Mar-a-Lago during the transition, and he has tons of contact with Kevin Hassett, as we already said. So Trump knows these people. Do you know what I mean? It's not like he's never met them. But, he's going to, and then Trump will do the interviews.
He's been saying a lot. So there will be like an apprentice finalist interview then, right? With what you're saying with President Trump.
Sure, there will be. I think the open question now is Scott Bessent has said that he's going to sort of narrow down the list of 5 now and give, Trump, let's say 3 to interview. And so the question is, who makes that final cut for the Trump interview? And I also think Scott Bessent is very wary of what happened with Secretary Mnuchin in the first term. And doesn't want to make a recommendation. Mnuchin, as you remember, recommended Powell, and Trump really blamed him for that. Scott Bessent has learned that lesson and is not going to tip the scale for any one of these candidates.
J.D. Vance gets his own interview, huh? That's the one-on-one with J.D. That's
I don't know if they're doing it one-on-one or if he's going to do it with other White House officials. But the thing is, he is in the mix for this job.
Understood.
And I think that is interesting in and of itself.
It absolutely is. Scott Bessent correct me if I'm wrong, was his number one choice, right? It's part of the stump speech now almost. Every time hey, Scott, if you want the job, it's yours, but he says he likes the Treasury better. Is that who he preferred for this job?
I think that he wants someone at the Fed who makes things simpler and who will follow his agenda. I think he really trusts Scott Bessent and is very high on him. So I think that we shouldn't discount in the 15th hour that there's some plot twist where, Scott Bessent maybe will get named both Treasury Secretary and Fed Chair. I think that's a possibility because I think Trump, over many months has talked about that idea privately with people I talk to.
I want to mention, and thank you, James, for this 10-year note is showing a lower rate. We just gave up the 4 handle on the 10-year note. This is incredible. Dipping below 4% for the first time since late October. As soon as this happens, market starts betting on rate cuts. I guess even before it happens, fair to say?
Yeah, I think people see, if Hassett's a front runner, people see Hassett as someone who will do the rate cuts that Trump wants.
Yes, even though he's one voice among many.
Sure. I mean, he'll have to convince the rest of the board, but I also think, the board seems to, be moving more in that direction as well.
We talk a lot about central casting when it comes to President Trump making hiring decisions, and you've seen a lot of folks come and go from the first term through the campaign to now. There's a news conference that comes with being a Fed chair now. Like in the old days when we used to watch Alan Greenspan, this was not a TV job. It is now, arguably. Yeah. How much of that factors into, and the look and the body language, the way we deal with reporters into the final decision?
I think that factors in a huge amount, and I think that that's why you're seeing Kevin Hassett do these longer form interviews, because I think that that is part of the apprentice-style audition, to show that you can be on TV, not just for like a, 4-minute hit on a TV network, but, you can parry questions back and forth for 45 minutes as you would in a press conference. Kevin Hassett, it should be also said, wants this job. He wants the job.
Let's be clear.
He's campaigning for it internally. He has a demeanor in these interviews where he is, more coy, but I'm told by sources that he really wants it.
Really interesting. We're still waiting for the pardoning here, right? President Trump is talking to a rose garden full right now, and once Turkey, Waddle, and Gobble get their pardon, we'll let you know. Realizing as well, I don't know if you knew this, Nancy, this is like the worst thing that can happen to a turkey is to be pardoned, because they die within a couple of months of the pardoning. Did you see this story?
I read this article.
Because we fatten them up so much for this moment.
I thought it was interesting. The turkey pardon, I've covered the White House for a long time. The turkey pardon is always a fun thing to cover.
Thank you.
Because presidents always say sort of really wacky, off-the-cuff stuff.
They do.
So, who knows what President Trump will say at this turkey
It is
pardon.
amazing that still now, in 2025, the leader of the free world still has to appear with 2 turkeys and try to make people laugh. One day a year.
Well, it's interesting, too. Trump has thrown out so many traditions associated with Washington and the White House. The turkey pardon lives on.
Don't mess with the turkey farmers. Think about it. If there were any industry that was selling a product to just about every American household all on the same day, if these were iPhones, Tim Cook would be at the White House today, right?
Yeah, I think Trump loves a turkey pardon, though.
Sure.
It's kind of wacky, comedic, plays with his
You miss this day-to-day thing at the White House sometimes, right?
Sometimes, but, my family my family doesn't miss it.
Well, I believe all of that. Our national political correspondent for a couple of reasons. Nancy Cook, thank you for the scoop. Read more about it on the terminal and online. Kevin Hassett at the top of the list to be the next Fed chair. I'm Joe Matthew in Washington, and we'll turn our attention not just to turkeys, but to potential peace in Ukraine. Straight ahead, Michelle Jamrisco joins us on Bloomberg.
It's 12:21 on Wall Street. I'm Amy Morris. Sources tell Bloomberg News White House National Economic Council Director Kevin Hassett is now seen by advisors and allies of President Trump as the front runner to be the next Fed chair. The search for a new central bank leader is entering now its final weeks. The tech sector has trimmed back some earlier steep losses from this session as traders contend with the AI chip rivalry between NVIDIA and Alphabet. NVIDIA now facing one of the biggest competitive threats it's seen since it's become the face for AI. Google now cutting deals with Meta and others to be their AI chip supplier. Google parent Alphabet shares are less than 1% higher. NVIDIA shares more than 4% lower. We do check markets for you all day long here at Bloomberg. The S&P 500 is 0.6% higher. NASDAQ 0.25% higher. The Dow 1.1% higher. The 10-year Treasury yield at 3.99%. The 2-year yield at 3.46%. U.S. consumers were much less confident in the economy in November in the aftermath of the government shutdown and amid weak hiring and stubborn inflation. The Conference Board says its consumer confidence index dropped to 88.7 in November from an upwardly revised October reading of 95.5. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew.
All right, Amy Morris, thank you so much, and welcome to the Tuesday edition of Balance of Power here on Bloomberg Radio, on YouTube as well, streaming live on Bloomberg Originals and your satellite radio. It's good to have you with us here as we try to keep the beat on a very fast-moving story that may be leading nowhere, but it could also be leading to a breakthrough when it comes to peace in Ukraine on this Thanksgiving week. That's the vision that President Trump had, and it's taken some interesting curves so far here, with this process going from Geneva to Abu Dhabi in the better part of 48 hours, and an army secretary who now finds himself across the table from Russians negotiating a deal or trying to sell a deal that has been revised significantly over the past couple of days. White House Press Secretary Caroline Leavitt was asked about this process just yesterday. Here's what she said.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth. I have watched as the president and his team have worked around the clock overnight with both sides on endless phone calls, endless meetings to try to bring this war to a close.
All right, let's bring in Michelle Jamrisco, who has more on this, of course, reporting on geopolitics and national security at Bloomberg, and a familiar voice recently on this program. It's nice to see you.
Yeah,
I've got a whole bunch of questions about what's going to happen here, because the Europeans are wondering what this plan is. We've gone from 28 points to 19 points. Senator Marco Rubio is apparently on Team Ukraine. We don't really know exactly how to describe Steve Witkoff or Jared Kushner at this point. But the Secretary of the Army is in Abu Dhabi right now, as I mentioned, staring across the table at not even his Russian counterparts. These are experienced Russian negotiators with a pretty difficult ask here from the boss to sell this plan. What's about to happen?
Yeah, so many big groups, meeting on all sides. We've got the U.S. and Russians, as you note, in Abu Dhabi, but also, as we understand it, a Ukrainian military intelligence officer in Abu Dhabi at the same time. Clearly, Ukraine side wanting to have their say as well. Europeans meeting this morning, or at least holding a call this morning. So, Joe, all these overlapping groups and moving in such fast succession here kind of ignore the fact that this comes down to, what does President Trump think in the end? He's coming back to this. He hasn't yet weighed in today on the progress and the plans and what we will do moving forward. But we'll have to see, is he willing to meet with Zelensky, as the Ukrainians would like to see happen? And where does this peace plan go? As you know, we don't really know what the details are from 28 to 19 points.
Right.
And the White House has been saying, a couple disagreements still linger. Well, those disagreements could be the same disagreements we've been having all along around territorial sovereignty, around security guarantees, NATO succession, all of those things that are really deal breakers on both sides of this peace deal.
Some of the more contentious issues here, like the future of sovereignty, to your point, the areas that are contested, as well as eligibility for NATO, have apparently been taken out of this plan based on some of the reporting that we've seen. I don't know if you can speak to that, but Zelensky says that a peace is doable under these renewed terms, this revised plan?
Yeah, I mean, the details, obviously, we cannot speak to in any certainty.
Have we heard him say that about any proposal, though? That's got to be a good sign.
Well, there are different levels here, of course. I mean, at various stages, as we know, there have been agreements on certain things while ignoring the big things that really matter to end the war in any durable fashion. So, you know, they could be close on agreement on something, but, you know, there's certainly other issues that need to be worked out, and there's nothing to suggest that they have come together, U.S. and Ukraine, U.S. and Russia, Ukraine and Russia. Nothing suggests that they've come together on an idea for something that will result in durable and lasting peace, and that's really what this is all about.
There was talk potentially of a Zelensky visit.
That's right.
Maybe this week. Do we see him roll in on Thanksgiving?
It's a toss-up right now. I mean, that's why we're so urgently awaiting Trump's next signal, because, you know, we've heard from the White House yesterday and today, big progress, tremendous progress. You know, Caroline Leavitt, you played the clip from yesterday. She kind of walked back her expectations a little bit this morning, sounded more measured in a post on social media in saying that there were not insurmountable differences that remained and the talks were ongoing. So all that seems correct. But where we go next will depend on whether the president is willing to meet with the Ukrainians, if they then agree on something, and if that agreement means anything when every agreement that they have is the opposite of what Russia wants. So we're still not clear on what is actually being agreed. It seems like all sides agree that they're not 100% agreed, but where we might find agreement and if that agreement really matters is the big mystery.
Well, the expectation for something emerging by Thanksgiving or Christmas was watered down a bit when we spoke with Ivo Dalder, the former U.S. ambassador to NATO, on the late edition of Balance of Power yesterday. Here's what he said.
There's not going to be a deal that the Ukrainians are signing off on, let alone a deal that the Ukrainians and the Russians are going to be signing off on by Thursday or by Christmas. This conflict has been going on for over 11 years. The idea that it's going to be settled because a bunch of guys come up with 28 points, it's just not how it happens. What Secretary Rubio did finally is sit down, have a serious negotiation. This takes time, it takes effort, it takes understanding.
Is Secretary Mark Rubio the grown-up here? That's how he's being framed in most major media accounts of what's happening behind the scenes.
Well, certainly in the eyes of the Europeans. I mean, if you're talking about a traditional national security apparatus where the U.S. is dealing with its allies as a foremost, he's the one trying to save the relationship with the Europeans, whereas you can see where another faction of the Republican Party, of others in the U.S., is to say, you know, our patience is running out. You know, Ukraine needs to come to the table. And that's where Trump has been at in recent weeks in applying more pressure on Zelensky to get to a deal. He says, you're vulnerable. He's looking at this, you know, corruption scandal and domestically in Ukraine that weakens Zelensky in Trump's view. So he's trying to take advantage, as he has all year, of the weaknesses of Putin and Zelensky to say, hey, you guys got to come to the table now and let's hash something out. But neither of them is really willing to give up on those main sticking points that they've had all along in order to get to a peace deal. The one thing I would say, though, is when we talk about what might be agreed, yes, there may be a watered down agreement. I could see that kind of coming through where both sides just want a little bit of relief because the winter months are coming. Perhaps. I mean, whether or not it's durable for hours or days or longer, but I see where Ukraine especially is staring down some winter months, attacks on its energy infrastructure, but both sides are lobbying attacks, even just overnight, on energy infrastructure that is really critical at this time of year.
Some brutal attacks that continue to this moment. I have to ask you about what's going on in Venezuela, because while the president is pursuing peace in Ukraine, the drumbeat is getting louder in the Caribbean, and we could find ourselves at war with Venezuela now that Maduro has been deemed by the State Department the head of a terrorist organization, yet the president, again, in the last 24 hours, says, at least behind the scenes, he's willing to talk with Maduro. So I'm getting confused. We're burning a lot of gas in the Caribbean right now, driving aircraft carriers and destroyers around. How long can we do this?
Well, you're right to be confused, Joe. I mean, I think the one other incremental development that we saw overnight, or at least yesterday, was that the Joint Chiefs of Staff would be represented down in the region this week in meetings in Trinidad and Tobago and in Puerto Rico as well. But just another sign of some sort of mobilization. Now, whether that mobilization means anything, again, it has to go back to the president. And yesterday, you know, we had this nice self-aware comment from Caroline Leavitt where she kind of reiterated, and I won't quote her verbatim, but she reiterated that all that really matters is what Trump says. You know, she's almost said in a lighter moment, like, you know, I'm telling you what I believe and what the state of play is, but anything I or anybody in the White House says can be overruled by Trump at any moment. And we've seen that happen time and again. So even something as big and consequential as Venezuela, as well as Ukraine and Russia, we have to wait to hear from Trump himself.
You've been around the national security space at the Pentagon enough, though. When you hear that the chairman of the Joint Chiefs has gone to theater, is that thanking the troops on Thanksgiving, or are we doing something else there?
Well, it could be.
Reviewing the troops
It
for
could be
war.
either both. We do know that he will be meeting with service members, of course, expressing gratitude. And so you can see how in a week like this, that would certainly be part of the agenda. But whether it's something more and more substantive, who knows? I mean, this could be part of the sort of window dressing, or it could be something that is a sign, at least to be ready and prepared if, you know, the commander-in-chief says, let's go.
Well, it's interesting because many of our same allies and partners are concerned about what's going on in the Caribbean as they are in Ukraine. That would be Europe.
Right.
With great exposure to the region in many cases. They might want a briefing at some point. And a lot of Democratic senators would like a briefing as well. Is the administration working on some broader theme here, or are we just going to keep picking off drug boats for now?
Well, I think the broader theme, as we've seen it, as much as the Trump administration has a foreign policy mantra, it's been this peace through strength. And that's certainly what they're demonstrating with any sort of mobilization, even if those troops, even if those weaponry don't get used to the extent that the mobilization might suggest. It's still the sort of reflection of the peace through strength mantra. We're going to show you what we could do in hopes that you will back down and not, you know, incur the worst. But, you know, we'll see how that plays out in coming days. And certainly on pins and needles, it's funny that Venezuela is actually like number 2, at least in our minds, and sometimes has pushed further down, especially in weeks like last week where we were flooded with so much other geopolitical news and questions.
Stories like these can bubble up now. Lawmakers are gone, right? We've got a quiet week in the news flow, at least so it feels at the moment with regard to the holidays. President's heading to Mar-a-Lago. That's also when stuff happens, as you know.
Yes, and in terms of a potential Zelensky meeting, you could see him inviting the Ukrainian leader down
Mar-a-Lago.
to Palm Beach.
Does he have like a version of the fatigues with shorts? Is there like a warm weather?
There's a casual side to that,
wonder. Michelle, thank you.
Thank you.
Always great to spend some time with Michelle Jamrisco from our national security team here in Washington. I'm Joe Matthew, and glad you came along here on the Tuesday edition. He finished the pardoning. It's over, James? Turkey, was it waddle or gobble? Waddle, gobble. Okay, I mean, they were both there, but gobble has been pardoned. It could be a tough couple of months for that turkey. Of course, many won't make it through the week, and I guess you need to count your blessings. We'll assemble our panel. Coming up next as the Pentagon investigates someone who many see as the face of the United States military, at least one of them, Senator Kelly. We'll have more on this straight ahead here on Bloomberg.
It's 12:40 on Wall Street. I'm Amy Morris. Sources tell Bloomberg the National Economic Council Director Kevin Hassett is seen as the front runner to be the next Fed chair. Treasury Secretary Scott Bessent is leading the selection process for the next Fed chair and has said that there is a good chance President Trump could announce his selection within the next month. The tech sector has trimmed earlier steep losses from earlier this session. Traders contending with the AI chip rivalry between NVIDIA and Alphabet. NVIDIA now facing one of the biggest competitive threats it's seen since it became the face for artificial intelligence. Google cutting deals with Meta and others to be the AI chip supplier. Google parent Alphabet shares now less than 1% higher, while NVIDIA shares are about 3.5% lower. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.75%, NASDAQ up 0.5%, and look at the Dow up 1.2%. The 10-year Treasury yield at 3.99%, the 2-year yield at 3.46%. And U.S. retail sales rose modestly in September, suggesting some consumers may have hit pause after several months of robust spending. And private payrolls fell. Bloomberg's Michael McKee.
We will get the monthly numbers next week, and that may give us a better clue as to where the labor market is. But it certainly looks like the weekly ADP numbers, to the extent you can trust them, are making the case that the dumps we're making the last couple days and suggesting that the Fed might want to cut rates again.
Money markets are pricing in about an 80% chance of a Fed rate cut in December. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew.
Okay, Amy, thank you so much. Amy Morris. We'll have more on the markets coming up at the top of the hour. 1 p.m. Eastern with a 3 handle on the 10-year. It's always something to be here in the newsroom at Bloomberg when somebody comes out with a scoop that actually moves the market. To move the bond market is saying something. Nancy Cook was with us at the top of the hour. I do believe she'll be back at 1 o'clock as well to talk about her scoop on the next Fed chair. Kevin Hassett looming large at the top of the list of finalists. It was interesting hearing from Nancy. We've still got a couple rounds of interviews to go here. You need to sit down with Susie Wiles, J.D. Vance, and then the boss himself, a la the finale of The Apprentice. Pretty wild times at the Pentagon these days for any number of reasons. We just talked about a couple of them with Michelle Giamrisco. But what's happening with regard to the investigation into Mark Kelly, Senator Mark Kelly of Arizona, Democrat, of course, veteran and astronaut, former fighter pilot, astronaut. He's like an American bald eagle. Now the subject of an unprecedented investigation. Pete Hegseth, the Secretary of Defense, says that he's being probed for serious allegations of misconduct after the retired astronaut, Navy veteran, joined 5 other Democratic lawmakers in the video message that we talked about. Remember, this was got Chrissy Houlihan and a couple of other folks in there, urging members of the military, all these lawmakers, veterans, urging them to refuse to carry out what they call unlawful orders. This is a little taste of that video ad, remember?
Americans trust their military.
But that trust is at risk. This administration is pitting our uniformed military
And intelligence community professionals
against American citizens. Like us. You all swore an oath.
To protect and defend this Constitution.
Right now, the threats to our Constitution aren't just coming from abroad, but from right here at home.
Our laws are clear. You can refuse illegal orders.
You can refuse illegal orders.
You must refuse illegal orders.
You can refuse illegal orders. That was him there, second to last. Mark Kelly. And I'll tell you what, he's not sitting around for this pretty interesting appearance on, what do they call it now, MS Now, the old MSNBC. Showed up on Rachel Maddow's show, defiant in the face of this investigation. I'll let Senator Kelly speak for himself. If we have that ready, here's the senator from last night on MS Now.
I've had a missile blow up next to my airplane. I've been shot down, nearly shot down multiple times. I've flown a rocket ship into space 4 times, built by the lowest bidder. And my wife, Gabby Giffords, meeting with her constituents, shot in the head, 6 people killed around her. A horrific thing. She spent 6 months in the hospital. We know what political violence is, and we know what causes it, too.
Wow. That's quite a response. By the way, A rocket ship built by the lowest bidder? Let's assemble our political panel to get a sense of where this is going, because, of course, this is all about politics. And Jeannie Sheehan Zaino is with us, Bloomberg Politics contributor, Democratic analyst, and democracy visiting fellow at Harvard Kennedy School's Ash Center. I'm glad to say Ashley's back today, Republican strategist Ashley Davis, partner at S3 Group. Great to see you both. Ashley, what do you think of this from someone who has worked in the national security space to the extent that you have? You're kind of giving Mark Kelly a political gift here, are you not?
Well, look, I personally don't like the video. I think it was a little careless of them to make, especially because of Senator Kelly. It hasn't usually been a flamethrower in regards to national security issues. However, from a political point, this is the gift that keeps on giving to him. This is his, so-called 5 minutes of fame here, where he is raising a ton of money on the video and being kind of the poster child for the administration to go after, because he is the highest ranking. He's a captain. So because he has a captain level designation, that is why he's the one that's being picked. The other ones do not. But that being said, I think from a Republican point of view, or at least from the administration point of view, more importantly here, they are raising a ton of money on what they're doing as well, running against what this video said. So both sides right now really feel that they have the upper hand on this messaging, which is interesting. And I'm sure they both do. The extreme right's probably giving a ton of money and supporting the president. And that's why they came out yesterday about the investigation. And then you have, the progressive left that are probably he's raising a lot of money from as well. So listen, he's been thought of to run for president for, the last 2 cycles, I would say. So this is something, I'm sure Gavin Newsom's a little disappointed right now because he's getting all the attention.
Oh, boy. Well, Representative Don Bacon took to Twitter, a Republican in this case, almost said what you mentioned there, and he was retweeting the Department of War official statement on the allegations of misconduct, as they call it, from Captain Mark Kelly. Amateur hour, once again, at the Department of Defense, he writes, I thought the video by 6 Dems was unnecessary and foolish. But the threats of sedition charges and courts-martial in response are also crazy. Let's show some common sense and restraint. Surely he cannot be serious, Jeannie. What do you think?
It is crazy. You are going to go after a war hero and other war heroes and veterans in terms of their call that they should, if you're in the military, not follow illegal orders, which is precisely what they're being told already. What happened to the Republican Party that supported free speech? It is a political miss. It is part of the president's consistent plan to try to go after people who he feels threatened by. They are, to Ashley's point, raising money off of it. And, the fact is that not only doesn't it make strategic sense for the White House, they're boosting, as you talked about, Mark Kelly, but it also is a waste of time for the Pentagon. Is this what the Pentagon is this the kind of threat they're supposed to be focused on with everything going on in the world? You're just talking about Ukraine, the Middle East, China, and they're going to sit around and investigate Mark Kelly? It is the height of absurdity. It is a waste of time, and it is exactly what Slotkin intended when she apparently was the brainchild behind it. I don't agree that this was a misstep politically for Democrats. They goaded the president into this because he's easy to goad into these kind of things, and it is a disaster for him and Republicans.
As we spend time with our political panel, Jeannie Sheehan Zaino and Ashley Davis, we have a new story that just hit the terminal, and I'll mention the fact that lawmakers have gone home for Thanksgiving, and there's a conversation underway in Washington about retiring early and whether we might see more examples of Marjorie Taylor Greenes who decide, you know what, this just isn't worth it when it comes to the threats, when it comes to the partisan politics and the rest, not to mention the fact that if you're rank and file, good luck getting a bill on the floor of the House or getting it out of committee. The House, we've learned, Ashley, and we've talked about this, certainly did in the wake of the president's attempted assassination and the killing of Charlie Kirk, The House will increase the amount of money available to its members for their personal security as part of a new program that is launching next month. We're just hearing about this. Members will have access to $20,000 a month to bulk up security at their homes, in their district offices, and while traveling. And they'll be able to purchase home security measures with a separate $20,000 lifetime allotment. Ashley, is this closer to what is needed?
Yeah, absolutely. And I'm sure, I would think, and I haven't seen that to be able to look at the actual details, but obviously if you're the speaker or certain leadership positions, that number would increase. But I think that it's exactly what's needed. I mean, unfortunately, this is the way the country is right now, and it's not going to stop. I mean, you see what Congressman Golden, what the reasons he gave of why he was stepping down as well from a Democratic perspective, and then obviously Marjorie Taylor Greene from a Republican perspective. So yes, I 100% support this. We spend money on a lot of stuff, and this is something that's really important. The death threats are real.
This came from a report in Axios, Jeannie, that got its hands on an email from the House Sergeant at Arms. William McFarland kicked out this email to members with the $20,000 a month to increase security at their homes. It was interesting hearing from Kevin McCarthy on cable news talking about this the other day, and how Marjorie Taylor Greene could be the canary in the coal mine, that there could be a mass exodus based largely around security. Jeannie, does this help to turn that around?
I hope it does. It is so difficult to know if this is enough. Obviously, there's over 500 members of Congress, 538. They have an enormous number of threats against them, and so to protect that many people is incredibly difficult and expensive, because of course it only takes one person, as we have seen time and time again. So this is certainly a step in the right direction. The problem, though, is that what did Marjorie Taylor Greene talked about? She talked about the fact that there was a target on her back placed there, not by somebody on the street. It was by the President of the United States calling her a traitor. Now you listen to Senator Kelly. He has experienced this firsthand, as you just played, with his wife, who was shot in the head as a member of Congress. And he is facing threats and charges of sedition, and that he should be hung and executed by whom? The President of the United States. This rhetoric, whether it comes from the left or the right, is unacceptable. President Trump said that after Charlie Kirk's assassination, he should not engage in it, and he has been in the last few days, if not weeks. And that is equally unacceptable. So I hope Congress would also call that down, because it is leadership that we need to tamp down on this rhetoric. And the president should not be going around saying the things that he has said against members of his own party and members of the opposition.
Yeah. When you start talking about sedition in the case of Mark Kelly, Ashley, is he correct in what he said earlier? Does that in itself put him in danger?
Well, listen, I think everyone would agree that those words weren't, well, most people would agree that those words were not necessary. Even if you go back to what Senator Thune said, Leader Thune, as well as the Speaker, they didn't condone that message at all, but they did not condone the video. I do want to say that I think members are stepping down from Congress for other, of course, security is an issue, and that's something that they've been talking about. But it just hasn't been fun to be a member of Congress these days because of all the partisanship and the anger from our country in general. So yes, it's part of it, but I think there's a lot of other things that the dynamics, and I think Kevin McCarthy's right. I think there's going to be a lot more. Why would you stay?
Why would you stay? And it's why Mike Allen woke us all up this morning with the headline, Washington's worst job, at the top of the Axios note. Man, I thought this was going to be a light day. I thought we were going to talk about pardoning turkeys at the White House, but we've got some pretty heavy-duty stuff here, whether it's Mark Kelly you're talking about or what's taking place in Ukraine, in Abu Dhabi, and in Venezuela. We've got a great panel for you. Jeannie Shanzano and Ashley Davis, they're going to help us work our way through our second hour here on Balance of Power as we welcome our global television audience to the conversation. But we can confirm that the turkey's been pardoned, okay? I know it's not an easy road from here because they've just been eating too much. But now they can go rest, not on a Thanksgiving table tomorrow, but apparently somewhere where they finish their lives in peace. They did pardon the Thanksgiving turkeys. Tradition begun by Abe Lincoln, Waddle and Gobble, will not be on the menu for tomorrow. The president started his remarks by invalidating all of Joe Biden's turkey pardons, he said, because of the auto pen. We'll have more ahead right here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
He's at the top of the list. Welcome to the Tuesday edition as Bloomberg reports Kevin Hassett, the front runner to become the next chair of the Federal Reserve. As the president's top pick now with the search just about to end, we'll talk about it with the journalist behind the scoop. Bloomberg's Nancy Cook will be with us here at the desk momentarily. Is Google resetting the AI race? We're going to look at this new deal with Meta today, the prospect of cheaper chips turning out more productivity. When we talk to Dean Ball from the Foundation for American Innovation, he helped to write the regulations for the Trump administration. And we'll have analysis from our political panel. Bloomberg Politics contributor, Democratic analyst Jeannie Shanzano is with us alongside Republican strategist Ashley Davis from S3 Group. It's all after we look at Wall Street. And for that, we turn to Amy Morris here in Washington. Her update on the markets. Amy, how's it going?
It's all green again, Joe. NVIDIA and Google, as you know, are in the throes of an AI rivalry, and Meta is in talks to spend billions on Google's AI chips, showing that Google can rival NVIDIA as a leader in AI tech. Well, Google has already agreed to supply up to 1 million chips to Anthropic, making it even more of a competitor. Google parent Alphabet shares are more than 1% higher. NVIDIA shares now less than 4% lower, trimming back some of the earlier declines. That's moved stocks higher. The S&P 500 now up 0.6%, NASDAQ up 0.3%, the Dow up 1.2%, 10-year Treasury yield at 3.99%, and the 2-year yield at 3.45%. And we can tell you that White House National Economic Council Director Kevin Hassett is seen as the front-runner to be the next Fed chair. That's according to people familiar with the matter. Hassett is viewed as someone who could bring President Trump's approach to interest rate cutting to the Fed. That's something President Trump has been wanting to control for some time now. Sales at U.S. retailers and restaurants did increase modestly in September. Resilient consumers moderated their spending after they splurged over the summer. And payroll processor ADP released its weekly measure of hiring, finding that companies cut an average of 13,500 jobs a week in the 4 weeks ending November 8th. That report may be a sign that hiring has slowed since September. Money markets are pricing in about an 80% chance of a Fed rate cut in December after some dovish remarks from policymakers signaling support for the labor market. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much. Amy Morris on the markets, and she'll have more in about 20 minutes' time as we try to connect the dots every day here on Balance of Power between Washington and Wall Street. Thanks for joining us on the Tuesday edition here on Bloomberg TV and radio with big news. It hit the terminal right at high noon, the redhead, and one that may not come as a surprise to you because he's been on the short list for so long. We can tell you he's at the top of that list. Kevin Hassett, of course, one of the president's top economic advisors, going back to the first administration. Now, according to Bloomberg's Nancy Cook, at the top of the short list to become the next chair of the Federal Reserve, a job he was asked about recently when he sat down with David Rubenstein for his program Peer to Peer on Bloomberg. They spoke at the Economic Club in Washington. Listen.
For me, I think that being director of the National Economic Council is my dream job. And if the president asks me to be Fed chair, then I'll do it. But if I'm not Fed chair, don't be disappointed for me because I love the job that I have right now.
And you aren't supposed to say that, right? You have to love the job that you have, Nancy Cook. It's great to see you, national political correspondent, with the headline, Hassett emerges as frontrunner in Trump Fed chair audition. He wants this job, right?
Yeah, Hassett really wants this job. So he's being coy when he's asked about this in interviews, saying, I love my job running the NEC. And he probably does, but he does really want the job. And internally, he is viewed by Trump aides as someone who is campaigning heavily for the job. But also, I think Trump is high on him. They had a few meetings in June, which we reported on, that went quite well. And I think that he was really, has been a favorite for a while now. And, he has the added value of also having proximity. He's in the White House all the time as the National Economic Council head. And, he's around Trump all the time. He is going on TV constantly to deliver the White House's economic message. So I think that proximity really matters to Trump.
Is he also the path of least resistance to lower interest rates? Is it as simple as that?
I think that's part of it as well. Another name that we've kept hearing about is Kevin Warsh, who was a Fed governor before, who Trump considered to be the Fed chair last time during his first term. But I think that there is some, he doesn't benefit from proximity. And I think that among the MAGA world, he is viewed as more, quote unquote, Wall Street than Hassett, and potentially more unpredictable. Whereas I feel like the Trump camp thinks Hassett will follow the Trump agenda a bit more.
It's hard to underscore the daily audition, to your point, with the interviews on cable news, on Sunday morning talk shows. That's got to play a big role in the president's decision because he's frequently defending Donald Trump's economic policies.
Yeah, and he's been, he was on CNN on Sunday morning.
Yep.
He did that, the DC Economic Club. He is appearing at a Wall Street Journal CEO Summit in early December. He is really making the rounds and not just doing sort of quick TV hits, but also doing more extended interviews where he's giving his thoughts on a range of policies, inflation, the Fed, all the things that, tariffs, all the things that are a key part of Trump's economic agenda.
He has said frequently, President Trump has said frequently in speeches and in public events recently that Scott Bessent was actually his preferred candidate. He's even pointed him out, saying, Scott, I wanted you, but Bessent likes the idea, likes the job of being Treasury Secretary. Is any of that true, or is he just playing with people?
No, what he is telling people privately, according to my sources, is that, he wouldn't mind Bessent doing both jobs, Treasury Secretary and Fed Chair. And I don't think that he's totally dropped that idea. That's not something that Bessent wants. Okay. And Bessent has told Trump that, several times.
Interesting.
And so one thing that I'm looking for is there an 11th hour plot twist where Trump just gives Bessent both jobs? Or does he go with Hassett?
Well, so what do we need to get through next? There are a few remaining hurdles, as you've been reporting. It's time for the finalist interviews next.
Yeah, so Scott Bessent has finished his interviews. Yeah. And what happens next is that the Chief of Staff, Susie Wiles, and Vice President J.D. Vance are going to do some of the interviews. To the people that progress. And then then people will meet with Trump. Scott Bessent is not going to recommend someone. Secretary Mnuchin did that during the first term. He recommended Powell, and I think definitely came to regret it. And that is one of Trump's big regrets from the first term. Yeah. Scott Bessent has learned from that, and he's not going to do that. But so the next steps are, some interviews with some top aides of Vice President, and then Trump.
Jay Powell, all the while, is hanging out watching the news, has a resignation letter handy. Does what next?
Jay Powell is hanging in at the Fed, and I think just trying to keep his head down and do the job, but also try to preserve the independence of the Fed.
There'll be a final interview then with President Trump. Does he put all three or however many in front of him, like The Apprentice? They all get a one-on-one. How is that going to work? That he could sell tickets to this.
He could. So we know how he did it the first term. Yeah. And so the first term he met with people individually. And so I assume that that's going to be the case here, where he'll meet with people, and he does know these people, or he knows some of them. He knows Kevin Warsh because he interviewed him the first time. Kevin Warsh also was down in Palm Beach during the transition. He talked to him also for the Treasury Secretary job. He knows Kevin Hassett, and then some of the other people like Fed Governor Chris Waller. He would need to meet with him and see what he thinks. There's some other people in the mix.
Really interesting. We've got a 3 handle on the 10-year. I know you're not a market analyst, Nancy, but you kind of move the market with this report today. That would suggest that if it's Kevin Hassett or maybe anyone else on the short list, you're going to have lower interest rates?
I think that people think that if Kevin Hassett is there, he will push for the rate cuts that Trump wants. He is very much in line with the Trump agenda and following that.
Okay. Are the Rick Reeders and all the others from outside the admin still on the list, or are we whittling this down?
I think that Hassett is really the front runner.
Got it. Great reporting today. Nancy, thank you, as always.
Thanks so much.
The great Nancy Cook with us here in studio. Everybody's picking up this story, and you'll know that it did come from Nancy's reporting here on Bloomberg. You can find much more on the terminal and online with the headline, as we mentioned. Hassett emerges as frontrunner in Trump Fed chair audition. This could come in the next couple of weeks, as we've been hearing, creeping up around the Christmas holiday with some of these interviews finally coming to a close. This is not the story we thought we were going to be talking about today. It's emerged as our top story, and it's even a market mover on top of the other market mover that we started our day with, and that's the Google story. The sleeping giant, as I read on the terminal, now fully awake. We like the drama, when it comes to AI. And on a story like this, having released the new AI software, it's got the new chatbot out that got everybody, including Mark Benioff, worked up yesterday. Now it's this deal with Meta and TPUs. I'm guessing a lot of people are hearing about TPUs for the first time today, not to be confused with GPUs made by NVIDIA. These are the Broadcom chips, these specially designed chips that might make an interesting path forward here. But as I mentioned, we seek context. on stories like these because there seems to be a different one every day. We can hardly count the trillions of dollars any longer. And I'm really excited to say that we're going to spend some time with Dan Ball, who essentially wrote the book for Donald Trump. He'll be modest and tell you many others were involved. But he helped to write the AI action plan. And I'll bring you back to July when President Trump rolled this out. Here he is.
Whether we like it or not, we're suddenly engaged in a fast-paced competition to build and define this groundbreaking technology that will determine so much about the future of civilization itself because of the genius and creativity of Silicon Valley. And it is incredible, incredible genius. Without question, the most brilliant place anywhere on earth. America is the country that started the AI race. And as President of the United States, I'm here today to declare that America is going to win it. We're going to work hard. We're going to win it.
And it has been quite a ride since then here for this administration, for the industry. When you look at the charts on Wall Street, maybe save the last week or so for some of them, you know what I'm talking about. But the leadership role appears to be evolving here. It's not just about NVIDIA. And certainly the stock is showing that as Meta enters discussions to use Google chips in its data centers that could help to establish TPUs as an alternative to NVIDIA's GPUs. Those TPUs are designed with the help of Broadcom, which has been enjoying a nice run-up recently as well. When it comes to that AI action plan, it was written, as I mentioned, in part by Dean Ball. When President Trump sits back, closes his eyes, and thinks about what to do with AI, he thinks of this man, senior fellow at the Foundation for American Innovation. He was senior policy advisor for AI and emerging technology at the White House Office of Science and Technology Policy. Recently, among the rest of us in the civilian world. Dean, it's great to see you. Welcome back to Bloomberg.
Thanks.
I'm sure I overdid your intro, and you can tell me about that later, but I'm just curious, does a Dean Ball wake up and see headlines like this with everyone pulling their hair out, we're putting in buy and sell orders based on this story, and roll your eyes? Do you have a much longer view than this particular news flow that might be missing the point?
No, I think it's a pretty substantial story, actually. So Google's TPUs, tensor processing units, as opposed to GPUs, graphics processing units, have been around for about 10 years. Google started creating them in 2015 for its own internal purposes, right? Google was running lots and lots of AI and machine learning applications, so they sort of needed this for themselves. But they're very, very, very effective chips, and it's sort of no surprise to me that a company like Google would start to see there being value in selling those chips to other people, particularly because any well-functioning capitalist system, if there's a company making 80, 90% profit margins, as NVIDIA does, you should expect there to be competition to start to lower those margins, and that is what appears to be happening here. We'll see if it works. NVIDIA is a fiercely competitive company, but that's what's happening.
So cheaper, doesn't run as hot, is more productive, therefore. A lot of folks have been asking whether there will be a real competitor to NVIDIA. Did we finally find one?
Well, I think it could be. I think there's a lot of obstacles that Google faces. The most important one by far is not actually just performance of the chip, it's the software ecosystem. So in a way that's a little bit similar to how the iPhone, Apple's iOS has this huge developer ecosystem, and all these developers, when they make mobile apps, they usually target the iPhone first because it's kind of the premier smartphone market. And Android being a close second there. There's something similar that happens with NVIDIA chips, where all the developers of machine learning models kind of use NVIDIA's software ecosystem, which is called CUDA. And that's a huge moat that NVIDIA has, possibly more significant even than just their hardware performance. So the question will be, can Google develop a similar type of ecosystem? And it's a big challenge when you consider that Google has been used to using these chips, these TPUs, almost entirely for internal applications and some things that were offered to developers, but this is mostly for them.
Because they were leasing them or renting them at some point for
yeah, they do. They rent them on their Google Cloud product, but the idea of selling them to other...
That's all new.
That's new.
So if you're Broadcom, did you just find your new reason to live? I mean, we've seen a huge run up based on a story like this, and just over the past couple of days, NVIDIA is one of the only stocks in the tech sector that's lower today. Is this all adding up in your head?
To a certain extent, I mean, the market might be overreacting to this particular piece of news. We'll see, right? I think the idea, Meta is going to be using NVIDIA chips for a long time to come. And by the way, Google uses NVIDIA chips too.
I was going to say, Google is a client.
Yeah, Google is, I'm sure they're one of NVIDIA's largest customers.
And then I'm supposed to ask you again about circular investing, which do you see as misguided in this case?
Not really in this case, no. I mean, look, again, are there some transactions that happen in this that seem sort of a little fishy?
Yeah.
Maybe, I'm not expert in such things.
Right, sure.
I'm more of a policy
You're not
person.
an accountant.
Yeah, I'm not an accountant. I do have opinions about depreciation schedules, but I'm not an accountant.
Well, those depreciation schedules are a big deal for the investment community right now. And when you look at all these data centers popping up that are going to, pay a lot of money for cooling, they're going to try to harness enormous amounts of energy. Does a TPU or the next generation make all of this unnecessary? Are we going to have data centers on mothballs when the technology catches up?
I don't think so. I think that there's just an enormous amount of underlying demand for AI services. And so, I think the companies that are building these data centers are building them primarily because they have trouble meeting demand right now.
Yeah.
OpenAI, Anthropic, these companies are always talking about how limited they are on compute and how they could serve more models, better models, different kinds of products to customers, but they can't because they're compute constrained. So I think they're making a logical calculation. At the end of the day, when it comes to these sort of frontier data centers, you do need to maximize basically computations per square foot. That becomes very important. But at the same time, Google, on their most recent earnings call, Google talked about how they had very high utilization rates of the NVIDIA V100. V is in Victor from 7-8 years ago at this point. So that chip is still being used for different kinds of developer purposes. So it might not be that you use the frontier chip, for everything. There's a lot of other use cases. And so I think that, the sexiest use cases of AI will probably always be on the big training and stuff like that. They'll be on the latest models, but I think there'll be uses. We'll see. We'll see if that changes. But I tend to think that the depreciation schedules that we see right now are actually reasonable.
Fascinating, and good for us to hit that before you go. We've got about a minute left. Do TPUs accelerate the end game here, where you and I both have a digital twin?
I mean, at the end of the day, competition is inherently accelerationist, right?
Yeah.
So competition is great in that regard. I hope it makes both NVIDIA and Google better.
Can you sell them to China?
The TPUs? I don't think Google currently does. I think
this could be the next big argument for export controls, huh?
There could be some chips. We'll see if Google wants to.
Right.
But it's very possible. There could be some chips that fall into the sort of export control regulations.
Well, there needs to be a new AI action plan. Do you go back and rewrite that thing at some point?
I don't know about me, but but I think that something like that, a plan like that is worth updating every once in a while. Yeah.
Fascinating. Yeah. Dean, thank you. It's great to see you back. Dean Ball, Senior Fellow, Foundation for American Innovation, with us live on Bloomberg TV and radio, and it's just the voice that we wanted today as we watch shares of these companies react to the news at hand. It's been a good one today for shares of Google, and they're still hanging in, up about 1% or $4. NVIDIA down 4% or $6 a share. We'll assemble our panel next on the fastest show in politics. This is Bloomberg.
It's 1:21 on Wall Street. I'm Amy Morris. After a slow morning, stocks are extending gains. We do check markets for you all day long here at Bloomberg. The S&P 500 now up 0.7%. NASDAQ up 0.3%. The Dow up 1.2%. The 10-year Treasury yield at 3.99%, and the 2-year yield at 3.45%. Google has released new AI software and struck deals, reassuring investors it will not easily lose to ChatGPT creator OpenAI and other rivals, including NVIDIA, which fell as much as 6% earlier today with concerns about competition, erasing more than $240 million in market value. Alphabet shares now more than 1% higher, and NVIDIA shares about 4% lower. Best Buy reported better than expected results for its third quarter, boosting its year forecast. However, guidance for the fourth quarter is a bit underwhelming. Shares of Best Buy right now about 6% higher, and Dick's Sporting Goods raised its outlook again, but investors focused on the costs of trying to turn around the Foot Locker sneaker chain that it recently acquired. Dick's shares more than 4% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much. We'll have more with Amy Morris on the markets in just about 20 minutes' time as we keep tabs here on an improving Tuesday trade. These numbers are looking better. Thank you for joining us here on the fastest show in politics. With our panel on deck, we keep our eyes on the White House today. The turkeys have been pardoned. The health care plan has not yet emerged, and that has been a big point of conversation this week, with early reporting late weekend and yesterday that the White House was about to put forth a health care proposal. And when I say that, I mean one that would answer Democrats on Capitol Hill following the government shutdown by extending Obamacare subsidies, reportedly by a couple of years, and putting limits on eligibility at 700% of the federal poverty level. This is not going to be coming forth this week for any number of reasons, and the press secretary, Caroline Leavitt, was asked about it yesterday. Here's what she said.
Healthcare is a topic of discussion that's happening very frequently and robustly inside the West Wing right now. The president's very much involved in these talks, and he's very focused on unveiling a healthcare proposal that will fix the system and will bring down costs for consumers. As for the details of those discussions, I'll let the president speak for himself.
Well, the president is not speaking for himself on this front. It was the Treasury Secretary, Scott Bessent, who had said the proposal could be out this week. So at some point, that likely was the plan. Republican lawmakers were said to be blindsided by this, and there was no love on Capitol Hill from the Republican leadership. So this is going to have to wait a minute. The proposal expected again to include extended subsidies for those purchasing health insurance through the ACA. But then, of course, the president will tell you that he wants to send money directly to people so they can buy their own insurance. We play it to the panel for their thoughts on this, and God knows we've talked about it before. Democratic analyst and Bloomberg Politics contributor Jeannie Shanzano is here, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Ashley Davis, our Republican strategist partner at S3 Group, is with us as well. Jeannie, we were making comparisons to Infrastructure Week yesterday. The fact of the matter is John Thune promised to vote on the Senate floor, I believe, by the 10th of December. So the White House will need something, will have to say something about this, unless Democrats on Capitol Hill are going to write their own legislation, and I don't believe that's how it works. When will Donald Trump have to put something on the table?
Yeah, I mean, it is really perplexing that anybody in the White House thought the Monday of the short Thanksgiving week hoist on the Republicans in Congress a plan to reform or at least address healthcare costs without discussing it with them apparently first. It makes no sense. And it was never going to be an easy task. And we know that because for decades, Republicans have had trouble addressing healthcare. This goes back so long. And, you know, the president's instincts on this are not wrong. Politically, he's right. They have to address this. The subsidies are going to expire at the end of next month. There's not a lot of time to deal with it. This is hurting Republicans in the polls as they head into the midterm. But he's facing Republicans who have for years voted against Obamacare. And now apparently the White House wants them to turn on a dime and vote to extend these subsidies. That's going to take an effort by not just the White House, but the president going to Capitol Hill, talking to them, addressing their concerns. And that hasn't happened. So politically, this really was not done well. And I'm surprised anybody thought you could just hoist this on them at the last minute and it was going to pass, given the history of this issue with Republicans on the Hill.
Ashley, you've got great contacts in the Senate. What does John Thune think about this moment? Is he hoping that the president will take a leadership role here, or does he need to figure this out on his own with Democrats?
Well, listen, Republicans have known for, a year that this period of time of these subsidies were going to expire. Remember, the crux of this issue is because they were expanded at a higher level during COVID, and the Republicans are saying it's time to go back. We're not in COVID anymore. That's a very difficult thing to do because a lot of families in our country have depended on it. So it's, even though intellectually you can understand the point about overspending, the human side is really impacting these members of Congress because a lot of their constituents do rely on it. I'm going to stick up for the administration here. There's plenty of people on the Hill that knew what was going on with the administration and what they were proposing. What was proposed has been talked about for months and months and months. You just can't negotiate with 535 members of Congress. I mean, it's impossible. So you have to have a smaller working group. That being said, I don't think that the administration appreciated how many Democrat votes they will need for some sort of plan with this, with any proposal, because many of the Republicans, especially on the extreme right, have no desire to spend money. The fiscally conservatives have no desire to spend money. So we are going to have a bipartisan package. And also, just finally, the Democrats in the Senate and the House have been asking for the president to engage in this process. So if you looked at even what Senator Shaheen said and several others, they were like, listen, this isn't going to be the final package, but at least we're starting to get engagement. And it looked like what leaked looked like a serious enough package. So the other thing that's always going to be an issue is the Hyde Amendment, which, is about spending federal money on abortions. And that was, there was some language in this proposal that focused on some of the other social issues that are controversial for Republicans, but the Hyde Amendment was silent. So we'll see how that always plays out in healthcare legislation. So, the drama will continue.
Jeannie, it sounds to me like Democrats might regret, and I know a lot of them didn't like it when it happened, but might regret this agreement with John Thune for a December 10 vote. This is why so many said there needed to be a deal, not just the promise of a vote, right? What if it doesn't happen by the 10th?
Yeah, I mean, it is horrendous for the American public if they can't strike a deal. And we get back from break in Monday, and we are in December already. You have a few days before that vote, and then a few weeks before the end of the year when these subsidies expire. So this is disastrous. I mean, forget about either of the parties for the American public, particularly people who depend on these costs. And, the reality is that we've had, 13 members of the GOP come out publicly and say they support extending the subsidies. All of them are in vulnerable districts. And so that's why the approach here by the White House makes no sense. You were going to have to deal first with the GOP, then reach across the aisle. This was going to take time and concerted effort. And they did know, to Ashley's point, for a long time, which makes this more perplexing. But I think it underscores what the Democrats have been saying, is that the president has not been focused like a laser beam on affordability. And now it is coming to hit the administration and, unfortunately, the American public. And so I'm not sure that they can get a deal. But I don't think it's just a problem for Democrats. It's a problem for Republicans and members of the White House and all of the American public, most importantly.
Oh, my God. So what's the answer then? What's the short-term answer, Ashley? Do you have to have a short-term extension of subsidies, kind of like a CR, so we can buy more time to figure this out?
That's what I keep thinking. And there is some money available that, December 31st, people's benefits aren't going to go away. I mean, you can do something through the first quarter. So, just to make sure that people aren't totally scared that are listening to us that depend on that, there is some flexibility there. But yes, I think that this is a caring issue enough, number one, I hope, for all members of Congress, but also a political issue for both sides that something needs to be done. I do believe John Thune will give the Democrats their vote on December 10th, as he promised, but going back to your, I don't know, December 10th, maybe that week at some point, whether it's legislation that can actually pass or not, it's the question. And that, I agree with you, Joe. I think it was, when you asked Jeannie, like, should they have gotten a deal that said we have to have legislation in place, but that would have been impossible during the shutdown, I think.
Well, if this doesn't get done, Ashley, do we shut down at the end of January? This is the question I keep asking.
Well, I always feel like shutting down was people calling bluff, especially for as long as we just did. No, I think we'll get something done, and I think it will go through September 30th. Or it may actually, it's going to have to go through September 30th just because it's a fiscal bill. So that means we're in September 30th dealing with the shutdown again right before the election, right before people are supposed to go home and start campaigning. So that's going to be a disaster too.
That's why there was a 2-year extension on this thing that leaked, Jeannie. You'd get it past the midterms. Donald Trump seemed to think that was a good idea. And, to Ashley's point, there were a lot of details on this. It looked like it was a plan that was being prepared for release. Jeannie, what would Democrats do with the plan that we described yesterday, including the limitations on eligibility? Would they have to vote for it?
I think they would want to talk about it. I think they would want to negotiate it. I think it was a step in the right direction. I am not a fan of these sunsetting attempts, and I bemoaned it when the Democrats did it in 21. I bemoan it now. If you believe that healthcare is a right for Americans, you should fund it. And so I think you may find people who feel that way, but of course you need to compromise when you're in the minority or even in the majority. So, but again, the president's instincts are right here, but the president has changed this party. He is now worried about a base who are being hurt by if these extensions expire, but you've got traditional Republicans who feel very differently, even members of the Tea Party more concerned about the fiscal cost. And that's where the rub is for Republicans. This is a issue that divides Republicans, and that's why the president's going to have to go in and make some deals with the majority in Congress to push this through.
Well, it's going to have to happen pretty quickly, and I thank you both for your insights on this. Jeannie Shanzano and Ashley Davis, a great panel. Thank you both. And can I say, Ashley, if I don't see you, happy Thanksgiving. I think we might have one more show left. Jeannie, I'm Joe Matthew in Washington. Thank you for joining us here on Balance of Power with a headline that just crossed the terminal. Bolsonaro ordered by court to start serving his sentence in jail. Indeed, the former Brazilian president, having told a judge on Sunday he violated his ankle monitoring the day before at his house because he had a nervous breakdown and was suffering hallucinations caused by a change in his medication. After tampering with the ankle bracelet, he has now been ordered by the court to start serving his sentence in jail. We'll turn back to potential peace in Ukraine.
It's 1:40 on Wall Street. I'm Amy Morris. Sources tell Bloomberg the National Economic Council Director, Kevin Hassett, is now seen as the front runner to be the next Fed chair. Treasury Secretary Scott Bessent is leading that selection process for the next Fed chair and has said that there's a good chance President Trump could announce his selection within the next month. The tech sector trimming back those earlier steep losses as traders contend with the AI chip rivalry between NVIDIA and Alphabet. NVIDIA now facing one of the biggest competitive threats it's seen since it became the face for AI. Google is cutting deals with Meta and others to be their AI chip supplier. Google parent Alphabet shares more than 1.5% higher. NVIDIA shares now 3.5% lower. We do check markets for you all day long here at Bloomberg. The S&P 500 is up 0.7%. NASDAQ up 0.4%. The Dow up 1.2%. The 10-year Treasury yield at 4% and the 2-year yield at 3.46%. A U.S. consumer confidence survey slid in November on growing anxiety about the labor market and the economy. A gauge of expectations for the next 6 months declined to the lowest level since April, while a measure of present conditions slumped to a more than 1-year low. And money markets are pricing in about an 80% chance of a Fed rate cut in December after some dovish remarks from policymakers signaling more support for the labor market. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew.
All right, Amy Morris, thank you as ever. Amy will have more on the Tuesday trade coming up at the top of the hour, 2 p.m. Eastern, as Bloomberg Business Week Daily gets underway here on Bloomberg TV and radio. We thank you for joining us. I'm Joe Matthew in Washington with our eyes on Abu Dhabi today. First, it was Geneva over the weekend. Now peace negotiations surrounding Russia's war in Ukraine have settled in the UAE, and an important task at hand for the Secretary of the Army, Dan Driscoll, who is across the table from Russian counterparts in trying to negotiate a peace breakthrough. The delegations are at it right now. The Secretary finding himself in a room with Russian officials that he may never have imagined when he took this role as the civilian leader of the United States Army. Ukraine's military intelligence chief also in Abu Dhabi for meetings. President Trump citing progress on the peace proposal that has gone from 28 points, we understand, to 19. That peace proposal, with elements initially rejected by Ukraine, starting to shrink in scope. And we understand, according to reports, that President Zelensky is standing by to visit Washington if and when there is the opportunity for a breakthrough. This idea of peace in Ukraine was discussed yesterday at the White House with Press Secretary Caroline Leavitt when she took questions from reporters. Here she is.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth. I have watched as the president and his team have worked around the clock overnight with both sides on endless phone calls, endless meetings to try to bring this war to a close.
Remembering it was just a couple of weeks ago that Zelensky was back in the White House. The president was on the phone with Vladimir Putin and turned away from this idea of providing Tomahawk missiles to Ukraine to try to hasten the end of the war. This multi-point plan has since taken over the narrative and may well provide the breakthrough that the president is hoping for. It's where we start our conversation with Kelly Grieco, senior fellow with the Reimagining U.S. Grand Strategy Program at the Stimson Center. Kelly, it's great to see you. Welcome back to Bloomberg TV and radio. All the while, we should remind our listeners and viewers that Russia continues to bombard Ukraine and continues to kill civilians by targeting residential areas. Kelly, before we ask you about negotiations, what is the status of this war on the ground that we had been describing for months and months as a war of attrition? What is Ukraine's posture right now?
Yes. So, it is a war of attrition, but it's not static. What we're seeing is that Russia is making slow, costly gains, particularly in the Donetsk region, and it looks like the town of Pokrovsk is likely to fall in the coming days or weeks, which is an important logistics hub for Ukraine. I think the important thing really is to emphasize that this is costly, but there is some movement on the battlefield, and the question becomes whether the Russians are really willing to pay those costs to try to take all the land by force. And if they do that, it would probably be until about 2027 before they could take the rest of Donetsk.
Wow. All the while, Ukraine is attacking Russia not by going after civilian neighborhoods, but energy infrastructure, particularly on the Black Sea. To what extent can Ukraine inflict damage without receiving more long-range missiles when it comes to energy infrastructure specifically?
Yes, so it's clear that the Ukrainian strikes on energy infrastructure have had some impact, but not probably enough to really impair Russia's ability to conduct its war, to finance its war. It certainly has made it more painful, and it's forcing some more acute choices on the Russians ultimately about how they're going to finance their war. The defense budget for this coming year is actually a bit smaller than it was the previous year. It's still enormously large, and well above large in terms of post-Soviet Russian defense budget. But you can see that there's some real choices that Russia would have to make if it's going to continue to fight this war for a few more years, including raising taxes. And of course, that becomes domestically much harder for Putin.
Well, so let's start looking inside this peace proposal, at least to the extent that we understand it. And Kelly, we should be honest, this is a fluid document, as the Secretary of State has made clear. But we're talking about a potential security guarantee by the U.S. and some of our European allies. And it would come at the expense, at least in terms of the early drafts, of a good chunk of Ukraine's standing army. It may not be able to defend itself without the security guarantee. So what does that need to look like for Volodymyr Zelensky for it to be acceptable?
Well, I would just step back for a moment and say that I think the notion that Ukraine cannot defend itself without a security guarantee, or at least if we're talking like a NATO-style security guarantee, is clearly not true, given what they've been able to accomplish on the battlefield so far. I think what we're seeing in the negotiations is it seems like an increasing recognition, which is clearly painful for Ukraine, but that the best security guarantee is going to have to be a robust self-defense. And trying to extract things from Europe and the United States to support that. The language in the initial proposal talked about some kind of response. It was very vague by the transatlantic community if Russia were to attack again, but it really doesn't commit the United States or Europe to anything specific. And it's clear that there's opposition to NATO membership for Ukraine, that's not going to happen politically, and that really Ukraine needs to move towards figuring out how it can get the kind of support it needs, more indirect form of support, to make its own robust defense to prevent another war.
Well, so it sounds like we need to see many more revisions. Maybe they're taking place right now, but selling this was already a lift for Russia, for the Army Secretary trying to sell this to Russia. If you start making some of the changes that you're suggesting, this could be dead on arrival then, right?
Yes, I mean, I think this is what's really interesting about this negotiation is that the administration's walking a fine line here, and that the more it compromises with Ukraine about some of these specifics, and of course, it's hard to know because we haven't heard a lot about what the 19 points the new version says, and the language really matters here a lot. Are these very substantive changes, or are these changes more to the language so it's a bit more domestically palpable to Ukraine? But if it's going to be really substantive changes, and particularly around the NATO issue, then it's going to be a non-starter for Russia. That's very clear. This is a red line for them.
Well, you're sounding a lot like Ivo Dalder, who we spoke with on the late edition of Balance of Power yesterday, the former U.S. ambassador to NATO, also hosing down this idea that we could see a breakthrough between now and the holidays. Some thought Zelensky could show up even this Thanksgiving week, either here in Washington or at Mar-a-Lago. Here's what the ambassador said.
There's not going to be a deal that the Ukrainians are signing off on, let alone a deal that the Ukrainians and the Russians are going to be signing off on by Thursday or by Christmas. This conflict has been going on for over 11 years. The idea that it's going to be settled because a bunch of guys come up with 28 points, it's just not how it happens. What Secretary Rubio did finally is sit down, have a serious negotiation. This takes time, it takes effort, it takes understanding.
That would imply, Kelly Grieco, that this war is going to carry into winter, and that brings a whole new strategy for both sides. What does Ukraine need to do to prepare?
Yes, obviously trying to get this done by Thursday is overly ambitious, and even Christmas is overly ambitious. just given the realities. I would just say that the winter is grim for Ukraine. On the battlefield itself, the winter and the weather very much favors Russia because they're using these infiltration tactics, very small numbers of forces, 2 to 3 at a time, that essentially slip through what's a porous Ukrainian line. So the cover of the fall of winter sky and rain and snow makes it harder for Ukrainian drones to detect those movements. So Ukraine is in a difficult position in terms of for this winter, in terms of preventing these kinds of infiltrations. And I think we'll have to make some challenging choices about how long to defend some key locations, including places like Pokrovsk, versus deciding that it's not worth losing more manpower and that they're better off moving back to a more secure defensive line. That's unfortunately the kinds of hard choices Ukraine will be facing.
If you're Russia right now, is it men or materiel that you're more worried about lasting through winter?
It's certainly not manpower. They have sufficient manpower, I would say, for about the next 9 months. I don't even think it's materiel if you're Russia, in terms of, you said Russia, correct?
Yes.
In terms of, the winter. If anything, I think their thinking is a little bit more long-term in terms of what they're going to do a year or 2 years from now if they have to ultimately take this by force and they're not able to do it at a negotiating table. In about 9 months, Putin, for example, would be facing a mobilization question again. Right now, they're paying high salaries to encourage people, from parts of Russia to come and join the military for these high salaries. But that's only can get you so far, and they would ultimately face a choice about whether they're going to mobilize more broadly to get the kind of manpower they need. And so I think they're thinking in a different timeline about a year from now, whereas Ukraine is really thinking about even how it gets through the next couple months.
Kelly, I mentioned Tomahawk cruise missiles, which apparently are not going to be arriving anytime soon in Ukraine. That was something that Zelensky had been asking for. He said it would turn the tide in the war by essentially putting fear into the hearts of Russians. They would know what it's like to be bombed the way Ukraine has been bombed for the better part of 3 years from a distance. But we saw initial reactions like this to any number of weapon systems that Ukraine requested, the M1 Abrams tank, the F-16 included, going back to ATACMS missiles. I'm just curious to what extent all of these no's that turned to maybes that became yeses were actually good ideas in the end.
Well, I think, if we've learned anything from this war, I hope it's that people realize that the idea of wonder weapons doesn't really exist. A single weapon system cannot decisively change the course of the battlefield. These things have mattered, for a period of time, a window when they've gotten a new system, a period of maybe 4 to 6 weeks when they have an advantage because the Russians are figuring out how to adapt. But after that, it returns to this sort of static, this attrition, a level of attrition, because both sides are clearly learning militaries. And that's what we would see with Tomahawks. And I'll just add that I think the Tomahawks are even less significant, providing even a 4 to 6 week window, because one, the Ukrainians have their own long-range strike capabilities, long-range drones at this point that are doing some of this. And then the numbers that we would be talking about are so small that it really would not have a large impact.
Are they using the F-16s effectively that they got their hands on? Remember, that was going to turn the tide of the war at one point.
Yes, what I would say is what we see is that to the extent they're using them effectively, it's sort of the way I predicted on this show, in that we wouldn't be seeing them using, over the battlefield to try to support forces and counteroffensives. They're using them much more in a defensive role, in an interception role of shooting down, incoming missiles and drones to try to keep the airspace contested, to try to protect their cities. So it's a far more limited role, which is not surprising given the reality of what Russian air defenses look like.
Well, she has a way of predicting things on this very program. Kelly, great to see you. Kelly Grieco, have a great Thanksgiving, and thanks for the insights today. Senior fellow with the Reimagining U.S. Grand Strategy Program at the Stimson Center, with us live here on Bloomberg. Headline on the terminal, Senator Mark Kelly's office receiving outreach from the FBI now via the Senate Sergeant at Arms, knowing that the Pentagon has launched an investigation into what it calls misconduct by the retired Navy captain. This is a story that we'll be following on the late edition of Balance of Power as well, with Senator Kelly pushing back on this idea of an investigation at the Pentagon. I'm Joe Matthew in Washington. We'll be joined by Ty Cobb for more on that story on the late edition of Balance of Power, and we'll hand things back to New York for Bloomberg Business Week Daily. Wall Street's holding positive. The S&P 500 moving higher by 50 points. The Nasdaq is up 100, about 0.5%. The Dow's ahead by more than 500 points as the Tuesday trade moves into the late stages. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenevec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, live across Bloomberg platforms. Yes, indeed, this is Bloomberg Business Week Daily on a day where Well, we are seeing both bonds and stocks rally. Kind of interesting. This is not what's supposed to happen in a normal trading session, but nonetheless, on this Tuesday, November 25th, that's what's going on. Maybe it's because, as Bloomberg News exclusively reported, that it looks like we know who is the front runner to take over for Fed Chair Jay Powell when his term is up.
Yeah, Bloomberg exclusively reporting that White House National Economic Council Director Kevin Hassett is seen as the frontrunner to be the next Fed chair. And when Bloomberg reported that story, right at noon, we did see yields on the 2-year and the 10-year fall. And also, Carol, we saw the S&P 500 start to climb, and then the Russell 2000 take off and running as well.
Yeah, right now the 2-year note with the yield of 345, 345. 10-year note just below 4%, folks, 3.99. So we're going to keep a track on that. The reason why is Kevin Hassett, right, seen as someone who would really bring the president's approach to interest rate cutting to the Fed, which President Trump has long wanted to control, according to those people in the know in that exclusive Bloomberg report. So it is moving markets.
It's moving markets. What else is moving markets? Google, which is now, quote, fully awake in the global AI race. Also, the question, what does it mean for NVIDIA?
Yeah, a lot of questions there. Plus, Ukraine, Russia, U.S., China. We talk national security and cybersecurity. Folks, it's all connected.
Also, Raquel Oden joins us, HSBC U.S. Head of Wealth, Premier, and Private Banking on the Giving Shift.
All right, all of that to come, folks, over the next 60 minutes. First up, let's get a check on that rally in both stocks and bonds on this Tuesday. Here's Amy Morris.
All right, thank you, Carol. Just want to let you know, just crossing the Bloomberg terminal, President Trump is considering removing Kash Patel as FBI director in coming months. That's according to MS Now. Reportedly, Trump and his top aides have grown increasingly frustrated by the unflattering headlines that Patel has recently generated. Again, this is just now crossing the Bloomberg terminal that MS Now is reporting President Trump considering removing Patel as FBI director. Now, NVIDIA and Google are in the throes of an AI rivalry. You guys were just referring to that. Meta in talks to spend billions on Google's AI chips, showing that Google can rival NVIDIA as a leader in AI technology. Google has already agreed to supply up to 1 million chips to Anthropic. Google parent Alphabet now shares are more than 1% higher. NVIDIA shares more than 3% lower. And sales at retailers and restaurants increased modestly in September. Resilient consumers moderated their spending after they splurged over the summer. Payroll processor ADP released its weekly measure of hiring. It found that companies cut an average of 13,500 jobs a week in the 4 weeks that ended November 8th. That report may be a sign that hiring is slowing since September. Money markets pricing in about an 80% chance of a Fed rate cut in December after dovish remarks from some policymakers signaling support for the labor market. And of course, we check markets for you all day long at Bloomberg. Green across the screen, the S&P 500 up 0.75%, NASDAQ up 0.4%, the Dow up 1.2%, the 10-year Treasury yield at 3.99%, and the 2-year yield at 3.45%. Sources tell Bloomberg National Economic Council Director Kevin Hassett is seen as the front runner to be the next Fed chair. Treasury Secretary Scott Bessent is leading the selection process for the next chair and has said that there's a good chance the president will announce his selection in the next month. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Masser and Tim Stenovec.
All right, always appreciated. Amy Morris there in for Charlie Pellet. Well, a rally in Alphabet shares really poised to shake up the ranking of the world's most valuable companies amid signs that the search giant is making headway in efforts to rival NVIDIA's best-selling AI accelerator. It is prompting investors to reassess the tech landscape and the potential changes in stock market leadership as rave reviews for Alphabet's new Gemini artificial intelligence model and demand for AI chips, Tim, pushes its shares higher. I have been talking about this stock over
it's
the
like
last
a gainer
week
for
and a half.
you every day.
It is, and hitting new records.
Well, look at this. Just going back to October 10th, so a little over the last month, shares of Alphabet are up 36%, up around 16% since mid-November, hitting another record, up more than 70% year to date. So it's outperforming all the other Mag 7 names. For more on what's going on over at Alphabet and Google and the mad dash to spend, that is today's AI race. Bloomberg News U.S. semiconductor reporter Ian King, he joins us from the Bloomberg News Bureau in San Francisco. Okay, so I just want to start with the basic question about what Alphabet has, Ian, that has these companies excited to work with it from a hardware perspective, from a processing perspective, from a chips perspective. What is it?
Well, you have to go back to the fundamentals, and this started about a decade ago. At Alphabet, they were one of the earliest to realize, hey, maybe having our own purpose-built chips will actually help us to be more effective. Maybe what Intel, because Intel was dominant at the time, is giving us isn't good enough. So they started with TPUs, really specialist chips to help accelerate search, turned into a successful program after multiple versions of it. And here we are 10 years later, where they have chips to the point where they are usable and other companies actually want to use them in a way that would help with their AI efforts.
So are they a real threat into NVIDIA?
Well, there are a number of ways to slice and dice this. On the one hand, if you believe what companies including NVIDIA, AMD, and all of the hyperscalers are saying, absolutely not, because guess what? Spending is going to the moon. This is the greatest bonanza ever, and there's room for everybody. If that's the case, then this isn't a threat. If you believe at some point the music is going to stop and that innovation is going to slow, then it becomes a scramble. If history is a guide, it becomes a scramble over market share, and therefore any chip that is potentially an alternative to what NVIDIA is offering is a threat.
Well,
you have to decide.
Ian, it looks like the market decided today, at least. I mean, shares of NVIDIA down as much as 7% earlier in the session, so investors see this as a threat, fair to say?
Some investors have become aware of that. I mean, this is an esoteric subject, right? If you look at I mean, we can only talk about what the companies say and what the basics are. On a basic level, there's nothing to see here. There's no problem. All of the foundational numbers, whether it's CapEx, whether it's revenue, whether it's orders, they're all there. Nothing to see. You're talking about investor sentiment and investor sentiment changing, this could definitely be something. And as we know, investors like to try and anticipate changes in fundamentals that happen. And this report, which again is unconfirmed, talks about 2027, which is a way off yet.
You know what? I want to go back though. Ian, is this about whether or not the AI spend and the eventual market size, the ultimate, how big it is? And who gets a piece of that pie? Or is it about Google actually being a rival when it comes to the expertise in chips needed for the AI build, like a real competitor to AI and its top AI chips?
Again, you know, competitor, partner, you know, there's somewhere in between is probably the right answer, and that's a horrible answer. But, you know, look at the numbers, look at the money. You know, which company is the greatest recipient of Google's CapEx, right? Google, the new chip champion, as we've discovered today. Who did they give their most money to in terms of CapEx?
NVIDIA.
NVIDIA, right. Why would they be doing that if they have everything they need and everything they want? The answer is they don't, right? The answer is it's more complicated. The answer is AI isn't one specific workload. If it was just one specific set of work, then doing what Google does would be the only answer, right? A specific chip for a fixed purpose that's never going anywhere. The answer is it's more complicated than that. Things are changing quickly. You need to back as many horses as you possibly can.
You mentioned a report. The report that we're talking about is the information reporting that Meta Platforms was in discussions to use Google TPUs in its data centers in 2027. Tensor Processing Unit, TPU. Explain exactly what that is.
Okay, a tensor processing unit started life about 10 years ago. It is what's called an accelerator, right? The answer is, instead of using what Intel provides, which is a CPU, central processing unit, which is a generalist chip, does lots of different things. You say, this is a fixed workload that this CPU isn't very good at. Maybe if we made a specific purpose chip that just speeds that particular workload up, and back in those days it was search, then maybe we get a better result from our system as a whole. The use of NVIDIA's GPUs, these graphics processor units, is kind of the same idea, and there's lots of different ways to try and get to the same end goal, and that's what Google did early, and then they've sort of morphed that chip to be good at these kind of AI workloads, which is making sense of this massive amount of data and focusing in on creating results and generating pictures or whatever it is that you want to particularly make out of AI. And that's been, you know, they were early to see that and they were early to react to that, so they're enjoying the benefits.
All right, so everybody's a little crazy. Last question here, Ian. It just does feel like, as you said, you know, all of a sudden it's like, wow, look at what Google can do. And it's like the only thing it feels like people can talk about in the market today. I don't know, what is your takeaway? And we often ask this in your expertise of following the chip industry for a long time and understanding development cycles, players who are number one and then they're not number one anymore. So I don't know, is there something to kind of pull away from this?
I think so. I mean, you have to look, you know, if you want to use history as a guide, then why did Intel lose its edge? Why did some of the GPU companies that were bigger than NVIDIA lose their edge? And it's the pace of innovation that wins. You make the best chip, you tend to win. You deliver it on time, you deliver it in volume, you tend to win. When you stop doing that, when you don't, you know, run into the future with massive amounts of money and massive amounts of risk, that's when you tend to lose. What's kind of different in this case is that the key buyers of this technology are also trying to run that race. So that makes it, in a way, more exciting and more intense. And that's where NVIDIA is right now. And are they slowing down? Absolutely not. Will they continue to win forever? I guess we'll find out.
All right. Good stuff as always. Hey, Ian, thank you so much. Bloomberg News U.S. semiconductor reporter Ian King. Shares of Alphabet, they're up about 1 1/3% today, up about 70% year to date. NVIDIA shares are down almost 4% in today's session. Tim, they are up about 30% year to date. Mag 7 pull back a little bit. They're up about 20% year to date.
Okay, well, let's talk about the big tech trade and where we go from here with our next guest, who sees markets remaining unsettled with core leaders coming under pressure. We've got Stuart Kaiser with us, head of equity trading strategy over at Citi. He joins us here in the Bloomberg Business Week studio. We're going to talk tech, but just about 2 hours and 11 minutes ago, our Bloomberg News team broke a story about Kevin Hassett of the National Economic Council, White House Economic Council, becoming the key emerging person who could become the next Fed chair. We saw markets react. We saw yields on 2s and 10s move lower. We saw stocks go higher. What was your reaction to the possibility of a Fed chair Hassett?
Look, I think Hassett's been on sort of the short list with Kevin Warsh and maybe Rick Rieder and you know, Waller maybe for a period of time now. So, you know, not too surprising that, you know, someone out of that core group is sort of being called the favorite. I'd probably tap the brakes on exactly knowing what the outcome here is because, you know, President Trump has tended to bounce around back and forth between the various candidates. But I think Warsh, Hassett, Rieder are all considered, you know, very credible economists. You know, very, very deeply understand macro markets.
Is Hassett credible?
Yeah, I think Hassett is, from an economics perspective, on the credible side of things, without a doubt. And if that's the case, then, you know, it's not too big an issue, you know, depending on who they settle from that group.
But would Kevin Hassett be a good and independent Fed chair? He is certainly seen as somebody who would bring President Trump's approach to interest rates and cutting specifically to the Fed, which President Trump has long wanted to control, at least according to those folks who we've been talking to in all of our reporting. And so maybe that is why he is coming out as the front runner. So I guess the question is would Kevin Hassett be independent? Would he lower or raise rates based on the Fed's mandate and not on the president's preference?
I mean, you have to assume so. I mean, remember, Trump appointed Powell, and now he doesn't consider Powell to be dovish enough. So, you know, I would say, you know, Supreme Court justices, Fed chairs, I mean, these people are generally pretty reputable people that respect the value and the independence of the organization, and you would hope he's going to make decisions based on the incoming data. Clearly, a president is going to pick a chair that is consistent with their view. So, you know, it wouldn't surprise you that maybe Trump would settle on someone that skews a touch more dovish. But the fact is that whoever the chair is walking into what's basically a split FOMC right now. That FOMC is also filled with 12 other people who are very reputable economists who are not simply going to be kind of pushed around, and I think who are going to respect the data, respect the dual mandate as well. So it's not as if you're appointing someone that goes in and just, you know, makes the decision, right? So again, I think all the three or four of the core candidates, I think, are pretty well respected economists. They're entering an institution which you would assume they would, you know, respect and support. You know, every chair is going to have a little bit of a hawkish or a dovish tilt, or maybe a little more focus on inflation versus a little more focus on the growth mandate, and that's fine. I don't think that's particularly offsides or inconsistent with history. So yeah, I mean, I think any of those core would be fine.
Let's talk markets.
Yeah, let's talk markets. I mean, we just talked about with our Ian King about what's going on in terms of Alphabet versus NVIDIA, who wins, who not. I mean, Alphabet's been on a tear this year, Stu. I mean, it's up about 70%. year to date. You do see the markets remaining unsettled with core leaders under pressure. How do you define unsettled when it comes to markets? What are you looking at? And what does this mean maybe over the next 6 months, 12 months?
Yeah, I think unsettled is kind of what we've seen really for the last month or so, which is four kind of key things have changed in our view that have made the markets a little squishier. The first is that retail has pulled back considerably. And whether you believe or don't believe that retail is driving the market, certainly institutional investors are aware of that shift in supply demand. So again, that's created a little bit of uncertainty. AI, the reaction function of AI has clearly shifted, whether that is Meta or Palantir or Oracle or NVIDIA, and you can't ignore that. The third thing is retail. Retail earnings were soft, and the commentary from managements was very, very cautious. We just got a pretty weak retail sales number as well. So regardless of all the rest of it, people are saying, wait a second, this U.S. consumer has been the white knight of the economy and, global economy probably for multiple years, and now seems a little bit under pressure. And then last would be the Fed, some uncertainty there. So not all of those uncertainties.
It's a lot.
Yeah, and like in and of themselves, each one of these might not be, an issue, but you put them all together and they've created some uncertainty. You're also in a tricky time of the calendar. You have portfolio managers who've had a really tough year.
Yeah.
If you're up year to date, you're not going to play hero ball between now and the end of the year as well. So I think you've made people a little more cautious for a lot of reasons. So I think right now it's hard to have a really, really strong tactical view. If we had to pick one, we're going to pick higher into year end. We do think ultimately you get a rate cut and the seasonality pushes you there, but the risk reward around that is not nearly what it was a couple months ago.
What changes your view between now and the year end, where you'd say, actually, we're not thinking higher till year end now?
Yeah, the data, probably December 16th would probably be the single most important date in the calendar, which is going to be, dual payrolls reports. Our view is the unemployment rate is, if you had to pick one thing, is the single most important thing for the market. So that's going to be a very important day. Before we get there, Black Friday, Cyber Monday will be important, but the single biggest day is December 16th.
And to remind everybody, that comes 6 days after we hear from Fed Chair Jay Powell, and the entire Federal Reserve, the FOMC, is going at this without the typical data that it has ahead of a Fed decision.
Yeah, 100%. I mean, and you're also getting the inflation print on the 18th. So you can imagine a situation where the Fed cuts 25 basis points, tells you they're data dependent in 2026, and then boom, you get hit with really weak labor markets the next week, and vice versa. So I'm not saying either or is going to happen, but our view at this point is the logic behind the rate decision is as important as whether they cut or not, right? If they don't cut and it's because the labor market looks solid and the beige book comes in very positive, that's good. If they do cut and the market's like, wait, you all look like you might be behind the curve a little bit because the next week we get weak labor markets, less good. So really, we are data dependent, probably a meeting before we expect it to be. But if you're asking what could change my view into year end and become more bearish, should be we get some weak holiday spending data, and then that labor market report is unfriendly to the markets.
Yeah, that would certainly do it. And because you'd be looking at both sides of the mandate right there for the Fed. Hey, Stu, thank you so much. Really appreciate it. Stu Kaiser, head of equity trading strategy over at Citi. All right, from markets and the U.S. economy to geopolitics, where we are when it comes to peace between Russia and Ukraine, and when it comes to the frenemy relationship between the two largest economies. Yes, we are talking U.S. and China. All of that when Bloomberg Business Week Daily continues on this Tuesday. This is Bloomberg.
It's 2:21 on Wall Street. I'm Amy Morris. Stocks pushed higher as traders contended with signs of competition heating up in the artificial intelligence arena. We check markets for you all day long at Bloomberg. The S&P 500 up 0.6%. NASDAQ up 0.2%. The Dow up 1.2%. The 10-year Treasury yield at 3.99, almost 4%, and the 2-year yield at 3.45%. Google releasing a new IA software and striking deals, reassuring investors it will not easily lose to ChatGPT creator OpenAI and other rivals, including NVIDIA. NVIDIA earlier fell as much as 6%, with concerns about that competition, erasing more than $240 million in market value. Alphabet shares now more than 1% higher, and NVIDIA shares now more than 4% lower. Best Buy reported better than expected results for its third quarter, boosting its year forecast. Guidance for the fourth quarter is underwhelming, but Best Buy shares right now about 5% higher, and Dick's Sporting Goods raised its outlook again, but investors are still focused on the costs of trying to turn around the Foot Locker sneaker chain that it acquired. Dick's Sporting Goods shares nearly 2.5% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Carol Masser and Tim Stenevin.
All right, got it. Amy, thank you so much. Amy Morris there. And for Charlie Pellet. Well, the White House signaled optimism around efforts to negotiate a peace deal, between Ukraine and Russia, while warning that additional negotiations to address remaining sticking points would be necessary, despite reports earlier suggesting, Tim, a deal was afoot.
With an update on this and more, back with us is Jennifer Welch, geoeconomics analyst at Bloomberg Economics. She joins us from the Bloomberg Washington, D.C. Bureau. Jenny, Bloomberg Economics out with a new report. It notes that the U.S.-Ukraine policy whiplash is benefiting Moscow. What do we know?
So it's been quite the roller coaster over the last few days. What emerged last week was a plan that seemed to be negotiated between the U.S. and Russia, largely favorable to Moscow in terms of, for example, capping Ukraine's military, ensuring that it would never be a part of NATO, in return for pretty ambiguous security guarantees. Since then, there's been a scramble by Ukraine and its European partners to engage Washington and try and alter those terms. It now looks like at least 9 of the points from that original 28-point peace plan have been adjusted or removed, including some of the ones that Ukraine felt crossed its red lines. And where things stand is finalizing those terms and then pitching them back to Moscow. But our assessment is that Russia is unlikely to receive in a positive way those altered terms based on how things have gone earlier this year in prior rounds of negotiations.
Wait, so you know what I keep thinking? Who's calling the shots of a possible truce? Is it U.S.? Is it Europe? Is it Ukraine? Or is it President Putin of Russia? Or maybe a little bit of all of them?
Or who even in Washington is involved in this? It seemed last week when this plan first emerged that some members of the President Trump's own administration weren't even entirely sure where this peace plan came from and whether it had been fully coordinated and agreed to by the U.S. side. But then it quickly moved from that to the U.S. setting an ultimatum on Ukraine to agree to it, and now we're renegotiating the terms of it. So it's been a lot of twists and turns here, but this isn't an entirely new story. This is something we've seen earlier this year. If you think back to August when President Trump met with President Putin and then immediately rushed into a summit with Ukraine and European allies, this feels very much like a familiar pattern and one I think is likely to produce the same outcome, which is no peace plan.
Well, okay, so on that, European allies, sort of another group here that we need to focus on. What do they want?
I think European allies are primarily concerned about, first, making sure that this deal isn't so heavily weighted in Moscow's favor that, for example, it doesn't end up preserving peace for the long haul. That, for example, it leaves Ukraine in a weakened position that could allow Moscow to just reconstitute its forces and re-attack. That not only has implications for Ukraine's security, but ultimately for Europe's. So that's going to be a major area of concern. Second major area of concern is one of the elements of that original peace plan was around the frozen Russian assets and how they would be leveraged, and in particular, how they might be leveraged to essentially pay the U.S. back for security commitments to Ukraine. That's something that Europeans have a stake in as well, and they would want to have a say in how those frozen assets are used, particularly as they're debating internally whether or not to use them to support Ukraine in the short to near term.
Hey, Jenny, I want to move on to U.S. and China, but one last question. Is there still a feeling here in the United States and obviously elsewhere in Europe, I think Europe it's a safe yes, but here in the U.S., that if this is a much more favorable agreement to President Putin, that he may in another few years, create another war and go after another land grab? I just wonder how much of that fear is still out there.
I think that's certainly a concern among foreign policy analysts, especially having watched Putin play this playbook before. We saw with Crimea back in 2014. He played out the peace process. He drew out negotiations and pretended to be genuinely interested in peace. And then he essentially snagged and pocketed the results of that peace process, reconstituted his forces, and launched a full-scale assault on Ukraine just years later. And I think certainly leaders in Europe and Ukraine, but also in the United States, many are concerned about the possibility of that happening again.
So in terms of just thinking about possible endings for this, as we do get close to the 4th year of this conflict, what would an end look like that Russia would be okay with and Ukraine and Europe would be okay with?
It's hard to see at this point a potential compromise position because Moscow seems to be betting on more battlefield gains and essentially seeing that time is on its side. It really doesn't have an incentive to negotiate for peace because it thinks it can just continue to win territory. The West's support for Ukraine will continue to dip. Ukraine will continue to have some of the internal issues we're seeing, like with corruption scandals and losing political domestic unity. And it will just have to bide its time and continue to push for the offensive. I think what could change Moscow's calculus is stricter Western sanctions that bring some of its economic troubles more to the forefront. That might press it into a position where it realizes it's not a war that it can continue to afford.
And just to clarify, we're in the 4th year. It'll be 4 full years of this war in February.
Yeah, I mean, it's just even hard to believe that that's where we are. Hey, I want to just quickly, one question to you on U.S.-China. President Trump, we know, held back-to-back calls with the leaders of China and Japan. We've seen escalating tensions over Taiwan threatening to derail his weeks-old trade truce with Beijing. It always feels so fragile. That relationship, U.S. and China, always complicated. Will a U.S.-China truce last?
I think my prediction is for the short to near term. Again, with President Trump, you kind of always have to have an asterisk because you don't really know exactly what he's going to do. But my prediction is at the moment, yes, I think it will last. I think the Trump administration is very focused on maintaining it. I think the calls that we saw yesterday were more about an effort to manage this China-Japan feud and avoid drawing the United States into it and avoid it upsetting that existing truce. I think the questions that we have for the longer durability of that plan are things that are, for example, outside the scope of that truce. Actions by Congress that Beijing could see as violating the spirit, if not the letter of the truce. Actions that the U.S. might take as sort of its normal export control policy updates that might violate it. So there are definitely a lot of potential speed bumps in the future for this truce. But at the moment, Washington seems very focused on maintaining it and keeping it in place.
All right, gonna leave it there. Hey, Jen, thank you so much. Jenny Welch, she's Chief Geoeconomics Analyst at Bloomberg Economics. All right, geopolitics, relationships among allies and friends, between enemies. I mean, this makes me think about cybersecurity and national security issues.
Well, a recent Bloomberg opinion piece by the editors wrote, America's enemies are growing bolder and more sophisticated in cyberspace. Carol, to fend them off, the government must stop unilaterally disarming.
All right, so we want to get into the state of readiness when it comes to cyber threats. Keep in mind that we've had 2 recent reports underscoring some of the danger that's out there. Mid-October, Seattle-based cybersecurity firm F5 acknowledged a catastrophic breach of its systems, which may have allowed Chinese hackers to penetrate networks used by federal agencies and Fortune 500 companies. There's, of course, other stuff that has happened as well. Back with us is Jennifer Eubank. She's founder of Adamant Strategic Advisors. She advises companies and clients on cyber resilience, digital transformation, geopolitical risk. She is a former CIA deputy for digital innovation. She joins us from Virginia. Jennifer, good to have you back with us. When it comes to the most urgent national security and tech issues, and I want to go with China right now, is it threats from China? Is it threats from Russia? I mean, like, what is it in terms of the United States?
Great to be back with you, Carol and Tim. Thank you. If we're talking about cyberspace, it's really about the People's Republic of China. Of course, Russia remains a very active actor in cyberspace. We can see that in Ukraine. We can see that regionally and occasionally here in the U.S. But in terms of sophistication, scale, and ambition, it's really all about China right now.
How sophisticated has China gotten?
Oh, incredibly so. You may have seen a report came out recently from Anthropic where they documented the first essentially AI-powered cyber campaign from inception to exfiltrating data that was almost exclusively conducted by AI agents. The agents would simply come back occasionally and ask the operator, is this what you want? Or would you like this instead? Or do you like that? And 80-90% was automated. And that came out of China and state-sponsored actors.
I don't love this, Carol.
Okay.
No, I wouldn't.
It's not like the people who are doing the infiltrating have to be only so smart, right? And you only have to outsmart them. Now we have to outsmart the machines.
God, that's terrifying.
Yeah, don't love this.
Yeah, how do we keep ahead of... Wait, go ahead.
Oh, no, I'm just going to say, it really does signal a major shift, right? We all knew this was coming, at least those of us in cyber realm knew that this was coming. When you see the confluence of AI and cyber, you knew we'd be facing this. And so really we have to be in a position where machines could start fighting and defending against machines. There's a certain risk in that as well, because machines are not humans. They don't exercise our judgment. All sorts of things can maybe go awry. But as a start, we're just going to have to be bringing more AI into our cyber defenses if we are going to actually harden our perimeters and protect our data.
Yeah, go ahead.
No, please.
Well, I was just thinking about President Trump signing that executive order yesterday. Genesis mission, it's a federal effort to boost innovation using AI. And so it's all about promoting AI technology and its adoption. As more AI is incorporated into the U.S. government, all governments, I mean, does that just increase the cyber risks, or does AI also help us fight these risks?
It's both. It's like any new technology. It's both shield and sword. It's both. And yesterday's announcement is actually pretty exciting in a way, because it represents a moment where the administration is trying to, let's say, bet big on AI's ability to help us discover new breakthroughs in all sorts of various scientific fields, not specifically about cybersecurity, but about quantum and biotech and space and lots of other things. And so one of the issues, and I'll tie that back to cybersecurity, one of the things that people are going to be watching with that effort is how do we protect the data? Because this is going to be a tremendously attractive target for adversaries. If you're talking about bringing together our national labs, the supercomputing capabilities, sensitive federal data sets on science, and then America's leading technology companies, that's going to be right in the crosshairs of our adversaries' targeting.
So then what is the right way, just very briefly, to protect this data?
Oh, well, I think, they're going to have to be locking down in every possible way they can. And kind of the chapter and verse on that will have to be worked out, because this is all still in formation at the moment. And I think people are going to be watching to see how the Department of Energy implements this intention, this order, if you will. So a lot to be determined right now.
I'm just going to unplug everything and throw out my phone. How does that work? Does that enough, or that's not enough?
Okay, one pro tip, put multi-factor authentication on any account that will allow it, and that will stop virtually all nefarious activity on.
And you need your phone for that, Carol. Sorry to tell you.
I do.
Don't throw it away.
Jennifer Eubank, always good to catch up, founder of Adamant Strategic Advisors, former CIA Deputy for Digital Innovation. Hey, when we come back, the giving shift, how affluent women are defining wealth and philanthropy close to home. That one, Bloomberg Business Week Daily continues.
It's 2:40 on Wall Street. I'm Amy Morris. U.S. regulators move to relax capital requirements that lenders said limit their ability to act as intermediaries in the Treasuries market during times of stress. These revisions would reduce holding companies' capital requirement under the enhanced supplementary leverage ratio to a range that's substantially equivalent to the plan from June. Sources tell Bloomberg the National Economic Council Director Kevin Hassett is seen as the frontrunner to be the next Fed chair. Treasury Secretary Scott Bessent is leading the selection process for the next Fed chair and says there's a good chance President Trump will announce his choice within the next month. The tech sector trimmed earlier steep losses from earlier this session. Traders contending with the AI chip rivalry between NVIDIA and Alphabet, and we check markets for you all day long here at Bloomberg. S&P 500 up 0.5%. NASDAQ little changed on the upside. The Dow is up 1.2%. The 10-year Treasury yield 3.9999%, right at 4%. And the 2-year Treasury yield at 3.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Masser and Tim Stenovec.
All right, Amy, thank you so much. Well, alternative asset managers have been snapping up insurers in recent years, gaining access to a stable source of long-term capital to fuel their investments. Apollo, we know, pioneered the model with its insurance arm, Athene, investing in financial products, Tim, created by its asset management division.
Recently, though, the close ties between private equity and insurers have drawn scrutiny as the latter had traditionally put their money in the most liquid parts of the market, such as high-grade bonds and stocks. The recent blow-ups of auto parts firm First Brands Group and subprime auto lender Tricolor Holdings have exacerbated fears about credit losses across the financial industry.
Yeah, this is a worry, and it really fits into, I feel like, the broader conversation we've been having about private markets, private credit. It's a lot going on. So we just wanted to throw that out because that's a story that is certainly on the Bloomberg today. And we want to talk about it a little bit with our next guest. Let's get to our weekly segment, Women, Money, and Power. We explore all the economic implications of how women are poised to control more money than ever before as the biggest beneficiaries of the great wealth transfer. So with more on all of that, we welcome Raquel Odin. She is head of international wealth and private banking at HSBC, joining us in studio. And we wanted to do that because part of, wealth, and when we talk to wealth managers, private bankers, is that we know investors, clients, consumers of yours, they're interested in certainly the private markets, and it's a big part sometimes of their portfolios, or they want it to be a part of their portfolios. Yeah. And we're going to talk about your report on the giving shift in just a moment. The credit concerns or private credit markets, private market worries, what are you hearing from your clients about that? What is the discussion you guys are all having with your team?
Yeah, so I think, as you said, this is one, it starts with diversification, right? So it's not the primary part of the portfolio, but there's clearly a need and there's an interest for a sleeve of your portfolio to be part of this.
How much is usually in a client's portfolio that you work with? And I know everybody does it a little bit different.
I was going to say, it depends.
But what's the range typically?
I think on this, you're talking like 10%, 5% of the portfolio. These are things you're going to look at. And by the way, this is if it makes sense for the client, if they have interest in it. I think as you think about the private equity markets, you think about AI, you think about, will the Fed make cuts? These are all the interesting questions we get from our clients today, specifically of how do I respond to that and make sure that I'm still focused on my long-term goals with all of these different aspects happening, as well as the regulation with all of this too. What is this going to look like and how do we manage these private equity markets? That's something that is certainly also being looked at.
But in that 10% slice, it's not 10% private credit, there's some venture capital in there. There's some private equity in there. I mean, some people may ask for exposure to crypto in that alternative. So I don't know, is that kind of how you see it? Like a very small portion of it, the typical portfolio would be private credit?
Private credit, but at the same time, exposure to crypto is something you have to decide if that's specific to you. I can't say that's something that big banks are getting behind. But again, it comes down to the individual, what they're looking for, and how do you balance the risks and all this that we're talking about, and also making sure this isn't becoming your primary way of attaining retirement is key to that.
Yeah, because it's just been interesting. We are trying and talking to smart voices like yourself and just trying to get an idea of what people are hearing, thinking, saying, because We know that Jamie Dimon made the comment about more cockroaches out there. We've been looking at, there have been some trouble, certainly in some of the subprime auto lending area. Yes. And we had the Apollo CEO, Mark Rowan, speaking as part of a presentation on the firm's retirement services business. Yeah. And he rejected the idea that private assets introduce risk to retirement and insurance portfolios. He said, quote, people have really just lost their minds and the headlines get more and more hysterical and have almost nothing to do with the substance. Having said that, one last question, and then we want to get to your report.
Again, the big key thing you said there is your risk tolerance, right? So it is a basic factor of how much risk are you willing to take on. And I think to your point of what you're hearing there is, whether it's crypto, and you've heard from other industry leaders, like I said, this should not be your retirement plan, right? Yeah. This is where you have the ability to take risk, but it's not needed for your livelihood or everyday living.
Well, so your client base, like I'm assuming, these are folks with high net wealth. Mm-hmm. And I'm just wondering, are they clamoring to do more and more in private markets? Do they want to see this open up more? Or are they pretty comfortable? Or they're like, you know what? We see the concerns. We're a little concerned too.
All of the above.
Okay.
Right?
Check.
Check. No, genuinely all of the above. But still, there should be some level of openness to the exposure to it. And I think that's the part you are seeing from this client base.
Now, I always think about this, and you and Tim and I talk about it. Men and women are different. And I always think about risk tolerance. But talk to us, you've got a report out, The Giving Shift, Global Living, Local Giving, how affluent women are defining wealth and philanthropy close to home. Yeah. Talk to us a little bit about this report. And I am always curious how it differs, maybe perhaps from what men might do.
Yeah, so I think it's between men, women, and the generations, which I think was great about the report. Yeah. And so we surveyed over 1,000 affluent clients, and really from the standpoint of what matters to them most. And I think there's 3 key factors that came out of this. The first one being 60% of affluent women said giving financially is extremely important or very important to them. So if you think about that as a factor in itself, so you just talked about the transfer of wealth going to women.
Right.
They're saying it's a top priority for them to give financial wealth, which I think is a very different factor between men and women. That's the first one.
What does that mean?
So what they're basically saying is, as I create my wealth, I want to make sure that I can give financially to giving, charity, philanthropy is 60% of a priority to me. So it's a very high number. So it wasn't like I want more accumulation of wealth. I want to make sure that I have the ability to give financially or give away my wealth in some shape, form, or fashion. And so what you've seen from the big billionaires that are out there, historically it has been they want to give a big check with a big name and put their name on a building or, into the theater. What's different here is what you're seeing in women and their giving. It really is they want to give close to home. They want to give to local charities or local things that they can see immediate impact, less about having their name on a building.
How much about the giving is giving while living versus promising assets or promising money in a will?
Question. It's both, right? So giving while living. So as they're accumulating their wealth, they're focused on how can I give while I'm living, but more importantly, how do I make sure my wealth lives on? So their passing on is just as important to them critically. Now, giving while living tells you at different stages of where they are, whether you're a Gen Z versus obviously baby boomer, there's a big difference in where your psyche is and what you're focused on. What's important about that, though, is we also have to figure out the confidence of women on their investing and their wealth.
Right.
Knowing that if it's a priority for them to give philanthropically, they want to make sure they're able to accumulate wealth. What we did see in the report that was very dramatically different is when you take a look at women and investing in their confidence, because we do know that's a huge factor in a lot of this. When it came to Gen Zs, 61% confidence. If you look at baby boomers, they're closer to 40%. There's a very dramatic difference between the generations of their confidence in wealth. And then we did it based on race, and we saw a dramatic difference there as well. African-American women came in at 69%, feeling confident that they would be able to attain their wealth. Hispanic women were 60%, white women were 47%.
Interesting.
Very interesting. So the attaining of wealth or the confidence that they can attain their wealth looked very different for African-American and Hispanic women. But generationally, Gen Zs have the most confidence in the standpoint that they feel good about their wealth and what they can do in markets.
I love that people continue to do research and find out more and more and understanding, especially because there's more wealth coming into the hands of women. Raquel Odin, she is head of international wealth and private banking at HSBC. Thank you so much. Thank you for also talking about the news of the day.
Some headlines crossing the Bloomberg terminal. U.S. presidential envoy Steve Witkoff advised Russia on how to pitch Ukraine plan to Trump. Check out the full write-up by Bloomberg News on the Bloomberg terminal. Once again, Witkoff advised Russia on how to pitch Ukraine plan to President Trump.